Through this year and maybe then into next. We are also watching the banking sector. The banking sector really in focus after we heard from one of the senior executives at JP Morgan. That sent the share price of JP Morgan down 4% in session yesterday, and it was all about concerns around the costs there. We'll also watch the mining sector. We've got silver prices looking resilient, but other metals prices looking a little softer. What does that do to London, Guy?
Okay, well, let's find out. Let's get to the market open. It's Fed Day in the USA. What does it mean for European markets? Well, at the moment, not very much. We are waits to hear what JPal has to say a little bit later on. It's going to be a holding action today. The FTSE 100, therefore, is fairly flat. The Stock 600 is fairly flat, but we're waiting for other markets to open before we get a clean read of what is happening there. I'm interested to see what the CAC 40 does today. Does politics influence that market this morning? What's happening over in Germany is going to be quite interesting as well today. Remember, we've still got other rate decisions still to come this year. The Bank of England, the SMI, BOJ is going to be one to watch out for as well. Other central banks started to sound more hawkish, and that's a message you're certainly hearing this morning from the ECB. Shimkus is out, Vilroy is out, sounding, I would argue, just a little bit more hawkish at the margin. The ECB's done, therefore you could assume that the next move is a rate hike. Does that come next year, and what impact will that have on stocks? Anyway, so that's the picture as I tap dance towards the CAC Open, which is not really playing ball this morning, down by 0.2%. The IBEX is down by 0.2% here. Feels like we're in a holding action and waiting for the Fed a little bit later.
As we wait, it would be great to see Guy Johnson tap dance, though. So if you'd like to see that, IB plus BBTV Go is the function to use on the Bloomberg terminal. European equity markets then, Guy, opening not quite as sluggishly as maybe we'd feared. Futures were suggesting something a little worse for the European equity markets. But we actually have, well, we're negative, so let's not lie about that. We're negative, but maybe not by as much as expected. In terms of the sectors, though, we are 3/4 of sectors in the red and only a few to the upside. Energy is the best performing sector. We're actually pretty flat on the oil price right now, but we see Siemens Energy, Vestas. This is a bit of a theme, isn't it? This is the wind story, perhaps, living another day. We were talking about that a lot in yesterday's session. Basic resources, yes, the silver price has outweighed concerns about other metal prices, and Fresnillo is the best performer in that sector, and we see that the mining sector as a whole is pretty resilient this morning.
So what I find interesting today is that the banks are up, not down. So JP Morgan got hit yesterday. Other banks in Europe are not doing a similar thing. So HSBC, third biggest weight to the upside when it comes to the Stock 600 this morning. Right behind it, UBS is trading higher. You've got some of the other European banks as well picking up the pace a little bit on the upside. So that story of higher costs at JP Morgan, in some ways you can argue would be negative for the rest of the sector. If JP Morgan's got a cost problem, what do you think the rest of the industry's got? That doesn't seem to be reflected in some of the European names. Miners are, though, having a better day. So you've got Rio up, you've got Glencore tracking a little bit higher as well, which is interesting.
Yes, it's always a good day to mention fast cars, so let's talk about Ferrari. And this is one of the biggest weights to the downside. Race IM in the auto sector under some pressure today, cut to neutral at Odo. So there's a broker action, analyst activity to think about. And this follows Monday, where we saw it downgraded at Morgan Stanley. The plan to limit volumes clearly going down negatively there. So we'll keep an eye on that one.
They had an okay Abu Dhabi Grand Prix, though. Anyway, let's park that one for the moment. Helen Jewell, International CIO of Fundamental Equities at BlackRock, joining us around the table. How important is today's Fed decision to what happens next in 2026 for global equities?
Yeah, great to be here, Guy. I mean, of course, it's always important, and there is an expectation of a cut. But I think what we all expect is that the narrative around the cut is actually going to be the more important thing. The expectation is going to be more of a hawkish cut. And we had, of course, originally priced in quite a few cuts kind of through to the end of the year and into next year. Now, If that starts to stabilise a little bit, then of course from an equities perspective, this incredible rise in equities we've seen this year might see a little bit of a pause. But as long as the narrative is not too much of a hawkish narrative, as long as there is a feeling of, okay, we have this in control, we're just managing it sensibly, I don't think it's going to be anything too much to worry about.
I was talking to Scholar about this a few minutes ago. She's talking about overheating. There's the risk of overheating that the Fed might actually have to hike in 2026. But if it comes, which one do I deal with first? Do I deal with the fact that actually growth could be better? Or do I deal with the fact that the Fed might have to hike as a result of it? Which one of those two narratives is more important?
I think the narrative of growth being stable and in good shape is the most important one for the markets at the moment. I think there's an expectation that there won't be anything which is overheating. If there is an overheating, that would not be good for markets. But a relative feeling of stability is the most important thing. And that, I think, is what we're also seeing in Europe this morning. You mentioned earlier on, Guy, about the European banks. I think the reason the European banks are up, actually, is that there is a narrative coming out that there is stability. Stability drives loan growth. Loan growth is what is driving those banks' prices this morning. So the narrative of stability is the single most important.
Are rate hikes good for European banks? Just sorry to jump in.
Not. I mean, rate hikes are always okay for banks, but they're not what is driving banks' prices at the moment. Okay. The thing that is driving banks' earnings, we're in a kind of sweet spot for rates. When you're in the level we're at now, a quarter bit, it's neither here nor there. The thing that really drives is the loan growth, and that is what's important. So it wouldn't be bad, of course, but I think actually from an overall perspective, where we're sailing at the moment is the sweet spot for banks.
Okay, Helen, good morning. Let's think about 2026 then, and Europe, and what to get excited about in Europe. I mean, banks is an obvious area of focus. It's done well. The sector has done well. I think it's best performing, isn't it, year to date here in Europe. But you point out that quality stocks in Europe had their worst year ever.
Yeah.
Remind us what that includes and why this has been such an area of underperformance in 2025, and whether that changes next year.
Yeah, no, it's a great point, Anna. So the quality stocks are those stocks, high returns companies, very resilient earnings, so high cash conversion. And the reason they've had a bad year in Europe this year is probably two reasons. The first reason is, on the whole in Europe, they are the exporting companies. And the exporting companies have been hit because the dollar has been weakened, and they've also been hit because you've got tariffs and tariff uncertainty. I mean, what a year it has been. It's incredible when we think about all the things that we've been through. So those two things combined have made it very difficult for those quality growth names in Europe. The second reason as well we should also put in there is that the valuations have on the whole been, over a period of time, just got higher and higher and higher. They always trade at a premium multiple to the market, but maybe that premium multiple had got a little bit stretched, and therefore they've come down a notch. So the two things of the type of companies they are, exporter companies, and the premium we were paying, means they've had a little bit of a reset in 2025.
Okay.
But I think it's time for them in 26. Maybe we've got stability in the dollar again. Maybe what we've seen is that worse in terms of the tariff news being over. The valuations look more interesting. So maybe it's time for those names to go again.
So that makes me think about China and the prospects there and the prospects to export to China. I mean, we've had the US administration calling on China to diversify their economy, to improve consumption in their economy so they're not so export driven. We've heard the IMF just this morning making that same point, saying, China needs to do something to stimulate the domestic demand story. Does any of that stick, do you think, Helen? Is that something that those European quality names can count on?
Yeah, no, I think there is understanding kind of where the export sensitivities really are. But then also this point of there's two factors, how much you are able to export and the demand for exports in that particular region. So when it comes to China, I think what we probably underestimated is the level of demand that there were for some of the goods within Europe. So even if there are some kind of controls on the level of exports, if the demand for those exports, because the China consumer is very solid, remains high, then actually those two things can in some ways net off against each other. So I'm not saying we're not concerned about that. I think already you've again seen it this morning. I saw on that list of stocks that are up and down, a lot of those are being influenced because they are exporting companies. And understanding where the exports are going and what is driving those exports is, I think, obviously I've been sat here as I've been seeing it come up, is probably what is driving those moves under the hood.
You've mentioned stability a few times.
A few.
How convinced are you that 2026 is a year of stability? It feels like the exact opposite to me. There's so many imponderables. I don't know what the Fed's going to do. I don't know whether the rate hike cycle is going to be coming through. I don't know if we're going to get a peace deal in Europe. I don't know what defence stocks are going to do off the back. The list goes on and on and on. There seem to be so many imponderables in 2026. Stability?
So for me, when I talk about stability, the single most important thing is the stability of the consumer and how the consumer is behaving.
Right.
And actually those things and those variables, again, if you think about the everyday consumer in the US, we're seeing some weakness on the lower side, but a Fed cut with some feeling of, okay, actually there is some kind of growth coming through in the market, not overheating, but a market and a jobs market by that. Yeah. That is actually really good for a consumer perspective. So when I see stability, I'm talking about stability in the consumer in Europe. Again, you don't go out there and feel like this is a country or a continent that is nervous in terms of consumption levels. And at the end of the day, Guy, that is what really drives the returns that we're seeing in the market. Now, do I think it's going to be a straight line? Absolutely not. But let's not forget this year. It was January, we had that enormous pullback DeepSeek day. Then we had Liberation Day. Then we had big degrossings in August. And yet we're still sitting here at the end or mid-December with so many major indices up double digits. So is it stability? Yes, but at the same time, it might be a bit volatile.
Double digits next year?
I don't think so. I think it's almost... is it odd to say? Don't really want that. This is the third
is that overheating? Would that be overheating?
That's unstable. Yeah.
And that's the point at which the multiple starts to go in excess of the earnings. And actually, we don't want that. It's been such a good year that those pockets of really interesting value that I talked about at the start of the year, things like European banks, European defence, they're still there, but they're not nearly as compelling. So actually, do you know what? Dare I say it? It might be nice to go for a 6, 7, 8% year next year.
Sounds a little sleepier, but maybe we take that. That's fine. But fundamentals, the big point then is that fundamentals return in a big way. If we get this stability, which is a big if, then there's room for fundamentals to sort of reassert themselves.
It really will be back about the fundamentals. And the AI story, now it's amazing in some ways that we've got this far without talking about that. It's all about where that goes as well. And I know we've talked about this a lot, and this obviously happened yesterday as well. That is where the energy names are starting to respond. And by the energy, we mean the breadth of energy, the clean energy, the traditional energy, the energy efficiency names, the networks as well, a number of which, and the utility companies, which also have had a very, very good year. So that second leg, and that's expanding, and that diversification from that core group of AI names is also key.
Yeah, and so where is the AI focus in Europe next year then? If that's what we're looking at, is it still around energy?
It really is. I'd love to say we have hyperscalers. I'd love to say we have some, other names in that part of the AI story, but really it is about the energy. But where energy comes from, where energy is efficient, and how energy gets from A to B. That's what it's going to be about.
Helen, great to see you. Enjoy the holidays. Thank you very much indeed.
Great to be here. Have a great Christmas and New Year, guys.
We will see you in 2026. Helen Jewell, Fundamental Equities International CIO, joining us from BlackRock. Call 6 looks like there's some of the names that Helen's just been mentioning. Maybe a focus on this board this morning. Some of the defence stocks which have had such a good year, maybe just a little bit of a move off from what we saw yesterday. Some of the luxury names are a little softer as well, but there's that tech trade. ASML front and centre alongside Schneider, which provides all the kits and everything else that goes into the AI centres, doing well. Let's focus where else we are watching this morning. I see insurance companies are catching close eye.
Yeah, absolutely. Good morning, Guy. Aegon is down massively this morning. We're down 7% after it announced quite a lot of changes, actually. So it's moving its head office and legal seat over to the US as an attempt to kind of refocus on that market. It will also rebrand itself as Transamerica, and it also announced a strategic review of its UK unit. So there's a lot to digest, and it seems that investors are maybe not too happy about this, and therefore we are down quite significantly for that insurance company this morning. Moving on to Delivery Hero, which is up this morning after saying it was considering the next strategic steps. So investors have been pushing for a divestment, a sale of maybe parts or the entirety of the company to really boost efficiency, boost profitability. And it seems that Delivery Hero is listening to them. No decisions have been made yet, but investors are quite happy that that company is thinking about those strategic steps. Moving on to Siemens Energy, which is up this morning as well. There's a couple of things happening there. First of all, we have got an activist investor pushing for a potential spin-off of the wind unit. And there's also really positive read across from GE Vernova over in the US, which doubled its dividend, boosted its forecast. And so that spells actually really good news for the electrification sector. And that is translating over to Siemens Energy this morning, with shares up 3.7%. And finally, Ferrari is down almost 2% after being downgraded by Odo this morning. This follows a downgrade by Morgan Stanley earlier this week. It seems that the focus on maybe refocus on restraining volume to boost exclusivity is not being taken that well by investors and analysts, and therefore we are down for that company this morning.
Ferrari then on the back foot, not in the fast lane. Chloe, thank you very much. Chloe Melly from our equities team with those movers. Coming up on the programme, JP Morgan shares fell after the US bank posted higher than expected, or flagged that it is experiencing higher than expected costs for next year. We'll have more on that story next. This is Bloomberg.
To Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Wednesday morning, Fed day. We've got a few hours. We should have a countdown clock. We should have a countdown clock to the Fed, because that's basically what we're waiting for today. European equities, look at that. Absolutely no movement. We are basically waiting to see what the Fed does a little bit later on. Below the surface, there's a few single stocks that are moving around that are really interesting. Aegon, I think that story is amazing. Maybe we'll come back to that a little bit later. But the UNCH tells you everything you need to know on that screen. In terms of the sectors, energy's outperforming. Media's not doing too badly. Basic resources on the mining story is up. Technology and banks. And banks takes me to our next story. which is that JP Morgan shares are under a little bit of pressure. This after the bank posted higher than expected costs for next year, or talks about higher than expected costs for next year. Tom Metcalf, who leads Bloomberg's EMEA finance coverage, joining us around the table to talk about this. This really caught my eye this morning, the fact that JP Morgan is out talking about the fact that its costs are going to be higher. And I just thought, if JP Morgan's costs are higher, that's bad news for everybody else. But just talk to us about the details of why and where the costs are coming from.
Yeah, so this is all coming off an event yesterday where Marianne Lake, who basically runs JP Morgan's retail bank, said we're expecting our expenses to go to about 105 billion. So it's about 9% higher than they were saying for 2025. So that's a big jump. And, you know, there's two elements here. One, this is bad news for JP Morgan, just generally. No one likes to see expenses rise. But it's probably worse news for its rivals. So if you see JP Morgan down 5%, you wonder how this might second order affect the Bank of America's, the cities. Because, you know, what Marianne Lake was saying is this is basically largely in her unit, so retail, community banking, and also that this is basically driven by volumes. So, you know, while there will be higher costs, you'd also expect a sort of revenue improvement.
Yes, that's what my mind went to when I saw this. I thought, well, that's only half the story, isn't it? That's, you know, the costs go higher, but it's driven by an expansion in the business. So what's the revenue number? We only got half of it yesterday. But this has happened before, hasn't it, Tom? This cost guidance and then the business responding to it, well, weighing on the shares, then the business having to respond to it. What's the playbook?
Yeah, exactly. Very similar to 2022 when it was almost the same. Expenses kind of spooked the market. And look, shareholders are extremely sensitive to the bottom line. That's something the company can control. So, you know, even if there's the positive revenue side of the story, it's understandable they react more to the kind of expense side. But yeah, what JP Morgan actually had to do in 2022 was, you know, they realised perhaps the message hadn't quite landed the way they wanted. They held an investor day, reassured the markets, and obviously been on a pretty much tear ever since.
There is an argument that says, to Anna's point, this is the wrong reaction. Knocking the stock lower is the wrong reaction, because actually they're saying it's a revenue. We're spending more money because we're making more money, and you wonder therefore. And Mike Mayo, I think, was making this point that actually a move lower in the share price might be greeted quite quickly with people coming in and saying, actually, this could be quite good news.
Yeah, absolutely. Yeah, Mike Mayo saying, hey, look at the other banks, basically, because, you know, that's the bigger worry. Because, you know, JP Morgan, market leader, this presumably will help deepen its position. So it'll be interesting to see, you know, and I think Mike Mayo was saying this, let's see how the other banks react to this. Are they going to send any messaging out as well?
Yeah, and what else did Lake have to say? I mean, I think she's on the consumer side of things, but did she have other clues as to how the business is performing more broadly?
Yeah, she kind of broadly spoke to 2026. So, you know, being Bloomberg, we're fascinated by the high finance side. So two things she said, sort of investment banking fees, I think she was saying likely to be in the low single digits. So sort of slightly coming off today, you know, this year's amazing performance. And then on the trade-in, which again, positive, you could argue, I think we were saying low teens on the trading side. And again, that's higher than what analysts were expecting or sort of predicting for 2026. So plenty of positives in this speech, but it's always interesting to see what the market jumps on. And right now, they're just going, look, bottom line, that's just bad news.
It was the costs. Okay, thank you very much. Thanks to Tom. Thanks for the update. Tom Metcalf, Bloomberg's Tom Metcalf, of course, bringing us the latest on the banking sector. Now, Marianne Lake, who we were just talking about there, head of JP Morgan's consumer banking arm, has cited investing in artificial intelligence as one of the key cost drivers for the Wall Street giants. That links us nicely into a new survey by Bloomberg Intelligence, which reveals that C-suites in all industries are experiencing shortages in AI infrastructure, acting as roadblocks to AI adoption. Matt Bloxham from Bloomberg Intelligence worked on the report and is with us now. So let's start with that point. Good morning to you, Matt. So this idea that they're all sectors reporting a shortage of AI infrastructure, does that mean we shouldn't worry quite so much about the speed and pace of AI rollout and build-out?
Yeah, I think definitely in the short term, I see this was involving over 600 C-suite executives. And one of the questions you asked is, what are the biggest concerns you have about implementing your AI strategy? And definitely the availability of AI infrastructure was up there amongst the biggest concerns. I think the short term, that kind of matches what we hear from the likes of Microsoft, that they can't bring enough capacity on quick enough to meet the demand they've got. I think over the medium term, that the picture's still quite clouded because higher up the rankings of concerns, amongst the C-suite in particular is the issue around the cost of AI implementation, linking to that JP Morgan story, and also the return on investment they're going to get from it. So I think 2026 is a critical year for corporates in how they evaluate the AI pilots they've got underway and whether it makes sense to move those forward in 27 to much bigger programs. And that's critical for the likes of AI that have this $1 trillion plus investment plan. And if corporates don't see the big ROI, then maybe it's going to take longer for that demand to come through.
Does AI equal job cuts?
According to our survey, no, it doesn't. I think in the short term, 66% of respondents said they have been making tactical cuts to heads, but it's more of a resource allocation. When you look on a 3-year view, 62% said they plan to increase jobs as a result of AI, on average by around 4%. I think this kind of plays into this kind of theme that actually, technology and human capital need to go hand in hand, and there's like a big role for jobs in the near term.
There's a good story on the terminal on this morning. You were flagging it earlier.
Well, yes, and part of your exactly, and part of your report pulls this out: the fact that in the banking sector, in the financial services sector, jobs might go up before they come down.
Yeah, exactly. In the banking sector, it's about a 5% average expected increase on a 3-year view in jobs. Over about 2/3 respondents in finance saying they plan to increase jobs, and it's across a range of functions. It's data scientists, model developers, and I think it's something we've been hearing on all of the roundtables we're doing. Lots of CFOs see that it's going to shift what human capital does, not replace it, and we're a long way from CFOs in particular fully trusting AI to replace humans. So it's going to be this hand-in-hand role.
Do we have a clear understanding of the effect that AI is going to have yet? It feels. I talk to a lot of companies about this, and the message that I get is we're experimenting. We still don't know. We have to spend the money because we need to find out, but we don't know what the result is. Is that the how long does that phase last for?
I think it could last for a good few years. I think you've got a lot of piloting going on, but you've also got a lot of technology change happening. If you look, there's a lot of frustration around how LLMs perform, the hallucination, and every 6 months, maybe even every 3 months, we get an updated LLM. So things are evolving. We're now even moving to small language models and agents. So there's a huge amount of complexity to play out, and it's going to take a few years for that dust to settle.
Does cost need to come down? If you think about kind of the process we went through in terms of the internet and putting cable in the ground, we went through this kind of big expensive build out, then cost came down, and that allowed the industry actually to have a much wider effect and reach out into every part of the economy. Do we need to go through that kind of a process where it's not 100 cents on the dollar, it's 30 cents on the dollar, and that allows me as a business to start actually implementing this without it crippling my bottom line?
Yeah, I think you're absolutely right, and that's definitely what CFOs will be looking at, because if they go from a pilot to kind of enterprise-wide deployment, the costs multiply dramatically, and you're not going to see the short-term benefits on that. So I think you do need to see scale benefits come through in terms of lower price points for LLMs and everything to do with AI for sure.
Matt, great to see you. Great report. Thank you very much indeed. Matt Blomsom joining us from Bloomberg Intelligence. What are we going to talk about next? We're going to stay in the technology space.
We are. Tell us about these aircraft.
Would you like to go from, so this is the offering. Go from Canary Wharf to Heathrow in 12 minutes. Go from Canary Wharf to Bicester Village.
Yes.
In a kind of 6-seater eVTOL.
Right.
That's what we're going to talk about.
That's what we're talking about next. I mean, can I do that in a helicopter already?
You probably can, but it's obviously that has an emissions issue and all kinds of other issues. Donald Slattery, chairman of Vertical Aerospace, is about to join us. We'll talk about all of these questions next. That is what's coming up. This is Bloomberg.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to the opening trade, 30 minutes into today's session. This is the picture across European equity markets then. With 30 minutes under our belt, we have gone absolutely nowhere. And that is entirely understandable, I suppose, because we are waiting for Fed Day, the second day of their deliberations about what they want to do with interest rates. Everyone is expecting a rate cut, of course, but how hawkish will the language around that rate cut be seems to be the question for markets. The DAX just on the back foot, the CAC on even more so. So the fact that the Prime Minister in Paris survives to fight another day with his budget has not lifted stocks there. The FTSE 100 are performing a little bit. The silver trade and the energy trade seem to be putting in a little bit of that upside. Guy?
Absolutely. Let's turn our attention to the internals of these markets. 195 up, 393 down. So basically a 2-to-1 ratio in favour of the laggards today. But as Anna says, at the top line, at the index level, we're not actually seeing very much. So you're getting kind of quite a big netting effect. So that probably tells you that some of the upside are some of the heavyweights. ASML is one of them. It's up by 1%. Heavyweights. HSBC up by 1.84%. Heavyweight. Novo Nordisk, another heavyweight, up by 1.32%. So there's a number of big heavyweight stocks that are doing some heavy lifting today in terms of netting out the losers that we're seeing on the other side of the ledger. Let's talk about the downside and what we're getting there. You've got some of the pharma stocks that are under pressure. Novartis is down by 1%. Vasi is down by 2.2%. But this is the story over here that I think really stands out. Aegon is going to relist. It's going to go to America. It's another company that is leaving Europe, potentially going to America. It's going to rebrand. And the market, look at the market reaction. Like it was down by 9% at one point. Now we're seeing it down by only 8%. But that is a big market reaction against quite a significant announcement for this company. A complete kind of culture shift in terms of its narrative going forward from here. It sees the opportunity in the United States, not necessarily here in Europe. And it's moving. It's going to America as a result, Anna.
Let's get up to date on some other stories we're covering this morning then, Guy. The European Central Bank Governing Council member, Jiminis Simkas, says he doesn't think interest rates need to be lowered further after economic activity and inflation both turned out stronger than expected. The remarks represent a shift for Simkas, who'd said in October that there's a bigger chance of inflation falling short of the ECB's 2% goal than overshooting it. Microsoft has pledged to invest $17.5 billion in artificial intelligence and cloud computing in India over the next 4 years. Speaking this morning in Delhi, the Microsoft CEO and chairman Satya Nadella said the tech giant is to train 20 million people in India. The news comes as Amazon raised its India investment pledge this morning to $35 billion by 2030. And Bloomberg has learned that SpaceX is moving ahead with plans to go public next year. Sources say it aims to raise significantly more than $30 billion in the IPO, which would target a valuation of about $1.5 trillion. The listing would be the biggest of all time. We're told SpaceX would use some of the proceeds to develop space-based data centers of all things. Guy.
That's really got Anna scratching her head. How does that work? Why would you want to do that? We'll discuss that maybe nearer the time. Kind of feels like it's coming. Let's stay in the aerospace sector and focus more on the aero than the space side of things. The UK-based company, Vertical Aerospace, is unveiling its latest vertical takeoff and landing aircraft, aka flying taxi, today. Named, I think it's Velo. It could be Velo, but I'm going to go with Velo. It seats up to 6 people and is designed to fly up to 100 miles at speeds of 150 miles an hour. The firm says it will get passengers from London's Canary Wharf to Heathrow in 12 minutes, which sounds highly desirable. Donald Slattery is the chair of Vertical Aerospace and joins us around the table. Good morning.
Morning, Guy.
That's the dream. Talk us through what you're announcing today.
Well, there's actually 3 announcements today, the first being the most important. So our new aircraft, Velo.
Velo? That's so I got it vaguely right. Okay, good.
No, you got it spot on. So this is Europe and indeed the UK's first major innovation in aerospace in over 40 years. We're one of a very small number of eVTOL manufacturers globally. Velo will fly up to 6 passengers, 100 miles at 150 miles an hour, and importantly, at 100 times quieter than a helicopter with 0 emissions. So it's a game changer in how people will move around the mega cities of the world.
Yeah, people talk about the low altitude economy. That's the kind of that's what we're moving to. But there's some huge challenges to get us there. Notably, as you say, certification. 2028, you're thinking certification. How much money is that going to cost? Are you going to need to raise money to get there? What are the challenges to getting to certification? Because this is a whole new kind of class of aircraft that we're talking about here. Regulators are going to look super carefully at this process, and there's a number of big milestones that you have to go through. And I suspect the CAA is going to take it quite seriously.
CAA and EASA are taking it very seriously. In fact, they have really set the standards for safety in this eVTOL sector. And my board colleague, Patrick Kai, who was formerly the Director General of EASA, was the executive who actually wrote the rules.
Right.
So we now have the IP internally. So there's absolute clarity with what we need to achieve, the timeline to achieve it, and the cost to achieve it.
And do you need to raise money to get there?
Yeah, so we will raise $700 million between now and the end of 2028. But the relative spend that we have is significantly lower than our US competitors, because here in the United Kingdom, we have the best aerospace engineers in the world, but they are 1/3 of the price of a similar engineer in California.
Right.
And we're also partnered with some of the top-tier aerospace firms in the world, like Honeywell, Aciturri, and that allows us to dramatically reduce our CapEx.
It sounds like they need to be asking for a pay rise. That's the first thing that I take away from that.
That's an interesting dynamic, low production cost environment here in the UK. Good morning to you, Donald. Really nice to see you. Yes, I mentioned helicopters as we were running into the break in the last part of the programme, and you preempted my question by saying that these aircraft are much quieter than helicopters. But you're convinced this is going to be a large mobility market product, as opposed to just a replacement for something quite niche, which is a helicopter. What dictates that will be the case?
So just take a step back and think about the 50 mega cities of the world that are growing and growing and growing, and they have literally run out of space to allow people to travel in cars effectively and efficiently. So whether it's Sao Paulo, where it can take you 2 hours to get from the airport into town, or Seoul, Korea, the same thing. So literally, the only way is up. And working with regulators globally, they've accepted that reality. So this low altitude economy is the reality of the future.
Yes, and a lot of wealthy people already make use of helicopters to do just that. So what turns this into a mass market product? It has to be a lot cheaper.
That's the key point. So we're going to democratize urban air mobility in terms of a price point. So the way we're thinking about it, and when we run the economics with our airline customers, a seat in our aircraft will cost you broadly the same as an Uber Black from, say, Central Business District to town. So in a US context, $120 from New York to JFK, Canary Wharf to Heathrow, Gatwick, or Oxford and Cambridge, as we announced earlier this morning.
It's interesting. I was talking to Joby at the Dubai Air Show, making a very our competitor is, or our price point is going to be an Uber Black. They're flying. I saw it. They flew around the Dubai Air Show with their aircraft. Do you need to catch up? Are you behind in this race?
Well, I think when you compare our aircraft with our competitors, it's a fundamentally different size machine, and people will get to see it today in Canary Wharf. So our aircraft is...
But it's not flying, is it? So
it is flying, yes.
It is.
Our prototype is flying. In fact, it's flying on right here, right now. It's in its flight transition test program as we speak. But the difference between our flying and our US competitors, we do it under the oversight of the CAA. Our US competitors fly with experimental certificates. And this is a fundamentally different safety point. But the key point that I was going to make is the size of our aircraft, Guy. It's 70% larger than Joby's. 70%.
Yep.
In a Joby aircraft, there's no room for baggage. In our aircraft, you can fit 70 pounds of luggage per passenger. So it's comparing, night and day, if you like, from a product perspective.
And has that been the big challenge, is being, yes, you want to be able to fly far enough, you want to be able to carry enough weight with the battery limitations that maybe you're working with?
Yeah, so my world, Anna, is the airline world. I've spent my entire career in aviation. So about 5 years ago, we talked to 140 airlines around the world and said, what do you need? And they said 3 things, okay? The first is we need space for the passengers that's comfortable. So our aircraft is designed to take up to 6 passengers, uniquely. Secondly, we want our pilots safe.
Yeah.
So if you've been in the Joby aircraft, there's no segregation between the pilot and the passenger. That's a significant safety issue. The third thing was our passengers are going to be coming from the airport. They need somewhere to put their luggage. And that was a big ask, 5 years ago when we were looking at the energy density of these batteries. But we cracked it, and today we're revealing Velo. It's real, it's there, and the prototype has been flying for 3 years now, and we're about to complete flight transition, which is the
just in terms of that process of what we go through, my point about kind of the fact that the Joby aircraft is flying, they're making flights from Jumeirah into the airport. They're starting to do those kinds of things. How far away are you from that here in the UK, and how different is the process? But they're doing it in the UAE, so
it's very different. They're flying under an experimental basis. They're not flying passengers. They won't be flying paying passengers for a very long period of time to come. So in our industry, safety is the currency of trust. Okay, that's why aerospace is the safest industry in the world. So we're certifying to the highest safety standard here in the CAA and the EASA. We will be certified in the second half of 2028. We've got very clear milestones. We're not creating some vision or aspiration that we can do this quicker. We're going to do it safely. We're going to do it on time and on budget with the best product.
Donald, thank you very much. Thanks for bringing us the story. Donald Slattery, Chairman of Vertical Aerospace. And I think Canary Wharf got a mention there, so don't miss our conversation with the CEO of Canary Wharf Group. That conversation coming up tomorrow at 8:30 a.m. UK time. What kind of difference would this kind of accessibility make to the Canary Wharf business case?
Yeah, if it's easy to get there rather than on the Jubilee line or on the DLR, maybe that will certainly open it up to other people. Let's talk about what else is happening in the markets and figure out what is going on right now. Silver extending gains. It's broken above 60 an ounce for the first time. Momentum certainly coming from supply tightness. Bets on further monetary easing by the Fed, certainly a factor here as well. Our metals reporter, Martin Ritchie, joins us now from Shanghai. Martin, we're through 60. Now what?
Very good question. It's been a huge move upwards in silver. I think it's shocked some people with the extent and the speed of the rise to this level. We've been sending headlines after headlines about new record levels. We did have a conversation with Marex Group earlier today. It's a major commodities fund, and their head of analytics, Guy Wolf, said silver at these levels is probably about 15% overpriced, and perhaps a correction would be a healthy thing. There's been a lot of what we call sort of retail interest. That includes sort of wealth managers piling in to the metal. Because they see it as a bet both on more Fed easing, but also on tightness of supply in the coming year. It's still highly uncertain because these things do tend to have a lot of momentum when investors get behind them. So we'll have to see whether 60 is the last level we've seen.
Yeah, it's all those headlines keep sending. Martin, that's having something of an effect. Let me ask you about what this means for other precious metals then. Is silver's gain gold's loss, or at least gold's stability? Just looking at how gold has performed through December, it's been pretty flat.
Gold has been pretty flat, and I think that in some senses, gold and silver are sort of coming from the same dynamic. It's a lot of money sloshing around looking for a home. Gold already had big gains this year, and I think to some extent the whole precious metals complex has become a place for money to rush in when you've got those fears about the dollar, fears about fiat currencies generally, and gold is looking a lot more placid. We'll see what happens by this time tomorrow, which will be after the Fed meeting later today, obviously. If there's any surprises from the Fed in terms of perhaps their outlook for next year, we could see sort of gold perhaps break out from its recent range.
We're going to watch carefully. It's all hanging on the Fed, at least for now. Martin, thank you very much indeed. Martin Ritchie, Bloomberg Metals reporter, joining us on what we're seeing in silver. What have we got coming up for you? We need to talk about this. Australia beginning enforcing the world's first set of legislation, basically booting young people off social media sites. We're going to have the details next. The ban is a big focus globally, and we'll talk about it and figure out what the implications will be. That's next. This is Bloomberg.
game here is understanding. These digital assets have the ability to change the payment landscape of the world, and we need to be ready. We, the regulators, the world needs to be ready for a new wave of technology.
Stablecoins are almost entirely used in the mechanisms of trading cryptocurrencies. What we saw is the opportunity for digital assets broadly, stablecoins in particular, to be used as a medium of exchange outside of the crypto world, what is today the fiat currency world. At some point, I think these digital asset wallets will be big enough and people will be comfortable enough using them. I think we'll have a flip from conventional payment mechanisms into stablecoin-based mechanisms.
Does that mean banks such as yourselves issuing stablecoins?
We could. We are issuing Hong Kong dollar stablecoins today. We're in a sandbox for tokenized bank deposits in Hong Kong. We're effectively issuing tokens related to trade finance in Singapore. So it's all on the table, but we're always going to tie it back to what our clients want and need. because if we don't get that one right, the rest doesn't matter.
The market capitalization of both type of instruments, crypto and digital assets, are both very low. Stablecoins today have $20 billion of flows a day. It's less than 1% of the flows of the payment system in the world. But because they have the ability to be very helpful in use cases, particularly in retail to begin with, but then potentially on the wholesale side, I think we will see a lot more of them.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back to the opening trade. We are 48 minutes into our session. It is 8:48 here in London, and European equity markets are in retreat just a little bit. We are unchanged on the FTSE 100. We're waiting for the Fed, essentially. US futures pointing a touch higher, up by 0.1% on E-minis and NASDAQ futures. Now, let's look ahead to what lies in store for the tech sector and social media in particular. In a world-first crackdown, Australians under 16 are now barred from accessing social media services like TikTok, Instagram, and Facebook. The landmark move means young people can no longer have their own accounts in a bid to curb the spread of harmful content and cyberbullying. Here's what Australia's Prime Minister Anthony Albanese had to say.
Well, this is a day in which my pride to be Prime Minister of Australia has never been greater. This is world leading. This is Australia showing enough is enough.
Australia seems to think it's setting a precedent. Let's talk about this with Bloomberg Tech reporter Newly Purnell, who joins us now from Hong Kong. Newly, great to have you with us. Talk us through how this is actually going to work. How is it being enforced? Who's at fault if teens make it onto these platforms? Talk us through the detail.
Yeah, that's been a key criticism that people have leveled at this. They say, how are you going to ever keep kids who tend to be usually technically much more savvy than their parents off of some of these services? So far, what we're seeing is that the platforms are preventing new users from signing up if they enter a birth date that would put them below the age of 16. And then for some of the users who are on the platforms who have already said that they're below that age, if they said they were 13 or 14 or 15 when they signed up, they're being asked to validate their ages through other means like video selfies or uploading some sort of ID if they have one. Now, interestingly, the onus is on the tech firms. It's not parents, it's not the young users who are going to be punished. It is the tech firms. The Australian government is really clear. They say this is a problem that the tech firms need to solve, and if they don't solve it, they're going to be fined $32 million or so US. So a very interesting move that they really are leading the world here in doing something quite so bold.
It's amazing. Just simply putting in your birthday, believe you me, having dealt with teenagers and technology, that is a very, very small barrier. So how are the tech companies reacting and dealing with this?
It should come as no surprise. They hate this. They have been very vocal. You know, sometimes when companies like this are presented with new regulatory movements or new laws around the world, they kind of keep a lower profile and prefer to deal with it behind the scenes. They've come out swinging from the very beginning. Since Australia passed this rule at the end of last year, they said it's misguided. They say that the public wasn't given enough time to consult with the government on it. They say that it's going to actually push kids to darker corners of the internet that are less safe. So they're very displeased. And I think it hits at a key demographic for some of these platforms. Of course, they make money on advertising. They want not just as many people in aggregate to be on them, but they want young kids because they're going to be consumers for longer. They don't want the trend moving against them where they lose some of those network effects where if young kids get on and they delay joining, maybe they just won't join at all.
Okay, Neely, what about other countries then? It's one thing this happening in Australia, but it does seem to be getting quite a lot of attention in other geographies. A lot of people watching how this goes.
Very much. It's been one of the most interesting things we've found in our reporting as we've talked to legislators around the world. We spoke with a very senior policymaker in Denmark who said, look, I'm inspired by Australia. We want to follow their lead. She said that they're working on rules for under 15s. We've seen Indonesia talk about new restrictions for under 18s. We see Brazil, a huge populous market with tons of young people on the platforms, talking about doing something similar. Some EU countries have talked about it. Singapore says it's talking to Australian counterparts about some sort of age assurance measure. So it does seem that the world is watching. They're going to see how this unfolds in Australia, but there is broad approval in Australia for it. 77% of parents, or sorry, of adults overall, people say that they agree with it in Australia. So I do think we're going to see additional countries around the world try to follow Australia's lead.
Nearly, thank you very much. Bloomberg's Nearly Purnell with the latest there on that, developing regulatory activity then in Australia. Let's talk about what's coming here in the global trading day ahead. 10 a.m. UK time. Rachel Reeves testifies to the Treasury Select Committee. We heard a lot from the Bank of England yesterday. Rate decision next week. What does the budget mean for all of that? Bank of Canada rate decision later, and of course the Fed. That's 7 o'clock UK time, the Fed rate decision, and Jerome Powell's press conference at 7:30 p.m. UK time. How many of those questions will be about Fed leadership, I wonder?
How many will be about rate cuts next year? I think probably will be a significant story as other central banks around the world increasingly start to look like they're done, and then you start talking about rate hikes. Anyway, let's kind of figure all of that out. We've got some great coverage coming up, by the way, on Bloomberg around all of this, and we're going to start it, well, we've already started it, but we're going to continue it right now with Valerie Tytel joining us around the table. This is the story. Others are beginning. The signal coming globally is not of more cuts. It's a potential rate hikes coming down the pike towards us. Yeah. The Fed feels out of kilter with that. But I just wonder how pivotal today could be.
Well, the Fed and the Trump administration, frankly. The Fed next year is really an outlier of those, assuming there's still going to be some rate cuts, while these other central banks around the world, be it Australia, be it the ECB, be it the Bank of Japan, are talking about rate hikes. But just how far will that narrative be shifted today if we do get some more hawkish comments from Fed Chair Jay Powell? I think the market has been bracing for that in the last few sessions. We've kind of priced out the amount of cuts in 2026. We're now just penciling in 2. And the way that Powell could frame maybe a more hawkish press conference while still appeasing the doves is to say that, look, the last 2 rate reductions really about risk management. Yep. We want to protect the labor market. We were worried about wobbles, but that risk management exercise is coming to an end, and we need to pause. We need to slow down the pace of rate cuts while we wait for the backlog of data, and while we wait to see how CPI shapes up at the early next year. A lot of inflation analysts have been pointing out that the January CPI print will be pivotal, because that in January, autos reset their prices. A lot of other goods-focused industries reset their prices in January. So if we're going to see any tariff-induced inflation, perhaps it'll come in that report.
Yeah, you do wonder if we've seen the full extent of that yet, whether that is still to come. Now, Valerie, this time tomorrow, we will undoubtedly be talking about the Fed. Will we also be talking about Oracle earnings and Oracle CDS, which seemed to be such a talking point a couple of weeks ago when everyone was worrying about where the tech story, the AI story was going next?
Look, a big focus also on these Oracle earnings out after the bell. After their blockbuster earnings in September, the shares of Oracle have dropped around 30%, and that comes after this debt binge they've gone on in order to finance fulfilling these customer contracts. A lot of focus will be on the sales figures on their cloud unit. That'll be closely watched, but any evidence of delays in monetizing or building out what they've promised for these customer contracts will be a big focus. We have seen a few tech companies of late warn of delays in fulfilling contracts, delays in building out data centers, and those kind of hiccups can be something that could really at least crush the AI trade next year. Also, any update on financing? When it comes to what else they need to do. You know, they've already raised a huge amount via investment-grade bonds. We'll be looking for some sort of guidance on their financing needs come next year.
Could be quite nice. I'm going to bed early.
Okay, so you won't be up for either of them. We'll catch up in the morning. Valerie can't sleep. It's just all too exciting.
It's going to be a long night for everybody, I think, tonight. Hey,
Valerie, thank you very much. Bloomberg's Valerie Tytel with what you need to watch out for the rest of your trading day. A reminder, we have, of course, special coverage of the Fed decision and Chairman Powell's press conference. Tune in from 6:30 p.m. London time. We'll be up for that, surely. That's not before our bedtime. 6:30? No? You guys looking?
Getting into that territory, it's late.
No commitment. It is dark, I will say that. That's it for the opening trade. The Pulse is up next. This is Bloomberg.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Used to be, one would say, what's that got to do with the price of tea in China, when they wanted to poke holes in the relevance of something? Now, though, if you're in tune with how events around the world affect each other, it becomes clear that the current going rate of tea in China has a lot to do with a lot of things, not just tea things either, but tariffs, franchises, and IPOs. How much?
Traders await the Fed's latest economic forecast, with the central bank expected to cut for the third consecutive time. The favorite to become the next Fed chair says there's room for a jumbo cut. Ukraine's president says he expects a meeting of leaders with the U.S. president as soon as next week. It comes after Donald Trump chastised European leaders for failing to end the war. And Bloomberg learns that SpaceX is pursuing an IPO as early as next year, seeking to raise $30 billion in what would be the biggest listing of all time. Now, we have some great guests coming up, including John Graham, the chief executive of CPP Investments, Canada's largest pension fund. Then we discuss the potential impact of a Fed cut on emerging markets with Amundi's head of EM macro strategy. But first thing is first, you know the drill. We're starting the show, so we look at stocks. Stocks marking a second straight day of restrained moves. There's a little bit of tepidness out there as traders await the Fed's outlook for interest rates in 2026. Traders definitely anticipating this third consecutive rate cut that we're expecting Wednesday today. All of the attention, of course, and will focus on the dot plot. S&P futures getting 0.1%. I like looking at euro dollar. It's always just a good indication of the friendship or not between the two allies. And then when you look at European stocks, look, they're just following what we saw in the U.S. Again, we had a rally in stocks that started in the U.S. and then followed through in Europe, but it's definitely stalling this week. Mixed economic signals, but also rift amongst policymakers of the Fed, maybe clouding the path for rates for 2026. Now, for the conversations that matter and the insights you need, let's get started.
newsmakers, and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So Canada's largest pension fund has brushed off fears of an AI bubble, boosting its exposure to NVIDIA in the last quarter. Now, CPP Investments returned 5.4% in the 3 months to September, boosted by stock returns and the strong dollar. It's also revamping its private equity strategy after getting mixed results. Now, the fund was worth more than $550 billion at the end of the third quarter, and I could not be more delighted to be joined by John Graham, CPP's President and Chief Executive. John, thank you so much for joining us.
Thank you for having me.
I mean, I need like 3 hours with you trying to figure out exactly what's happening in the world, but governments in countries such as the UK, Canada, and Australia are intensifying pressure on pension plans to actually invest more domestically. Are you concerned that your government will do the same?
It's a topic domestically, as you mentioned, it's a topic around the world, as countries around the world are thinking about big infrastructure build-outs, which, if you take a step back, that's a good thing for investors like us who want to invest in long-duration assets such as infrastructure, especially things like pipelines, toll roads, these type of assets. Ultimately, though, what needs to happen is competitive capital comes into these opportunities. So I think there's probably a lot of discussion about it. I think the noise is probably bigger than the reality, with an understanding that the issue right now is opportunities. First step is to start creating the opportunities, and then the institutional investors will come in. And there's been a lot of talk domestically about what's the right source of capital at what stage of development. Pension plans aren't always the best source of capital for early stage development, but they can be there as a pretty reliable, trusted source of capital later in the development cycle.
I mean, are you looking at specific funds or places to allocate more capital in Canada?
Canada is an important market for us. So the U.S. is our biggest market with respect to investment destination, and Canada is second. And we are invested across the public markets, the private markets. I think what we would love to see is more opportunities on the large-scale infrastructure side, whether that be data centers, whether that be ports, whether that be LNG. And there's a lot of discussions going on right now domestically about building some of this critical infrastructure, which we're encouraged by.
Will it come soon? I mean, do you need another team to look at it, or how does it work? I mean, again, are there any thoughts about preempting, or you're just treating it as all other investments?
Like all other investments, and we don't need a special team. So we have pretty well-developed infrastructure energy teams. They invest across the globe. They invest in Europe and U.S., Canada, and they're actively engaged in opportunities. Again, some of these, at the early stages, they got to work through the permitting. They got to work through where government is really the right people to shepherd these projects early stage before some of the investors come in.
John, many alternative asset managers are also ramping up efforts to basically attract retail investors. What does that mean for, does it mean that retail capital will just take a lot more of the co-investment pie? And what does that mean for institutional investors?
Yeah, I think this is a big topic of conversation and one we spent a lot of time thinking through. I think with respect to retail, it's still early. It's still very early on how retail is going to play. I can see many scenarios where it's synergistic to the traditional institutional investors. But at the same time, I look back and take the private equity market. We've been investing in a very successful model where I think it's win-win for the general partners, win-win for us, where we invest in blind pool funds and then participate in fee and carry advantage co-investment and co-underwriting. It's worked for 25 years, and it's worked for everybody for 25 plus years. And what retail does, I think, is still in the very early innings.
So is there a point, and I don't know whether it'll take a long time, that I guess the pool of co-investments available for institutional investors will shrink, or is it something that you talk about but not worry about?
I think we talk about it, but we don't worry about it in many ways because we see this, again, this relationship as being very symbiotic and have been very much win-win. And we've stayed through and stayed committed, let's say, to private equity through the financial crisis, through COVID. Even now, when there's been kind of a distributions have not been where they've been historically, we're still very committed to the asset class, very committed to these partners that we've had for 20 years. And so we are confident that this model will be able to keep being win-win for both the general partners and the institutional investors.
John, we've made it to the end of 2025. Congratulations to everyone in the markets, because it's tariffs, it's inflation, it's Fed. We've kind of had it all. There's like, every week there are worries about an AI bubble that never really come to fruition. Is it going to be, most of the same themes for next year?
Yeah, I think every year at the end of the year, you reflect and say, this has been the most volatile, challenging year we've ever worked through. This year may actually be it. But at the end of the day, when you take a step back and look at the markets, they've been pretty resilient and pretty robust. We continue to worry about valuations in the market. We have been knowingly underweight the AI theme in the U.S. equity markets, which from a relative performance perspective is painful. But who we are, the purpose the organization has, we have not been participating in that. So going into next year, I think we would expect some of the same themes. But for us, what's important is to have conviction and to stick to your fundamental investment beliefs.
But do you worry about an AI bubble or an AI data center bubble or AI infrastructure bubble?
I think we'd worry about valuations. And I think you have to separate, the technology may very well fundamentally change the world, but it could still very much be overvalued at certain points in time. On the data center side, we are active in data centers around the world. And in many places around the world, the data center theme is as much about cloud migration as it is AI. So there's still interesting opportunities. It is actually a little bit location specific, and I think you have to be very thoughtful about where you're investing in data centers.
Yeah, I know you've also been very active in the secondaries market, which is a bit of a hot spot for investor interest recently. Do you think it's such a hot market at the moment because buyers want to flip assets to retail investors? Yeah. Or is there just longer term opportunity?
My personal perspective is the secondary market is an important market within private equity and within the private investments markets in general. I think about the stock and the flow, and the stock being the existing portfolio and the flow being the new opportunities. A lot of focus and fixation on the flow and the new deals and the M&A, but we have a $140 billion Canadian PE portfolio, and there's a lot of pressure on the teams to manage that and to portfolio manage it. And I see the secondaries market as a very effective portfolio management tool. So we put a lot of emphasis on the secondaries market, and I'm always encouraging the teams to use the secondary market as a portfolio management tool.
Can you talk to me a little bit about hedging U.S. dollar assets, actually? Yeah. Does that continue into 2026?
For us, no. And we actually don't hedge U.S. dollar assets. We tend not to hedge that much currency. A view that over the long run, currency doesn't have over the very long run, it's not going to have a big impact. On the short run, it can add a lot of volatility to the portfolio. But we actually largely stay unhedged with the view that hedging costs money, and we don't have an expected return from it. So we wear the short-term volatility and with a view that it'll add long-term value. So U.S. dollar, I know a lot of discussion on U.S. dollar. We still largely have it unhedged in our portfolio. And you have to think about the Canadian-U.S. dollar relationship, which is a little bit different than the euro-U.S. dollar relationship.
And that's never your approach to it has not really shifted.
It hasn't shifted historically, and as the plan matures, it's certainly something that we would revisit. But today, we've largely stayed unhedged.
What's your take on U.S. assets, full stop, and dollar into 2026?
Yeah, so we had at year-end 47% of our investments in the U.S., and we're a big believer in diversification. And diversification is an act of humility. Another way we invest the money is we're always invested. We don't time markets. We don't pick up. We don't hoard cash. So we always stay invested. And every time we have a discussion around, do we want to sell geography A? Then the question is, what are you going to buy with it?
Right.
What are you going to buy? If we want to sell U.S., what do you want to buy? And right now, there's no safe harbor. There's no place that you can go to that you can see as a safe harbor and is without risk. I think you can get yourself kind of worked up almost every geography and region in the world. The U.S. continues to be the deepest, most liquid, most sophisticated capital markets. And I suspect most people will continue to be heavily allocated to the U.S.
John, why do you think? I mean, you're right. There's not a natural, I guess, haven. Is it because things are changing too fast, or we're redrawing our economies, or what does it mean for markets longer term?
I think there's a lot of reasons. Some of it might be geopolitical. I think historically people were able to invest globally, invest around the world with only a secondary consideration for political risk, a secondary consideration for geopolitical risk. Over the past 5 years, that's changed. And people need to think long and hard about how they invest in different countries in the world and how these regimes are changing.
John, you've also been outspoken against the use of PIK interest in the past. Where are we on that now?
With respect to PIK interest?
Yeah.
Yeah, I think within the private credit markets, I know, again, another hot topic. I'm thinking about that.
We're hitting the hot topics this December, getting ready for 2026.
Getting ready for next year. PIK interest is, I used to run the global credit business.
Yeah.
And PIK was something we certainly had in the portfolio. And there's certainly times it makes sense, and certainly times it doesn't make sense. And certainly times where you would prefer to get cash interest. I think maybe just to comment on the credit markets in general, because I know it's been a hot topic. I think we continue to be actually reasonably constructive on the private credit markets. We think they play an important role. We think they actually help almost stabilize the broader credit markets. But the U.S. markets are pretty fairly valued. And if I look at our team and what they're doing, much more active in Asia and much more active in Europe than North America right now, where there's a lot of money in North America. Retail money has certainly come into the credit space, and we're seeing spreads pricing pretty tight.
John, thank you. We've hit all the hot topics. We've done it in like 12 minutes. John Graham, President and Chief Executive of CPP Investments. Coming up, the Fed expected to cut again in its final decision of the year. We'll discuss what central bank might say in its new economic forecasts. That's next, and this is Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
You know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
Astonishing day for U.S. technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Jay Powell has done the right thing, which is he's taken the far left people of the board and he's coalesced them around, it looks like, a rate cut, which is the right move right now. I might like a bigger one, but I think that that's what the Fed chair has to do. Don't forget, you're managing a committee. And so getting rates down right now, it's a good thing. There's a lot more room to go.
Kevin Hassett, the White House National Economic Council Director, who's seen as the front runner to replace Fed Chair Jay Powell. Now, global bond yields rising or have risen to highs last seen in 2009 ahead of the Fed's rate decision later today. Investors looking for clues in the updated dot plot for a likely path for rates. Now, we're now joined by Simon McAdam, Deputy Chief Global Economist at Capital Economics, and Skylar Montgomery, coding from Bloomberg MLive. So thank you both for joining us. It's exciting, right? I mean, Fed officials are probably primed to deliver this third consecutive interest rate cut on Wednesday. What are you watching for?
Well, that's the thing. It's an interesting juxtaposition. You've got bond yields rising, expectations of sort of hawkish turns of monetary policy around developed markets, and yet here we are bracing ourselves also for a cut from the Fed. In terms of like the summary of economic projections, I'm not sure a huge amount will change. If there is a cut that has been negotiated, I imagine the hawks will have also negotiated as part of that, changing some of the language in the statement. But in terms of the actual projections themselves, well, of course, the Fed's been starved of some of the top-tier data over recent months. So it'd be interesting to see what could possibly change the macroeconomic outlook fundamentally if they sort of going blind a little bit.
Skylar, you've turned a little bit more hawkish this week.
Yeah, absolutely. I think heading into the decision itself, that's also where the markets turn. Yep. But I think there's still ways to go. And there are kind of three metrics that I'm looking at to gauge how dovish market pricing is. One is we have a cut fully priced for this meeting. And I think a month ago that wasn't pretty much guaranteed, at least as much as it is by pricing. The second is bets that Kevin Hassett will be Fed chair have risen quite significantly, and that's kind of your more dovish outcome of Fed chairs. And then the third is where your terminal rate is. Now this week we've had that edge up a little bit, but we're still hovering around the lows at 3%, and that 3% terminal is in line with the long-term dot. What we've seen from the Fed is as the economy is held up against very high rates thus far this cycle, they've had to move that long-term dot up. So 3% looks more like a floor, and a few times this cycle already we've had a terminal price closer to 4%. So I think certainly as we head into next year, you need to be thinking about upside risks to that forecast, given that we're pretty much at the lows.
Yeah, it just makes it difficult, right, for the Fed to toe this line. I don't know whether it's a fine line because someone will be disappointed, but it's really the inflation bit of it, the fact that it's stickier than expected, that's making a lot of people nervous on the committee.
Yeah, I mean, I think this is the thing. It's very finely balanced today. As you say, I think it's a bit odd that markets have swung themselves to be so certain. I mean, I can understand there's been relatively little pushback to John Williams' speech last month. So I can understand why maybe that might be the fine balance of the outcome of today's meeting. But in terms of the inflation outlook, we've also had the NFIB survey this week, which was another call to say that actually there are some persistent price pressures that are going to be keeping the Fed rather uncomfortable in the year ahead. So, I mean, it's our expectation that we only see one more cut next year. I think the market's still got two fully priced in for next year. And I think you're quite right. 3% is very much a floor, very much at the lower end expectations for where the Fed funds rate would end next year.
I mean, to both of you, I guess we've seen a fragmented committee in the past. This feels a little bit different because of the nature of the recovery, right, or the nature of the economy. Is that fair?
Yeah, I think it's fair because I think people are still trying to get the grips with the idea of what's actually happening to the underlying growth rate of the economy and whether this sort of AI investment boom that is becoming the sort of a major driver of GDP growth, whether that's got legs and whether that will continue. Our view is it is, but of course it's somewhat uncertain. But on the flip side, of course, the debate 6 months ago was how much were tariffs going to be dominating the inflation outlook. Now that's sort of shifted towards some sort of persistent price pressures in the services sector. So yeah, the debate has been changing, and with that, you've got understandably a very divided Fed in an environment which they haven't got the data releases that they'd like to have by now.
What does it mean for the market, Skylar?
Yeah, I mean, I think what's super interesting is if you look at the Fed projections, yes, they're unlikely to materially change because we haven't had a big source of data. But the 2026 growth outlook for the Fed from September was the same as in the first quarter of 2025. And we've had huge policy shifts within that time. We've had markets move quite significantly. And I think that tells you that when you have so many policy headwinds or shifts or things going on and you have high uncertainty, you just kind of forecast trend growth. And it means you have to watch the data, which means as we have a board that's more divided, as you have to look to these individual members when you don't have consensus kind of forming behind the Fed chair as you have previously, you're going to have more volatility. You're going to have to watch the data very closely. And while risks are still skewed hawkish, that doesn't mean you're not going to get ups and downs along that way.
Skylar, what do you think happened? I mean, when we do actually have the appointment of the new Fed chair, if it is Kevin Hassett, as widely expected, does that move the markets, or is it already priced in that he will just be much more dovish?
I think you get an initial reaction, but it's probably more of a sell the fact event. I think you also have to put it in the context of where were earlier this year, as in we were talking about Fed chairs that would have been very problematic just from a credibility standpoint, there is some economic backing and some reasonableness behind Kevin Hassett, even if it is skewed dovishly a little bit. So we've moved quite a long way from that, and we're not having this broad changeover of the Fed board that some were worrying about. So it's one member that's changing, maybe two if you have Stephen Moran and Powell stepping down, but there's 12 members that vote, and so you're not going to see this broad dovish shift. So yes, you get an initial reaction, but I think then there's recognition of the kind of sanity and credibleness that still stands behind the Fed.
Simon, when you look at bond yields, I mean, Japan to Germany, they've climbed to multi-year highs. What is there some, does that complicate matters for a lot of debt-laden countries and therefore central banks?
Well, I think in Japan's case, it's despite rising bond yields, despite the fiscal stimulus that is being announced by the new Prime Minister, actually, I think the fiscal health in Japan is actually improving. I think it's still underestimated how healthy Japan's fiscal balance is. General consensus expectations, the IMF forecasts have continually, massively understated the health of the fiscal trajectory in Japan in the last couple of years, and they continue to do so. So you're stimulating from a relatively healthy place. And the pass-through from bond yields to the actual debt interest costs for the Japanese government are extremely slow because of the long-dated nature of the maturity bucket of their outstanding bonds. So I really don't think this is a big fiscal concern for Japan. But in terms of in the European markets, Germany's obviously in a very healthy place. It's what we've got to be watching there is spreads. And for that reason, we've got to be worried most about France, for the same discussion as the last time I was on the show. And we're discussing about how France is still politically and fiscally in the sort of same position as it was many months ago.
I mean, traders now no longer see an ECB interest rate cut in 2026. This is largely after we also spoke to Isabel Schnabel. Traders see the ECB boosting. Basically, you see a 50% chance of a 2026 hike, which also seems quite high.
I think markets have got the wrong direction. I understand what this is partly a response and reaction to what Isabel Schnabel has said. I think we've just recently had Villeroy de Galhal come out and say the opposite. I think what we've got to look at is fundamentals. Yes, in the very near term, I don't think there's any reason for the ECB to fundamentally change its position that rates are in a good place. But I think going into next year, I think German stimulus is going to disappoint. Underlying growth is weak. And of course, I think on the inflation side of things, we're also going to get undershoots that people aren't appreciating.
Okay, thank you both for joining us. Bloomberg MLive's Skylar Montgomery coding. I suggest everyone go and read MLive. It's just absolutely fantastic. Simon McAdam, Deputy Chief Global Economist at Capital Economics. Now, on to geopolitics, and Ukrainian President Volodymyr Zelensky says he expects to have a meeting of leaders with U.S. President Donald Trump within the next couple of weeks. This comes as President Trump chided Europe in an interview with Politico, calling its leadership weak. Bloomberg's chief Europe correspondent Oliver Crook joins us now with the very latest. So, Ollie, what more do we know about this leaders meeting sometime in the next couple of weeks?
Yeah, I think that for the Europeans and the Ukrainians, really the priority here is to get back inside the room with President Donald Trump. We know that Donald Trump is susceptible to persuasion from the people that he speaks to, and he hasn't really been in the room with European leaders in quite some time. And as a consequence, potentially, you've heard him speaking on many of the same talking points, many echoing some of the views of the Russian position on the conflict in Ukraine. We heard him speaking in that interview with Politico yesterday, basically saying that in his view, and this is really echoing what the Russian propaganda is, that it's just a matter of time before basically the Russians win the war, and saying that basically the only determining factor in this war is going to be size, and Russia is much bigger. There are, of course, countless examples in the past of military mismatches, potentially the biggest in modern history between Vietnam and the United States, and we know how that ended, where you have examples of the contrary of that, but that is not Trump's position as it stands. So what we understand now is that President Zelensky would like to get back in the room to Donald Trump to get the opportunity to make his case, but another olive branch that Zelensky put forward yesterday, saying that basically, and this is echoing some of the Russian talking points, and something we've heard from Trump from time to time, that there hasn't been an election in Ukraine in quite some time. And Zelensky said, listen, if you can guarantee security for Ukraine, get security guarantees from the Europeans and the Americans, we are willing to hold an election in the next 60 to 90 days. So potentially an olive branch there from the president of Ukraine, putting his own office up for sale in these negotiations to try to get those security guarantees from the United States.
Ollie, how's the relationship between Europe and the U.S. right now after some of those strained messages over the last week and a half?
Yeah, Francine, it's hard to get into kind of all the details of it with the sort of national security architecture that was put out by the United States on Friday. Suffice it to say, there are some legitimate critiques of Europe within that from the Trump administration. I think that many will agree that Europe talks too much, does not act enough. That being said, I think saying that basically Western civilization and European civilization is on the sort of point of total collapse and decay is not something that the Europeans would agree with, but it sort of puts them in a very difficult position when they're trying to deal with the Trump administration, not just because of the sort of economic problems they're trying to solve, but with an administration in the United States that's actively trying to promote nationalism and undermine the European Union.
Ollie, thanks so much. Oliver Crook there with the very latest on Europe and Ukraine. Coming up, Bloomberg learns that SpaceX is moving ahead with plans for the biggest IPO of all time. More on that scoop later in the program, and this is Bloomberg.
The key issue right now for us in the diamond space is the declared divestment of Anglo from DBS. And as you know, Anglo holds 85% stake in DBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in DBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Traders await the Fed's latest economic forecast, with the central bank expected to cut for the third consecutive time. The favorite to become the next Fed chair says there's room for a jumbo cut. Ukraine's president says he expects a meeting of leaders with the U.S. president as soon as next week. It comes after Donald Trump chastised European leaders for failing to end the war. And Bloomberg learns that SpaceX is pursuing an IPO as early as next year, seeking to raise $30 billion in what would be the biggest listing of all time. Now, the chief executive of HSBC says structural changes need to be made from the top down when he began his radical restructuring of the bank 15 months ago. Georges El-Hedri says not enough executives were fully accountable for the performance of their businesses. Well, he's been speaking with me for the upcoming Leaders with Francine Lacqua podcast series.
I was definitely ruthless about killing the complexity and the drag in the bank. And I had all my colleagues who wanted to achieve the same. And, we set out to do it. The most difficult part is when you have to separate with some of your colleagues. I think we've been very thoughtful. We've been very considerate. We've done it, hopefully, the right way and the most respectful way for the benefit, ultimately, of the firm and its customers. And everybody, that's a guiding principle, is what do the customers want? They want a bank that moves at their pace. They want a bank that moves fast in a fast-moving world, fast-moving customers. We needed to be agile. We needed to be, to be ready for a modern world. And to be that, we needed to be simple. And therefore, kind of everything then drives what decisions you take from that mission statement. The importance for us is to be disciplined about what we want to do, is to be able to do it at pace, but to do it safely. And it's always balancing how we do it safely, yet moving at pace and with discipline to deliver what we set out to do.
How did the bank become so complex? And again, this is something that actually most organizations have to face as they grow. I guess there's, various factions, or a lot of companies actually could just become much more simple and simplified. What did you see?
Look, I think, kind of back to my engineering days, entropy is a feature. Entropy tends to increase, which means complexity, if you do nothing about it, tends to increase rather than decrease. So things don't become complex by design. They end up becoming complex by lack of focus. So bringing the focus at the simplification will allow you to start dealing with it. That's the first observation. Second observation is you have to be extremely methodical. Again, I'm using a lot of my kind of first principle engineering days. Is like you transfer them and go first principles. What has created the complexity? How can it be addressed methodically? Try to identify ways to be simple. Some of the ways to be simple is to decide not to do certain things, and this is why we exited a number of activities, but to be able to basically build it, if you want, from the bottoms up. The third thing is when you're taking structured decisions, you have to start from the top down. You can't take structured decisions from the bottoms up. Your first principles start from the bottom up. Your structural decisions, your organization decisions have to start from the top down. This is why the first decision structurally I've taken relates to simplifying the group operating committee. We moved from more than 20 people to about 12. More importantly, we moved from 0% single accountability. Everything had dual or multiple accountability to now about 60% of our revenue is generated under single accountability. So that's important. And then the last thing, Francine, is to be patient, because we're not solving simplification overnight. It's going to be a journey, and we have to be relentless at that journey, quarter after quarter, month after month, until we get the desired outcomes. And that journey is still on, we're not there yet.
And you can catch more of our exclusive conversation with the chief executive of HSBC when the new Leaders with Francine Lacqua podcast launches next year. Now, the Fed is widely expected to make its third consecutive cut this evening. Asian stocks were mixed as investors are awaiting clues about the central bank's policy path and its final interest rate decision of the year. Now, joining us now is Alicia Berardi, head of emerging macro strategy at the Amundi Investment Institute. Alicia, thank you so much for joining us. I mean, it seems that everything that the Fed does, of course, will have an implication worldwide, but emerging markets overall, oversimplifying things, are just in a better place than they were 2 years ago. Is that a fair starting point?
Yes, I think this is very fair. Emerging markets have been increasing their credibility premium, let's say. During the last couple of cycles, so on the hiking cycle and then on the easing cycle, emerging market central banks have been acting quite promptly. So central banks start to hike when the Fed was telling that inflation was a temporary phenomenon. Central banks in emerging markets such as Brazil start to cut when the Fed was still hiking. because let's say there are two main drivers here. One is that these central banks have been focusing mostly on their domestic conditions.
Yes.
So inflation and how to rein in the inflation base. Maybe emerging markets are more used to the inflation, out of the anchored, and therefore they were more promptly to act. And on the second side, let's say the emerging markets have been graduating from their kind of external fragility or external vulnerability. They have much healthier reserves levels. They've been rebalancing in terms of external accounts. So that clearly helps in having less exposure to the dollar strength.
Alicia, talk to me about, it's U.S. dollar, right? So it's U.S. dollar appreciation that could maybe change the way that emerging market central banks will be foreseen and what they do next. What are you expecting dollar to do actually next year?
Yeah, we still expect dollar remaining relatively weak. And that clearly is, together with lower or relatively lower U.S. yields, is a very conducive environment for emerging markets investments, even in 2026. Indeed, I think that dollar behavior is one of the catalysts to look at for emerging markets, because we are wondering how the dollar can return to be the safe status asset. And that maybe if the Fed changes completely the path, and then instead of cutting or even remaining on hold, is going to hike. That is completely out of the radar, so we do not expect that happening.
I mean, there's a lot of talk, and I keep on hearing about, there's a lot of Asian trade amongst Asian countries, for example, because of China. Now, the question with China is, are we going to see decoupling, or are we going to see stimulus into 2026? How much does the China story actually change how you see some of the emerging markets in Asia?
Yeah, we've been seeing interesting data out of China on trade, and even some interesting trends on the renminbi. So first of all, trade. Trade is a confirmation of the trends that are there since a while. There is a sort of, let's call it decoupling, even if it's a strong word, because exports to the US have been declining since a while, and exports to the rest of the world are instead increasing quite safely. On the other side, let's say imports are weak, witnessing that domestic demand remains weak. So the story of China is really well caught in that trade balance data. On the renminbi side, the market has been increasing, is more and more convinced that there is some kind of manipulation of the currency by authorities. We really don't buy that. Looking at the fixing, PBOC is fixing, the renminbi on the weak side in the latest days. So that means that there are seasonal factors, dollar weakness, that are supporting the renminbi. But in reality, we don't think that the central banks and the authority wants a strong currency.
If you had to pick a couple of emerging markets where you see the most, interest or value into 2026, how do you break that down?
Yeah, we have to distinguish between asset classes, right? Because on the debt side, for example, on the local debt side, we still like Latin America and Eastern Europe, maybe less Asia. On the our currency side, we like high yields, so sub-Saharan African country and countries like that. While on the equity side, we remain constructive on Asia for an alternative to the IT, let's say, sector, or eventually for valuation reason or other exposure to interesting trends like FDI, commodity. We like even Latin American countries.
Such an interesting conversation, Alicia. Thank you so much. Alicia Berardi, Head of Emerging Macro Strategy at the Amundi Investment Institute. Now, Amazon has more than doubled the amount it plans to invest in India, pledging to spend $35 billion in the country by 2030. Investments will be AI and logistics infrastructure and is expected to create an additional 1 million jobs in India. Now, it follows Microsoft's pledge to invest $17.5 billion in cloud computing in India over 4 years. And Australia's ban on social media for under 16s take effect today, with platforms facing hefty fines if they fail to block young users. TikTok, Instagram, Snapchat, YouTube, and Reddit say they will comply, despite voicing opposition to the rules, while policymakers in countries including Indonesia, Denmark, and Brazil are weighing similar measures for the Lackwet households. I may just make the kids believe that we live in Australia. Now, Bloomberg has learned that SpaceX is moving ahead with plans for an IPO next year, potentially the biggest in history. Sources say it aims to raise significantly more than $30 billion, with the company seeking a valuation of about $1.5 trillion. Let's bring in Bloomberg's Kate Duffy. Kate, this is so exciting because it's such a massive IPO. Like, first of all, why are they pursuing an IPO? And good morning.
Morning, yeah. Thanks for having me on. So SpaceX is obviously one of the biggest names in space right now. It's the company that everybody's talking about in the space sector, and companies are comparing themselves to SpaceX's progress at the moment. So this is really exciting, and SpaceX is also the only company at the moment that can reliably deliver satellites and people into orbit. No other company can do that around the world on a frequent basis as SpaceX is doing. And so some of the funds that they expect to raise from this IPO is going to go into space-based data centers. So there's clear ambitions for growth here with this IPO. You know, they have their Starship space rocket. They have the Starlink satellite internet service, and also the Falcon 9. We're seeing progress through that, and this IPO will just only present more progress for them.
So, I mean, again, it's incredible to just think of how big this IPO would be. I mean, are there some concerns about, you know, first of all, the CEO and who's in charge, and whether they can attract enough capital?
Yeah, there's probably some doubts in the sector. That's still yet to be seen. But as you say, this would be one of the biggest IPOs. They're set to raise more than $30 billion. So this is an incredible amount. And also, they're currently one of the world's most valuable companies at the moment. They're, as I say, making progress with their Starship rocket. This is the rocket that they intend to send humans to the moon and sometimes beyond Mars as well eventually. They're also inking far more deals with Starlink at the moment. That is something that is a very lucrative business segment for them. The likes of British Airways and Virgin have now got Starlink, or will roll out Starlink on their aircraft. So we're seeing, potentially some growth there.
So interesting, Kate. What a story, right? Kate Duffy, they're the very latest on SpaceX. Coming up, President Trump lays into European leaders in an attack on Washington's traditional allies. We'll dig into that next. And this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Well, the chief executive of HSBC says he's ramping up the integration of generative AI into the lender's operations. In an exclusive conversation with me for the new Leaders with Francine Lacqua podcast series, Georges El-Hederi talked about the technology's impact on productivity.
We now rolled to 170,000 of our colleagues internal productivity tools that can materially improve their capabilities of reading documents, reading emails, writing documents, emails, querying, challenging.
It's a dream.
Process. 170,000 of our employees. I mean, soon all the way to the 200,000+ employees. But for the moment that's in the rollout phase, we've already reached 170,000. Of course, I will be monitoring usage. I'll be monitoring super usage. Those will be the most kind of influencing among their colleagues to drive the utilization. But utilization is not optional, because that's how people remain very relevant in the future workforce 5 years down the road. But we're using Gen AI in wealth, we're using Gen AI in markets, we're using Gen AI in contact centers, we're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers, are enabled with Gen AI. The speed at which we're able to patch for, say, code weaknesses or kind of vulnerabilities is 10 times faster already now with coding assistance than it was the case last year. 10 times, and we're not talking
in 12 months.
In 12 months, we're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities in our code. This is hugely transformational. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that are needed for banks? I would say there is no one particular skill that's going to be critical, but it is going to be the ability to learn. Because you can come in a bank coming from an engineering background, from a technology background, from an accounting background, from a finance and economics background. You can even come into a bank somewhat from a different field than directly related to banking. But once you're in the bank, your career, the customer's expectation are such that you're going to have to continuously learn. And if you think you know it all, then there is no place for those in an evolving landscape. It's very important to continuously be ready to learn and put in the hours and the effort to learn something new, a new skill, an additional skill. Today, the most important learning capability is how to best embrace Gen AI and innovation in general.
And you can catch more of our exclusive conversation with the chief executive of HSBC when the new Leaders with Francine Lacqua podcast launches next year. Now, U.S. Senator Elizabeth Warren is asking the chairman of UBS, Colm Kelleher, for details of any discussions he may have had with the Treasury Secretary Scott Bessent over a potential relocation of the bank to the U.S. Now, Warren has asked for a summary of interactions with Bessent and other officials on the topic, including if he'd been offered incentives to relocate the bank. Now, President Trump is seeking to alleviate voter concerns on the economy, saying he believes people are starting to learn the benefits of his tariff scheme. Across the Atlantic, he's escalated tensions, taking aim at Europe and calling its leadership weak. So to discuss all of this, we're joined by Katie Gadini, Associate Professor of Sociology at University College London, and with us here in the studio, Stephanie Baker, Bloomberg senior writer and author of Punishing Putin. So thank you both for joining us. Stephanie, I mean, it's quite shocking. We knew this when we heard J.D. Vance at Munich Security Conference, that actually they were kind of beating up on European leaders. But it was shocking last week to have this paper from the White House questioning then this interview of Donald Trump to Politico. Like, where is Europe right now in relation to the U.S.?
Right, we had it codified, so to speak, in the national security strategy, which came as a surprise. And then Trump doubled down on it in his interview with Politico. It is taking relations with Europe to a new low, I would say. The security strategy talks about the risk of civilizational erasure because of migration and low birth rates. And Trump doubled down on that, saying that European leaders were weak. And that they were blocking efforts to obtain a peace deal in Ukraine. And we saw European leaders this week meet with Zelensky trying to work out a compromise with the U.S. But I think that the real challenge here is that Europe does need to step up. And no peace deal in Ukraine can be enforced without Europe at the table. And they do have leverage. Specifically, they have about $200 billion worth of frozen Russian assets that were mentioned in the first initial 28-point peace plan that was leaked. And I think that's a key issue in the negotiations as to what happens to that. And you now see European leaders trying to figure out ways to indefinitely freeze that pot of money. And that is their leverage.
Katie, where do you see actually the Trump administration at? First of all, what do you see in the polls? And does that influence domestic politics for Donald Trump and also what he's trying to do on foreign policy and with Europe?
Yeah, so right now Trump is looking ahead to the midterms, which will take place next November. There's been fractures within the MAGA coalition in the United States. He's polling really low on approval ratings. And one of the major reasons his voters voted for him was to pull out of foreign wars and end U.S. support for international wars. So there's an immense pressure on him to show that he is putting America first, which is a big reason why he was elected, and to try to boost that approval rating ahead of the midterms.
So what do you think, Katie, each party, both the Democrats and Republicans, need to do in the midterms to give themselves a good chance of winning voters?
Yeah, so I'll start with the Republican side. They really need to focus on the economy, or to show that they're focused on the economy. In my research with Trump supporters, that was the #1 reason they were voting for Trump, is because they believed he would make a very strong economy, and that was a top concern for them. And that's a major reason that a lot of them are disgruntled with Trump right now. They don't feel the economy is any better than it was when they voted for him. So there will need to be a strong, at least, display of focus and care and concern for that issue within the next year on the Republican side, as well as the set of priorities showing that Trump is putting America first. The Republicans are putting America first. On the Democratic side, you know, the party is really fractured right now. Still has not been able to come together and set any sort of cohesive agenda following the dramatic loss in the 2024 election. There is still infighting between a more centrist establishment, kind of old school part of the party, and a younger progressive faction of the party represented by figures such as Zohran Mamdani. And there needs to be some sort of cohesiveness, some sort of way to bring these differing strands into cohesiveness in advance of the midterms.
Yeah, and Stephanie, how does that impact actually what he's trying to do abroad? Because he doesn't maybe want to be as involved, but it feels like he's also involved in absolutely everything across the world.
Yeah, I mean, he promised to bring down prices when he was campaigning, but instead his presidency has been consumed by foreign affairs and the Middle East conflict, and, you know, the end to the war in Gaza, his efforts to end the war in Ukraine, and there hasn't been enough focus on the economy, which is why you saw him give this speech in Pennsylvania, where he actually tried to dismiss the word affordability as, you know, not a ridiculous concept, which I think is in a way doubling down on the sort of message that Biden was giving, was that, you know, inflation wasn't a problem. In reality, inflation is about the same as it was now, as it was when Biden left office. So I think his advisors were trying to get him to focus on the economy, and he kept wandering off script, talking about immigration, all these other things. And so I think the ability for him to focus on the economy is, you know, really key here. And the central issue facing the Republicans is whether or not to extend these affordable care subsidies, which is going to be a huge hit to particularly Republican voters going into the midterms. But the Republicans have not been able to come up with an alternative plan, and they just backtracked on their announcement, saying that they were planning to do that, and, you know, they've just backtracked. They're not going ahead with any concrete proposal. It's a kind of framework.
Yeah, and Katie, I mean, given, you know, Stephanie's good points, who's the group that's most behind Donald Trump right now, and who from his MAGA faction is actually trying, maybe breaking away because of concerns around affordability?
So I'm seeing that a lot of the religious voters, the Christian voters who would probably line up really closely with Christian nationalist beliefs, are still standing behind Trump, and not so much because who he is, but because of what he signifies as a litmus test for a style of politics that is aggressive, that is nativist, and that is emblematic of MAGA. I think some of the breakaways are happening perhaps with voters that aren't as closely aligned to religious nationalism, but are very closely aligned with the America First agenda. But we're also seeing factions, within both of those groups when it comes to views on the Epstein files, when it comes to the prosecution of the killer of Charlie Kirk. So there's a lot of smaller splinters that are showing up right now, and it remains to be seen kind of how big they will grow and across what lines they will really divide.
Yeah. Thank you both for joining us for a very important conversation. Bloomberg's Stephanie Baker and Katie Gadini, Associate Professor at University College London. Now, stick with Bloomberg for comprehensive coverage of the Fed's rate decision. Our special program begins at 6:30 p.m. UK time. It's Fed Day, everyone, so happy Fed Day. Up next, a Bloomberg Brief. They'll have a full roundup of what markets are doing. Then we have a couple of good stories also from corporates. This is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question.
You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life.
I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Treasuries lower as the market looks to this afternoon's FOMC decision for answers on the health of the economy and committee consensus. President Trump is said to be starting the final phase of Fed chair interviews this week, pitting frontrunner Hassad against other contenders. Plus, SpaceX is said to be targeting an IPO next year and a valuation of $1.5 trillion. So let's get to those markets. 9 hours and counting. And honestly, the actual decision that we get is probably the least of it today. Traders will be parsing the language, the forward guidance, whatever Powell has to say, who might be the front runner for next year after this week. We have a lot to get through today. But again, futures treading water before today's FOMC decision. Obviously, we're very likely to get a 25 basis point cut, but how much will labor market weakness play into today's decision and the Fed's thinking going forward? Let's take a look at the bond market because we are seeing yields higher. We're up to 420 now on the 10-year yield, right back up to 481 on the 30-year yield and 361. I mean, yes, these have been tight ranges generally, right? But this is a good 15 basis points higher than just a few days ago. So it will be fascinating to see what we have to hear today. And then, of course, there are some more earnings. We have Oracle after the close today and Costco as well tomorrow. So let's get to some individual equity movers now. Over to London and Valerie Teitel. Valerie.
Good morning, Ivani. Let's start with a check on how the energy race, at least when it comes to AI, is shaping up. GE Vernova really shocking markets, boosting its profit guidance, boosting its dividend, doubling what it's calling for its dividend, and also boosting its profit margins. GE Vernova up nearly 8% in pre-market trade. This is a company that has really benefited from the AI electrification trade. The shares are already one of the best performing in the S&P 500 this year, and the CEO was saying at the investor day yesterday that they're going to generate lots of cash and they're going to have the ability to now play offense. Let's move on to the restaurant space. The shares of Cracker Barrel are in the red this morning, down over 8%. The restaurant chain has now cut its outlook. It is still suffering from the rebranding of its logo that got criticism even from the U.S. president. The restaurant chain is aiming to cut costs and boost some marketing campaigns when it comes to its core customers. Lastly, let's check on Palantir. They have secured another government contract when it comes to defense. The U.S. Navy will be using Palantir services in order to adjust their supply chain to help their production of their submarines, which have been fraught with years of delays and overrunning on costs. So we're seeing shares of Palantir higher by 1.5% in the pre-market trade this morning. Bonnie?
All right, Valerie, thank you so much. Valerie Teitel there in London. And coming up this hour, we're going to count you down to that Federal Reserve decision with Robert Socken of Citi. So futures steady then, yields a little higher ahead of that decision and the outlook for 2026. Let's bring in Bloomberg Markets Today co-editor Morwenna Coniam. Morwenna, what will traders be most focused on today, do you think?
Well, I think the Fed is obviously the key event for today, and it's widely still expected that we will see an interest rate reduction. That's the third consecutive one from the Federal Reserve, but that could be it. What we've really been seeing in recent days is the paring back of those bets on further cuts, and that is being reflected in the bond market today. And in fact, this is a global situation. We're also seeing no more rate cuts really priced in from the ECB, and also actually a paring back on rate cut bets from the Bank of England next year as well. So whilst we're seeing this current round of easing still playing out, there is a sense that perhaps this is coming to an end and markets are adjusting accordingly.
So it's likely there'll be a huge focus on dissent, who dissents, how many people dissent, and what their reasons for dissenting are, Morwenna. I mean, if the labor market is looking a little weaker in the United States and we're likely to get a more, dovish Fed chair next year at some point, wouldn't the market be right to price in more, not fewer cuts next year, at least in the United States?
Well, that would seem to be the case, and that was perhaps how it had been anticipated to be, up until about a week ago. But what we're seeing is potentially higher inflation coming through, and that's something we're also seeing in Australia, and it being mentioned in Europe as well. So the concerns actually about an overheating, inflationary concerns are having to be balanced against that weakening labour market, which I think is really why there is likely to be a lot of dissent, and it depends where people see the biggest risk.
It may happen that we get repricing again after today, but particularly next week, Morwenna, we're going to get a whole batch of data, and it's going to be the freshest data that we've had in a while. Will that affect traders, obviously, going into the last few sessions of the trading year?
Yeah, I think absolutely, and that is one of the reasons why there's so much uncertainty actually at the path currently, because we have had that real dearth of US data. Like you said, coming up next week, we're actually going to get some which is perhaps a bit more useful for making those decisions. So I would expect to see the market paying a lot of attention, to those reports coming out next week as we go into the end of the year at a time when perhaps normally things would be a little bit more settled.
Yep, the 16th and the 18th. All right, that's what we'll be focused on after today, of course. More Iconium, thank you so much. Last night in Pennsylvania, President Trump rallied supporters calling for a new era at the Federal Reserve.
We're checking this. We have a bad head of the Fed. We're going to be making a change. Fortunately, this guy's out. But we have 4 members appointed by Sleepy Joe Biden.
The highly anticipated change is his pick for the next Fed chair. Frontrunner Kevin Hassett weighing in on the upcoming rate decision as well on Fox News.
Jay Powell has done the right thing, which is he's taken the far left people of the board and he's coalesced them around, it looks like, a rate cut, which is the right move right now. I might like a bigger one, but I think that that's what the Fed chair has to do. Don't forget, you're managing a committee. And so getting rates down right now, it's a good thing. There's a lot more room to go.
Joining us now from Washington is Kate Ackley of Bloomberg Government. So President Trump also making some comments on tariffs, Kate, at that rally in Pennsylvania last night. Let's just take a listen.
What's amazing, it's the smart people understand it. Other people are starting to learn, but the smart people really understand it.
I mean, is this a good way to approach voters that are concerned with affordability? Telling them basically, if you don't get it, you're not smart enough, so you better pretend you get it, or at least get it, and that way you'll be smart?
Well, this is part of his, new kind of road show. He started doing more domestic travel again with this trip to Pennsylvania and trying to, address voters' concerns about the high cost of goods and services, the high cost of living. That's something that Democrats in Congress and on the campaign trail are increasingly talking about. So he's trying to build support for the tariff agenda and saying that it's, brought in revenue that allowed him to sort of authorize a bailout, if you will, for farmers who have been strained by the tariffs. So we'll see how this resonates to voters, as you said. But the president has long been a big supporter of tariffs and really is dug in on that.
And of course, as we heard earlier, his frontrunner to be Fed chair says that he would like an interest rate increase and that maybe if it were up to him, he'd do more than 25 basis points, or at least he'd like for that to happen. What do we know about this week in terms of interviews and next week as well?
Well, I mean, you had Kevin Hassett there, the clip earlier. He is seen as the front runner. Bloomberg has been reporting. There are some other people in the mix, also, Fed governors. But I think this seems to be, as of right now, that Hassett would be it's his job to lose, if you will.
Yeah, exactly. So separately, we're hearing now that perhaps Scott Bessent was talking with the UBS chairman about moving UBS to the United States, Colin Kelleher, right? Senator Elizabeth Warren has now requested that those details be divulged. What do we know about this particular story, which is just emerging now?
Well, what Senator Warren is reportedly asking about is she wants, details about any kind of conversations, and has Secretary Bessent or others sort of promised favorable regulatory treatment? Is this, I don't think the term was in there, but what she was getting at is there some sort of a quid pro quo here? Is Secretary Bessent offering favorable treatment in some way for a relocation of headquarters to the United States?
All right, Kate, thank you so much. We'll keep our eye on all of these stories. That's Kate Ackley of Bloomberg Government in Washington. And history potentially in the making. Elon Musk's led SpaceX is moving ahead with plans for an IPO next year. It could be the biggest of all time. Bloomberg learns it aims to raise significantly more than $30 billion, with the company setting a valuation of about $1.5 trillion. Saudi Aramco, of course, currently the biggest IPO of all time. Bloomberg's aerospace reporter Kate Duffy joins us now for more. So will this be an easy path to an IPO? It's supposed to happen towards the end of next year, potentially, Kate.
Yeah, potentially. I mean, SpaceX is the company on everyone's lips in the space sector at the moment. It can reliably and frequently deliver humans and satellites into orbit, and that's what everybody's comparing themselves to at the moment. So we've heard that potentially with this funding, this could go towards some space-based data centers that SpaceX is planning to build up in orbit. And obviously, this clearly points to the plans for the company to grow. And this is something that investors will be really focused on in the coming year or so. It could happen in 2026, that it could also slip into 27. So it's still yet to be seen as to how this could accurately develop.
What about pricing on it, Kate? I mean, obviously we have, the effort to get to $1.5 trillion. Is that just because that would make it the biggest IPO in the world, or are bankers already working on this and suggesting that this is what SpaceX is worth?
Well, it's one of the world's most valuable companies at the moment. So obviously you have the progression that they're making with their Starship launch vehicle. This is the rocket that intends to take humans to the moon and beyond, eventually to Mars. They also have their space-based satellite internet service called Starlink, which is currently creating lots of deals with major airlines around the world, such as British Airways, Virgin Atlantic, and loads of American airlines as well. And you also have the Falcon 9 rocket, and that is the most reliable service they have at the moment, and that is the rocket that is delivering frequently satellites into orbit for themselves, for the Starlink service, but also for other companies as well, such as BAE Systems, that we've seen, a defence company listed here in London.
Kate, I mean, if this does indeed go ahead, will Elon Musk's role change in any way? Will his compensation change? What will we hear?
That's yet to be seen. That still remains very unclear as to what his role will be. But what is clear is that this will change the investment landscape for the space sector in the US. Obviously, space is a huge part of the economy in the US. The US puts a lot of money towards it in comparison to other regions around the world. And obviously, there is this huge competition with China as well. Who's the first person or the first country to get to the moon? And so this is what the US is really focused on at the moment. But as you say, it is all down to the timing. This IPO could happen next year. It could happen in 2027. There's still things that are yet to be cleared up.
All right, Kate, thank you so much for keeping your eye on all of these details for us. That's Kate Duffy there. Now on to other top stories trending on the terminal this morning. ECB Governing Council member Gerimantas Simkus said interest rates do not need to be lowered further after economic activity and inflation both turned out stronger than expected. Investors now see a 50% probability of a rate hike next year, but Simkus and other policymakers say it's too soon to think about rate hikes. Aegon's shares dropped after it unveiled disappointing payouts, overshadowing a confirmation it will move its headquarters to the US. The company will buy back $466 million of its own shares next year. The Dutch insurer, which will rename itself Transamerica, intends to complete the move over the coming 2 years. And Nintendo's shares slid to their lowest since May, weighed down by concerns that the surging price of components will erode profits. Shares of the game maker have declined in 7 out of 8 trading days in December, losing roughly $14 billion in market value. Coming up, we'll bring you our exclusive conversation with HSBC CEO George El-Hedary on the bank's integration of generative AI. That's next. This is Bloomberg.
Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Today, the Fed decides.
There are credible arguments to cut interest rates. Equally, there are credible arguments to do absolutely nothing.
I think the Fed believes that this is a risk management exercise.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
You wonder at this point how much the Fed is between a rock and a hard place.
There's going to be a lot of hyperventilation about this.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Bloomberg Brief. I'm Bonnie Quinn in New York. Wall Street's AI adoption will potentially drive a hiring boom, at least initially. In the latest Bloomberg Intelligence survey, 2/3 of financial services firms responded that their staff numbers will likely increase as they adopt AI. Bloomberg's Francine Lacroix spoke exclusively with HSBC CEO Georges Elhedery on the bank's integration of generative AI and how aspiring financial professionals should prepare.
We now rolled to 170,000 of our colleagues internal productivity tools that can materially improve their capabilities of reading documents, reading emails, writing documents, emails, querying, challenging,
the dream
process. 170,000 of our employees. I mean, soon all the way to the 200,000+ employees. But for the moment that's in the rollout phase, we've already reached 170,000. Of course, I will be monitoring usage. I'll be monitoring super usage. Yeah. Those will be the most, kind of influencing among their colleagues to drive the utilization. But utilization is not optional because that's how people remain very relevant in the future workforce 5 years down the road. But we're using Gen AI in wealth. We're using Gen AI in markets. We're using Gen AI in contact centers. We're using Gen AI, of course, in technology. Now 30,000 of our technologists, engineers are enabled with Gen AI. The speed at which we're able to patch for, say, code weaknesses or kind of vulnerabilities is 10 times faster already now with coding assistance than it was the case last year. 10 times, and we're not talking
in 12 months.
In 12 months, we're not talking some productivity in 5 years. We're talking productivity already here. We're already 10 times faster at identifying and patching some of these vulnerabilities in our code. This is hugely transformational. So you can imagine how important it is. Now I go back to the first part of your question, Francine, is what are the skills that are needed for banks? I would say there is no one particular skill that's going to be critical, but it is going to be the ability to learn. Because you can come in a bank coming from an engineering background, from a technology background, from an accounting background, from a finance and economics background. You can even come into a bank somewhat from a different field than directly related to banking. But once you're in the bank, your career, the customer's expectation are such that you're going to have to continuously learn. And if you think you know it all, then there is no place for those, in an evolving landscape. It's very important to continuously be ready to learn and put in the hours and the effort to learn something new, a new skill, an additional skill. Today, the most important learning capability is how to best embrace Gen AI and innovation in general.
HSBC CEO Georges El-Hedary speaking there with Bloomberg as part of the new Leaders with Francine Lacroix podcast series airing next year. Coming up, Venezuela's Maria Corina Machado will not travel to Oslo to accept the Nobel Peace Prize in person. A look at what's making headlines in your front page news next. This is Bloomberg.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Brief. I'm Vonnie Quinn in New York. Time now for your front page news. First up, the Washington Post is reporting a House panel plans to end its probe into the boat strike that killed 2 survivors of an attack on their alleged drug smuggling vessel. The Republican chairman of the House Armed Services Committee said he'd received all the information he needed. The Post says Democrats, questioning the legality of the killings, are calling for the release of more evidence, including unedited video of the strikes. Next up, the Financial Times is reporting EU countries are trying to fast-track a decision to indefinitely immobilize up to 210 billion euros of Russian sovereign assets. The FT says the hurried effort to pass legislation aims to bypass a potential veto by Hungary's Viktor Orban. The move aims to protect Brussels' leverage in peace talks over the war in Ukraine. And finally, on the Wall Street Journal, Venezuela's opposition leader, Maria Corina Machado, will not collect her Nobel Peace Prize in person in today's ceremony. Instead, her daughter will travel to Oslo on her behalf. The Journal says Machado has spent most of the past year in hiding to avoid arrest. All right, it is FOMC day. Let's take a look at markets. So cross-asset, we have futures really just steady, unchanged, right? We're not that far off records, and we just had fractional moves in yesterday's session, waiting not just for the decision, which is very likely to be a 25 basis point cut, but for the amount of dissents, who dissents, why they dissent, what's the outlook for the labour market, what's the outlook for inflation, and does the Federal Reserve think the fog has lifted at all? Has anything really changed since the last meeting? The dollar index also doing nothing. I did want to point to silver, though. This is a slightly separate story. Lots of reasons why silver is higher again today. It has outperformed gold by 50% this year. Gold, by the way, holding steady. So let's take a look at the bond universe, because that's really telling us the narrative of the Federal Reserve and central banks. We're up another 2 basis points over yesterday's session at the short end and the long end of the curve, 482 there, and we're right back up to 420.74. What is that telling us exactly? Is it telling us that we're going to see a more dovish Fed? We'll ask our next guest, because we're going to be drumbeating to the Fed's last rate decision of the year. Citi's Robert Socken joins us next. This is Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view. As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Here's what you need to know. Treasury is lower as the markets look to this afternoon's FOMC decision for answers on the health of the economy and on committee consensus. President Trump is said to be starting the final phase of his Fed chair interviews this week. He's pitting frontrunner Kevin Hassett against other contenders. Plus, SpaceX said to be targeting an IPO next year at a valuation of $1.5 trillion. So let's take a look at those markets then. We have futures fractionally lower, just very small declines here as we await the decision, but also the news conference in particular, what the Fed chair says about the labour market. And don't forget those weaker JOLTS data weighing a little bit on this market as well. You see it in the bond space too, with yields definitely higher, 362, 420 and 482, so higher across the curve, and we're up about 15 basis points from just maybe a week and a half ago. We obviously have a lot to consider, but it's just about 8.5 hours now before we get that particular decision. So in the metal space, spot gold pretty steady, and silver is continuing to print fresh records. Bitcoin as well, it did push past $93,000. It's just below that right now, so a little bit going on in this market. Let's get to some individual movers now. With that, Valerie Titel is in London. Valerie.
Good morning, Bonnie. Let's start with a check on GE Vernova. They had some very bullish things to say at their investor day yesterday, and the shares are up near 7.5% in pre-market. They have boosted their buybacks, doubled their dividend, and increased their profit margin guidance. This is all in the back of the success around the AI trade. The electrification of the economy means that the products that GE makes are in high demand. We also heard the CEO saying that they are generating a lot of cash, and then it's time to play offense. Those bullish comments from the GE CEO are seeing GE Vernova very much outperform in the U.S. pre-market this morning. To go on to the restaurant space, Cracker Barrel is still suffering from a pullback in sales after the logo mishap earlier this year that even attracted the criticism of President Donald Trump. So Cracker Barrel on a back foot, down nearly 8% in pre-market trade. The restaurant chain has said that they will be pulling back on some of their cost-cutting measures, but they want to target their core consumer with some new marketing campaigns. Lastly, let's touch on Palantir. They have secured a new contract with the U.S. Navy in order to help the U.S. Navy in its supply chains around its submarines. Palantir shares are just up just a touch over 1%. The U.S. Navy has been struggling with years of cost overruns and delays to its new class of submarines, and Palantir contract hoping to fix some of those issues. Bonnie?
Valerie, thank you so much. That is Valerie Titel there in London. Citi's Robert Salkin anticipating further cuts in January and March, in addition to that quarter-point cut, which is widely expected today, with risks favouring even more cuts next year. He writes this: with nearly half of Fed officials sceptical that the cut being delivered at this meeting is appropriate, Powell will be reluctant to signal further rate cuts to preserve some degree of consensus across the committee. I'm pleased to say Robert joins us now. He's senior global economist at Citi. Robert, thank you so much for joining.
Thank you.
There does seem to be this idea that Powell kind of has to go today because the market is anticipating it, and then there's going to be more rate cuts next year, never mind the health of the economy, but simply because people are dissenting in favor of further cuts, and we may get a very dovish Fed chair.
I think in terms of this meeting, given that we have a lot of risks around the economy and not a lot of new data in recent months, given the government shutdown and delays there, I think the best course of action, the easiest course of action, is to follow the path that you were planning on before the government shutdown, which was to ease further at this meeting, and I think you've seen market pricing move that way. I think next year, as you highlighted, our team's base case is that we get a few more cuts early in the year, but that's going to depend on how that data eventually comes in, how the data that's been delayed comes in, how data early next year comes in, and there's a lot of question marks around that. I think you see that in markets as well. Markets are pricing more cuts from the Fed next year, but the timing is very uncertain, and given how resilient growth has been up to this point, whether we get those cuts is uncertain as well.
Why would the Fed chair decide that he was going to go with his feelings about the economy before the shutdown? We haven't had any concrete evidence since, except for some anecdotal evidence from the beige books and, maybe the JOLTS data, but that's really showing, low hiring, low firing economy. It's not literally showing serious weakness in the labor market. And he did say at the last meeting, we're in a fog, we should slow down.
Yeah, absolutely. I think a fog is a good way to describe the environment we're in. And if I had to pick a data point that is really pushing the committee to continue easing at this meeting, it's the unemployment rate, because there's a lot of changes in the labor market.
Which unemployment rate? We don't have any.
Well, in the most recent data that we had, it has been trending up. It is still relatively low, but around 4.4%. That's notably higher than it was at the beginning of the year. And historically, when the unemployment rate starts to move up, if it moves up by a certain amount, it tends to keep going, and that's the fear that's going to keep them, I think, easing at the meeting. Now, not everyone agrees with that. I mean, we're going to have probably a fair amount of dissent at the meeting. We're seeing dissent publicly over the last few months. So it's by no means an easy call. But if I had to pick something, it's the fact that the unemployment rate has been rising that's giving them cause for concern.
Sure, and they have said that, you know, in the past that they were more focused on, well, they've indicated that they were more focused on the labor market. But will the balance of their focus be a little different at this meeting, given that we really, you know, haven't had that much new information on the labor market, and they can't really project from, you know, last September's data?
Yeah, and that's the challenge. And I think Chair Powell is going to have to find some way to pull all of this message together at the press conference. And so I think if we get easing today, I'm not expecting the chairman to really lean in to additional cuts going forward. I think the way that you kind of square that is you say, yes, we are in a fog. We need a lot more data. There's still downside risk to the labor market, but inflation's also elevated. We have to see what comes in. So I think he could be hawkish at the press conference.
Sure. Is there any impetus for him at all to not cut, given that everyone is expecting that the next Fed chair is going to cut more than potentially what they would do?
Yeah, I think on the one hand, I think the data and where he would be with that data supports the view for a cut. On the other hand, yes, we are going to get another Fed chair next year. Most market participants would say probably someone that leans more dovish than Chair Powell and the center of the committee does at the moment. I would agree with that. But there's also a lot of uncertainty about who that candidate is going to be and really how much they're going to be able to shape policy at the Fed, given that decisions are done by committee within the FOMC. So I do think that they're going to be thinking about, well, what has the data been telling us up to this point? And at the end of the day, as you noted, I think push comes to shove, it's really a committee that's going to be more focused on the downside risk to the labor market and on where inflation is at the moment. But as noted, there's a lot of division.
No chance then of an insurance non-cut?
I can't see it. And, you know, I know if we go back to the last meeting, the language was a bit more hawkish than many were expecting. It sounded like they were weighing this more closely. But as you noted, market pricing has really moved to point to a cut today. I think they'd be loath to go against that without really strong reasons. And again, I think the way the data have moved, yes, the economy's been resilient, but there's enough additional weakening in the labor market that I think it supports another cut at this meeting.
You said upside risks to inflation are limited.
Yes.
Even with the fact that we don't know what the impact of tariffs are fully yet, some tariffs haven't even been placed on goods. There's more talk of new tariffs on individual goods. And you're also looking for 3 cuts by March. That's an awful lot of easing into an economy that's experiencing tariffs.
Yeah, exactly. And this is the big risk. We don't know the full effect of tariffs. We're seeing tariffs push up goods prices. Goods prices in the U.S., the inflation there has diverged from goods inflation in the rest of the world. It's been more muted than we would have thought, but you are seeing in the data. And there's a lot of uncertainty, as you said, going into next year. Now, if you go back relative to a few months ago, our inflation forecasts are lower because you're getting offsets in some other areas. So in some services inflation, you've seen more moderation than we would have had. You net all of it out, it's core inflation somewhere near 3%, end of this year, early next year. But I do think the upside risk is capped in terms of that on the one hand, you have that services disinflation. On the other hand, you know, I think as the administration pivots its focus to affordability, there's the potential you could get even some tariff relief next year, which would limit some of that upside. So I do think a lot of risk there as well, but I see more downside risk to the labor market than I do see upside risk to inflation.
Total of 175 basis points of easing since September of last year. What has that done for the economy? Has it propped up the labor market to the extent that it has been propped up?
Well, you know, this is always the big debate, is how much effect does central bank easing have in this type of environment? I think net, it's helpful in the sense that growth would have been softer if we did not have those cuts, but it has been fairly limited, and you've seen that reflected in the labor market, that you see a continued deterioration through the year. I think that points to other factors aside from interest rates that's driving those changes. So net, a positive. But I think another important point is most Fed officials, I think, would argue that despite the easing that we've seen, interest rates are still above neutral. And so if they cut further, they're not bringing it into outright accommodative territory, but they're just bringing it closer to what they think is a more neutral policy rate.
Well, we shall see. In 9 hours, we'll know an awful lot more. Our thanks for his visit in studio to Robert Socken of Citi. Now to other top stories trending on the terminal this morning. SpaceX said to be moving ahead with plans for an IPO next year, potentially the biggest in history. Sources say it aims to raise more than $30 billion. The company is targeting a valuation of about $1.5 trillion. SpaceX's management and advisors are said to be pursuing a listing as soon as mid to late 2026. The U.S. is proposing to require social media checks on visa-free foreign visitors entering the country. The mandate would apply to travelers from about 40 countries. They include Australia, Germany, Japan, and the United Kingdom. The proposal was given a 60-day notice with requests for comment. And China is said to be considering whether to allow its tech companies to buy NVIDIA's H200 chips. The Information is reporting that the country convened an emergency meeting with tech giants, including Alibaba and Tencent, on Wednesday to discuss the matter. It all comes after President Trump's decision to permit their exports to the country. Coming up, President Trump back on the road. More on his rally in Pennsylvania last night as he seeks to reset perceptions about the economy. That's next. This is Bloomberg.
Coming to you live from Kuala Lumpur, the whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa.
New episodes every month, only on Bloomberg.
What's amazing is the smart people understand it. Other people are starting to learn, but the smart people really understand it.
President Trump back on the road addressing supporters in Pennsylvania on his tariff policies. Back with us in Washington is Kate Ackley of Bloomberg Government. So what was he trying to do there, Kate? Change people's perceptions of themselves as smart human beings, or change perceptions of his economic policies?
This is really a kickoff of the midterm campaigns, and this is the president being sort of a campaigner in chief, if you will, heading to, the battleground state of Pennsylvania. Obviously, he's not on the ballot next year in 2026, but Republicans are increasingly concerned about their ability to hold the House of Representatives, and of course, they've got key Senate races in battleground states that they're also, looking at. And this is the president coming in and trying to assure voters that he and Republicans care about rising cost of living and, other sort of bread and butter issues, economic issues.
Right, and he was trying to convince voters that tariffs enabled him to pay support to farmers and also brought manufacturing back to the United States. But I'm not sure how many manufacturing bases have actually provided jobs yet. Are voters aware that there might be a false premise or two in here?
I think voters are looking at what their own costs are, costs of groceries, costs of other things that they do, on a sort of daily or weekly basis. So, he's got to sell them on that Republicans and the administration are doing something to combat, people's perception that costs are high. Tariffs, we've seen a lot of pushback from the business community, retailers saying that, they're concerned about tariffs and that those costs are going to potentially trickle down more to, everyday people.
So the other notable thing that happened yesterday in terms of next year's midterms is that the Miami mayoral race was a loss for President Trump for his endorsed candidate, a win for the Democrats. And, President Trump had flipped that county, had flipped Miami-Dade when he won this time round. How predictive, if at all, is this of anything for next year?
Well, of course, time will tell, but you saw immediately after that election was called, Democrats leader in the House, Hakeem Jeffries of New York, saying, next Democrats will be coming for Republicans who hold House seats in South Florida. So they're saying, they're trying to gain some momentum from this, just like Democrats did in, the New Jersey and Virginia elections in November. So, these are data points. It's, almost a year away. The midterm elections are almost a year away, but everybody is looking for data points. And this is certainly one that the Democrats are going to be using to say that they have momentum on their side heading into the midterms.
All right, Kate, we have to leave it there, but thank you so much. Kate Ackley of Bloomberg Government in Washington. Turning to tech now, a new survey by Bloomberg Intelligence reveals C-suites across industries are experiencing shortages in AI infrastructure, acting as roadblocks to AI adoption. Matt Bloxham from Bloomberg Intelligence, who worked on the report, joins us now. Matt, what were the main findings?
Yeah, so this was the big survey, over 600 C-suite execs involved. As you kind of said there, one of the key roadblocks that people see is the lack of AI infrastructure. I think short term, we've seen that play out with the likes of Microsoft struggling to bring on enough capacity to meet demand. I think beyond that, no big surprise that every board is looking intensely at AI. More than 80% of respondents said it's a top 3 priority for their strategy. I think when you look below that, what's quite interesting is where the emphasis is, and that essentially that the kind of top objective for AI implementation is about productivity. And the second most important objective is sales growth. Looking at jobs is kind of further down the kind of report card.
So are CEOs reporting any kind of improvement in profitability or margins or even efficiencies yet, or is this still just a hope and a prayer?
I think it's an ambition, maybe hopefully more than a hope and a prayer, that on over a 3-year view that the respondents are expecting something like on average a 7% sales growth and a 7% profit growth coming from AI. And I said that's kind of more about operational efficiency. One of the big surprises is that in the near term, most of the respondents, over 60% of them, anticipate over the next 3 years that they'll actually increase jobs as a result of AI, not cut them. On average, expecting a 4% gain in jobs. So there's like investment in the near term to release what they hope is kind of midterm revenue and profit gains from this technology transition.
Matt, what does the report tell us about what sectors are seeing the biggest gains from AI?
Yeah, I think there's some interesting stories there, I think, and it varies a lot from sector to sector. I think pharma, definitely one where we're seeing lots of opportunity to improve drug development. Obviously, the software and services industry, optimistic about the sales opportunities. They topped the outlook in terms of sales and profit growth. And even other sectors like consumer and media see opportunities more on the cost side as they can overhaul the way they deliver products. And certainly in media, kind of deliver content. It's obviously kind of a big topic right now, given everything going on with Netflix, Paramount, and Warner Brothers.
Matt, did anybody, whether it's in the survey or even just anecdotally and in some of the responses, suggest that AI wasn't really doing much for them at all, that yes, they were going to try and wire it into their systems because that's just what everybody is doing right now, but they don't anticipate that it's actually going to, improve efficiencies or anything like that?
No, I mean, I think overall the results show a broad level of optimism about the opportunities from it. I think one of the issues that did come up, though, when we asked about roadblocks and concerns was the magnitude of investment costs and the uncertainty around return on investment. So I think that's going to be a big theme for corporates in 2026, is moving AI projects from pilot to scaling and what the return on investment really is and how long this investment is going to take to pay back. And I think that's crucial for the outlook beyond 2026 for the likes of OpenAI and whether this kind of $1 trillion plus investment is going to pay off.
Matt, why don't we have answers to some of those questions yet? I mean, is it that hard to model out what an AI will do for a company?
I think it is. And obviously, when there's lots of different ways that you can deploy AI in a company. Some are kind of fairly obvious, like kind of customer call centers. I think that's a kind of fairly straightforward payoff. I think when you look, lots of companies are rolling out Microsoft Copilot into their office suites. I think the broad scale benefits of those are less clear, and how much productivity benefit does that deliver to your average employee? What does that then translate to in terms of whether you can cut headcount, or are you seeing incremental revenue opportunity and just kind of general better productivity? I think that's a very complex set of issues for CFOs to work out, and the cost dynamic of how much it costs to implement AI is evolving all the time too, and new models are coming out every few weeks. And so I think there's a lot of moving parts right now, and I think we need some time still for it to kind of stabilize and for the kind of benefits to really become more apparent across the different back office functions in particular.
To paraphrase somebody else relevant today, we are operating in fog, Matt, and maybe we should slow down a little bit. That is Matt Bloxham of Bloomberg Intelligence. Coming up, that Fed decision front and center. We'll get up and set you up for your trading day next. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
Now a look at what's ahead today, or what else is ahead today, I should say. The Bank of Canada rate decision is coming at 9:45 Eastern, and of course, it's the Fed's turn at 2 p.m., followed by Chair Powell's press conference at 2:30. We also get Oracle and Adobe earnings after the market close. Let's take a look at some pre-market movers now. Palantir is higher. The U.S. Navy is partnering with the firm to speed up some submarine production. GE Vernova, an obvious beneficiary from AI, and that's because of power. It boosted its buyback to $10 billion and is doubling its dividend. Cracker Barrel expects sales to fall faster than it previously forecast, and that stock is tanking. This is the macro picture before your Fed decision. Futures going nowhere. U.S. dollar going nowhere. The 2-year yield higher in the last few sessions. That's it for Bloomberg Brief. Surveillance continues the conversation.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We think the setup is really constructive into next year for a broadening in earnings.
There's this element that maybe things could be better, and you have a lot of stimulus coming.
Let's not be complacent and just expect the same really positive performance we've seen so far this year.
If you start to see any kind of degradation in earnings, I would be much less optimistic.
The market tends to discount both good news and bad news fairly quickly.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It's Fed Day. Good morning. Welcome to Bloomberg Surveillance. Stocks looking for direction, bonds finding some, and not in a good way. Yields surging globally, despite expectations for a rate cut at today's Fed meeting, with investors looking to the end of a worldwide easing cycle. And in the United States, economic data keeps showing a mixed picture with a wage inflation report due out today. We get that employment cost index ahead of the Fed meeting, and then Oracle earnings after the bell. All eyes right now very much on bonds, with yields climbing despite some of the assertions from both Fed officials as well as this administration.
And that makes it a bit more of a difficult picture for the Fed. I've read about 4 different takes this morning on why yields are rising. Is it because what's going on in places like Japan, Australia, Canada, we have the end of some of these cycles or potentially some hikes in some of these countries? Is it because there is concern over the deficit? Think about things that are hanging over this economy, whether or not the Supreme Court tamps down on IEPA. Do we get $2,000 dividend checks from this administration in a midterm election year? They're concerned about affordability, and then that money goes out the door once again, and not to bring down the deficit? Or is it because investors are worried about the other mandate the Fed has to worry about, which is inflation? And right now, the bias is on the labor market.
And that seems to be globally what is getting people a little bit concerned in terms of, have we already reached the peak of disinflation? And are we going to lead to the end of a global easing cycle? People pricing in the chances of a Bank of Japan hike, Australian rate hikes, ECB potentially not having any additional rate hikes. Just to put into perspective, the Federal Reserve has cut rates 175 basis points since it began the cycle back in September. A real question here, is this going to be an increasingly politically motivated Fed at a time where gold is surging and people are wondering, whither the dollar?
And also, this meeting particularly is very challenging. We have not had jobs or retail sales numbers for October and November. The Fed is still driving a bit in the fog right now. And Jay Powell is not a dove or a hawk at this meeting. He is a lame duck. And potentially, does it even matter how many dissents we get? And is it going to foreshadow how difficult the path is going to be for whoever the President of the United States puts in as his replacement?
I feel bad that the duck is the ultimate destination, given the fact that it could be a dove or a hawk. Right now, we also are heading into Oracle earnings at a time where that really is the key question. Can AI hopes and dreams continue to support this market? Right now, this market is not finding direction on the stock side. You're seeing pretty much across the board meandering between gains and losses, down about 0.1% for right now. Yields are finding a direction. 4.2% on the 10-year. Globally, 10-year yields at the highest levels going back to 2009. In the United States, the highest levels going back to September. They were at 4.07% at the last Fed meeting on October 29th. What we do see is a little bit of dollar weakness and crude prices rising. Coming up this hour, Julian Emanuel of Evercore ISI with stocks on hold ahead of that Fed rate decision. Erica Najarian of UBS as JP Morgan warns of higher costs ahead. And Neela Richardson of ADP on the state of the labor market as the data paints a mixed picture. We begin this hour with stocks little change as investors await the Fed's last rate decision of the year. Julian Emanuel of Evercore staying bullish into 2026, writing earnings strength, fiscal and monetary stimulus, and a capital market cycle moving into higher gear are laying the groundwork for 750 at year-end 2026. Julian, I am so glad to say, joins us here. Julian, thank you for being here.
Good morning.
So what do you make of the yields rising this morning?
Look, the first thing is we have to step back and understand something, that bond market cycles are very long-legged things, and the 40-year bond bull market ended at the pandemic lows in 2020. And when you think of, and Anne-Marie, you just detailed all of the reasons that yields are going higher, and the answer is yes to every single one of them. You put it together, in our mind, if you think about it, it's almost remarkable that the confluence of the U.S. being the premier destination for capital has actually caused spreads against global bond markets to compress. You know, if you had said to me Japanese 10-year yields were going to be close to 2%, I would have told you at the beginning of the year that U.S. 10-year yields would be close to 5%, and we're not there. But all of these pressures are building, in our mind, towards higher yields.
If we do get a hawkish Fed today, is that going to diminish some of the optimism that you have heading into 2026, or support it, given the fact that the Fed is looking at a rosier economic backdrop?
So that is the question that is really fascinating in our mind, and we're a little bit uncomfortable by this, you know, incredibly staunch consensus that we are going to get precisely a hawkish cut that is going to be bullish for stocks in the near term. We actually think long term it is bullish for stocks because simply it shows that the Fed is cognizant of the inflation problem as well. But the other issue there, Lisa, is the labor market is about as clear as mud. I think whatever, it's not even mud, it's just, it's unknowable right now, and that's really the aspect of the flying blind that is probably going to weigh on markets.
Julian, what unnerves you about the hawkish cut consensus? Is it the hawkish part, or is the fact that people think that is going to be bullish for stocks?
No, it's actually the deep consensus. So what we've seen this year, and our survey team has really been front foot on this, particularly during the government data blackout, is that anytime we've had really, really deep consensus, whether it was going back to that week in April where our clients, 81% of them thought we were either in a recession or it was going to start in the second half, or going back to the end of October when a record 75% of our clients responded in our polling that the next 10% in the S&P 500 was up, and then you immediately had that 5% pullback. That's what bothers us, and the consensus around the fact that this is likely to be bullish. And frankly, if this was any other month than December, it probably would not be as sharp a consensus, but December tends to be a good month for stocks. We think there is potential for surprise here.
Like what? What's the surprise?
Well, look, if you look at last year, you had a hawkish cut at the December FOMC last year, and the market pulled back. It didn't derail the bull market in any way, shape, or form, but it made December an unexpectedly volatile month. And you add in the fact that you're going to get data, employment data, on the 16th. Who the heck ever heard of the Fed talking and then getting the data?
Agreed.
It's just, it's ridiculous.
You're speaking Anne-Marie's language. She's saying, come on, move the meeting so we can actually get that data. It's not just the employment data. It's also a question around the big tech space and exactly what they are doing. I think about John Stoltzfus. He comes in every day singing, it's how you do the things you do. And it's sort of this question around Oracle, which reports earnings after the bell. How much are they, yes, planning for expansion, going to beat expectations, but continue building their debt pile in a way that seems not unsustainable, but potentially a little more precarious when it comes to capital markets?
Yeah, no, and actually from our point of view, the concern around the debt loads of these companies, this one in particular, is quite rational. If you think back to this whole talk about an AI bubble, which we don't believe we're anywhere near the end game yet at all, in AI. But if you think back to the late 1990s, the concern was just a random throwing money at everything, everywhere, without revenues. And in that respect, having a little bit of capital markets discipline around a company that is assuming a bigger debt load is very, very measured. And it shows that people are not losing their heads. But our question is that when those earnings are announced this afternoon, is it more the sense that the AI bubble is going to pop? We think it might actually be more the sense that the fear bubble, as reflected by the credit default swap market, may pop.
In other words, the idea that people are pricing in the highest chance of some sort of default or demanding the highest amount of compensation for default from the likes of Oracle going back to 2009, that might have to diminish. I do wonder the Fed's role, putting these two stories together. What is the Fed's role in lifting the AI bubble? This idea that if the Fed is overly easy, and I say overly based on the economic conditions, what they might warrant, does that lead to an inflation of some of these valuations and, frankly, the debt profiles of some of these companies that raises your concern?
It certainly could. And we have said for the last several months that given this sort of extraordinary time that we're in, where earnings are going to be good, the economy's humming along, even with the questions around labor. But the point is both monetary and fiscal stimulus really do have the potential. We've said there's a 30% chance that you get a full-on bubble next year, which we define as 9,000 in the S&P 500, which I think is also why, on balance, the Fed is trying to remind everyone of the dual mandate in general. But again, the questions around the labor market are very, very intense.
Especially given Joel's data came out yesterday and just added to this confusion given the fact that the headlines number came in pretty well, and then you saw the quits number coming at the lowest pace going back to May of 2020, so choose your own adventure. Is gold telling us something? Because I was looking at the moves since the last Fed meeting, and what stands out to me, 10-year yields, 30-year yields, and gold, up 7% in that period of time. Are we getting a signal there about the path of travel right now in terms of the U.S.'s role, in terms of fiscal dominance when it comes to the U.S. dollar, and when it comes to just going forward, what people think about this policy?
Well, gold has really the last couple of years been a portfolio diversifier. And then from our perspective, you know, you saw what we believe is a reasonably significant dollar top in the first quarter of 2025. So gold tends to trade better on that. I would say, frankly, you know, gold has actually lagged the last month or two as silver has shot the moon. That to us says that there's probably a pause in the precious metals frenzy coming, you know, into 2026.
Yeah, silver prices surging. Julian Emanuel of Evercore, I'm so glad to say, is sticking with us. Yesterday we were talking a lot about how President Trump allowed NVIDIA to sell the H200 chips into China, a reversal. The big question was, if we sell it, will they buy? And the answer is evidently yes. According to Reuters, ByteDance, Alibaba, both of them looking to order NVIDIA H200 chips after we heard yesterday.
And the information said the government actually called in these companies, wanted to sit them down and ask them, what is the appetite? Do you need these chips? And I guess, according to Reuters, the answer was yes. Remember, the Financial Times said they were going to look at this, potentially have a lengthy process on who should be getting these chips. Because, of course, China, rather, they buy the homegrown champions. But it clearly shows that nothing is better right now than what the U.S. has in terms of advanced artificial intelligence semiconductors.
And some meetings taking place in China to discuss the extent of that connection coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. President Donald Trump holding a campaign-style rally in Pennsylvania last night. He told the crowd people are starting to see the benefits of tariffs as his administration tries to address affordability concerns. The president arguing that tariffs have allowed him to provide aid to farmers and force manufacturers to build plants and data centers in the U.S. Meanwhile, White House National Economic Council Director Kevin Hassett says he sees plenty of room to substantially lower rates. Hassett, who is seen as the front runner to replace Fed Chair Jay Powell, says if he becomes head of the Fed, his loyalty would be to his independent economic judgment, which he thinks the president trusts. And SpaceX is moving ahead with plans to go public next year. Sources telling us here at Bloomberg, Elon Musk's company aims to raise significantly more than $30 billion in its IPO. SpaceX is targeting a valuation of about $1.5 trillion, making it the biggest listing of all time if it happens. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, President Trump's economy.
Lower prices, bigger paychecks. Inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Bloomberg's Tyler Kendall and Anna Wong both joining us next from New York. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Christmas tree inflation really on fire this year. It's one thing we were noticing. Question is everything else on fire too when it comes to the inflationary backdrop in markets, looking for direction in the equity space, still hovering near all-time highs and just pushing back from some of the lows in futures earlier this morning. A bit of dollar weakness as we look ahead to another Fed rate cut. That is the expectation, which would bring total rate cuts to 175 basis points since the beginning of the rate cutting cycle last September, and 10-year yields surging to the highest going back to the end of September, 4.2%. Back when the Fed last met, it was 4.07%, a 13 basis point increase since that last meeting. Silver surging to new all-time highs with another 0.7% gain this morning. Under surveillance this morning, President Trump's economy.
The new word is affordability. So they look at the camera and they say, this election is all about affordability. I have no higher priority than making America affordable again. Lower prices, bigger paychecks. $1.99 a gallon. How would you like to have $1.99? Inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Here's the latest. President Trump promoting his economic agenda during a campaign-style speech in Pennsylvania, touting the success of tariffs and saying his administration is bringing down prices. We've got team coverage with Bloomberg's Tyler Kendall and Anna Wong, both in Washington, D.C. Tyler, I want to start with you. What was new that we heard yesterday? Was there any kind of shift in President Trump's tone?
Yeah, hey, Lisa, good morning. Well, this was really part of an administration-wide push to change the president's messaging when it comes to the economy, marking his first domestic policy address since Republicans were dealt a series of election losses last month. President Trump touted his policies, not necessarily anything new, but it was in this bid to address voter concerns around affordability, as polls and data shows sagging sentiment. A new survey released this week by Fox News shows that 76% of American voters view the economy negatively. The president claimed people are starting to understand the benefits of his tariff policies, though did concede that he's gotten a lot of heat, in his words, over the tariff regime. At the same time, though, his aides are really trying to plead with the public that they need to have some patience here, even as we've seen new policies rolled out in recent weeks, everything from proposals of investigations into the food supply chain to actually issuing agricultural exemptions when it comes to certain tariffs. So we're going to have to see how this goes, because Lisa, really, as we careen into the end of the year, it's going to be another affordability issue that is putting pressure on this White House, and that has to do with health care. As we careen into the end of the year, lawmakers are trying to grapple with that deadline for those expiring Affordable Care Act premium tax subsidies.
Yeah, and Tyler, this is a reason why people are having a hard time getting their hands around exactly what the inflationary pressures are. And Anna, I'd love your take on that, given the fact that the Fed feels like inflation is the lesser of the concerns between the jobs market and price stability. What are we seeing, whether it's the employment cost index that we get today at 8:30 or just in general when it comes to surveys about just how much price pressure there actually is?
Lisa, so the short answer is not much right now. So the employment cost index that's coming out, it's likely to show that the employment cost is running about at 3.6% this year. So if you think that the labor productivity is running at about 2%, that means that, you know, productivity adjusted wages is below 2%. So as Powell said, the labor market is not the source of inflation right now. Then we look at goods, which is how common people feel or gauge the price pressure, and what this affordability debate is about. Well, so Chicago Fed President Austin Goolsbee runs a firm, or used to run a firm, that collect online prices. It's called the Adobe Price Index. And basically that index is showing that the November inflation for our goods actually declined by a lot compared to last year. So, and that's the same message we are seeing in our own collection of millions of online prices as well, that November was actually a very low inflation month. Now, being forward-looking, we also look at earning transcripts, which can predict inflation in 3 or 6 months, and that is showing very little inflation pressure in the next couple of quarters.
Thank you so much, Anna Wong and Bloomberg's Tyler Kendall. And I just mentioned Christmas trees, so I went to find out exactly what the Christmas tree inflation was. And it turns out that more people are buying fresh Christmas trees because the price of artificial ones have raised 10 to 15% due to tariffs on China. This according to the American Christmas Tree Association. So that's actually a real phenomenon.
And you can get a Christmas tree right outside your doorstep in New York. They're just on the street there.
Yeah, but they're actually, well, like you mean after Christmas and then celebrate Christmas in January. You can get it for free. Julian Emanuel of Evercore ISA still with us this morning. Julian, how are you looking at affordability issues when it comes to trying to position and understanding exactly which sectors could potentially outperform?
Sure. Well, let's take a step back and recognize how unusual this cycle is, right? Literally, consumer sentiment has been subdued, or worse than subdued, essentially since the pandemic, without any let-up. That's totally unprecedented in an environment where we've never even had the threat of a recession, despite perceptions earlier this year. And so this whole concept of affordability sort of addresses the desire to boost sentiment and really, you know, grapple with the concept that the consumer is feeling K-shaped, the economy is feeling K-shaped, and ultimately the flow-through has been the stock market has felt K-shaped. And from both the demand side, i.e., you know, big, beautiful bill stimulus, potential tariff rebate checks, and then the supply side, reducing coffee tariffs, importing more beef from Argentina. The whole idea is to boost that sentiment. And from our point of view, we think it's a very unique opportunity to own the beaten down consumer names. There's just a lot of consumer names that have been left in the dust in both the staples world and the discretionary world, as people have, you know, perhaps rightly so, concentrated on putting their money behind the AI theme. But we do think, and we've seen a lot of these sort of mid to lower end names report and have very positive price reactions the last number of weeks against the holiday season that's shaping up nicely. And then the last thing is that the tendency for these names, many of which are down in a bullish year, to outperform in the first quarter, the reversion trade, very strong. So we think the K gets addressed by policy and likely shows up in the stock market.
So does that mean you believe in a rotation?
It is part of the story. Look, again, when we think about 2026, this notion that the market can still travel higher without the AI trade leading, we're a bit skeptical about that, you know, but think about it, is we had the government shutdown. Everyone recognized very quickly that they were A, underweight healthcare, and that B, healthcare was the central policy issue around the shutdown. And then we had this massive healthcare outperformance. We think we'll see the same thing in the consumer space.
We're really going to get fiscal juice when it comes to the one big beautiful bill. Now they're teasing out potentially $2,000 tariff dividend checks. This is the same group of people, Republicans, who then criticize the Biden administration for doing just that, sending out checks. Do you think this will also goose inflation? Doesn't that become a more difficult story then to tame for the consumer and for the Fed?
Well, look, if you're going to put more money in the system, you're going to underpin inflation. But I will say when we think about 2025 and thinking into 2026, look, we and most everyone else overestimated the impact on inflation from tariffs. Okay, and so as that continues to dissipate and make its way through the system, the likelihood is the path of travel for inflation does continue down, which again is why, you know, when you think about the course of interest rates next year, there's no set of economic statistics where the Fed will end up hiking rates at all next year. And frankly, the market is very rationally priced for the number of cuts expected next year.
Yeah, watch the dot plot. Do we get the same kind of one cut next year and then one cut in 2027? Does it mean anything given the fact we could get a real change on the Fed's leadership? Julian Emmanuel, always wonderful to see you. Good luck with all of the shopping on all holiday counts. Evercore ISI's main markets maven, who we love speaking to. Coming up, we're going to be speaking with Erica Najarian of UBS on the state of the financials with JP Morgan shares falling by the most in 8 months. Plus, Danny Berger with your morning movers. GE Verona jumping after doubling its dividend. What we're seeing in markets more broadly is just a real kind of sense of malaise. I mean, what is exactly going to motivate anybody to take conviction right now ahead of this meeting?
No way, not ahead of the Fed meeting. And then even after the Fed meeting, there is still feels like one more week left of this year. And that's because we're going to get jobs data next week.
Exactly, which will definitely color things. Right now, we are seeing a real outperformance when it comes to silver ahead of those Oracle earnings. From New York, good morning. This is Bloomberg Surveillance.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're the 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We are close to all-time highs, but not exactly finding direction this morning. Seeing stocks just come off a little bit, futures just touch lower, although they had been down significantly more earlier this morning. A focus on dollar weakness, although 116 is essentially where we were when the Fed last met on October 19th. Here we are again at 116.35. We have been snoozeville in the FX space. 10-year yields anything but. We see 1 basis point increase this morning to 420. On that 10-year, we had been at 4.07 in the last Fed meeting. A real question here about what is driving the global bond sell-off in longer duration notes. We see that across the board in silver, surging to new all-time highs, up 0.5% this morning to more than $60, 3 hours away from the cash open. Here are your morning movers with Danny Berger. Danny.
Hey, Lisa. It's earnings season for some of the big power players, and what an earnings season it is. It's really fueled by the AI boom and the positivity that these companies see to capitalize off of it. GE Vernovia is one of them. They've increased their buybacks, increased their dividend, increased the revenue that they see coming in. In fact, they say that the backlog for electrification for this power player is going to double by 2028. The reaction in share prices is one that you might expect. Shares up 9.4%. Elsewhere in terms of movers, we have a new deal between Palantir and the Navy. The Navy is going to be using some of their platform for their submarines. The deal worth about just under $450 million. So Palantir rallying 1.3% off the back of that in the pre-market. Finally, we had earnings from Cracker Barrel after the bell yesterday, still hurting, at least they say, from the drama over its logo change that changed and then didn't change because of pressure from the White House and other conservative commentators. The results were pretty poor. Their outlook, they're burning more cash than they expected. They're trying to cut back on expenses. Foot traffic fell 11% through this most recent quarter. The CEO saying that a recovery will take some time. Of course, it's not just the logo drama. It's also just the pain for a lot of these more kind of casual restaurants. So those shares down almost 8% in the pre-market, Lisa.
Thank you so much, Danny. All about the logo. Come on, and forget everything else. On our radar this morning, the race to replace Jay Powell heating up, according to multiple sources. President Donald Trump is interviewing Fed chair finalists this week. Wasn't he doing it last week? Well, the Financial Times saying Kevin Hassett remains the front runner. Meanwhile, Oracle set to report quarterly results after the closing bell. Investors looking for an update on the health of its cloud infrastructure business and proof that the future of AI computing is sustainable. And Chinese tech giants Alibaba and ByteDance reportedly eager to purchase NVIDIA's H200 chips. This is important. Reuters reporting the tech giants have spoken with NVIDIA following the reversal of the export restrictions. We heard that yesterday from President Trump. The information also reporting that Chinese officials held an emergency meeting with tech giants earlier to assess their chip demand. So will they, if we sell it, will they buy? The answer seems to be yes.
Yes, it is definitely yes from the C-suite of these companies like Alibaba. It seems like they're just waiting on that final green light from the Chinese government. Remember, the Chinese government told these firms to shrug off the H-20 when the U.S. lifted that export control. That was the chip NVIDIA designed specifically to sell into China. China said, no, we want the top level. We heard Jensen Huang talk about this recently, saying China does not want a depreciated chip. They want the full advanced chip. And now it looks like they're going to get it, and the appetite is there.
Yeah, this is what people are tracking to understand the tit for tat in the battle for AI supremacy between the U.S. and China. Looking for the battle of supremacy in the media space, the battle for Warner Brothers Discovery showing no signs of letting up, the company not planning to cancel its agreement to merge with Netflix, putting the ball in Paramount's court as it weighs the next steps. Bloomberg's Geeta Raghunathan joins us now. It seems like this is truly going to be a battle with Paramount appealing directly to shareholders. How much do you expect them to increase the share price that they offer?
Yeah, I think they definitely have to sweeten their bid at this point, Lisa. So the $30 per all-cash bid that they offered for Warner Brothers Discovery, and this is for the entire company, this is something that they had submitted last week to the board, the Warner Brothers board, and the Warner Brothers board obviously had rejected that and gone for the Netflix offer, which is a slightly different offer. It's just for the streaming and the studio business. So everything really right now hinging on the cable network business, which Paramount values at about $1 a share. We think it's worth much higher. I think the Warner Brothers Discovery Board also thinks it's much higher. So as far as we are looking at it, we think that they have to at least sweeten their bid by $1 or $1.50 per share for it to really kind of move the needle with the Warner Brothers Discovery Board.
And just to put into perspective, Geetha, Warner Brothers has no incentive to cancel the agreement with Netflix because they would be on the hook then to pay a pretty hefty fee, correct?
They would have to pay $2.8 billion of a termination fee if they decide to cancel. And I don't think it makes sense for them right now because I think they also value the company slightly higher. That said, I mean, this is, at the end of the day, Lisa, I mean, Warner Brothers Discovery, David Zaslav really wants to see his assets bid up as much as possible. So, you know, if we're looking something at like $34, $35 a share, I think that's where he wants this bidding war to, you know, kind of end. So we'll have to wait and watch, see what happens.
Who doesn't want that? Geetha Ranganathan of Bloomberg Intelligence, thank you so much. Turning to financials, especially as we get this surge of deals, JP Morgan shares dropping by the most since April after warning of higher than expected costs. The bank saying compensation, marketing, and AI investments are driving up expenses. Erica Najarian of UBS has a buy rating on the stock, a price target of $357. And Erica joins us now in studio for more. Erica, wonderful to see you. Thank you for being here.
Good to see you.
Before we get into that, the idea of the emphasis on increasing costs, how much can that supersede the idea that we're embarking on an M&A boom that we were just talking about, as well as potentially a surge in IPOs?
It's a commoditized business, right? So there's actually nothing that JP Morgan does that's special versus peers other than execute, right? So the talent needed to close those deals, the investments needed to, you know, be very competitive with American Express Platinum, with, you know, Chase Sapphire Reserve, that all costs money. And, you know, what JP Morgan has shown us really, you know, over the past 15 years is they've been the heaviest grower of expenses among the banks, but they've also had the best revenue growth and the best returns. So I'm not worried. I think this is a timing thing with JP Morgan, and they'll give us the revenue number in January. But I bet you that most of the banks next year, and we got some indication yesterday from a regional bank that said they were also growing expenses heavily next year. It's going to be a year of saying, we have deregulation, we have a good revenue backdrop, possibly a very steep yield curve. Why not invest for the future?
Well, this raises this issue of more broadly in markets. Are we seeing companies get penalized for spending on AI versus earlier this year when companies couldn't spend enough and they were rewarded for that investment with the expectation that it would bring efficiency and better execution? Is that something that's a momentary blip or something that you see lasting in the financial space?
I think it's a momentary blip, and I'll tell you why. We actually had a meeting, I think 4 weeks ago now, with the head of AI at JP Morgan. And what she said really opened my eyes. She said, guys, you're all asking me about ROI on AI investments, but what's the ROI on internet access? What's the ROI on having a PC? So what she was saying is that AI at the desktops, or in terms of how, you know, bankers go about their day, is going to be table stakes for the industry. So I think it's a momentary blip, especially since a lot of investors seem keen on the idea, on the theme that AI could lower costs meaningfully for financials.
That's what I wanted to ask you. Wells Fargo CEO yesterday was talking about how artificial intelligence can actually be the reason to bring down costs. But when actually could we see that if right now you're hearing from the likes of JP Morgan that they're actually spending more?
Well, I think we're in the cycle where you're not really going to see it quite yet, and we don't quite know where it's going to be improved productivity or actual costs getting cut. Remember, we're in a regulated industry, and so, you know, I doubt any of these banks will all of a sudden, you know, cut 30% of their call centers and replace it with agentic AI, you know, only to have the AI technology technology, have a hallucination, and all of a sudden, you know, your grandmother is in structured credit and crypto, right? So
hallucination, but carry on.
Hallucination, yeah. Exactly. But my point is that it's a regulated industry, and I don't think the regulators are as advanced as the banks in understanding, and so they have to tread carefully. So while that's an opportunity for certain parts of the business over the long term, I think we're going to go through a period of you have to spend money to be able to, you know, be at the top of your class with regards to having this technology for your employees.
You mentioned deregulation a few times.
Yeah.
How do you actually see the deregulation working in real time? What are you expecting in 2026 that maybe we didn't get from the Trump administration in 2025?
Yeah, so perfect example, you know, because this was rooted in law with the Chevron case, the stress test had to change immediately. In fact, it was a Biden Fed that's, you know, self-started this in December of 2024. So all the banks got great results in June, and all of a sudden, and again, part of this is the market demand as well. I mean, trading revenues just went off. Right, and there was actually more balance sheet-driven trading revenues as well. So banks were, you know, taking more risk. So that was the more immediate impact. On Friday, there was a leverage lending limit that all of the federal agencies pulled. A lot of the regional banks have been saying that that was been a big catalyst for lending from banks really going away to the non-banks, right? And so that being pulled will be, you know, a big immediate impact for next year. And of course, you have all the capital, you know, the leverage ratio, the G-SIB surcharge, you have all that on tap to be regulated. And what that really means is that there's more balance sheet for markets, but more importantly, more balance sheet for Main Street.
I'm thinking right now of a $59 billion bridge loan from Wells Fargo, BNP, and HSBC for the Netflix bid for Warner Brothers. I'm just wondering how much this expansion, effectively, of their balance sheet is going to help fuel what we're seeing in M&A and IPOs, with the pace really heating up and financing seemingly plentiful.
Market is near all-time highs, spreads are at all-time tights, and, you know, bank balance sheets, even before you redefine capital, I mean, they have plenty of room, right? I mean, they have been losing direct lending to non-banks for quite some time now, so they have plenty of room. And so I guess it sets up pretty well for, you know, a pretty nice, I was going to say the word frothy, but who knows, for a frothy 2026. It's like giving, you know, sugar to your kid, right? Maybe he'll stay awake for a while. I don't know how long the economy will stay awake for, but it makes sense. We have the midterm elections coming up. And I'm sure that this administration will put lipstick, contour on this economy to get it through the finish line, right? And the president started to talk about make affordability great again. So I think we're starting. He talked about the tariffs checks. So I think it's going to be, you know, a big year for increasing demand for bank balance sheets.
I'm feeling the holiday evening, putting on makeup, giving the kid hot cocoa, seeing them go absolutely bonkers. But then they crash.
Exactly.
And that's exactly what I was going to say.
Yep.
That essentially you're building risk, you're building the frothiness, you're building the excitement, and they haven't taken a nap. So at what point do you get worried about the other side?
Look, I mean, I use the sugar analogy very precisely, right? I'm a mom. Look, I'm a little bit nervous. Like, we have been, like, pumping this economy, and obviously we're seeing a little bit of, you know, fraying at the seams. The unemployment picture is not fully bright, right? We have, you know, white-collar layoffs that you guys have announced at various points over the past quarter. You know, you have a real struggle with university graduates finding jobs. And of course, you have, you know, government jobs being reduced. So, you know, I mean, again, we could put the lipstick and the contour and the Band-Aid in the economy, but underneath the surface, like, what's going to happen? And with, you know, the tariff policy, right, the consumers aren't feeling it, but if you have thinner margins at companies, that means that, you know, that's not going to be great for hiring. And, you know, credit quality is going to be, is the end all be all in bank stocks, right? So it's, everything is fine in 2026, but, you know, is there a nap? Is there a crash that's going to happen in 2027? You know, let's see. And it's going to be very important who we have in the Fed, at the Fed, in terms of policy and credibility with the bond market.
Erica, thank you so much for being with us. Wonderful to have you, as always.
Thank you.
Erica Najarian of UBS, and good luck in the holiday celebration. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa.
Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom from AI fails to consider how many people will be able to afford the additional goods produced. Meanwhile, Amazon making a big investment in India, the company pledging to invest $35 billion in the country over the next 5 years. In a statement, Amazon saying it will invest in areas such as AI and logistics infrastructure, helping create an additional 1 million jobs in India. And Australia begins a ban on social media today for anyone under 16. Platforms are facing hefty fines if they fail to block young users. TikTok, Instagram, Snapchat, YouTube, and Reddit say they will comply despite opposing the rules. Policymakers in countries including Indonesia, Denmark, and Brazil are weighing similar measures. That's Bloomberg Brief. Lisa?
Thank you so much, Yahira. I thought this was fascinating. I am actually really looking forward to see exactly how effective this is, although I heard that Discord downloads actually just went off the hook for people who are preparing for their summer vacation out in Australia.
Well, when it comes to what social security concerns for teens that are dealing with things like TikTok, you're seeing this on a state level, actually a lot more pressure, especially from parents, putting on the legislator or governors to do something about it.
Yeah, definitely something front and focus. Meanwhile, talking about the Federal Reserve, up next, balancing the dual mandate.
Central banks are getting to the end of their cutting cycles. From here, it's going to take further weakness in the labor market to get them to move a lot more.
Neil Richardson of ADP joins us next as we take a look at the labor market. Globally, you're seeing bond yields surging to the highest levels going back to 2009 in the United States. 10-year yields at 4.2%. This is Bloomberg Surveillance.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Kind of meandering around. It was a Santa Claus rally that just got stalled out ahead of the Fed meeting. Right now, really seeing just a touch of losses across the board. S&P futures lower by 0.1%. NASDAQ underperforming, down 0.2% in pre-market trading. If you take a look at 2s, 10s, and 30s, the action has been and continues to be at the long end of the yield curve. That's where you're continuing to see a sell-off on the price, an increase in the yields with 10-year yields at 4.20, 30-year yields at 4.81%. The 2-year yield back on October 29th, when the Fed last met, was 3.6%. Guess where it is right now? 3.62%. Has not moved. It has been a yield curve steepening ahead of this central bank meeting. Under surveillance this morning, balancing the dual mandate.
The U.S. labor market is soft right now, relatively weak, you might even say. Our view is that as you move through 2026, it looks stable, resilient, even improves as it goes along, and that's what's going to determine the Fed cutting path. From here, it's going to take further weakness in the labor market to get them to move a lot more. Central banks are getting to the end of their cutting cycles, so that's something that investors have to really make a big call on for 2026.
Here's the latest. Investors weighing mixed signals from the labor market as policymakers gear up for the final Fed rate decision of the year. Neela Richardson of ADP highlighting the warning signs coming from small businesses, writing small employers historically have been a bellwether for the macro economy. The pullback in small business hiring has led to large losses for the labor market as a whole. Neela joins us now. And Neela, wonderful to speak with you, especially given the lack of clarity everywhere else. Yesterday's JOLTS data was a mystery wrapped in a riddle, depending on which angle you looked at it. Why are you taking such a signal from small businesses?
Because they're the engine of growth for the economy. I mean, if you look at the very smallest firms, 4 in 10 workers, U.S. workers, work in those firms, and those are firms with under 50 employees. And if you even go up to 250, you have 3/4 of U.S. employees working at those firms. So we watch the headlines from the big companies, but the hiring comes from the small ones. And they're more vulnerable to macroeconomic conditions, whether they're to the downside or to the upside. So these are the firms that are going to signal progress. It's the small firms. When they start hiring broadly, that's when we know that the labor market is not only resilient, but dynamic, which is what we need for an AI future.
Neela, is the small business indication that you're seeing in markets right now a forward-looking indicator, a backward-looking indicator, or a coincident indicator, given the fact that people are looking for visibility not to the end of this year, but into 2026?
Yeah, so market small firms and small cap is a little different than the mom and pop stores that we were tracking in terms of the labor market. I think what we're seeing in the markets is a very strong upward movement led by tech firms. But for the small firms that I'm talking about, the ones that you buy like your paper towels from at the bodega in New York City, they're not represented in the markets. And that's why it's so important to keep a mindful eye towards the hiring rate. If you look at that JOLTS report, there was a lot of attention to job openings. My eye was laser focused on the hiring rate, which stepped down from September to October. And Lisa, this is where the metal meets the road, because it's not just about 1 month. It's about the frequency of pullbacks on Main Street whenever they feel some turbulence on the macro side.
When it comes to those small businesses, could a likely Fed rate cut today help?
It could help. It's not going to help immediately. It could help because small firms get their financing from banks. And so rate cuts lead to loans that are cheaper, which means that they can expand their companies and their hiring count. But that doesn't happen overnight. It doesn't happen in a month. It doesn't even really happen in a quarter. And so if you take a long-term view on those rate cuts, they do hit Main Street, but with a lag, long and variable.
You also mentioned the JOLTS data. October job openings, I know, did get a lot of fanfare, but it's because it increased the highest level in 5 months. That is good news. Where exactly are those openings?
Yeah, we're seeing some good news actually as well in our weekly NER Pulse report that we released yesterday. We saw an uptick in hiring for the week ending November 22nd. So it rhymes with some of the better news in terms of job openings. But if you look at where hiring has been strong, even for small firms, actually only for small firms, it's been in healthcare. That has been the key to unlocking the labor market. And I would expect overall, even with the JOLT signal, that healthcare would be the industry that will be doing the lion's share of the work for the labor market.
Neela, I know that you've been doing some work with some Stanford researchers on artificial intelligence and the ramifications for the labor market. Howard Marks, in a memo yesterday, came out and said that artificial intelligence was terrifying for the labor market in terms of some of the destructive capabilities, removing the need for certain jobs. Are you seeing that increasingly used as an excuse? We always kind of take your temperature on this, but what's the latest on that front?
Yeah, we've seen some AI impact on early career. Stanford researchers, the Stanford Digital Economy Lab looked at ADP data and they were able to slice it by demographics. And you're seeing a slowdown in AI exposed occupations like software developers when it comes to young college graduates, the 22 to 25-year-old range, but not for tenured workers. And I think that's very important to keep in mind. Look, technology, automation, and displacement is not new. It happens with every productivity cycle. What could be new for AI is making mediocre performers great and making great performers thrive and excellent. And that's kind of what the data is suggesting right now. Even this early data, it is increasing employment for tenured workers. And other research that Stanford has done shows that in an increase of low performers to higher performing standards. So we're still in the early part of this boom. And if AI fulfills its promise, it's not just going to automate, it's going to create. And it's going to create something new, unique, and different than what human creators can do.
Love the optimism. Neela Richardson of ADP, thank you so much for being with us on this pre-Fed morning. And really, this is going to be the focus, right? How much is structural? How much is cyclical? Are we seeing lagging indications of weakness? Or is this something more pernicious as we change in terms of technological leadership?
And I'm really glad you brought up that Howard Marks blog post, because he talked about these promises that potentially some billionaires on coast having all this money, making this technology that puts millions out of work. And what does that mean politically? I already think we're seeing that. And that is why we continuously be in this populist wave. And how does the Fed address AI-induced labor cuts? You can't.
Right, which is something that they've talked about in terms of, do you see at least an increase in productivity? Coming up next, Chris Harvey in his new seat at CIBC, Sarah Bianchi of Evercore ISI, Lindsay Piegza of Stifel, and Tony Rodriguez of Nuveen as we await that Fed meeting that concludes later today. This is Bloomberg Surveillance. Good morning.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Now, would you say, when you look at your career, that the pivotal moment was actually that meeting with Robert De Niro? It took him 4 years to convince you to open a restaurant near him. You eventually did, and that started a partnership that has lasted through the decade.
You know, I met him 1988 after my first restaurants opened. He asked me to come to open the restaurant in New York, and beginning, I didn't know what he did.
You didn't know he was an actor?
No, I don't know. What he doing? Because I never watched the movies. You know, I was traveling the business. But of course, after, people, hey, no good, so you must know him. And then I understand.
How is he as a partner?
He's, for me, and a great partner. He understands to my concept. He supports me 100%. But he's a very smart people. Sometimes, so strange idea, but it's good idea. So, example, Nobu Hotels, idea come from him. He said, hey, Nobu, so we have a lot of new restaurants coming in somebody's hotel. For him, Doesn't make any sense. Then we start to Nobu Hotel in Las Vegas 11 years ago. Now it's a big success. So next step is the residence.
We're coming to you live from Kuala Lumpur. The whole world is
The
here.
APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance. Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
We're in a process of normalization of interest rates.
We also anticipate further rate cuts in the coming year.
The market's been pretty anchored to sort of having the year-end target range kind of around 3% at the end of next year.
The rate cuts are baked in as far as the yield curve, shows you.
We don't think the Fed should be cutting rates at every meeting from now until next June.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on this Fed day. Stocks looking for direction. Bonds have direction. They're going down. Yields surging globally despite expectations for a rate cut at today's Fed meeting, with investors looking to the end of a worldwide easing cycle. And in the United States, economic data keeps showing that mixed picture, the mystery in the labor market. Wage inflation report due out today around 8:30 a.m. Oracle set to report earnings after the bell, with a real question about how much AI can keep bolstering expectations.
And one portfolio manager that owns Oracle says their neck is sticking out because when they announced this massive debt deal, their stock fell 33%. 3 months ago when they reported earnings, it was one of the best days they had. Shares absolutely ripping. Now everyone is concerned because there are still fears in the AI bubble and the fact that all of these companies are tapping the debt market, and then there's a lot of questions about the circular financing of all of it. You can have my chips, I will invest in your company. Doesn't make a lot of sense at this moment. 2026 is going to be huge for this trade.
Yeah, and this is a reason why I keep thinking of John Stoltzfus this morning, who comes in, the biggest bull on Wall Street, singing, "It's the way you do the things you do," because ultimately it is about the debt side of things. In the debt side of things, it really is bonds front and focus this morning ahead of that Fed meeting. Torsten Slok put out a note this morning from Apollo saying a mystery in fixed income. The bottom line is that the yield curve continues to steepen, and investors across all asset classes need to think about why, as we do see the biggest sell-off, yields rising on the 10-year denomination globally to the highest level since 2009.
And anytime I started talking about the deficit this morning or potentially other concerns about inflation, a lot of people are saying, no, this is a global problem. The United States may be done with the easing cycle today, or maybe just one cut next year. You have Japan preparing for a hike. You have to look at what's going on in Australia. The ECB is not hiking anymore. And this is just a global phenomenon, has nothing to do with what's going on in the United States. Time will tell.
Yeah, this is a reason why people are looking at the reaction to the Fed meeting that kicks off in terms of rate decision. We get that decision at 2 p.m. Eastern time. At 2:30 p.m., we get the duck, the lame duck, coming out, Jerome Powell. Although, is he, right? This is really going to be the key question as he takes the helm of this press conference at 2:30 p.m. Eastern in Washington, D.C. How much clout does he still have on the Fed committee, given the fact that he has a good degree of respect at this point? And then after that, we get Oracle earnings. Get a sense and a read, as Anne-Marie was talking about, of just how much people are getting tired of the debt-fueled cycle. Coming up this hour, don't miss this. Chris Harvey of CIBC going risk on into the new year. Sarah Bianchi of Evercore as President Trump tests his affordability message. And Lindsay Piegza of Stifel as Fed Chair finalist Kevin Hassett pushes for a bigger rate cut. We begin this hour with stocks stable ahead of the Fed decision, as well as more tech earnings. Chris Harvey, head of equity and portfolio strategy at CIBC, writing, "We expect risk on into 2026 and do believe we see a 7 handle on the SPX before year end." Chris joins us now from his new seat for more. Chris, wonderful to see you. Thank you so much for being here.
It's good to be back.
Congratulations.
Thank you.
So let's just talk about heading into next year, the role of the Federal Reserve in this, because it is Fed Day. How much is it crucial that the Fed does keep easing at a time where there are increasing questions about the capacity to do so?
That's a tough question because we're in the transition, right? And so let's just talk about today. There's a lot of thought that this is going to be a hawkish cut, that Powell's going to come out, cut 25 basis points, and throw water on the belief that we're going to have any more cuts. I'm not really sure, even if he does that, I'm not really sure the market believes that because the candidates that are coming in are a lot more dovish than that. So I think we walk through that. I think the market believes that we're going to have a dovish Fed, more accommodation in 2026. So I'm not too worried about things right here, right now. The other thing, I think Powell will probably go right down the middle. He'll say we're data-driven. Right? He's not gonna lean one way or the other. He'll just say we're data-driven and leave it at that. So that's one of the reasons why I think in the short term we're still in a risk-on type period. But in 2026, I think we're going to have a lot more flare-ups in risk. We'll have a lot more bouts of risk aversion. In 2026 or the first half of 26, it's really about risk mitigation and trying to keep up with the market, but really protect to the downside.
What risk mitigation is most necessary? The risk of overheating AI's valuations or the risk of a U.S. economy showing some signs of strain?
Not so much about the U.S. economy. It's really the return to risk is exceptional this year. And it's right across the board. If you look at IG credit spreads, they're at, I think, 77 basis points. We haven't seen that coming into a new year since 2005. If you look at the return to risk, the S&P high beta index is up 34%. And we expected that post-Liberation Day, but not 6 and 9 months later. And so what we think is the bid for risk has gone a little bit too far. And when we turn the calendar, what you're going to do is you're going to reset risk budgets. You're going to have a lot more concern about the Fed. You'll have perceptions about the economy go. And so as a result, we'll see more bouts of risk aversion. We'll see more spikes in volatility. But at the end of the day, we still think there's still upside to be had.
You say the wild card today is Oracle, and you're really watching that for risk.
Yep.
Is that going to paint the tone for the rest of this AI trade?
No, so it's funny you say that because if you look, and there's been a lot of talk about the paper that's been sold, right? A lot of hyperscalers have issued paper, but if you look at Meta, Google, I think it was Amazon, all that paper is trading better than when it was issued. Oracle's off its wides, but still wide. And so what it's saying is Oracle's over here and the other hyperscalers are over there. And so, yes, it's a wild card because it's such a big risk at this point in time and all eyes are focused on it. But if you look at the broader market, the broader hyperscaler market, it actually is performing pretty well. And the market's not that worried about it. It's more idiosyncratic.
So when you say there's going to be volatility in 2026, 2025 was all about policy uncertainty in Washington.
Yeah.
What is 2026?
Well, I think the first thing, maybe I'll throw out a phrase, it's about the corporate collar, right? So at the beginning of the year, what do? You issue guidance. It's been a great year for a lot of stocks. A lot of stocks have done well. So what am I going to do? What makes sense? I'm going to manage expectations down. So that's one area where risk may come in. We're having a transition with the Fed. We don't really know how that transition is going to go. It's long. Usually the Fed transition is at the beginning of the year. This is not until May. Leaves a lot for interpretation. And then lastly, expectations for the market for stocks are increasingly high. At the very least, that perception can change or that can disappoint. So there's tons of area where you can get more volatility next year.
Do you believe in the rotation trade, which is something that everyone seems to be talking about?
A little bit. What I'm thinking is, we were going around the desk. Hey, what's the contrarian trade? What's the non-consensus trade? And the non-consensus trade is everyone says it's the rotation, but suddenly it's become the consensus trade. So I'm a little bit worried about it. What I'm also saying is there's been a lot of talk of bubble, but when we go back and we look at things, the banking sector and JP Morgan has outperformed large swaths of the technology sector over the last 3 and 5 years. And so where the consensus trade seems to be in financials at this point in time, not so much across the tech sector, believe it or not.
So this really goes to the heart of a question of how much is this market dependent on Fed rate cuts? The rotation trade is, to some degree, the idea that that will help bolster some of the more cyclically facing areas. How much is the tech sector also very much beholden on an accommodative Federal Reserve?
I would say it's helpful, but the bigger issue is credit spreads. At 77 basis points, if credit spreads start to widen significantly, that's going to take a lot of risk off. That's going to reprice risk, right? We'll continue to debate whether the Fed's going to cut, how much they're going to cut. Yesterday, it looks like Hassett put 50 on the table. Again, perceptions are going to swing wildly, but really keep a focus, keep an eye on what credit spreads are doing. They're really tight, right? They stay that way, things are okay, things are fine. They start widening out, that's where we have the real problem.
So a question about cockroaches. I'm sorry to bring it back up. It's always kind of unfortunate this early in the morning, but we did see First Brands, which did become insolvent, already run into more trouble. The idea that loans are selling off once again with further questions even after some of the rescue financing. Is this a one-off, or does this indicate sort of loose standards and oversight on the part of lenders, even when it comes to known troubled names?
Yeah, I'll throw out an old phrase. I think there's been too many dollars chasing too few assets, and we have gotten a little fast and loose in certain things. The First Brands looks more idiosyncratic than anything else, but yeah, should you be concerned? Absolutely, you should be concerned. But when we look at the broader market, when we look at high yield and IG, it's performing quite well, and there's still a ton of liquidity there. So we're not worried about it just yet, but we are on, let's just say, we're waving the yellow flag. We're being cautious.
Between now and the end of the year, what do you need to know to get a year-end price target for 2026 in the works?
Well, what I need is a little bit more time. It's been great at CIBC, but it's a ready, fire, aim type situation. So it's been go, 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 and I really just need a little bit more time. That's all.
Right now, yeah.
Yeah, so you don't need actually any answers in the market, just some more time to digest it all.
That's it.
So I'm just wondering, just to finish up here, how different is it to work for a Canadian bank at a time of some pretty fraught relations between the U.S. and Canada?
You know, it's really interesting because you hear both sides of the commentary and both sides of the narrative, and I feel a lot more informed at this point in time. Also, you have a broader view of what's happening, a more holistic view. So for me, it's a lot more informative. I feel like I understand the situation, the issues much better. And because the information is coming from both sides of the border, right? Some things the Canadians see and know a little bit faster. Some things the U.S. see and know a little bit faster. And I'm in a great seat to really understand that and digest it.
Chris Harvey, so good to see you. Congratulations again.
Thank you.
Chris Harvey of CIBC, and happy holidays going forward. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Chinese AI startup DeepSeek was found to have used NVIDIA's top-of-the-line Blackwell chips in the development of its next major model. Sources telling the information that the chips were smuggled into China through a scheme involving Blackwell chips delivered to servers in other countries before being dismantled and brought into China. Meanwhile, President Donald Trump reiterating that he has a good idea of who he wants for Fed chair. According to multiple sources, the president will begin interviews with the person to replace Jay Powell this week. The Financial Times saying Kevin Hassett remains the front runner, but his selection is not guaranteed. And a Democrat has won Miami's mayoral race for the first time in nearly 30 years. Eileen Higgins will also be the first woman ever to lead Miami. Higgins beat Republican Emilio Gonzalez, who was endorsed by President Trump. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. This Miami story is actually kind of a significant deal. I'm wondering, AMH, your take on it, given the fact this comes after the midterm elections and the shellacking that the Republicans got.
And it's another boost for Democrats ahead of the midterms. The same night, the president was out because he talked about how affordability has become an issue. And he said, my team, like Susie Wiles, his chief of staff, said, you need to get on the road ahead of the midterms. There is a lot of concern right now in Congress, which is why you might see a lot of Republicans actually retire, because they know that this is going to be an incredibly challenging midterm election for them.
So how did President Trump do last night? Up next, testing the affordability message.
Lower prices, bigger paychecks. Inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Sarah Bianchi of Evercore joining next. This is Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Getting a little bit of a sogginess ahead of that Fed meeting, at least in equity futures across the board, just fading a touch after seeing near all-time highs, led by the NASDAQ 100 futures lower by 0.2%, a similar decline in Russell 2000 ahead of the open. And the S&P futures lower by about 0.1%, possibly due to what's going on in the income space, 2s, 10s, and 30s, seeing just that ongoing sell-off, that bleed upward in yields driven by the long end that we have seen globally. It is a global phenomenon. Nonetheless, the fact that 30-year yields are 4.82% in the United States ahead of a $22 billion auction today at 1 p.m. gives some people pause, as Torsten Slok of Apollo said. Why are these yields rising? You need to ask that question as they become unmoored from the front end of the yield curve. Under surveillance this morning, testing the affordability message.
The new word is affordability. So they look at the camera and they say, this election is all about affordability. I have no higher priority than making America affordable again. Lower prices, bigger paychecks. $1.99 a gallon. How would you like to have $1.99? Inflation, we're crushing it. The only thing that's really going up big, it's called the stock market and your 401ks.
Here's the latest. President Trump touting his administration's economic policies in the battleground state of Pennsylvania, hoping to ease affordability concerns and possibly assuage some concerns in his polling numbers. Bloomberg's Tyler Kendall joins us now. Tyler, what was new from some of his proposals or commentary last night as he tries to get this message under control?
Yeah, hey, Lisa, good morning. To be honest, a lot of what we heard from President Trump sounded similar, though this event was designed to be a kickoff of sorts of what's expected to be a domestic tour heading into the midterms. President Trump really trying to tout his policies in this bid to tamp down on concerns related to affordability, as new polling and also data shows us that sentiment has been souring. Just look at this new survey out from Fox News this week, which shows that 76% of American voters feel negative about the economy. Plus, pair that with election wins for Democrats last night. You had mentioned earlier in the program the win for Democrats in Miami for that mayoral race. I'll also point out Democrats were able to flip a key Georgia state House seat last night, long held by Republicans too. Now, President Trump zeroed in on his tariff policies, saying that he thinks people are starting to understand the benefits of his tariff regime, though did concede that he's gotten some heat, in his words, for those policies. Now, in recent weeks, we've really seen his aides try to urge the public to be patient, even as the administration starts to roll out new ideas, such as investigations into food supply chains. And of course, President Trump floating the idea of tariff revenue rebate checks. Now, it's going to be another affordability issue, though, that's going to ramp up the pressure on this White House as we head into the end of the year. And Congress grapples with that deadline for the expiring Affordable Care Act premium tax subsidies. And Lisa, while it was our understanding that last night was going to be solely focused on the economy, of course, President Trump also hit on some other key issues that we know pull well with his base, including immigration policies and also former President Biden's use of the auto pen. I bring that up because last night on stage, he spoke about this idea of potentially launching an investigation into whether Biden used the auto auto pen for the appointments of Federal Reserve governors. We should say, experts say we're not actually expecting an investigation to be launched here. We won't get into all the legal complications associated with this, but I bring it up, of course, because on this Fed Day, it just shows us another illustration of how President Trump has been ramping up the pressure on the central bank.
Tyler Kendall, thank you so much. And I'm really glad that Tyler brought up the auto pen issue, because on one hand, you got to say he can't be serious. On the other hand, maybe this will lead to an investigation, because clearly this administration wants to get a greater majority on the FOMC.
Well, he called out Scott Bessent, not just saying that he's a perfect exterior, but saying he's going to check on this because he says it is a problem going after these 4 individuals that were appointed. Of course, Powell was reappointed, but I'm thinking of Lisa Cook, Barr, and Kugler that were appointed by the Biden administration. I think it just signals that this administration is looking at the Fed a little bit more holistically, not just the chair, and they really want to remake it. But these are Senate-confirmed individuals. This is going nowhere.
Which is, but it does underscore this question around affordability, around the Fed's role, and exactly what this administration can and will do in order to address the problem. Sarah Bianchi of Evercore ISI joins us now for more. Sarah, I want to start there, this idea of how much are you looking at the potential for this administration to truly take actions in the next few weeks, as we do get a sense that polling really is shifting away from the president when it comes to the affordability message?
Well, I'm not sure he's going to be able to take action in the next couple of weeks, but I do think that looking into 2026, the State of the Union is going to be critical. And it's very hard for presidents in this kind of situation not to be defensive, not to defend their own policies. But I do think by the time he gets to the new year, he's going to have to come up with some policy ideas. The tariff rebate, probably the most specific that we've seen, but he'll want to put some ideas, more ideas out on housing, energy, and then, as you mentioned, figure out what he's going to do in this healthcare space.
Sir, when it comes to the president's speech last night, he once again talked about how the word tariffs is one of his favorite words. At the same time, we do see the administration looking at some tariff rates on especially food products and agricultural products, and they're actually clawing them back. Do they have a message that they need to recalibrate when it comes to trade?
Well, it's really interesting. The size and scope of the food tariffs really wasn't particularly significant. And so while I do expect them to claw back in some areas, I expect, generally speaking, the overall tariff rate to stay relatively constant next year. That's even likely through what we think will probably be a loss in the Supreme Court. So he is making some adjustments. But by and large, this is his signature policy, and I think they're going to try to keep it as intact, at least as they can.
If you think they're going to lose the ability to use IEEPA, what are you planning for that? Especially as you were a former trade representative, what are you planning for then in terms of what this administration is going to put in its place?
Well, they can do a series of 301 investigations, and there's a lot of legal precedent for that. The challenge is those do take time. It's a little bit strange to do it on so many countries as they would have to do to replace IEEPA, but again, we think they're fairly committed to this. There is a question of how they might bridge the gap, because those will take a bit of time. There's some authorities, Section 122 has been mentioned, that allows for a 15%. But I think our general message to the market is, look, at this point, when we're sitting here next year, maybe tariff rates will be a little bit lower than they are today, but don't expect them to go anywhere near where we started in 2025, which was quite low, 2 to 3%.
When it comes to China, the administration, as you know, is now giving the green light for H-20s to go to Beijing. And we do see that the Chinese government is calling on these companies and seeing what the appetite is. And it seems that the appetite is there. Do you think this administration is putting the economy and trade above national security?
Well, I certainly think that many of the kind of MAGA advocates and China hawks in the administration and outside of it are concerned that the kind of pro-tech AI parts of the administration continue to be winning. There are a lot of people who argue that selling those chips is a national security risk. But irrespective of that, you see again and again calling for federal preemption of state regulation of AI, chips, deregulation. So a very, very pro-AI posture that the administration has taken this year, obviously helping fuel the market and economic gains we've seen. But I do think as they get into the midterms, there are a lot of people, including Steve Bannon, who are saying, watch out, this stuff's not very popular with the MAGA base and with lots of Americans.
Well, it raises a question. The information is reporting this morning that DeepSeek is using banned NVIDIA chips as it does create some new, more efficient models when it comes to search and other AI technology. How much do you see this as being the source of a real flare-up in terms of tensions between the U.S. and China in the upcoming months?
Well, the administration is doing its best to keep things calm in what is a very fragile détente. You hear Bessent and Jameson Greer saying, oh, everything's going well. They're implementing everything that we've said, kind of nothing to see here. And some of that is to, again, maintain stability, to try and give the United States some time to catch up around rare earths. But you're also starting to see Republicans in Congress and governors and state AGs a bit more vocal on this as the president's numbers have come down and they start to feel a bit more liberated to be more full-throated on their own views. So I do think it's very possible that you could see more and more people start to raise concerns, whether it's the selling of these chips, whether they have chips they shouldn't have. I think this will continue to be fraught in 2026, and it will be very hard to maintain this fragile détente without any disruptions next year.
Sarah Bianchi of Evercore, thank you so much for being with us in this report from The Information saying that NVIDIA's state-of-the-art Blackwell chips have been smuggled in and have been behind some of the gains that we've seen from DeepSeek.
And those chips, Blackwell, is banned in China. Right now, the administration is giving the green light for the H200s, but Blackwell is banned. And at the same time, we talked about this yesterday, the administration doing one thing and saying another, given they are going after smugglers for the H200.
We've got more on that coming up. Also, Lindsay Pieggs of Stifel as the search for the next Fed chair enters the final stage.
Technology is embedded in every aspect of our lives.
and laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars, Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Vonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity, only on Bloomberg.
Some skepticism ahead of the Fed meeting later today. A question around just how much the Fed is poised to disappoint a market looking for Fed rate cuts, not just this year, but really heading into 2026. Right now, just a little bit of a softness in equity futures ahead of the open, down about 0.1% on the S&P. A little bit of dollar weakness. We've seen real stability in the FX cross just because there are as many concerns over in Europe as there have been here in the United States. Watch this space, though. The big question this morning, why are long bond yields rising so much globally? In the United States, 10-year yields in the U.S., 4.2%, up almost 2 basis points this morning. That is up from 4.07% the last time the Fed met. What is going on here? Silver prices, meanwhile, at another all-time record high, up 0.6% in pre-market trading. 2 hours away from the cash open, here are your morning movers. Danny Berger. Danny.
Hey, Lisa. Starting with GE Vonovia, reporting earnings incredibly strong, upping a dividend, upping its buybacks, upping its projections. For electrification demand, they see their backlog doubling by 2028. That's thanks to the demand. You guessed it. AI data centers, those shares up 10.4%. Also trading higher this morning, Palantir reaching a new deal with the U.S. Navy. The U.S. Navy, for their submarine services, will be using Palantir technology. That contract worth about $450 million, so those shares moving higher by 1.2%. Rounding things out with earnings, we got at the top of the hour, and that is the pet company, Chewy. Shares are up 3.3%. Sales mostly in line to a little bit higher, but again, maybe these more consumer-facing companies, there's some fears around, so that was good news. The company CEO also saying that they are growing. They are taking market share, so shares up 3 1/3% to the pre-market. Lisa.
Thank you so much. Always taking a look at pet food as a key gauge of people's devotion to their pets and consumer appetite. Right now, under surveillance this morning, Chinese AI startup DeepSeek has been using NVIDIA's top-of-the-line Blackwell chips to develop its next model. Sources telling The Information that the chips were illegally brought into China, where they remain banned through a complex smuggling operation. This follows a discussion yesterday around a DOJ probe to 2 individuals about possibly smuggling H200 chips. These are the more advanced version and really underscore some concerns about the relationship between these 2 countries.
And what does the U.S. government do, especially since they are trying to make sure that the temperature is low, on a low boil when it comes to China and the United States? The president will be going there early next year. He had this détente with Xi Jinping, and now they're giving the green light for the H200s. At the same time, the DOJ is actually going after smugglers of the H200s. So they really need to decide what is the strategy going forward, because at some point we have seen this administration say one thing but do another when it comes to national security concerns and export controls.
So back in October, when President Trump met with Xi Jinping, he said that Blackwell is 10 years ahead of every other chip and that China would not have access to them. This information report says that actually DeepSeek had access to the Blackwell chips in the last quarter of 2024, at the same time that companies including Google, Microsoft, and OpenAI started to receive them, really raising questions about, first of all, how much the U.S. is going to do in terms of creating this distance, this bifurcation in the chip world between the U.S. and China, but how effective they've been to date.
how effective they've been to date in terms of making sure that these chips don't get into the wrong hands. Clearly, they are happening. And remember, when DeepSeek came onto the scene earlier this year, people were saying, don't you think part of this has to be them stealing U.S. chips that are banned in order to have this level of technology? And I go back to what Jensen Huang has said many times, and he's recalibrated a little bit because it's politically fraught, but he has said basically, China is neck and neck with the United States when it comes to the arms race.
Yeah, and how much does this potentially increase that race? Meanwhile, President Trump suggesting he could remove Federal Reserve governors appointed by President Biden if their commissions were signed by AutoPen. The president asking Treasury Secretary Scott Bessent to investigate.
Have you checked that? Are you hearing it? Who signed it? Did he sign it or did the AutoPen sign it? I think it's something we have to look into. They put people there that are not authorized to be there. I'm hearing that the AutoPen could have signed maybe all four, but maybe a couple of them. We'll take two.
The Federal Reserve declined to comment on the president's claim. It does raise questions, though, how far the administration is willing to go to try to get some more dominance and control over the FOMC.
I think it signals that they really do want to remake the Federal Reserve. A lot of administrations come in and their goal and dream is to maybe get someone on the Supreme Court, right, for a legacy. This administration really sees the Federal Reserve in the same way. And they understand, you heard Scott Bessent recently talk about this, understands that the Fed chair definitely has an enormous amount of clout at the Federal Reserve, but it's a deliberative body. So they're looking at potentially, they've already done so with Lisa Cook and looked at potentially these other individuals, but this would mean a ton of legal pushback, and also these individuals were Senate confirmed. So not really going anywhere anytime soon.
Yeah, the Fed meeting today at 2 p.m. We get that rate decision at 2:30 p.m. We get Fed Chair Jay Powell's press conference. We'll get more on that in just a second. Amazon and Microsoft announcing a combined $52 billion investment plan for India. Amazon planning to pump $35 billion into India by 2030 as Microsoft commits to more than $17 billion.
It's fantastic to see this all landing and ultimately being able to parlay these tokens per dollar per watt into all of the applications, systems that are going to get deployed broadly across the country. And so the $17.5 billion, which is the largest investment we made in Asia to date, and so we're thrilled about it.
Google also recently pledging $15 billion to build data centers in India. Turning back to the Federal Reserve, President Trump reportedly planning to start his final round of interviews for the Fed chair in the coming days. The frontrunner, widely believed to be National Economic Council Director Kevin Hassett, who said there is, quote, plenty of room to cut. Joining us now is someone who disagrees with that statement, Lindsay Piegza of Stifel. Lindsay, you've been really vocal on the fact that you do think that inflation is very much a preeminent concern and is being underplayed by this particular Fed. How much do you expect that to come to bite the Fed when it comes to really yields, which is what we're seeing this morning?
Well, I think the Fed is well aware of the fact that inflation remains a very sizable problem. As we see, the majority of Fed officials have come out and spoken against, or at least questioned the need for further rate cuts. So there's a very clear divide among Fed officials right now, some focused on the employment component, but still, as I mentioned, a majority concerned that we did not do enough the first time around to reinstate price stability, and now it becomes even more of a challenge for the Fed to get us back to 2%, having left prices well above that target level for so many years now.
Where is the inflationary pressure coming from, given the fact that people have seen rent prices actually come down, not just disinflation, but outright deflation in a couple of rent metrics? And we are seeing pretty contained price increases, certainly during the holiday season, even on consumer goods. So what's going to drive this?
Well, there still is some improvement. We have seen some improvement, as you mentioned, in these pockets. But when we look at the cost of services, this is still going up consistently over 0.3 on an average monthly basis. So that's continuing to fuel these overall annual inflation numbers up near 3%. Remember, it was never about getting us down from 8 to 6 to 4, close to 2%, but back to 2% on a sustained level. And the Fed failed, as I mentioned, to really bring us to that sufficiently restrictive level the first time around, stopping short at 5.5. And so now the Fed continues to contend with above-trend price pressures.
Does this get worse when the president gets his pick for the Fed chair?
I think the Fed is going to have more of a lean to the dovish side. There may be more of an inclination to err on the side of additional rate cuts, as opposed to holding steady, moving to the sideline, waiting for the data, depending on who takes the lead at the Fed. But remember, all of these members are pro-growth, pro-market economists. They're looking to support the economy. They're looking to meet the Fed's dual mandate, and they will base policy appropriately to achieve that legally mandated goal.
When you look at potentially inflation next year, where is that coming from? Is that coming from like almost a self-induced crisis in Washington because the one big beautiful bill and maybe these $2,000 dividend checks?
Well, so this is one of the biggest concerns. Right now we're looking at inflation and we're saying, okay, there's not necessarily a tremendous amount of upside momentum that we're concerned about. But as we turn the calendar page, if we see a stronger growth profile than expected, right now, according to the Atlanta Fed, we could see Q3 GDP up over 3.5%, much stronger than what the Fed had anticipated. We're still seeing a very spendy, solid consumer as we go into this holiday shopping season. And my biggest concern is businesses drawing down inventories, eating into profit margins. If they begin to pass through more of these tariff-related or other policy-related costs onto the end consumer, any one or a combination of those factors is going to drive inflation higher. So we can't get ourselves in a position where the Fed eases dramatically and then quickly we have to reverse course because inflation is taking off up near 4% or beyond.
I just feel this but coming in.
Yes.
All these people who are listening to this saying, but that GDP number was really driven by data center investment. And what we're seeing right now, potentially next year, is greater efficiency, greater productivity that could fuel both growth but also a disinflation. That was
There
really
is
what a lot of people think
disinflation on the AI side, absolutely. Increasing productivity, increasing efficiencies, as you mentioned, but there's also an inflationary component too, driving demand higher for these AI services, as well as this sizable energy component, driving higher demand for data centers. So it's not necessarily a clear-cut argument that AI is going to, or other technologies are going to drive inflation down. There still are a lot of question marks, and if we factor in tariffs, if you factor in consumer and growth prospects, I think the risk still remains to the upside.
Where's the political risk here in the case that you just made? You talk about how it can be inflationary, and then you think, okay, energy costs, and we are going to be speaking with the Chevron CEO, Mike Wirth, later on. It should be a great moment for energy costs, at least from the producer side, because you should see them going up because of how much energy is in demand.
Well, we have seen energy go up over 40% in just the last 5 years.
But we haven't seen oil prices go up. And this is sort of the question of, at what point can you factor in government interference in trying to skew prices to the downside because of some of the political concerns, leaving a sort of subdued inflation, even if the supply-demand dynamic might otherwise signify something else?
Well, there will be pressure on the administration to step in. As we know, the fastest way to derail the American consumer is sustained heightened energy prices. And that will show up in the polls, be it the midterms or other. And so there will be a lot of pressure on the administration to step in, not necessarily with a long-term solution, but certainly with some short-term reprieve.
Well, that's with electricity. Is it balanced out with the fact that the president last night was talking about gasoline $1.99? So then I looked, and actually there is a gas station in Oklahoma that has a gallon for $1.99. In Colorado for $1.69, the Gas Buddy has everyone mapped out. And I said, wow, they really are that low, below $2 a gallon. But the issue people have at home is electricity prices.
Right. And
do they negate each other?
For the household balance sheet, the average consumer will look at where they're allocating those funds, be that to the gasoline tank or be that to the household energy bill. And so if one is improving and the other isn't, we're still going to feel that pressure as normal consumers, normal spenders.
Lindsay Piegza, it is great to see you in studio here.
Thank you so much
for being here, and happy holidays.
Happy holidays.
Lindsay Piegza of Stifel on the Fed debate later today. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Money manager Mario Gabelli saying it's, quote, highly likely he will tender his client's Warner Brothers shares to Paramount in an effort to spark a bidding war. The media investor is signaling he favors Paramount's deal, but saying it will have to increase its $30 a share bid, and Netflix will likely still counter. Meanwhile, JP Morgan announcing $105 billion in expected spending next year, higher than the top estimate from analysts surveyed by Bloomberg. The Consumer and Community Bank is a big driver of the expense growth due to higher compensation for advisors, product marketing, building branches, and investing in AI. And the U.S. is proposing that foreign visitors provide their social media history over the last 5 years to enter the country. It would apply to travelers from about 40 countries who can stay in the U.S. for up to 90 days without a visa. The proposal was given a 60-day notice. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, a tech paradigm shift.
The spend has been enormous, and to some degree, some of these companies don't have the revenue to back up that spend. It's a paradigm shift between companies that were all cash generative to companies that are now using that cash, companies that were asset light to all of a sudden having assets.
Tony Rodriguez of Nuveen joins us next to talk about, in part, the fixed income side of this story. This is Bloomberg Surveillance. Good morning.
Climate change is going down right now. It's going down. And we've tried everything to shame people and blame people and put them in their place and tell them that they're doing things wrong and that they're killing everybody. But if we keep telling them that, then we are going to kill everybody. So we got to figure this out. And we're not going to do it by blaming people who are just trying to wake up and make ends meet every day, especially when a lot of those people have the same connection to nature and the environment that we all share here. I hike and I ski and I love the environment just as much as anybody else, but so does somebody who works in an oil field. The Cabela's shopper and the REI shopper want the same things. They want clean air and they want clean water and they want to be able to recreate outdoors. So until we figure out how to get on the same page, we will continue to lose. We cannot afford to lose anymore. We need to build a winning coalition of people across the political spectrum, or we will never create the solutions that we need.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
It seems like in Washington, D.C., people are waking up and realizing they're going to have to come out, message a Fed rate cut, meaning 175 basis points of rate cuts since September, and then giving guidance at a time where there is none economically. Right now, we're looking at S&P, NASDAQ, and Russell 2000 futures all lower ahead of the open, led by NASDAQ. Tech futures down about 0.25%. Similar move for the Russell 2000, S&P lower by about 1/10. It really has to do with the bond space, especially ahead of this Fed meeting. 2s, 10s, and 30s. The long end of the yield curve, not just here in the United States, but globally, has been rising substantially. As Torsten Slok was saying of Apollo, a fixed income mystery. 30-year yields up about a basis point, 4.82% ahead of an auction later today, $22 billion of notes, and 10-year yields hovering around that 4.2% after climbing to the highest levels going back to the end of September globally, the highest 10-year bond yield globally since 2009. Under surveillance this morning, this has been the focus for tech, the tech paradigm shift in debt.
The spend has been enormous, and to some degree, some of these companies don't have the revenue to back up that spend. Some of the companies are using their balance sheets. Some of them are going to be taking out debt. This is going to be a big switch. It's a paradigm shift between companies that were all cash generative to companies that are now using that cash, companies that were asset light to all of a sudden having assets.
Here's the latest. People looking ahead to the Fed meeting to really understand exactly how much more room some of these tech companies have to issue. Is it because there is an accommodative backdrop in credit markets, really ameliorated by the easing of Fed rates? Right now, we are so grateful to have Tony Rodriguez, head of fixed income strategy at Nuveen, here with us in studio. We're going to get to the tech space and just what exactly we can expect with issuance and what this means. But I want to start on the Fed and how much it's fueling some of this risk-taking appetite. How much do you think that the 175 basis points of cuts that are expected after today's meeting since September have really eased financial conditions in a way that's underappreciated?
Well, I definitely think they have eased financial conditions. We see that across all markets, whether you talk about commodities, equities, and certainly the credit markets from high grade to high yield. So the new issue spigot is wide open. We've seen over $1.5 trillion of new issuance in investment grade space this year. So yes, financial conditions are easy. That is certainly prompting some of the borrowing. But when we talk about the specific kind of boost we've seen from hyperscalers and AI-related investment, we think that's a little bit more just secular in nature. We're going to see that over the next, people are talking about $3 trillion worth of CapEx over the next 3 years, half of which probably comes to the public debt and private debt markets. So that is not really kind of Fed-induced in any way. That is really structural and secular in our minds.
How much does this secular wave of issuance really feed into this rise in yields that we're seeing globally? How much is the idea that there just is a glut of bond sales coming down the pike as the financial world has to suddenly finance the physical world in a way it hasn't for so many years?
Yeah, the technical supply pressures are large, both in credit markets because of hyperscalers, but also in sovereign markets because of the high debt levels that we see really across the globe. So the kind of sovereign story is one of really steeper curves, long end suffers. So we're seeing that in the US, but we're really seeing it globally as well. So those fiscal pressures, there really is, as far as the eye can see, no relief for that. When we talk about the credit markets, what we're seeing there is the technical pressures hitting high quality, technology, and the long end. That's really where the concentration has been of supply coming from, the Mag 7 type hyperscalers.
So parlay this into the question that we've been asking all morning, which is why are sovereign bond yields rising so much on the long end while they seem relatively pegged on the front end? Is it because of the supply issue? Is it because of some of the deficit concerns? Or is it something else entirely?
I think it's around the deficit concerns primarily, but we've also seen some stronger growth numbers over the last week or 10 days. You think about the German data, where a lot of people thought Germany is really kind of one of the weak sisters in Europe, saw some strong data. So a little bit better kind of data on the growth side. But the fiscal concerns, whether it's because of defense spending, whether it's because of, fiscal spending in the U.S., which is beyond strategic and defense, that I think is really pressuring the long end. Term premiums we've seen rising for since September, really. That we think that pressure is going to remain in place. So you're seeing it in the long end of not only the U.S. curve, but global curves as well.
Is this going to continue in the U.S. if the Supreme Court decides to strike down IEPA? Or this administration does decide to do these $2,000 checks?
I definitely think it's going to continue. Even if they strike down IEPA, we still think they'll be able to implement the vast majority of the tariff policy through other means. So we don't really see much of a change there.
That's good for the deficit, right?
Well, we think it's okay for the deficit. It's not good for the deficit. A lot of that's already baked in. So, really what it's most negative for is really around the consumer and higher prices and kind of the stress we're seeing there, particularly on the low end of the consumer. So from a fiscal side in the U.S., right now we're talking about 6 to 7% deficits for the next 4 to 5 years. So unless there's really something structurally changing on the spending side or the revenue side, it's unlikely we're going to see any relief in the long end. So we think long end rates stay steady. The front of the market might rally a bit here following the Fed over the next 6 months.
So steepening yield curves. What are you looking for in terms of messaging from Fed Chair Jay Powell later today? We were talking earlier about how he is a lame duck, not a dove or a hawk. How much does he really have control over the committee and have the ability to signal to markets what the path ahead for the Fed really looks like?
Yeah, I mean, I think his ability to do that is certainly compromised now, lame duck status, along with all the other pressures that are coming down on the Fed. So what we think they'll do, they're going to cut. They'll try to make it a hawkish cut, but I think it'll be quite subtle, really more from the standpoint of instead of talking about, additional policy moves, they might talk about the extent and timing of additional adjustments. So trying to kind of introduce a little bit of just ability to pause over the next couple of meetings. We think they'll go one more time before Powell is done, called maybe the April meeting. And then we think that would probably be it under maybe a Waller, or if Powell were to stay in power. If you go with a Hassett, then we start to think that there's probably a second half of next year an additional cut. So we get today's and two more, whereas fundamentally the economy is probably going to be okay with just today's, maybe one more in the middle of next year, and that gets us pretty close to neutral and maybe a steady state for a bit from the Fed.
So just taking a step back, what's your highest conviction heading into next year if you do think the economy is in a pretty good place, but potentially this Fed could cut more than is economically warranted?
Well, we think that the best place to be really is kind of the mid-quality level of the credit markets. So we expect some weakness in the high-quality areas I mentioned because of excess supply that's coming. We expect some weakness in the lowest end because our growth forecast is for a little bit below 2%. So that's an okay environment for growth, but the weakest companies might have a little stress. So kind of mid-quality credit in a diversified fashion, to us, that's a sweet spot. Earn the carry. You're not going to get a big tailwind from lower rates, but we're not expecting a big spike in rates either.
Just real quick here, if the Fed does indicate that it's going to cut rates substantially more in the upcoming year, do you expect the long end rate to rise substantially more than we have seen already?
I think it would rise beyond our current. We think maybe 4 3/4 for the 30-year, let's say, 4% for the 10-year. We could see 50 basis points higher than that if you had significant additional cuts that are clearly not motivated by fundamental economics.
Tony Rodriguez, thank you so much for being with us this morning. Tony Rodriguez of Nuveen. As we head toward that Fed meeting, and frankly, as we head toward a question around one of the more indebted of the tech space, Oracle reporting earnings after the bell, and a question of supply. It's not just the government supply, it's also very much the corporate supply that we've seen from some of these AI leaders.
Tony said it, $3 trillion. It's unbelievable when it comes to how much money these tech companies are tapping in the debt space to finance this entire AI build-out trade that a lot of people still have a tremendous amount of questions and concerns about.
Right now, what you're seeing in markets is a little bit of softness ahead of that Fed meeting, as well as those Oracle earnings. And you can see those bond yields on the long end just creeping up. When we talk about the incredible amount of build-out in the tech space, you have to wonder about how that affects the energy costs. We'll be talking about that coming up. First, we've got Gargi Chowdhury of BlackRock, then Chevron CEO Mike Wirth. Do not miss that. Tiffany Wilding of PIMCO, as we do get the employment cost index from October, and Robert Tipp of PGIM Fixed Income. We start to look at a Fed cutting rates into already pretty easy financial conditions. Right now, what you are seeing in markets, silver rising to an all-time high as maybe people look to precious metals ahead of this meeting. Right now, this is Bloomberg Surveillance.
Such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything. The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked. This platform shift that we are living through, I think, is going to create untold amounts of value for the world, but also for the businesses and for economies, which is why I'm incredibly optimistic in this moment for Europe, but also for the whole world.
How do you think about job losses or safety for some of the AI tools?
You know, I hear the anxiety, and I understand the anxiety about jobs. I think that we are certainly going to live through a massive transition about how people learn to work alongside these tools. I mean, the reality is I do think there'll be some number of jobs that are displaced. I think it is a smaller number maybe than some anticipate. We estimate it's around 7%. And I think what's important is that we have programs that help those 7% transition into new fields of work. I think what is more likely is that most of us are going to learn to work alongside these tools. So we estimate about 2/3 of us. If you think about the tasks you do in your daily life, when you look at every industry, there are administrative tasks that are happening everywhere, and that's what AI is most helpful in improving.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you know, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. You know, I'm not here to say what I would and wouldn't do in the future. You know, but the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. You know, I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. You know, but that's where I'm at today.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
We think the setup is really constructive into next year for a broadening in earnings.
There's this element that maybe things could be better, and you have a lot of stimulus coming.
Let's not be complacent and just expect the same really positive performance we've seen so far this year.
If you start to see any kind of degradation in earnings, I would be much less optimistic.
The market tends to discount both good news and bad news fairly quickly.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on Fed Day, with stocks fluctuating near all-time highs ahead of earnings from Oracle and that key Fed rate decision at 2 p.m. Eastern. Traders expecting central bankers to ease policy for a third consecutive meeting, but the path after that increasingly murky and increasingly underpinning skepticism that we could see in the bond market.
Actually, what we're seeing today in the bond market, if you've been talking to, just yields continuously rise. A lot of people have different reasons why. Tony Rodriguez just talking about deficit concerns are still an issue in the United States. A lot of people are talking about actually this is just a global phenomenon right now. When you look to Japan, Australia, Canada, hiking or hikes priced in. What the Fed has to do today, I guess everyone can ask Jay Powell about why he thinks yields are on the rise, but he is a lame duck today. And I think what's going to really overshadow this is not just the fact that we had a 43-day government shutdown. We don't have the latest job data as they make this decision. But what happens next year as we have musical chairs at the Federal Reserve?
Especially given the fact that right now we're in a data desert. We haven't been getting economic data. Today we'll get at 8:30 a.m. Eastern some employment cost index that is dated, but might give us a sense of a labor market that has been absolutely a mystery. What we are expecting is also a statement of economic projections. How does this Federal Reserve give an economic projection, given the fact that it really is a huge debate about the momentum in the economy and, frankly, even what has happened over the past couple of months?
Well, the problem is, to this data desert, we don't exactly have a clear picture of what happened. Jobs and retail sales numbers for October and November have yet to be released. The Fed is meeting today, yet they get the jobs report next week. So potentially next week, they're either going to give themselves a pat on the back and said, yes, we made the right decision, or they're going to, but some of them might walk out of there and think, oh, maybe we should have had on pause, have gone for a deeper cut, because right now, we heard from Neela Richardson, there are green shoots when it comes to the labor market. When you think of there are some hiring. We saw that in JOLTS yesterday, but then she talks about concerns in small businesses.
Yeah, so how useful will the dot plot be? It always is incredibly useful, of course, but this time, how useful will it be? The expectation is for one rate cut next year and one rate cut the following year in that dot plot. Again, do you just throw it all out the window? Right now, the state of play that you're seeing in markets is a little bit of softness in the equity space. Futures lower by about 0.1% on the S&P. A bigger decline in the tech area. You are seeing a pretty flat market when it comes to FX, but the yield space, as Anne-Marie was mentioning, 10-year yields up about a basis point, had been up more, but fluctuating around that 420 level. Coming up this hour, Gargi Chowdhury of BlackRock, with stocks wavering, Chevron CEO Mike Wirth, as gasoline and oil prices are trending lower, and Tiffany Wilding of PIMCO, expecting a more hawkish Fed in 2026. We begin this hour with stocks just slightly lower as traders await the latest interest rate decision by the Federal Reserve. Gargi Chowdhury of BlackRock joins us now. Gargi would love to be a fly on the wall in the Fed's meeting today. Thank you so much for being here. Why do you think this is going to be such an exciting meeting down in Washington, D.C.?
Absolutely. Thank you both for having me. And as I was preparing for this, I was looking at the S&P dot plot. And to your point, maybe you take it with a grain of salt, maybe you throw it right out, but it does give us some information. And one of the things that I was looking at is the estimates for neutral from September. And if you remember that, you'll notice that at least 4 or 5 of the members had already at that point said that we were near the neutral level, which we are at today. And then obviously with the 25 basis points cuts that are going to come, many will have already thought that that was not needed. So whether or not there's going to be as many dissents as many expect, I don't know. Personnel is policy. I think Chair Powell will probably do a great job in building consensus. He's done that many times, but the discussions will be fabulous, and I think we learn a lot from the minutes in 6 weeks.
I love generating consensus. I thought you were just saying herding cats, because that's what it always feels like. But meanwhile, Torsten Slok puts out a note this morning saying a mystery in fixed income, and that really the key question, as we've been talking about extensively, why are long-term rates rising so much if the Fed might be poised to really cut rates more than even might be warranted? As people worry or think about there could be potentially a political motivation to lower rates, why are long-term yields rising globally to the extent they are?
Yeah, so I think the last part of your sentence, globally, is important. So this isn't a US-centric matter. It is rising globally. I think there are a few concerns there. Number one, I think the person that was here before me spoke about just generally concerns around fiscal discipline. That is something that hasn't gone away. We were thinking about it 6 months ago. We're thinking about it now. I would question why we had rallied so much. Why were we below 4% not that long ago, especially when we didn't have too much data? Now I think having sort of sold off back to this 420 level with some expectations of hawkishness, almost everybody that you speak to expects this meeting to be hawkish, and it's hard to imagine that Chair Powell can be dovish given all of the foregone conclusion language that he had used in the last meeting. So I think some of that is also just expecting the, pre-pricing the hawkishness. What I think we should all focus on is the opportunity that this backup in yields is creating in a world where so many other parts of the market, if you look at, just broad indices, have rallied so much, but bond markets, especially that belly of the curve, creating this opportunity for income, I think it's pretty fantastic.
So what do you like when you look at opportunity?
Yeah, so a couple of things. Number one, within the fixed income market, we're telling investors that the backdrop of solid growth with a Fed that's either going to pause or maybe cut one more time in the beginning of next year, that creates a wonderful opportunity to clip coupon. But really, you don't want to take too much duration because of the fiscal concerns that we were talking about. So really keep it maybe out to the 10-year point, belly of the curve, focus on income, focus on all-in yields that are available in the fixed income markets. Within the equity space, the core of your portfolio needs to be in large cap. And that's because we think that even though small caps have rallied so much, it's not going to be sustainable in a higher rate regime. So large caps, AI are a focus, and then a lot of diversifiers around it, because obviously, as we've seen, there's a lot of pressure to pull back when news arises, and we might see that today.
So are you a believer in the rotation trade or not yet?
A rotation trade into...
small, mid cap?
No, so I actually think I'm quite in the opposite camp, where I think that the small cap rally that we've seen on the all-time highs has gone a little too far. In fact, what we think is we should rotate back into the large cap space, which should be the core of your equity portfolio, with some allocations to other themes such as cyclicals, especially in financial space. We think dividends as a source of income can be really powerful here, but really keeping large cap at the core and the belly of the curve in fixed income as your fixed income allocation, with other diversifiers like gold, with liquid alternatives.
Which is the reason why I think a lot of people have been going into gold, and it has rallied some 7% since the last Fed meeting. How does tech play into this large cap emphasis that you're putting out there? We're going to get Oracle earnings after the bell, an increasing focus on the connection between big tech and the debt markets, given the financing needs of some of these companies. How much do you need that to perform? The idea that these companies can continue to get the financing at relatively attractive pricing in order to keep building out and generating the optimism that they have in 2025.
Absolutely. And I think one of the things that has changed this month over maybe 3 months ago is new deals being announced is not viewed as a positive thing anymore. But where they're coming from is important. So if you have these large tech companies that are actually really profitable, have a lot of free cash flow, at the same time have very little net debt, we all know that chances are likely very high that the companies will be able to finance this appropriately. And I think maybe there'll be pullback in the credit market, but over the long run, at these level of all-in yields, the supply will likely be absorbed, but who's doing it matters. So the free cash flow generating, low net debt, high EBITDA companies that are then coming into the credit markets, I think that goes okay. But obviously when it comes from other parts where there isn't that free cash flow associated with the names, I think that could be a little bit trickier. But one of the things that we've seen over and over in 2025, this being one of the years that we've seen a record amount of fixed income flows, is investors want multi-sector fixed income in their portfolio. They want that income. So every time you have these massive issuance weeks, you actually do see a lot of demand come into fixed income markets.
Let's say you were down in Washington, D.C. today. What would be the one question that you would have to Fed Chair Jay Powell in the press conference? If you were there, Gargi Chowdhury, in the front row, what would be your question?
I've thought about this. I would love to be there. Shout out to Mike McKee. But I think I'd ask Chair Powell what he would need to see in the deluge of data that we're going to get in the next month or so to decide about what drives market rates in January and March.
Gargi, wonderful to see you. Thank you so much for being with us today. Gargi Chowdhury of BlackRock here in studio as we do count down to that Fed decision. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump suggesting he could seek to oust Federal Reserve governors appointed by President Joe Biden if their commissions were signed by AutoPen. Trump asked Treasury Secretary Scott Bessent to investigate the issue. AutoPens have been used in multiple presidencies tracing back to the 1940s. Meanwhile, lawmakers in Brazil have approved a bill that could lower former President Jair Bolsonaro's jail time. If it passes the Senate, the legislation would curb prison sentences for Brazilians convicted of crimes linked to the insurrection attempt after Bolsonaro's loss. Bolsonaro's sentence could go from 27 years to 20 years and 9 months. And money manager Mario Gabelli saying it's, quote, highly likely he will tender his client's Warner Brothers shares to Paramount. The media investor signaling he favors Paramount's deal, but saying it will have to increase its $30 a share bid, and Netflix will still likely counter. The bidding war is expected to last well into 2026. That's your Bloomberg Brief. Lisa?
I'm getting Jerry Maguire feelings. Show me the money from all of the shareholders. Up next, the morning calls, plus Chevron CEO Mike Wirth as gas prices have dipped below $3 a gallon for the first time since 2021. Is it still drill, baby, drill? That's next. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Seeing a bit of softness ahead of that Fed meeting. Good morning. Just a little bit of a dip in futures this morning. It could all change, clawing back from some of the earlier losses. Quiet in the FX space. 10-year yields higher by a basis point, 420, continuing that sell-off. And silver prices at all-time highs. We haven't been citing oil prices, and the reason is because they have been staying in the same place, fluctuating from gains and losses, but really around that $50 to $60 a barrel, with a lot of questions around supply, not just the demand side. Time now for the morning calls. First up, HSBC raising its price target on Eli Lilly to $1,070, calling it positioned to outperform next year, especially if AI panic kicks in. Next up, Citi lowering its target on Cracker Barrel to $20, citing declining traffic, not exactly the logo incident, down 3.1% in pre-market trading. And finally, Morgan Stanley raising its target on ExxonMobil to $137 a share, highlighting increasing free cash flow. Those shares up by 0.3%. Let's stick with the energy space. President Donald Trump touting lower prices.
We're down lower than we've been in 7 years in gasoline prices and oil prices, not just the 3 states that I talk about with $1.99 a gallon. How would you like to have $1.99? You know, that's the equivalent of a very major tax cut, you know, when you get the energy prices down.
The national average for gas falling below $3 a gallon for the first time since 2021. Mike Wirth, the CEO of Chevron, joins us now for an exclusive interview. I am so glad that we're getting to speak with you, Mike. Thank you so much for being here with us.
You're welcome, Lisa.
So let's start about that. $1.99 a gallon. It might be great for a lot of people in terms of filling up their gas tanks. A real question around drill, baby, drill, and how much you're incentivized to increase production given the lower cost of oil.
Well, you know, we make our investment plans on a long-term basis. We look at supply and demand well out into the future. And so the price of oil today can affect short-term financial performance of the company, but it really doesn't play as much into some of the longer-term investment plans as we look down the road, not really out the window, as we decide what the capital program looks like.
But how do you reconcile the two? Because you're doing a lot of exploration internationally. And to Lisa's point, prices are low and potentially are going to even go lower.
Well, exploration is a long cycle business. We just brought a project online in the Gulf of America last year where the discovery was made 20 years prior. And so the timeline between when you actually make a discovery, when you appraise that, and you ultimately develop it and bring it to market can be years or even decades. And so we really have to take that long view on the business. And, you know, in the short term, we'll keep costs tight. We've guided to, you know, industry-leading free cash flow over the next few years as we bring costs down, capital spending down, increase the synergies on the Hess transaction. So we're going to deliver strong financial performance through the cycle.
Based on what the IEA has said, recalibrated where they see oil demand growing, it was 2030, now it's 2050. OPEC says they had a rendezvous with reality, seeing that the world needs a lot more of this, a lot more fossil fuels. If outlook is so strong, should Chevron, should all of these big oil companies, should they increasing more of that investment?
Well, on the IEA, even a broken clock is right twice a day. So they have finally acknowledged what we've long known, which is that the world will continue using oil and gas for many decades into the future. We are in that long cycle business, and The capital spending, Anne-Marie, has become more efficient in our industry. A decade ago, we were spending money on big projects. There was a lot of growth going on in shale at a relatively high cost structure. And the entire industry has found ways to standardize designs, simplify projects, and actually get more for every capital dollar that we spend. So the size of our capital spending doesn't necessarily correlate to the growth the way that it would have in years gone by.
When it comes to expansion, the U.S. government is backing this plan Iraq has to transfer Lukoil stakes to an American company. So it's really only you or Exxon. How are those negotiations going?
Well, I can't comment on commercial negotiations. What I will say is we've got a well-established reputation as a good partner, as a world-class operator in international locations. We're sought out as a partner in countries around the world. We've got a long history working in the Middle East, and we put a real premium on partnership, and that goes to every country we work with and every company we work with.
Can you talk about those assets, though? Do you think those would be good assets to the Chevron portfolio?
Well, we always look to strengthen our portfolio. Iraq is a country that's blessed with very substantial petroleum resources and some of the largest fields in the world. And so those are the kinds of things that we always look at.
You've been talking about the capital profile and investments and how it's become a lot more efficient to make the same kinds of investments and frankly, the same kind of output. Where is this efficiency coming from? Is it coming from artificial intelligence? Is it coming from just better technology and getting oil and gas out of the ground?
Yeah, so in shale, for instance, which is something the U.S. has been a world leader in, a decade ago, break-evens were $70 or $80 a barrel. Today, they're not even half of that, as we found ways to drill longer laterals, to optimize the spacing of wells, to complete wells at lower cost with greater production coming out of them. So it's a series of things. In the deep water, we've simplified and standardized designs. And what used to take $30 a barrel or more in terms of cost of capital to go into a project now has been cut in half. And so it's not driven by AI yet. I do think over time we're going to see technologies like that continue this path that we're on.
We're going to get to that in just a second. If that's the case, if you can get more, even at a break-even cost that's a lot lower, why has the rig count gone down so much? Why aren't there more rigs coming online given the capacity here in the United States?
Because we can drill more feet per day with a rig today than we could in the past. And so rig count is not nearly as interesting a metric as how many feet a day you can drill, how many wells you can complete in a period of time. And so we're getting more work done out of fewer pieces of equipment today.
You talk about how AI isn't delivering those efficiencies yet, the indication being that maybe down the road it might be the case. Where specifically are you thinking? And I'm saying at a time when Chevron's cutting staff, so are other people. Is this a headcount issue? Is this something else? How are you seeing it being deployed?
Well, I think we're still in the very early days of applying AI at scale in our industry. One of the things that's undeniable about AI is it needs lots of data. A company like ours has as much data as just about any company in the world. And so we've got decades and decades of geologic data, seismic data, operating data, all of which can be used to feed these models to optimize operations, to improve our exploration success, to squeeze more production out of existing assets. And so we see huge opportunities to run our business with smarter technology, get better decisions made faster. And so there's certainly a cost dimension to this, but I think the real opportunity is going to be about the productivity of our assets and our business.
You announced this project, the first of its kind, to provide natural gas-fired power for data centers. Do you expect to do more of these projects? And what's the update on this one in West Texas?
Well, certainly the demand for power has been talked about now for the last year or so as the constraint in the growth of AI. Data centers and the ambition for data centers at a scale we've never seen before has become a commonplace. The reality is we need large-scale power. What we're working on is off-the-grid power because it's also becoming an issue with electricity prices, and we're seeing this show up in consumer sentiment, in elections. Our approach is to develop gigawatt-scale power generation, not through the grid, but dedicated to data centers. We've got a project in a couple of sites, actually, we're working on in West Texas, where we've got a lot of natural gas. We've got large gas turbines, the largest in the world, being delivered starting next year. And we're deep into discussions with multiple customers that would like to site data centers to use this power.
You're at the center of a lot of politically very important conversations, not just when it comes to AI, not just when it comes to Lukoil assets, also Venezuela, the only American company left. Can you give us an update on either conversations with the administration, your team on the ground? What is the future of Chevron in this country as the president says maybe he's going to send troops there?
Yeah, I don't know what the president's intentions are. We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela. The Venezuelan oil is sought after by U.S. refiners, and we operate there in full compliance with all U.S. law and sanctions. We're in discussions with the administration to ensure that we stay in compliance, that they understand the value that our presence brings to America, and so, you know, that's.
And you plan on being there for the long term?
Venezuela actually has more oil and gas resource than Saudi Arabia. It's right here in our hemisphere, very close to the Gulf Coast refining complex. And we've been there through ups and downs. And like many places in the world, we have to take a long view on our presence in countries like this.
You talked about succession yesterday at this conference. How are you thinking about that as you talk to the board? Is there something you want to get done before you hand over the reins?
Well, the succession discussions begin on day one, I think, for most CEOs. It's part of a board's responsibility to be thinking about the next generation of leadership. I have a long list of things, some of which have been accomplished. I mentioned the Hess transaction, which was a big one for us earlier this year. We have laid out a plan for the next several years to investors last month that grows free cash flow, that drives significant return of cash to shareholders. All of those are things that I want to make progress on. But when the time is right for someone to follow me in this job, the board will make that determination, and I will happily hand over to
Will
the
you
next
go right
person.
for landman?
Just 30 seconds left. Do you think that in 10 years, gas or oil is going to be more valuable?
Well, on an energy content basis, you know, oil's got about 6 times more energy content per unit of volume than gas does. And so, you know, they trade in sympathy with one another because energy is somewhat fungible. I think both of those commodities are going to be essential to the global economy. I think demand for both of those will be much higher than it is today. And I think you're going to see good companies in our industry still producing more of that and doing it in a way that keeps costs very affordable for the economy.
Mike Wirth, wonderful to see you. Thank you so much for being with us here this morning. Mike Wirth, the CEO of Chevron, as we look to the question around powering AI. Coming up, plus Tiffany Wilding, Ev Pimko, and Robert Tipp of PGIM Fixed Income with the latest Fed interest rate decision on deck. This is Bloomberg Surveillance.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Stocks dipping just a little bit ahead of that Fed meeting as people wonder exactly how much the Fed can come out with any kind of signal, let alone a dovish one, given the potential change in leadership. S&P futures, though, turning upward as the session grows older, up about 0.1%. This is a reversal from earlier, where it had been down as much as 0.1%. You can see NASDAQ futures also essentially flat, clawing back about 0.25% losses. Same kind of story on the Russell 2000. In the bond space, 2s, 10s, and 30s. A real question here about how much you get that sell-off with yields rising. Right now, just crossing, we get the employment cost index with the latest read on wage inflation. Bloomberg's Michael McKee joins us now with more. Mike, what does this data from the third quarter tell us?
Well, it tells the Fed that the labor market was a little bit looser maybe in the third quarter because we didn't see a big rise in wages and salaries. It comes down from what we had seen in the second quarter. The overall ECI comes in up 0.8%. The forecast was for 0.9, the same as in the second quarter. Wages and salaries were up 0.8%. They were up a full percentage point in the second quarter, and benefit costs increased 0.8%. That was a slight rise from 0.7 in the second quarter. A little bit less meaning to it because we don't have the other labor data, like how many people have jobs or have been getting jobs, but it does give the Fed a bit of a read on inflation, and it's not bad news.
Mike, how much are we expecting to sense at this meeting later today? We're looking at data like the ECI. We're looking at JOLTS data where you could have a choose your own adventure kind of interpretation. And then we could potentially get even as many as 4 dissents in both directions this afternoon.
Well, it's going to be a very interesting meeting, perhaps, Lisa, the most interesting meeting that we have had in years and years. Markets are pricing, of course, the idea of a hawkish 25 basis point cut with those multiple dissents expected on both sides, some thinking we should cut more, some thinking they shouldn't cut at all. We'll get the dot drama of who thinks or how many think they're going to cut how many times in 2026 and their unemployment and inflation outlooks for the coming year. But as you mentioned, it's the dissents that will get a lot of attention, both in the dot plot, because how many people thought they perhaps shouldn't have cut rates at this meeting. We haven't had 3 dissents since 2019. We haven't had 4 since October of 1992. Now, if you want to go beyond that, 5 dissents, wouldn't that be fun? 1983 was the last time we saw it. We haven't had 3 governors dissent since June of 1988, so we'll see what Bowman and Waller and Myron do. If they all dissent, then that breaks somewhat continuing record. So we will be watching closely to see what they do, and we'll have all that for you at 2 p.m. and 2:30 with the Chairman's news conference.
Yeah, the Fed party like it's 1988. Michael McKee, thank you so much. Let's stick with the Fed. Tiffany Wilding of PIMCO writing, we expect the Fed to deliver another 25 basis point cut while at the same time signaling that it's likely to start 2026 with rates back on hold. Tiffany joins us now. Tiffany, great to have you. Thank you so much for being with us. So you think a hawkish cut is what's on deck later today?
Yeah, absolutely, and thanks for having me. Yeah, so we ultimately think they will cut at this meeting, but all of the other information that we're going to get will probably have a hawkish shift. So we think there's a pretty good chance that the 2026 median dot shifts up from implying an additional cut in 2026 to being on hold. We also think Chair Powell will be having to explain at the press conference that this is the last cut for a little while. We ultimately think the Fed is likely to be on hold throughout his term, and you could also see some hawkish shifts in the statement. Really sort of underscoring that additional cuts from here will be dependent on downside risks that we've been talking about in the labor market actually being realized.
How much does it matter if he indicates that he is going to hold rates tight, given the fact that he's probably not going to be on the Fed after the first couple of months of next year? In other words, is he just a lame duck, or does he have more clout on the committee than some people are giving credence to?
Well, I mean, ultimately, he has not signaled that he's going to step down. So there's a very good chance, although, the precedent has been that chairs, when their chair term ends, they do ultimately step down from their governor roles as well. But it does seem like there's more question around if Powell will do that. If he does stay on, then he will have a say. He'll continue to be a voting member on the FOMC as long as he's there. Ultimately, the markets have already priced out. I think the next additional cut is more fully priced into markets in June. So that markets have kind of reflected this idea that we're probably going to be on hold for the remainder of the year.
Do you think he hasn't?
For the remainder of his term.
Do you think he hasn't signaled yet, to your point, whether or not he's going to step down as a governor, although it would be very odd if he didn't leave the Federal Reserve when his chairmanship is up. Do you think for him it really is highly dependent on who the president picks?
Yeah, I mean, Powell. It will be obviously it will be a little bit unprecedented for him to stay on. I think Michael Barr is another one that is also a question of if they'll step down, and we haven't heard anything from him on this. Yeah, and I mean, I do think that both of those folks and everyone at the Federal Reserve is very committed to the independence of the institution. And I think their commitment to that, could drive them to stay a little longer. But, of course, we'll have to see.
When it comes to Fed independence, the president yesterday was talking about how these governors appointed under the Biden administration were done via the auto pen. He wants the Treasury Secretary to look into it. A lot of people don't think this is going anywhere because without legal challenges, these individuals were Senate confirmed. But do you think at some point the market will maybe test and this concern about Fed independence?
Yeah, well, I mean, this has been a major a point of issue, and I think the fact that we're even talking about it, is maybe somewhat concerning in terms of the broader market discussion. But I think there are several points next year where that discussion could certainly come to the forefront. Now we'll have, I guess, in January the president will announce who he is picking for the Myron opening. And we think ultimately that will probably be who he wants as the next chair. But then after that, we'll also have the Lisa Cook case that is also being heard early next year. And the merits of that case are likely to be announced later in the year, possibly in June. So that will be another point that the markets will have to contend with this question on how many personnel, how many new governors ultimately Trump will have to put on the FOMC. And there is a scenario out there where he has a significant amount of governors that he can appoint, which can shift the view or the bias of the committee in a more dovish way. Of course, we'll have to see what happens, but it's certainly a risk.
Tiffany, it seems like a lot of people in the markets believe that actually the Fed does have room to cut a significant amount more, in addition to the 175 basis points of rate cuts that we've gotten since September, if the Fed does indicate that they are going to lower by another 25 basis points today. Why do you disagree with that, given the fact that we have seen some potential hiccups in the labor market and real concerns, certainly in sentiment surveys among consumers?
Yeah, well, I mean, we're much clearer, we're much closer to neutral now than we were, even back in June, right? With today's rate cut, we'll be 75 basis points closer. I think the median FOMC official puts the neutral interest rate at around 3% right now, so we're very close to that. On the other side of that, though, you do still have inflation that's running above target. 3% is where we think that it'll end the year this year. Growth has been much more resilient than expected in 2025. You have consumption that has been much more resilient than expected in 2025, despite the labor market weakness. And that growth resilience of 2025 is what's coming into the year, where we're also expected to get more fiscal easing. So the One Big Beautiful Bill Act that was passed last year included some pretty decent-sized fiscal easing and supports that offset the tariffs in the first half of this year. So consumers and households will get pretty big tax refunds. So we think there's certainly a risk here that you could see inflation that's a bit more sticky and takes a bit, is further delayed in making progress towards target. And the prudent thing to do in that scenario, is to continue to wait because you've already cut rates closer to neutral. But taking a step back from all of that, we would agree that there is more room to cut interest rates versus neutral here. It's kind of more just a matter of time and risk management in terms of the Fed outlook.
Tiffany Wilding of PIMCO, thank you so much for being with us this morning. Turning now to bonds. Bond yields sniffing out something. Global yields rising to levels not seen since 2009. Robert Tipp, head of global bonds at PGIM, writing, a disappointment trade is unfolding across several developed markets as investors come to grips with central bank rate cutting cycles that may be ending soon. Robert joins us now. Robert, thank you so much for being with us. What exactly do you think is behind what is going on in long bonds globally, not just here in the United States?
Right. Well, there's quite a bit of focus among bond market investors on the JGB market, right? Japan, after achieving their inflation, more than achieving their inflation target now for some time, has been hiking interest rates, and you've had a tremendous bear steepening of their curve, with their yields pushing up and into European bond yield levels. And so the bottom of the envelope of what people saw as reasonable DM yields and the lower end in extremis has been pushed up. At the same time, central bank easing cycles have ended and raised the question of, is the next move a hike? And this has happened in a number of places around the world, whether you're looking at Europe, whether you're looking at Australia, New Zealand, Canada, where all of a sudden, after these eases, you get a delayed reaction in the economy, and all of a sudden the markets have to think about, wow, where should the 10-year be if the next move is going to be a hike? And so I think that's been an element in the recent sell-off in treasuries.
Do you think, Robert, that there is anything that the Federal Reserve can do to lower 10-year yields if this is a global phenomenon, even with the use of balance sheet, even with potentially an additional 100 basis points of rate cuts over the next 16 months?
Right. Well, I think that the Fed wants to have a balanced outcome here. They want to have inflation come down to target, and they want the economy to keep expanding. And when you look at what the Fed's guidance has been for the last 2 years, it's been that a couple years out, they were going to get towards a 3% Fed funds rate. And as they did that, the yield curve would achieve a slope of about 100 basis points, and the 10-year would be around 4%. And honestly, I don't think there's going to be a lot of change from that. In your coverage of the ECI, here we've seen this in the other BLS statistics as well. Wage growth is very moderate. That is an ultimate driver of service inflation. So there is reason for the Fed to look at the slowly rising unemployment rate, see that building slack, have some optimism that inflation is not going to spiral out of control and ease. And I think one of the things that could curtail or not, depending on how things go today, some of this increase in rates is where we see the dot go for next year. Right now, there's a 3.6 and done kind of cluster of dots there for next year. And I think you're going to see that tick down. I think some of the longer term dots you may see move up towards that level. But I think creating some optimism that rates are still headed down towards 3% in a soft landing, successful scenario may help to cap yields here.
If you do get a really dovish Fed that comes out, even Fed Chair Jay Powell indicates that there is more rate cutting ahead, and you do see that long-term dot not move up, but actually stay lower and continue to go down. Does that make you more bearish on long-term bonds? Does that make you concerned about the investment prospect longer term?
Yeah, well, I think the front end of the curve is an important anchor. And if you get a massive drop in the front end of the curve, it's going to be very difficult for the $8 trillion in money funds to sit there earning much less than treasuries and say that they're going to have a buyer's strike. So I don't know that that would push yields up. But in terms of a dovish outlook for today, I think one of the things that the potential nominee Hassett has indicated is forward guidance is kind of dead. You know, once you're not at zero and you know you're going to be there for 5 years, you're up, you're at 3.9%, you can't tell people what you're going to do. So I think they're going to leave it open-ended today. But the fact of the matter is the economy is decelerating. They have optimism that inflation is decelerating. And I think that, you know, somewhere within, you know, a quarter point of where we are here, you're going to see a cresting of yields on that kind of optimism.
Robert Tipp of PGIM, thank you so much for being with us this morning ahead of the Fed. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. New data from Pfizer suggesting a potential change in the future of breast cancer treatment. A study revealing that adding Pfizer's Tukysa medicine to initial therapy treatment delayed tumor progression by over 8 months. Researchers say the findings support giving the drug earlier, potentially prolonging the time until the disease progresses. Meanwhile, JP Morgan announcing it expects to spend $105 billion next year, higher than the top estimate from analysts surveyed by Bloomberg. The consumer and community bank is a big driver of the expense growth due to higher compensation for advisors, product marketing, building branches, and investing in AI. And Oaktree Capital co-founder Howard Marks says AI has created a terrifying outlook for employment. He warns that the assumed productivity boom from AI fails to consider how many people will actually be able to afford the additional goods produced. Tune in tomorrow at 8:45 a.m. Eastern for Lisa's interview with Howard Marks. That's your Bloomberg Brief, Lisa.
Thank you so much, Yahira. Up next, Bloomberg's Ed Ludlow, breaking down the latest reports surrounding DeepSeek's usage of NVIDIA chips as we wonder the national security aspect, the issue between China and the U.S. and trade relations, and then the ongoing desire for the likes of NVIDIA and AMD to get a full footprint in the international chip sales space. From New York, this is Bloomberg.
Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1-1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzón.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Caroline Connon in Paris, and this is Bloomberg.
We have to step back and understand something, that bond market cycles are very long-legged things, and the 40-year bond bull market ended at the pandemic lows in 2020. If you think about it, it's almost remarkable that the confluence of the U.S. being the premier destination for capital has actually caused spreads against global bond markets to compress.
That was Julian Emanuel of Evercore ISI on the surge in global yields ahead of today's Fed rate decision, making the argument that, if anything, U.S. rates are relatively low compared to the global bond yield sell-off. And indeed, if you take a look at bond yields right now, they are below where they were to start the year at 4.6%. Right now, we're at 4.2%. So yes, still it is up from the recent lows, but down from the start of the year across the board. 2s, 10s, and 30s. You are seeing a little bit of a sell-off, but nothing very dramatic. Counting down to the opening bell, here's a trading diary for the week ahead. 2 p.m. Eastern, the FOMC rate decision, followed by Fed Chair Jay Powell's press conference at 2:30, plus earnings from Oracle after the closing bell, a real question around the indebtedness of that company. And plus Thursday, another round of jobless claims, as well as earnings from Broadcom and Costco. Friday, we get Fed speak again from Presidents Anna Paulson, Beth Hammack, and Austin Goolsbee. Turning back to a developing story, the information reporting earlier today that Chinese AI startup DeepSeek used NVIDIA's top-of-the-line Blackwell chips to develop an upcoming AI model. Sources saying that the chips were smuggled into China via other countries permitting their sale. Bloomberg's Ed Ludlow joins us now from San Francisco. Ed, thank you so much for being with us. This is something a lot of people suspected, that DeepSeek couldn't have done this without access to some of the highest tech chips. How does this change the landscape in terms of what people understand about the efficiency and some of the gains that we've seen in Chinese AI technology?
Well, it changes the landscape, for one, because it's currently illegal and prohibited for the Blackwell technology to be exported to China. Again, this is the information's reporting, and Bloomberg has not verified the reporting. But what the information report sets out is that DeepSeek acquired the chips at a point of origin, a country where they are permitted and were already installed in data centers where they were authorized. Those servers were dismantled and the chips were smuggled into China, according to the information's report, even passing inspections by server companies that are authorized to do business. So there is some disconnect there. And again, in the information report, DeepSeek has not commented, NVIDIA has not commented, Bloomberg has not spoken to either of the parties. There's a line in the information report which I want to flag very clearly. The information are reporting that DeepSeek would use thousands of the Blackwell chips to train a major model that is not yet released. Now, the reason that's important is that when you speak to anyone in industry, even with Blackwell, the absolute cutting edge at this moment in time, if you're going to train a major model, you don't need thousands of Blackwells. You need hundreds of thousands of Blackwells. And bearing in mind that NVIDIA will ship millions of units of them this year, but is still supply constrained to an extent, the question will be, well, hold on, how do hundreds of thousands of Blackwells go missing or unaccounted for? And is the information right here that it's thousands? Because,
and also which countries potentially we are seeing some of this leaky tech. And also, can you give us an update on what's going on with the H200? Seems that there are Chinese firms who are interested and want to buy them.
Yeah, so as I understand it, according to one source, the president was given a range of options, right? Export zero, no tech, because of national security risk. Export all the tech, the absolute latest, flood the Chinese market, cut off Huawei, the oxygen to Huawei. They decided to go with H200, not as good as Blackwell. But what China and Huawei have been able to do is take that specific chip and in the form of a rack or a cluster at scale, lots of chips in aggregate, get performance out of its Cloud Matrix 384 system that it is comparable with Blackwell. So that's the narrative, right? They're exporting H200 to the Chinese market. It's 18 months behind the technology that American companies have access to. Blackwell is what we're talking about. But noting that the real concern is that actually China's found a way to get performance out of technology that is generations behind at the chip-for-chip level.
Ed Ludlow of Bloomberg, thank you so much for being with us. We look forward to hearing all of Ed's reporting. He did have this incredible scoop about SpaceX potentially having an IPO of $30 billion next year, one of the biggest ever. Really interesting at this moment.
Yeah, mid to late 2026. So this is going to be a massive story for Elon Musk and those investors that are into SpaceX for next year, and Ed Ludlow leading the coverage there. That is going to be something, wow, because people kept thinking the timing would slip until 2027. Doesn't look like it.
This is the backdrop that we're looking at with a lot of enthusiasm around tech of all sorts, whether it's SpaceX, whether it's Oracle coming out after the opening, after the closing bell today. Coming up on the Fed special, which really is the marquee moment, 1:30 p.m. Eastern, Bob Michael of JP Morgan, Subhadra Rajappa of SocGen, Matt Lazzetti of Deutsche Bank, and Stephanie Roth of Wolfe Research. The expectation is that we are going to get a 25 basis point rate cut. That leads to 175 basis points of cuts since September of 2024. It has been a real easing cycle that has come on in a stealth mode, with a lot of people sort of suggesting that policy was still tight.
And at the same time, when the Fed has not reached their inflation target, the bias right now is still to the labor market. The press conference is going to be so interesting because obviously on the other side of Washington, D.C., there might be interviews taking place for who's going to be the next Fed chair. And how many dissents do we get at this meeting? And what is Jay Powell going to say about it?
Yeah, and does it matter? Can he wrangle together a committee that is incredibly divided, potentially the most divided, going back to the 1980s. Coming up tomorrow, Dan Skelly of Morgan Stanley will be joining us, Libby Cantrell of PIMCO, Kristen Bitterly of Citigroup, and don't miss this, Oaktree co-founder and co-chairman Howard Marks, after a memo where he talked about the possible concern around job losses tied to AI, plus questions around a tech bubble. This was Bloomberg Surveillance. Good morning.
Okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
It is hump day, 30 minutes until the start of the cash trade. I'm Matt Miller.
And Fed Day, I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, a divided Fed is set to deliver another rate cut today, but the big question is, what happens next?
And Oracle's earnings may set the tone for the final few weeks of the year as those AI bubble fears still linger.
Plus, SpaceX plans to launch the largest IPO of all time, and it could unleash a wave of listings in the new year.
Matt, I want to give a check on Meta shares this morning. Let's go over here and take a look because I think we might be getting some news from them. Yes, we are indeed. Shares are now down 0.03%. Meta's Mark Zuckerberg, he has directed his team to pivot away from open source AI. According to news, again, we were just breaking that moments ago. Zuckerberg apparently getting involved in the day-to-day work of Meta's AI plans. They're developing a new model codenamed Avocado that it may charge users for access. Matt, we're going to talk to more about Ed Ludlow for this, but it just shows maybe some divide, a little bit of discontent, at least when it comes to Meta and their AI.
All right, well, interesting. From llama to avocado. Stocks like EchoStar and Rocket Labs are climbing after Bloomberg learned, and we're going to talk to Ed about this as well. SpaceX is moving ahead with plans for an IPO targeting a $1.5 trillion valuation. It would raise more than $30 billion to fund projects including space-based data centers, and that would beat out the Saudi Aramco IPO, which remember was $29 billion raised.
Yeah, it would be huge. Let's get to both those stories. Joining us, as we said, is Bloomberg Tech co-host Ed Ludlow, joining from San Francisco. Ed, a very busy past 12 hours, just starting on this Meta story, because the story with Meta typically is they hire, ex-AI expert from Apple. They've hired up so much talent. You'd think that they have an insane bench and that things are going smoothly. Does this suggest that things are not going so smoothly with Meta and their development of their AI offering?
Well, in the first instance, when the story hit, there was a kind of strange algo spike and then drop in the shares, but we're now down 1.5%. So it's difficult to interpret the market's read on Meta shifting to closed model. What Kurt Wagner and Riley Griffin, our colleagues, are reporting is a lot of detail about the specific model, Avocado, which had originally been planned as an open model and, according to sources, may launch as a closed model. It's interesting in the technology development side because what Meta did was take models from others, including Alibaba's Gwen model, for example, and use that existing work to distill and prepare their own model. That's something that Frontier Labs do all the time. But it's not new, the idea. that Meta might go from a very clear open source approach to closed. Mark Zuckerberg talked about it in July's earnings call, basically saying at some point in an open source world, the models are so big and the resource requirements are so high, what's the point? Academics don't have the funds to work at that scale. And really, it's only relevant to private industry if you're working on a model that has that level of parameter and requirement.
All right, that's a fascinating story we're going to continue to dive into. I want to ask about the SpaceX story. Your name was on the byline yesterday, and it looks like we could have a $1.5 trillion valuation. And in my mind, I'm always adding up Elon Musk's assets to see if he ever gets to $8.5 trillion in total.
Yeah, my understanding is that this is very much underway. The work is being done by SpaceX's management, by SpaceX's board. The target is the middle of 2026. Things always change, right? So the valuation, where we settle, we'll find out. It's interesting. From the amount of money they want to raise perspective, this could be the biggest of all time. And what sources tell me is it's going to be far north of $30 billion. Which is interesting because Musk has really pushed back recently on SpaceX's capital needs. But what sources explain to me is that SpaceX has this vision where humankind is multiplanetary. You know, Musk has talked about this, the role of Starship in getting us to Mars. But the next big market for them is space-based data center. Literally taking AI GPUs, putting them in a satellite form factor, putting them in constellation, running workloads in space, largely inference. That's going to take a lot of money because SpaceX would need to buy the chips. And I think that that's the story here. But who doesn't love the story, potential biggest IPO of all time?
No, it's a fantastic story. And by the way, do you follow my logic on the $8 trillion? Like Tesla's worth 1.5. You know, SpaceX is going to be 1.5. You start to fold these things together, and eventually he could get to this milestone that would give him a $1 trillion payout.
Just really quick, can I ask your audience if they know the answer, like message me on socials or whatever, but as far as I can tell, in SEC rules, any other rule, there's no rule that precludes Elon Musk being the CEO of two more than $1 trillion market value companies. How do they work together? Interesting, like we talked a lot about Elon Inc. You know, if they're going to do space-based data center, isn't that highly analogous with XAI, a private company? I'm trying to work that out. That's kind of the next frontier.
All right, fascinating, fascinating stuff. This is why we look forward to your show every day at 11. Ed, thanks so much for joining us. Bloomberg Tech's Ed Ludlow there. We also have our eyes on Oracle and Adobe. Both companies will be reporting earnings after the bell today. And of course, Oracle is under the spotlight. It's got to ease investor anxiety about a potential bubble in the AI spend as Adobe fights increased competition. Let's discuss with Anurag Rana, senior tech analyst for Bloomberg Intelligence. So first off, Anurag, with Oracle, what do you need to see from them?
I think they need to come out and talk about where is the money coming from and how are they going to fund this massive RPO that's on their balance sheet, because that's really what the biggest uncertainty right now is. How's this big OpenAI order going to flow into sales down the road?
Anurag, I mean, just how much is at stake in terms of the narrative of debt building up, especially for Oracle with CDS spreads widening up? How much is at stake when it comes to that and the ability for markets to not push this? What we're looking at is CDS spreads even higher.
Yeah, when you look at Oracle, you know, they've given a very large number of sales target of about $225 billion by FY30. That a large portion of that is going to come from those OpenAI workloads or the AI workloads. So everything rotates around how is this consortium going to fund the expansion, create new data center, and how is OpenAI going to use those, you could say, the big promises that they have made into sales for Oracle? I think that's all we care about at this point. Everything else, to be honest, is on the backseat.
All right, and of course, we'll see Adobe as well. I want to pivot, though, to an NVIDIA story with you, Anurag, because we've been talking with Mandeep, your colleague in the tech coverage at Bloomberg Intelligence, about you know, whether NVIDIA can sell chips into China, whether the Chinese will buy them. It seems that Beijing is trying to dissuade private companies from doing that. But it turns out that DeepSeek is planning on using NVIDIA chips in its next model. So they clearly want to use this product and have some access to it.
See, when it comes to training, I mean, I don't think there is a chip out there that's better than what NVIDIA is offering. So if you are trying to compete for the best frontier model out there, I mean, you will be using those chips one way or the other. Whether you publicize or not, that's different. Very few companies have the access to Google TPUs, for example. So NVIDIA is the normal choice for them, especially for training. You know, for inference down the road, we could argue that, you know, you could use other semiconductor devices, but, you know, for now, we really need NVIDIA for training reasons.
Yeah, a really interesting story from the information. Anurag, thank you so much for joining us. Anurag Rana of Bloomberg Intelligence, who, by the way, is going to be back in the next hour. Anurag and the team at Bloomberg Intelligence did a fascinating story. It is the biggest C-suite survey that reveals heightened awareness of AI disruption risks, so stick around for that conversation. First, though, the Fed is expected to deliver another rate cut today. The surprise may come to how dovish or how hawkish their guidance is. Joining us now is Michael McKee, Bloomberg's international economics and policy correspondent. Mike, there are some analysts out there saying that we might have as much as half of the committee possibly opposing whatever outcome we get from the Fed decision. Just how much of a divided Fed are we going to be getting today?
Well, we're going to get a divided Fed. How much they want to publicize that is kind of the question, Danny. I mean, with all this tech news going on, the Fed is going to have to really perform today to try to get in the headlines, and I think they might do it. We did have a little bit of news just a short time ago. The employment cost index for the third quarter came out, and it showed wage growth is slowing 3.5% on an annual basis for the quarter, and that just suggests that the affordability problems people are talking about are out there, but it also means that it is not an inflation issue. So we shall see if that figures into their decision. Now, as you mentioned, we are expecting what is called a hawkish cut. They'll cut by 25 basis points, but in theory, signal that they are not going to be cutting anytime soon after that while they wait to see what happens with the economy. And we are expecting multiple dissents. Remember, last time we had two, one on each side. This time, there could be as many as 3 or 4. We haven't had 3 dissents since 2019. We haven't had 4 since 1992. So that might get us on the front page. Dot drama. The market sees 2 cuts in 2026. How many does the Fed see? And how many say they did not see another cut this time, even if they weren't a voter? That's going to get a lot of attention out there. Also, the unemployment and inflation outlook that we get from them. So look forward to seeing a lot of perhaps division. Of course, the minutes are going to be very interesting, but this is definitely a divided Fed, even if the markets are pretty certain about what the outcome is going to be.
All right, Mike, we look forward to the meeting, to the outcome, to you on Bloomberg Television this afternoon. Michael McKee in Washington, D.C. Don't miss our special coverage of the Fed decision that kicks off at 1:30 p.m. New York time right here on Bloomberg Television and on Bloomberg Radio.
All right, a quick check on markets this morning. Sorry, Matt.
No, I appreciate it.
You paused. I thought maybe I'd jump in. Okay, S&P 500 and NASDAQ futures are still negative this morning after a day where we kind of did absolutely nothing yesterday. We basically did nothing the day before. Small caps did outperform. They underperformed today. Matt, it has been bond yields under pressure, moving higher. That's been pressuring stocks, but maybe going a whole lot of nowhere today just until that Fed decision.
Yeah, right now at 418, almost to 419 on the 10-year yield, which I've found fascinating ever since Ed Harrison's story out on Monday that global yields were going to drag interest rates up here in the U.S. as well. Let's get a look at some of the other movers on our radar. Single stock stories that you don't want to miss. People in the control room truly concerned about Cracker Barrel.
You're not?
It expects sales to fall faster than previously had been forecast. It does plan to cut costs by up to $25 million to offset those losses. But don't forget, in case you're skipping it because of the logo, they went back.
They did go back.
They went back.
How much of this is people being like, oh, I'm mad at them for the logo thing, so I'm not going to go, versus people just aren't going to Cracker Barrel?
Still just a delightful place
it is
to bring the family.
It is an old country store, and you gotta love it. By the way, GE Vernovia, a completely different company. It's surging. It's doubled its dividend. It's boosted buybacks to $10 billion. It's a firm part of its 2025 guidance because they do energy and AI demand means we need more energy.
Yeah, a lot of dividend news yesterday. MasterCard also $15 billion, buyback. Chewy exceeded the high end of net sales guidance as it retains customers through pet supply subscriptions. You can see Chewy shares up almost 7% in the pre-market.
Coming up, we're going to talk more about AI. It's expected to drive, at least for now, a hiring boom on Wall Street as investment bankers build out deal data sets. We're going to have more on that coming up. And in the next hour, we're going to talk about AI, private credit, and more. We have an exclusive interview with Blue Owl co-president Craig Packer. Don't miss that and more on Bloomberg Open Interest.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with another season of The Deal. With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones.
Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it.
Up to the minute news whenever and wherever it happens. I'm Haslinda Amin in Bangkok. This is Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Getting out of high interest, look what's making headlines around the world. The U.S. is proposing that all visa-exempt visitors from nations like Australia, Germany, Japan, and the U.K. submit 5 years of social media history before entering this country. Customs and Border Protection says the data would become mandatory through the online travel authorization system. It comes as the Trump administration tightens entry rules and reviews past approvals. Eileen Higgins has won Miami's mayoral runoff, defeating Trump-backed Emilio Gonzalez and becoming the city's first woman and first Democratic mayor in nearly 30 years. Her decisive 18-point victory caps recent Democratic gains nationwide. The win is a shot in the arm for Democrats in Miami, who have been losing their grip on South Florida, previously a Democratic stronghold that previously a Republican stronghold. Obviously, it's South Florida that Trump won by 11 points last year. Investment banks are mining years of deal data to sharpen their AI tools and win more mandates. Moelis and Houlihan Lokey say richer data sets help them advise clients faster and better, and in some cases even create new data products. Executives insist AI won't replace junior bankers, but it will speed up deals and boost productivity across the industry.
Let's get more on that story, Matt. Joining us now is the reporter behind it is Bloomberg banking reporter Todd Gillespie. And Todd, the reason this story, I think, captured a lot of people's attention is it feels like a little bit of the opposite of the narrative. The narrative had been that AI is replacing bankers, it's going to cost jobs. This is saying maybe at least for now it's additive.
Yeah, well, we're certainly at this stage, Danny, where investment banks are sort of trying to calibrate, trying to understand exactly where the productivity savings are coming from the AI tech that they're doing. Remember, this is a heavily relationship-based industry, always has been. It's about the relationships with bankers and their clients, sometimes that last decades, golfing, family, you know, all this kind of thing. That's really the meat of what the industry is about. So for these people to now sort of try to understand efficiency savings and implementing technology that they've never really had to think about that deeply, maybe apart from the old Excel spreadsheet and modeling, you know, thinking about what that really does to the composition of the bankers that they have, the relationships that these bankers might bring in, balancing all of these different considerations. Some of these banks are now sort of, they're sort of in that phase where they're thinking about what is this going to do to our headcount. Some of them further down the line admit maybe this may still change. I think it's maybe still too early to say definitively whether some of these investment banks might start hiring fewer junior analysts. Maybe these analysts might just be emboldened to do more of the relationship type work.
Is it too early to say that? I was having dad's drinks last weekend in Scarsdale with a bunch of lawyers and consultants and investment bankers, and they all said that they don't really have any reason to hire a freshman class. Like, AI does almost everything that these kids would be doing.
Yeah, well, then that raises the question, Matt, like, what happens when, I mean, I'm sure you're a long way from that and your friends are a long way from that, but what happens when they retire? To have senior bankers, you need junior bankers coming
No, that's exactly the worry. That's exactly the concern.
And so I think you sort of need, to some degree, to have these people who are at least trained on these tools. And I think, you know, Blair Efron said this a little while ago, but, you know, he was sort of saying if he was advising someone to go and study at university now, actually going and studying a liberal arts degree or thinking about critical thinking skills is just as important, if not more important, in the AI world than understanding the tech. As long as you can use these tools, actually the edge that you gain in using these relationships and knowing how to build these relationships and capitalizing on that is just as important as it ever has been, if not more important.
Yeah, and you feel bad for everyone that was like, go get a computer science degree, because that's going to be the thing, but now coding can just be done by AI. Separately, okay, hiring is one thing.
All software can be done by AI.
All software. We're going to have this conversation later on, Matt doing a deep tease for the show. Okay, but at the same time, what you're describing is hiring people to bring in AI expertise, developing these different models. That costs money. How much of that is related to the JP Morgan warning we got yesterday from Marion Lake that they are going to be spending and having higher costs than they previously assumed?
Yeah, I mean, it's certainly one thing that she did raise in her long list of causes for a rise in expenses that sent their shares down about 4% yesterday. I mean, I was at the conference myself. A lot of the investors and analysts there were quite shocked, thinking about the read across to the rest of the industry, how much of this higher spend is going to be affecting, it's going to be seen at these other banks as well. So far, we haven't quite seen that read through. JP Morgan did also list off, higher compensation for advisors, branch building exercises, and AI as well. So it's kind of unclear at the moment exactly where that cost is going to be allocated. But it is reminiscent of an episode a few years ago of when JP Morgan did also come out with higher than expected guidance and then had to go and pacify investors through an Investor Day by breaking it all down in a minutiae way.
I was just looking to see what your major was when you went to Harvard and Cambridge.
Thanks, man.
Yeah.
Never heard of them.
Political science?
Yeah. So yeah.
Danny, your major?
Journalism.
At UVA?
At UVA, yeah.
All right. Excellent. Todd, international business at Antioch College, the now defunct.
Well, at least you can do math.
Antioch College. Todd Gillespie joining us from the BN side and Harvard and Cambridge. Coming up, Allsprings Ann Milletti shares her top 6 ideas for 2026. This is Bloomberg Open Interest.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
We're coming to you live from Kuala Lumpur. The whole world is here.
The APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Given this sort of extraordinary time that we're in, where earnings are going to be good, the economy's humming along, even with the questions around labor, but the point is both monetary and fiscal stimulus really do have the potential. We've said there's a 30% chance that you get a full-on bubble next year, which we define as 9,000 in the S&P 500, and which I think is also why, on balance, the Fed is trying to remind everyone of the dual mandate in general.
Julian Emanuel from Evercore, who, by the way, his year-end price target is 7,750, but says we could go to 9,000 in the case of an AI bubble. Let's bring in Allspring's head of equity investment, Ann Maletti. Ann, wonderful to see you this morning. I mean, 30% odds that we get, that seems pretty high. What do you think are the odds that we get a real bubble building in some of these AI names, which already have very lofty valuations?
Yeah, I mean, I kind of liken it to the fact that we've moved from still to sparkling water. So lots of little tiny bubbles, whether any of them emerge as a bigger bubble that causes a major problem has yet to be seen. And I know the last time I was on, we talked a little bit about the internet cycle and working through that as an analyst myself, as a media analyst. And it was like, are we in 98 or 99, or are we closer to 2000? And I think that's kind of what the market's trying to determine right now with AI. I mean, the innovation cycle is real, but as you go through the CapEx build, it's likely that there's a lot of money being spent that probably doesn't need to be spent.
Yeah, it seems like it's a question of when, but not if, right? There's always a bubble of some sort when you get this level of disruption in technology.
Yes.
All right, Ann, you're going to stick with us. We got to pay the bills first, so we're going to go to break. But after that, the opening bell coming up as we look at futures that are doing a whole lot of nothing. Once again, what's going to break us out of this cycle? Well, maybe it happens today. Remember, it's Fed Day, and we got the opening bell, the cash trade on the other side of this break. This is Bloomberg Open Interest.
would say that there's maybe a little bit of a bubble in AI. When you have companies with market caps of $5 trillion, you don't see any bubble there at all?
Whenever we have an acceleration in technology and people get excited about it, you have significant capital formation around new companies that are trying to capitalize on that opportunity. And, you know, we've seen this before through history, and you're seeing it now. It won't be a straight line. The opportunity set with AI is enormous. There will be winners and losers. And it's hard to pick the winners and losers now. And certainly a lot of the capital that's being deployed will not produce adequate returns, and a bunch of the capital that's being deployed will actually not produce any returns. But it's hard, it's hard to call the timing on these things. And the thing I'd point to just from a historical lens is in the fall of 1996, Alan Greenspan talked about irrational exuberance in stock markets, and the NASDAQ was at 1,300. And the NASDAQ peaked 3.5 years later on over 5,000. So, these things can go on for a long time, but ultimately, there are adjustments, there will be drawdowns, there'll be rebalancing, and just, it's hard to call it because the technology trend and the investment is real.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geoeconomic news whenever and wherever it happens. I'm Bonnie Quinn in Sao Paulo, Brazil, and this is Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and it's Fed Day. So typically what we see on Fed Day is not a lot of movement. Essentially, traders turn off the algorithms and wait until they get a human to parse through the statement. We're not seeing a lot of movement right now in futures. They are to the downside, and we haven't had a lift for a few sessions now. So we'll see what happens at 1:30 p.m. today. We air our special The Fed Decides. Tom Keene coming back to TV is always an amazing thing to see. So definitely you're going to want to watch this. The Magnum Company ringing the opening bell down at the New York Stock Exchange after their IPO, a spin out.
Cowbells?
That we
Is
saw.
That normal? That's not normal, right?
Oh, you need more cowbell. I think you need more cow.
It's the only cure.
You always need more cowbell. And this guy has a tie-dye shirt on, which I love, what an interesting story, and MICC, the ticker there, and it was an $8 billion market cap. So wearing leather jackets down at the NASDAQ Stock Exchange with a man bun, the CEO of Atlassian, which, believe it or not, Danny is, you know if you watch the show, Danny is the Formula One addict. So
I was going to say, the reason I know who they are is because they're the title sponsor for Williams. Like, they're Williams, Atlassian, Racing, or whatever. I don't know much about the company. I think they do data things, but they sponsor Williams, which is
very, very important, to Danny and 600 million people around the world who watch F1.
I'm not alone. By the way, Matt, I want to show you what Meta shares are doing here at the Open. They're not down as much as they were right around 30 minutes ago because we had that breaking story that Mark Zuckerberg has directed his team to pivot away from open source AI, according to our very own Bloomberg sources. And Zuckerberg is also getting involved in the day-to-day work plans of their AI. The firm is developing a new model codenamed Avocado that it may charge users in order to access. And so that's no longer Llama, now it's Avocado, and they're trying to make money off of it, Matt.
All right, very interesting story, and honestly, the competition builds. Do you pay $20 a month to ChatGPT? Do you pay $20 a month to Gemini 3? Do you pay $20 a month now for an Avocado, which is much cheaper than your typical monthly avocado bill?
You're so right, Matt.
Danny. All right, Oracle and Adobe reporting earnings after the bell. Oracle shares have plunged by a third since hitting an all-time high in September because investors are concerned about debt, because investors are concerned about AI spending. Adobe has been struggling to keep up with competitors in the AI age, and I guess a concern there is software is going to get eaten basically by AI. And You still won't be able to cancel your Adobe Acrobat subscription. Let's bring back Allspring's head of equity investments, Ann Maletti. Ann, what do you think about this idea that AI can do everything software can do? I mean, Howard Marks was out yesterday with a newsletter, not talking specifically about software companies, but talking about their employees and saying, you no longer need coders.
Yeah. Well, I think the new software environment is going to look different than it has in the past. And so while it probably doesn't destroy every software company out there, it changes the trajectory and the look of what the industry looks like going forward. And so I think it's going to be fascinating to see, but AI is changing a lot, and not just for technology or software.
I was going to say, you look at a company like CRM, for example, that's the ticker of Salesforce. I mean, the thing has gotten so beaten up. It's down 22% this year. The S&P is up 16%. Matt and I are going to be speaking with Craig Packer of Blue Owl in a little bit in the next hour, who about 30% of their funds, or more than that, is concentrated in software. For a client who has a big concentration in software, is this a scary time? I mean, would you be recommending taking positions, selling positions? What would you do with the sector right now?
Well, again, I think our teams are not as excited about this sector right now. But as an investor, what you have to really watch for first, I think, is pricing. And, you know, as a consumer, as a company that consumes a lot of software, you pay a lot. You were talking about, you know, from a retail perspective, what consumers pay, but businesses pay a lot for the software. And, you know, I think the first thing we'll do is see compression in pricing as companies figure out what they can do on their own with AI. And again, then you'll start to see the changing hands of, like, what can we do with AI? What do we need new software tools for?
So I wonder how it changes your macro view, right? As you know, productivity increases, does that mean that we add a point to GDP, as you know, some Fed governors have suggested, or does it mean that, you know, unemployment goes to 5%?
Yeah, you know, it's interesting because I do think the first phase of this is, you know, kind of, we call it AI 2.0. It's really, it broadens out the economy into, it broadens out into other sectors within the economy. And at first, it can create more opportunity, more productivity, higher margins in many cases. But it will definitely have effect on winners and losers. And again, I think that's where active management really can play a role, because company fundamentals and where companies are investing for the future and their management teams all play a role in what's going on there. And so that's where our investment teams are paying a lot of attention to.
By the way, one of the other big exciting narratives to end the year that's really had some juice to it is media consolidation with Warner Brothers Discovery. It's the kind of thing that would make for a really good book. It feels like Barbarians at the Gate 2.0. Does it say something to you about animal spirits? And again, you know, much of your career was as a media analyst. Does it say something about wider market conditions, the fact that this battle is even happening?
Yeah, and look, I'm fascinated by the battle given my former history, but it is one of our 26 themes, right? Broadening out of the markets into many different sectors. M&A as a pickup. We certainly have seen M&A pick up the back half of 25. I think we're going to see more of that. The market conditions are more conducive, lighter regulatory conditions for the most part, lower rates than we had last year. We have private equity that has a lot of, you know, companies that they need to get out into the public markets, and, you know, companies that I think are ripe for consolidation. And so that will continue. I think that actually plays into our third theme, which is, you know, small and mid-cap companies can still do well based on some of those macro factors, but they're also kind of great targets for M&A.
I got to ask, you know, as a former media analyst, when you look at the competitive landscape, do you look at, you know, streamer versus streamer versus streamer? And where does, you know, YouTube, and by the way, I'm only doing this because the tiles on my Apple TV are the streaming services, and then YouTube. But more and more I'm clicking down to YouTube rather than clicking on Amazon Prime or Apple TV to watch stuff.
Well, I know you have two little ones.
True.
And
so Disney is obviously an app
Disney,
that we're on all the time.
But I have 3 grandchildren too, and YouTube is still like a favorite.
I don't
place
believe
of
you.
theirs.
I don't believe you, Ann.
Thank you. I hope it's about the grandchildren, but the YouTube platform is, you know, more and more in future generations becoming more important than it was for my generation. Like, I don't spend a ton of time on YouTube other than watching Bloomberg in the morning, but I watch what, you know, not only my kids are doing, but my grandkids are doing too, to say, all right, what does future state look like? So I think you're right. The landscape has changed versus when I was following media stocks.
Such an interesting time. Ann, thank you so much for joining. You are truly one of the best. That is Allsprings and Maletti. I want to get a check on your equity market right now. As Matt pointed out at the open 8 minutes ago, going a whole lot of nowhere. We are slightly lower. Breath is pretty even between the upside and the downside. What is getting us there? When it comes to the upside, Amazon's doing really well. GE Vernova, they had earnings that were incredibly good. Dividends, buybacks, upgrades to their future outlook. In fact, they said that the backlog for electrification will double by 2028. You guessed it, it's an AI data center story. Looking at the other side, Microsoft, I've actually been trying to look for a reason for why this is so weak today. I don't necessarily see a clear one. It's down 2.5% today. Meta is doing poorly. Again, we broke that news, that Bloomberg scoop at the top of the hour, that they're rethinking some of their AI offerings. Intel is falling. This is lawsuit related. Those shares a little bit weaker in today's session. Looking at some of the sectors this morning, you can see a lot of those tech players were down. So you can see that. And the worst performing is Infotech, down 0.6%. Communications, same kind of companies too. At the top, you got industrials, consumer discretionary, real estate. But Matt, how much of this is going to change after 2 p.m.? Probably a lot of it, I guess. It seems like it's going to be a spicy Fed decision. So at least that's how things stand at about 9:40 a.m. this morning.
I got to tell you, I'm pretty interested in GE Vernova, and not just because of the dividend and the buyback story, but a few months ago, I had a viewer write in and say, dude, you guys have to look at the backlog for these gas turbines.
It's huge.
It's years. And obviously, they are, GE Vernova, the world's largest manufacturer and supplier of gas turbine technology. So it's just a massive piece of this data center build-out.
But it's going to get worse, right? They said in their earnings that the current backlog, which you said is going to be years for them, is going to double by 2028. So it's not getting better. It's getting even worse.
Yes. Charles, if you're watching, thank you very much for the note, and anyone else, feel free to write in with tips. Coming up, it turns out that the Cracker Barrel logo fiasco didn't help sales last quarter. Details on the state of the, is it a fast casual? It's not so fast.
It's a restaurant.
It's pretty casual, but it's not super fast. But it's delicious. We'll talk about Cracker Barrel, just a lovely place to spend time with your family, but not enough families are doing so. This is Open Interest.
The key issue right now for us in the diamond space is the declared divestment of Anglo from GBS. And as you know, Anglo holds 85% stake in GBS. Botswana, the government of the Republic of Botswana holds 15. We are resolute now, and we've communicated a firm intention to increase our stake in GBS to a controlling stake. We have lined up a number of potential collaborators with us, if I may put it that way. We have targeted funders, we have parties, we have the Oman Sovereign Wealth Fund, we have others who are willing and ready.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Bersachi in Beirut, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Let's look at some of the top calls this morning, what analysts are saying on Wall Street. First up, we have JP Morgan. They have upgraded PepsiCo. They cited strong productivity savings. We heard the story yesterday. PepsiCo has an agreement with Elliott. They're going to trim its lineup up to 20%. They plan to cut prices, streamline staff, which I guess means firing people, to help the company's focus. Shares are up 2% after a rally yesterday. Next up, HSBC. They've cut Biogen to a sale. The analysts say that the drug maker faces weaker growth, pressure to cut costs, and sees no clear deals on the horizon to revive momentum. Finally, Blue Owl, that gets an upgrade to a strong buy at Raymond James. The firm says that investors are overstating risks that its private lending funds will face heavy withdrawals next year. They also argue that Blue Owl's strong fees, high margins, 20% plus earnings growth make the stock too cheap. And as Matt just pointed out a moment ago, we're going to be talking to the Blue Owl co-president, Craig Packer. That's at 10:30 a.m. So in just under an hour's time, Matt.
Yeah, and they've had a big run up, 15% from the November low in shares of OBDC. So a lot to talk with Craig Packer about, but we want to get to Cracker Barrel. Shares falling as the company says sales will fall faster than previously expected. It is planning cost cuts to offset those losses and recover from an about face over its logo change. Bloomberg's Red Brown covers the restaurant industry, joins us. This is one that, I mean, for some reason, our control room, you know, the kids in the back row there have a very high interest in Cracker Barrel, and Paul Sweeney on Bloomberg Radio, it's like his #1 favorite restaurant.
All right.
So what's going on?
Yeah, no, this is a story that keeps on giving. It seems like, you know, the backlash that we all track so closely from when they tried to change their logo with this more streamlined look, removed this character known as Uncle Herschel from the logo. They still seem to be dealing with that fallout. It seems like consumers are still continuing to kind of punish the brand, or maybe they've left and just not come back. So we saw today, yesterday, excuse me, they lowered their full-year sales guidance below what analysts were expecting even. They said this, so far, quarter to date, sales foot traffic is down 11%. So you can really see in that number that like things are just lingering. This backlash is lingering so much, and now the company is kind of in this self-help mode.
How much of this, though, is like just an excuse? Okay, I'm sure it hurt, right? Because it can't. They got so much national attention that has to have some sort of repercussions. But we've seen a lot of the sort of food companies, restaurants, fast casual, whatever, that sort of market to kind of a middle type consumer not do well. So is there an issue with just Cracker Barrel in general, logo or no logo drama?
Yeah, I think so. For Cracker Barrel, like they also talked about how they struggled with some of these. They had this phase 1 initiative, and they were trying to like change how they do things back of house. And they said that actually made things a lot more complicated, made things harder to execute. They've had food problems. People don't like the food as much anymore too. So there are actually these things that they've done.
The Big Boy Country Breakfast.
There's things like, I mean, they're bringing things like that.
Everyone's on weight loss drugs. Maybe you don't want the Big Boy Country.
That is
you know?
a very good point, Amy. I do think, though, it must be a really different clientele than a Sweet Greens or a Chipotle, right? Cracker Barrel is on the highway. If you're on a trip, or if you're a family with kids that care about like Moana because they sell all those trinkets in the front. So it's not the same as a place you go for lunch in Midtown, right?
Yeah, no, it tends to be like you're saying, a little bit more family oriented, also a little older, which is a segment that we have seen like hold up well in some other restaurants. It might not just be translating into like the regional, more like rural areas that Cracker Barrel is in. I think in general their customer base does skew a little less economically healthy at the moment. So I think that also is weighing in to the results. The company did call out the economic situation. I kind of take that with a grain of salt because of some of these more structural issues that they're having between, you know, the logo change was obviously was a misguided, and then also some of these menu changes that they've done as well seems to not be resonating with the clientele.
Red, thank you so much for joining us. Red Brown, the latest with Cracker Barrel. Coming up on the show, SpaceX's potential IPO could be the breaking point, kicking off a new wave of IPO activity. We're going to look at the sector as a whole coming up next after this break on Bloomberg Open Interest.
Vehicle pitching downrange.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talked with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Bringing you up to the minute news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
This is Bloomberg Open Interest. Quick check on what's going on in stocks ahead of the Fed decision, and that's a key clause because usually nothing happens ahead of the Fed decision. Right now, we're looking at exactly that. The S&P 500 unched at 68.42. By the way, apparently we've replaced the phrase unch with just dash dash.
Ew, hate it.
I'm hoping at one point we see an unchanged move on one of these tiles, so I can verify that. NASDAQ 100, the tech stock's down about 0.2%, and you can probably see over my big bald head that NVIDIA is red. It is down about 0.2% as well. Obviously a big heavy weight. Facebook also off right now on, well, as we get news, not necessarily on the news, that it's coming out with a new AI product, Avocado, that's pay to play instead of the free llama. Oracle is down, Adobe is down. They're coming out with earnings later on. We're watching them closely, but EchoStar is gaining 6% right now, and Rocket Lab is up only a measly 0.2%. But the reason we tell you about these is because Ed Ludlow and team wrote a story yesterday that the SpaceX IPO could value that company at $1.5 trillion and bring in more than $30 billion in proceeds. And that's a key number Danny, because it beats out what we saw from Saudi Aramco as the largest IPO in global history.
Yeah, so it would be just a monster offering. What would that do to overall markets, to overall IPO markets? Bloomberg's Bailey Lipschultz has been writing that it could put $2.9 trillion worth of IPOs in play. He joins us to explain. Hey, Bailey, thank you so much for joining. I mean, is this just a case of like, you get this thing, if it gets digested by markets, animal spirits awaken, everything is fine and dandy for IPOs?
It kind of feels that way. We've been talking to bankers. They're always optimistic. They're paid optimists. But they were optimistic about 1Q before this became more real. And now as it gets more palatable, do we see SpaceX list mid-year? And what does that then mean for the OpenAIs of the world? As you see on that chart, a lot of valuation of these companies that have been staying private and been able to raise billions upon billions of dollars privately could then be encouraged to go public, something that we've been talking about for years, but it always seemed like maybe next year.
All right, so we're not going to overcome 2021, right?
No, it depends how big it is. Because if we say $200 billion was what was raised aside from SPACs in 2021, and SpaceX raises $50 billion, and Fannie and Freddie raised $25 billion, we're already $75 billion there. We're already on
valuations, right? But in terms of the number of IPOs, because when I talk to people from the NASDAQ, they're like, okay, you've got to take 2021. It's an outlier. So put it to the side when you're looking at IPOs. By the way, look at this. I feel like
I'm getting a little small. I make you feel small. Yeah.
Yeah, so, I mean, can we get back to that kind of craziness, that kind of froth, euphoria?
I don't think so. I think it would be one or two companies doing the heavy lifting. We use that $2.9 trillion number. $1.5 trillion of that is SpaceX. So it would be a number of these companies lifting kind of that tide. But we do have a number of companies looking to go public, and we do have a lot of excitement, whether it's artificial intelligence, whether it's quantum computing, or clean energy.
But that's the thing. Unless you're a big tech company, unless you're SpaceX, unless you have something that really fits with the thematic vibes of this market, can you IPO? Because private equity is still sitting on some real stinkers that they don't want to IPO into the market because they're concerned about what valuations they might get.
Well, we'll get the big test next week, and that is Medline. That's a company that's looking to raise north of $5.25 billion. That'll be potentially at the top end of the range, a $55 billion company, a critical healthcare company owned by a consortium of private equity, Carlyle, H&F, and Blackstone among them. So that'll be a key litmus test. How does that deal get executed? How does that price? How does that trade? Because again, if you stack up a good deal with Medline and you go into a year that maybe people are more optimistic and private equity says, you know, maybe we do cave a little bit on valuation, that does bring at least private equity off the sidelines.
All right, Bailey, thanks very much for joining us. Bloomberg's Bailey Lipschultz there talking to us about the IPO rush that we may see kicked off by the SpaceX story. I have to issue a bit of a surveillance correction here.
Please.
In that, you know, I said Antioch College was now defunct. That's my alma mater. I went to the little liberal arts school in Yellow Springs, Ohio for 4 fantastic years. An alumnus writes in and says, hey, it's back. Okay. So Antioch, when I graduated, we were only 900 students, and it had fallen rapidly. By 2007, they just shut down shop. But in 2011, they opened back up again. And
this is so vital for our viewers. So I'm so happy you're issuing. I thought you were going to say, one of the producers pointed out, Matt said that Unshed was gone. There was literally an Unshed behind you as you were doing that big board back
yes,
there. I thought that was going to be your correction. That the boards do say Unshed.
The boards on TV. I'm talking about the Bloomberg terminal. So if you look at the Bloomberg terminal now, at least according to Paul Sweeney and a number of other really highly regarded sources, Unshed is no longer, I don't know if it's because of Lisa's opposition to the phrase Unshed, but we've replaced it with just 2 dashes. Hopefully we bring it back because it means a lot to a lot of people.
Yes, I do believe that Lisa should have the power, though, to completely change what's shown.
I was just shilling for my alma mater because I have
we check on stocks so we give people something of value before we get to the end of the hour.
Let's look at what's going on. I mean, there's not much of value in terms of a check on stocks either right now because we're waiting for the Fed decision. Our special coverage of that starts at 1:30 today. Coming up in the next hour, Goldman Sachs' David Miracle shares his Fed outlook. Plus, we have Blue Owl's Craig Packer discussing the uphill battle for credit heading into the new year and the CEO of the WTA.
cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money. Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
CBS News on the Hour, sponsored by Eggland's Best.
I'm Deborah Rodriguez. We're waiting for news on an interest rate cut. But first, breaking from New York, moments ago, a federal judge granted the Justice Department's request to unseal records from Jeffrey Epstein's 2019 sex trafficking case. Yesterday, a federal judge said the department could release documents from the case against Epstein's former girlfriend, Ghislaine Maxwell, who's serving 20 years in prison. It won't be long now until the Federal Reserve wraps up its two-day meeting and makes that announcement on interest rates. CBS News business analyst Jill Schlesinger expects it'll be a good news, bad news event.
We're going to likely get a 0.25 percentage point reduction. That's great. It's going to help people who are borrowers because they're going to say, oh, maybe that interest rate on my credit card balance a little bit better, a little bit easier for the new car loan. But for savers, not so good because you're earning less interest.
Lawmakers in the House are poised to vote on a measure to compel the Pentagon to release unedited footage of those controversial strikes that killed survivors on a suspected drug smuggling boat. Virginia's Democratic Senator Mark Warner.
It's a little strange where administration officials say, well, we can release edited versions of videos that they like to brag about, but then not at least show the immediate moments up to and including the second strike.
Provision calls for withholding part of Defense Secretary Hegseth's travel budget until the video is released. Two major winter storms are moving across the country. CBS meteorologist Rob Marciano.
These Alberta clippers are moving really quickly. So a smattering of snow across some areas from parts of Ohio back through the Appalachians. We have blizzard warnings that are posted right now for parts of the Appalachians.
One man was killed when he was hit by a snowplow at the airport in Minneapolis. It won't be long now until Americans hit the road for Christmas and Hanukkah. Transportation correspondent Chris Van Cleve.
The next big holiday travel rush starts a week from Saturday, and AAA expects it will be the busiest end-of-year holiday stretch ever. Kelly Walsh is spending it in Florida.
I think you just, kind of plan ahead and just go with the flow, and whatever happens, happens. But it's been pretty good lately.
Readers are remembering a British shopaholic. CBS's Vicky Barker from London.
In 10 books and one 2009 film.
You speak
Prada?
Sophie Kinsella's Confessions of a Shopaholic novel sold more than 45 million copies worldwide. Her family has just announced that Kinsella, real name Madeline Wickham, died Monday from complications of brain cancer. She was 55.
This is CBS News. A man's being held in connection with the stabbing death of his Grammy-nominated father.
Mary, did you know?
Singer Jubilant Sykes was found stabbed to death at his home in Santa Monica, California. Police say the 71-year-old Sykes had critical stab wounds when police arrived and died at the scene. The victim's 31-year-old son was in the home and was arrested. Police say a weapon was recovered. Sykes was nominated for Best Classical Album at the 2010 Grammy Awards for Bernstein Mass. He said he felt comfortable singing every genre of music from pop to opera. Steve Kathan, CBS News.
Next year's Met Gala could have a Southern flair. Beyonce, who hails from Houston, will co-chair the starry event at New York City's Metropolitan Museum of Art May 4th. Venus Williams and Nicole Kidman will host too. Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube as well, so you can head over to YouTube, search Bloomberg Podcast, and that's where you'll find us. Scarlett Fu is out today. Not to worry, Christina Kino sitting in for the next 2 hours, so we're in good hands here. It is Fed Day. We'll have full coverage of that coming this afternoon, starting at 1:30 p.m. on both radio and television. Tom Keenan and the surveillance team will be with you. We're going to start off strong here. Ed Ludlow, he's the B-Tech co-anchor. I want to ask him about a bunch of stuff going on there. We've got, Meta. They're going to kind of focusing more on making money from the AI thing. That's important.
What else would they be doing?
Exactly. I don't know. We've got NVIDIA out there in the news flow. I got SpaceX is looking at an IPO. Could raise above $30 billion. So there's a lot to talk to Ed Ludlow about. Matthew Bloxham is going to join us here, talk to us about. He's at Bloomberg Intelligence. He's a tech analyst. Disruption risk puts AI at the top of the C-suite agenda. That's according to a survey there. And then one of our all-time faves here on Bloomberg, Ann Maletti, head of head of equity investments and chief diversity officer at Allspring Global Investments. She's based in Milwaukee, but she's here today, so that's a good thing. So we'll have her in studio. So we got a lot going on. Let's kick it all off with John Tucker and a Bloomberg Business Flash. John.
All right, hi guys. This business flash being brought to you by IBKR. Will the average global temperature in 2025 be greater than 2.45 degrees Fahrenheit above the 20th century average? At IBKR Forecast Trader, the yes was recently at 6%. Start predicting today at ibkr.com/forecast. Last trading day for this contract, January 9th, 2026. In the run-up to the Fed decision, major stock averages, I don't think this is any surprise, mixed a little change. Right now, you have 8 of the 11 major industry groups in the S&P 500 higher. Industrials in the lead, and that's home to GE Vernova, which is also the best performing stock in the S&P 500 right now. It was up close to 14%. Meantime, Amanda Gotti at PNC Bank says after an expected 25 basis point cut today from the Fed, it's the view forward that really matters.
Our base case is that maybe we get, after today, one more rate cut early in 2026, but that should be good enough for a while. And I don't know that the market is thrilled with that point of view, because the market wants stimulus, right? The market craves the sugar high.
And among the other stocks on the move, Meta Platforms, those shares right now down 1%. They have a new AI model coming out, codenamed Avocado.
Sure.
Which makes perfect sense. It's expected to debut sometime next spring, and it'll be launched as a closed model. So somebody smarter will have to come along and explain all of that, why that matters. Home Depot doesn't see a housing rebound anytime soon. The home improvement giant delivering a sales forecast for next year that comes in well below Wall Street expectations. The housing market is weighed on Home Depot as consumers kind of remain on the sidelines for big ticket items. I do admit I was in a Home Depot over the weekend.
I'm sure you were.
Buying,
of course,
get
where else
it,
would you be?
an artificial wreath.
Oh, no.
Yeah, it was 99 bucks. Well, here's the thing. The real one, and it's gigantic for the outside of the house.
Okay.
The real one was $345.
Wow.
Unlighted, no bow. The one at Depot, 99 bucks,
right,
lighted with a bow.
Then you can reuse it.
And, you know, if you blur your eyes and stand a mile away, it looks real.
It looks real. Okay.
So there you go. That's my reason for the purchase. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Christine and Paul.
All right, John Tucker, thank you so much. We appreciate that. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Market Drivers today is brought to you by Harvard Business School Executive Education, a world-class learning experience for aspiring and established changemakers. Prepare for the next elevation for your organization and for yourself. Learn more at hbs.me/breakthrough. So there you go here. Let's take a look at what stocks are moving today. We can do that with Bloomberg's Tatiana Darie. Tatiana, what are you looking at?
Good morning. Kicking off with GE Vernova, those shares up about 13% today after the supply of electric generation equipment boosted its buybacks from $6 billion to $10 billion, doubled its dividend to 50 cents, and issued 2026 guidance ahead of expectations. So lots of positive updates here for investors. The company, of course, has benefited from soaring U.S. demand for electricity, driven by the data center build-out in the country related to artificial intelligence. And perhaps this quote from the CEO sums it up. He says, AI is the real driver for us right now, which also really encapsulates the state of affairs for many utilities and power companies right now. And its particular expertise in high and medium voltage technology boosts its potential to be a partner for the hyperscalers investing in these data centers out there. Investors are certainly recognizing that potential. Shares are up more than 100% this year, one of the best in the S&P 500 and the best in the industrial sector.
All right, Dr. Well, speaking of AI, I'm sure that this company that you're going to be talking about will also be speaking about that later at their results. What can you tell us about Oracle?
Exactly. Another core name to the AI theme. Oracle reports today. Its shares were down about 1% earlier. It's flat now. The company is an important one to watch because first, it's a core name for the AI theme, but also for credit. Just not too long ago, we've seen its credit default swaps soaring to the highest since the global financial crisis at some point, as Wall Street is really worried about this company stretching its balance sheet for the AI capex and build out. And analysts here expect a really big focus on cash flow and expect free cash flow to be negative for the next couple of years. So the bar is really, really high for this earnings report. And Wall Street is expecting a pretty high move. Those options imply about a 10% swing in either direction today.
All right. When I go to Cracker Barrel, this is what I do. I unbutton the pants, sit down, undo the belt notch.
This is like way too much detail.
And then you get a country boy breakfast with a country ham. That's the meat choice. Biscuits and gravy, extra gravy. And then I order a pitcher of iced tea And then I say, just leave me alone for a couple hours. That's how I go. So what's happening with our friends at Cracker Barrel?
Well, if you were part of its core audience that did not return after the marketing change, then you are to blame.
People
because
don't like change.
Yeah, exactly. Traffic declined here 7% in its first quarter. The dining chain reported weaker than expected sales for the first quarter, cut its annual sales and profit guidance. This really goes to show this company is still struggling following its backlash after that failed logo has since been returned and reversed. But the shares tumbling 35% since mid-August, since that change, and have not been able to recover. That just goes to show how hard these marketing changes are.
Yeah, people don't like change, particularly, restaurants, I think. So we'll see how that goes. All right, very good. Tatiana Daurier, thank you so much. We appreciate that. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else you listen. A lot of news John Tucker's been reporting today on the technology front. I want to start with the Meta news because it looks like Mr. Zuckerberg really is putting himself personally on the line here for some of their AI businesses. Ed Ludlow joins us, Bloomberg B-Tech co-host. He's out there in San Francisco, where I think they have some technology people. Ed, what's the news coming out of Meta today? Can you tell us what that is and kind of if it's important or not?
Yeah, our reporting is very detailed, which cites sources that Mark Zuckerberg is getting much more hands-on on the minutiae of generation-to-generation model releases, AI model releases. But the bigger picture is that Meta, which has kind of been the stalwart of open source AI models, is realizing that it may not be the viable path. So there is a specific model that they're due to release called Avocado. And at one time, that had been due to be an open source model. What we're reporting, citing sources, it's now likely to be a closed source model. Alexander Wang, who leads this kind of AI lab team that Mark Zuckerberg's put together, is a great advocate for closed source. And what you need to know is that in the earlier days, when models were much smaller and Meta kind of wanted workshopping among industry and academics worldwide, it worked. But the problem now is that these models are so big, the resources required to utilize them are so severe that it's just not realistic to have an open source policy universally, because you need money, and private industry has money. You have to make it a kind of for-profit exercise in order for the economics of training and then running the models to work. And that's what our story details. It's really is a must-read. What I would say is that Meta in its earnings call in July did kind of tell us this was coming. They're committed to open source, but they're going to have to start looking at the reality of what it takes to build and train a model and then put it out into the real world in terms of who can use it.
All right, Ed, you've been very busy. I know you've been writing about SpaceX as well, so I want to ask you about that. Tell us about this IPO. I mean, it seems like it's going to be trying to rival the Aramco IPO that we saw a few years ago. 1.5 trillion valuation. What's the single biggest justification for that?
Yeah, I mean, we're reporting that it's happening. You know, my understanding from sources is the work is well underway. They're speaking to the bankers, they've told the investors, they're hiring for the internal roles that you need when you do a big IPO, and the target's the middle of next year. You know, the valuation is what everyone's talking about, $1.5 trillion. We confirmed that the company's latest valuation in the private markets through a tender settled at more than $800 billion. So that is kind of like a stepping stone to an IPO. But what I understand is they need some cash for a specific project. We can get into it if you want. That cash is probably well north of $30 billion, maybe $40 billion. And that would exceed what Aramco raised in 2019. So from a dollar raised perspective, it would make it the biggest IPO of all time, which is exciting.
It surely is. I mean, particularly for the bankers on that. What's the total valuation? Do we know the total valuation of SpaceX these days? Because I've heard some just monster numbers.
So Elon Musk has been pushing back on X recently about reports of SpaceX's valuation. What we have reported, and this is, we stand by that reporting, is SpaceX has gone through a tender, a secondary offering. That is a mechanism where the company allows existing employees and some insiders, early investors, to sell the shares they already have. As part of that, SpaceX actually buys back some stock, but they don't raise any new equity. They don't raise any funds for the company's treasury. But you still need a price for those shares and that determines the valuation. That price was settled at $421 a share, and that gives a valuation north of $800 billion. And that's settled. But again, SpaceX does this twice a year typically. You know, tenders, buybacks, etc. But in this case, this would be the big one to kind of get fair market value ahead of an IPO.
All right, this is great stuff. Ed, thanks so much for joining us. Really appreciate it. I've said it once, I'll say it before. Tons and tons of value across the Bloomberg terminal. I don't care if you trade stocks, bonds, currencies. You all got your functionality that you love that you use in your workflow. But for me, and I think for a lot of other people, the value of Bloomberg News and the reporting these folks do, that's worth the price of admission right there, I think, for the terminal. Ed Ludlow, Eric Johnson, reporting on SpaceX with some great stuff. And on the Meta stuff, we depend really on Kurt Wagner, Riley Griffin. They're out with some great reporting today on the change in strategy for Meta. It's on the Bloomberg terminal, folks. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Traders widely anticipating a third straight rate cut from the FOMC. Investors going to be hanging, of course, onto Fed Chair Jerome Powell's every word this afternoon, with the attention centered on the latest dot plot and the economic projections for the Fed chair. Right now, in anticipation of that, kind of blah, the markets, S&P 500, up 3 points, the Dow up 160, the NASDAQ Composite Index is down 42 points right now. The policy reactive two-year yield down a basis point, 360. The 10s down almost 2 basis points right now, 417. Investors also going to be watching for Oracle's results. That comes after the close of regular trading today. The company's emerged as, I think it's fair to say, something as a barometer for AI risk.
Yeah.
And the shares down 33% from their high just in September. And then the best performing stock right now in the S&P 500, GE Vernova, they boosted the buyback, also doubling their dividend. Holiday shoppers, I don't know if you're going to get a PlayStation, Xbox, or Switch 2 from Santa. You'll notice the consoles now say, made in Vietnam.
Nice.
So a pretty swift supply chain sparked by
amazing how they've done
the
that.
Trump tariffs.
Yeah.
Well, stick a label on it.
Yeah,
we check the market's view all day long, right here on Bloomberg Radio. I'm John. I asked for socks, actually.
Did you?
And I
sure
really do need socks.
You'll
so.
get them. All right. Now
Anyway.
I know what to get you. John Tucker, thank you so much. Appreciate that. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We had a client earlier, Christine, was referencing, he has some fiduciary trust. He's referencing, I'm waiting for the BI survey on AI. And I'm like, what BI survey on AI? Matt Bloxham joins us. He's a tech analyst for Bloomberg Intelligence. Hey, Matt, talk to us about this BI survey on AI. What is it, and what's it telling you?
Yeah, sure. So this was a big survey we did, polling the views of 604 C-suite executives across a range of industries across the world, really kind of trying to get a sense on how corporates are assessing the current AI situation and what they think it's going to do to their businesses over the next kind of 2 to 3 years. So we kind of looked at the motivations for AI investment, what it could do to headcount, what they're expecting in terms of revenue and profit uptick. And we had some kind of interesting results out the survey. Not surprisingly, perhaps, AI is very much at the top of the C-suite agenda. Something like 36% of those polled said it was their top strategic priority, and another 47% said it was within the top 3 strategic objectives for them. When we looked and asked about the main objectives behind their AI strategies, what came out top was improving operational efficiency, which was number 1 with 47% of the respondents. And in second place was boosting revenue at 21%. Interestingly, headcount cuts were quite low down the pecking order. Only 13% of respondents put that as their top priority. And actually, it was the highest ranked in terms of the least priority. So I think it's interesting that companies are looking to boost productivity, but they're not afraid to make investments both in technology and headcount in the near term to kind of release those opportunities. And actually, on a 3-year view, 62% of respondents said they expect AI to lead to an increase in headcount over the next 3 years, an increase, not a decrease, and the average increase they're looking at is about 4%. So that kind of flies in the face a little bit of a lot of the kind of headlines we see about job cuts. I think overall, corporates see the need to invest more in staff, to roll out their AI strategies in the coming years.
Yeah. Well, Matt, you mentioned 36% of C-suites now rank AI as their top priority. That number actually strikes me as a little low. I would have thought it would be at least half of the people surveyed. But what do you think? Is that something that's just set to grow in future surveys as really kind of AI becomes central to a lot of companies' workflows these days?
Yeah, I think so. I mean, obviously, if you add the 47% that said it's in the top 3, I mean, an overall top 3 priority gives you the kind of vast majority of the respondents. Obviously, companies do have to wrestle with lots of other issues too. There is going on in the world beyond AI. Obviously, trade policy is another big thing that's probably on the radar for a lot of these companies too. So yeah, maybe it will kind of inch up, but I think given that aggregate, 80% plus in the top three, probably what you'd expect to see.
Matthew, how about return on investment here? That's kind of what the street's starting to ask for now. We know these companies can spend big money on AI, but what's the return for shareholders?
Yeah, I think that's still very opaque. And actually, when we asked the respondents to flag the biggest roadblocks they could see to AI deployment, the investment needed in AI and the question marks around the return on investment were definitely up there amongst some of the most important concerns that respondents have, alongside data security and clean data. We didn't ask much of the specific ROI expectations. We just kind of get the sense that it's a bit too early to get an accurate read on that. I think most companies are still kind of at a relatively early stage of their AI trials. Lots of them have moved out of the kind of testing LLMs. They're into pilot phases. Some of them are even moving into scale deployment. I think it's fair to say a lot of them are not really quite sure yet what the return is going to be and how quick it's going to come. And obviously it's kind of a bigger issue for the wider tech sector. And you mentioned Oracle as a kind of a barometer for the kind of broader pulse on AI. And I think 2026 is going to be a really crucial year for kind of what corporates make of the midterm ROI. And if they don't see a big ROI, then that's probably going to slow the pace of revenue growth. And that's going to have a knock-on effect to the levels of investment we're seeing made by the likes of Oracle and OpenAI and the revenues they're bringing in.
All right, Matthew, thank you so much for joining us. Matthew Bloxham covers all the TMT stuff for Bloomberg Intelligence. He's based over in London. And folks, I'm just looking at this Bloomberg Intelligence research report, the survey about AI cross-industry disruption. This is no joke, people. This is 117 exhibits. Our entire global technology team participated in this. So if you want to know what companies are thinking about AI across a variety of industries, this is the report to look at. So go BI Go on the terminal, and guess what? It's free with your Bloomberg subscription. That's how we roll here at Bloomberg Intelligence. Let's take a look at these markets here. 2025 was a good year. How about 2026? Anne Maletti joins us. She's been doing this investment thing for a long time. She's over at Allspring Global Investments. It's basically the Strong Alumni Club. Let's be honest here. Some of the smartest people I know in the business are out there in Milwaukee. And boy, if you look at equity markets, S&P up 15% year to date, NASDAQ up 20% year to date, high single-digit returns in the bond market. How are you setting up for 2026?
I think as we think about 2026, we think there's going to be a better mix, actually, right?
Really?
Like,
okay.
you just did lay out, we've had good returns in small cap. Even EM didn't mention that, but like almost double the returns of the S&P 500,
That's
which I know we talked about earlier in the year. And when I look at the domestic markets, a lot of the returns have still come from technology, AI investments, et cetera. We think it's going to broaden out into other sectors. And so while you see positive performance from most sectors in the index, we think that will continue, and it will be led by small and mid-cap companies.
Boy, I missed that. You're right. The MSCI Emerging Market Index up almost 29% this year. I missed that.
Yeah.
And you were talking about that earlier this year.
The quiet winner.
Yep.
Is there anything in EM in particular that you're looking at as maybe underappreciated at this point in time or underpriced in terms of the potential gains for next year?
Well, look, I think China's always the country that gets talked about the most, just given the weight. It wasn't the reason why we were interested in 25. I do think China does become a little bit more important in 26. It does look like the growth prospects are a little bit better, mostly because of government stimulus that's likely to happen in 26. Also, I think you see a little bit less tension between the U.S. and China. Again, anything can happen, but at least kind of have a better idea of what the path forward. So I think China's going to be important. India will be important as well. But get a stable dollar. Again, a lot of the AI building blocks are coming from EM countries as well. So, and some of those emerging countries are maturing, which is also leading to good things.
Way back in the day, Anna and I worked closely together on media stocks, investing in media stocks. And boy, a lot of the media stocks are in discussion right now with all this M&A, Warner Brothers Discovery, Paramount, Netflix. M&A typically is good for small and mid-cap stocks in particular. Is that going to be a catalyst, do you think, for 26?
I do think so. One of our themes, so we have like 6 themes for 26. EM is one, M&A is another, and feeding into that, into the small and mid-cap cycle. And you're right, Paul, like we're seeing a lot of big mergers being announced right now, and it has picked up in 25. But we think what's going to happen is investors, again, when there's less regulation, when money is fairly inexpensive and getting cheaper with rates being lowered, companies look at valuations and things that have been ignored. And so I've always focused on private market value, given the fact that I did cover media, and there's only so long where a company's price can be ignored before someone else pays attention to it. So I do think M&A is going to continue, not just in the media space, but across all sectors. Healthcare is probably an area that's ripe as well.
Yeah. Now, I know that one of your areas of focus is also quality investing in 2026. What's the one quality metric that investors should prioritize, especially in this late cycle environment?
Yeah, I mean, I think return on invested capital, but free cash flow is probably our primary one. And the interesting thing is, like, look, we were believers in small and mid cap for 25. Where I was wrong personally was the lowest quality, the tail of small cap worked in 25, right? So lowest quality names, lowest priced, highest debt levels, lowest ROE companies have outperformed the quality names. And I think it's not that surprising when you think about it, because in a lower right environment, people are just going for where do you get the most alpha potentially in small cap, and it's where the most leverage is, right? And so that's the first area. That's actually normal in a new small cap cycle, that the lowest quality area outperforms first. If this cycle continues, quality will matter. So I like to say durability outweighs drama in the long term in the small cap space.
30 seconds left. AI has been such a theme for the broader markets for the last 2 or 3 years. Is it still a theme in 26?
It's definitely a theme in 26, but I think we're calling it kind of AI 2.0. And so what does AI bring to companies across industries like industrials, healthcare, more the broader economy? What level of productivity does it bring? What value can you add to your businesses through AI technology? And I think that's where investors will pay more attention.
All right. Again, folks, I'll refer you back to that BI survey just published today. It really surveys over 600 companies to say, hey, what are you guys doing with AI? Is it a net positive, a net negative? Is it a competitor? Is it an enhancement? Check out that research. Ann Maletti, Head of Equity Investments and Chief Diversity Officer of Allspring Global Investments. She's based out there in Milwaukee, but here in our Bloomberg Interactive Broker Studio, which is a good thing here. Looking at the markets, S&P's down 5 points. That's nothing. The Dow's up 87 points for John Farrow. The NASDAQ down 73 points. That's 0.3%. Again, it just feels like the market's waiting for the Fed meeting this afternoon. Again, full coverage, Bloomberg Radio and Television. Tom Keene, Bloomberg Surveillance Team, starting at 1:30 Wall Street time. They'll take you right through it all through the afternoon. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. The betting today, quarter point rate cut this afternoon from Jerome Powell and Company. It's the path ahead that's really going to draw the most attention. The final Fed rate decision of 2025, just hours away. Conference Board senior U.S. economist Yelena Shaletova says policymakers should be more focused on the cracks in the labor market.
The risks to inflation are manageable at this point. It seems like, the most of the focus should be on the labor market, given all the recent data.
The S&P 500 just 10 points lower right now. The Dow up 61, and the NASDAQ 100 is down 120 points. That's down just about 0.5%. The more policy-reactive 2-year yield, that is down close to 2 basis points ahead of the meeting, 359 ahead of the decision. Competition for Instacart, shares right now down 6%. Amazon.com said it's expanded same-day delivery offering for partial groceries to over 2,300 cities and towns, and with more coming next year. And then real quick, Dave & Buster's up 17%. Analysts highlighting improving comparable sales trends despite a third quarter miss. And we've been talking about the biggest rise in the S&P 500. GE Vernova up close to 10% right now after their results. Part of that story, and the Boston Globe points this out, this is actually a nice part of the GE Vernova story as well. They set a new Guinness World Record title for the largest online toy drive in 24 hours. They collected donations up there in Boston for over 23,385 toys.
Wow.
So, yeah, good for them. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Christine and Paul.
All right, John Tucker, thank you so much. We appreciate that. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Brokers studio, streaming live on YouTube as well. Ton of technology news out today. Let's get right to it. Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence, joins us here in studio. Mandeep, I want to start with the perfect timing, I think, of a Bloomberg Intelligence survey that was published just minutes ago. Talk to us about that survey, because it goes to AI and how corporate America and maybe the world corporations are thinking about it.
That's right. And if it is a survey that spans 600 enterprises here in the U.S., they cut across different sectors. And really what we're trying to gauge is, how does AI adoption vary by industries, by size of companies, by job functions? And the results didn't surprise that much in terms of, of some of the major functions that have been early adopters or industries that have been early adopters. But what it tells you is that IT budgets are going up, and they're going to continue to go up because everyone wants to invest in AI. And that actually exceeded our expectations in terms of what we thought originally going into the survey. So clearly, this AI spend has a lot of legs, and everyone is prepping for that change. Even if they don't have that data readiness, they're investing in a sort of building that sort of pipeline so that they can pivot to AI quickly.
So for our clients looking at the survey, there's actually a very helpful heat map here that kind of just summarizes the industry impact of AI across different kind of factors here, right? So one thing that I found surprising about the survey is the fact that, when it comes to the AI impact on headcount cuts and expectations for that, a lot of the industries surveyed are actually saying the risk is either low or very low, say for a few industries. What do you make of that?
Well, so that just goes to show that AI will most likely augment the existing employees into their daily workflow as opposed to automating it fully, which, when you talk to the frontier labs, they tell you, AI agents can do things end to end, and, that will clearly lower the headcount additions at companies over time. But that's where this is going to be a lot more incremental as opposed to a step change. And the survey sort of validates that you need a lot of data that people do on a day-to-day basis to be able to augment them first before you can talk about, completely having an AI agent do what folks are doing right now at enterprises. So clearly, AI is very powerful. There is a tacit acknowledgement in the survey of that, but it needs to be trained, fine-tuned, and that will take a while.
All right, folks, this is a definitive survey on where corporate America is today as it relates to investing in AI, implementing AI into its businesses. You can find the results of that survey on the Bloomberg terminal. BIGO is the function. Then just type in the toolbar AI survey, and that's where you'll find it. A lot of more news here about the AI just coming out in the last 24 hours. Let's talk about Meta. Meta's talking about launching a new model into the marketplace. What is that model? And how is it different from our prior models in AI?
So Meta's large language model is called Llama. They have released 4 versions of it. And what happened with the last version was, even though it was a big model, in terms of their own usage and adoption, I think they clearly realized that they are behind the other frontier labs like OpenAI, Anthropic, and Google. And that's where, Mark Zuckerberg has formed a new superintelligence unit. Jan LeCun has left the company, their chief AI scientist since then. And they're making a lot of changes. So now Meta really doubled down on open source before. Now they are saying we will use Alibaba Qwen as the baseline, Google Gemma, which are open source models, and do our own fine tuning on top of that, so that we make that model more useful quickly, as opposed to doing everything from scratch, which is what they were doing before. So most likely, I think this is a harbinger of Meta raising their CapEx for 2026. They've already talked about over $100 billion, but they don't want to miss out. Even though they don't have a frontier model right now like the other labs, they still want to invest, and Mark Zuckerberg has been very vocal about it. And this is just a change in strategy in terms of how they're approaching the market. But there is no doubt they want to build more infrastructure, they want to invest in the models, and they want to deploy it across their family of apps. I mean, Meta's biggest advantage is they have a big surface to deploy this. I mean, imagine Instagram having chatbot functionality, and they have a lot of video content where you can interact with it using a chatbot. That'll be huge. A virtual assistant on Meta's apps like WhatsApp, that will be huge. So they just need the model to get better, and that's what they're working towards.
All right. Is this something that could finally put Meta potentially in direct competition with peers like OpenAI, Anthropic, if this does become a revenue generator?
I mean, that's what they are after. They want to be a frontier lab company. Look at how far Gemini has come over the last 2 years. Now it's even leapfrogged OpenAI, in some ways. So clearly Meta feels they can do something similar in terms of catching up to the frontier models. And this space is so fast that, nothing is out of reach. If you have the compute, if you have the talent, you can leapfrog and catch up with the competition. And that's what it sounds like the strategy is.
Boy, they're not shy about spending money. The CapEx for the company in 2023 was $27 billion. Forecasted for 2026, quadruple to $109 billion. And that could even go higher.
That could go higher.
Now, are investors okay with that?
Well, so we know it's going to be a negative free cash flow year with that kind of CapEx, anything over $100 billion. What they did last week was to pull back on their metaverse spend.
Thank you.
And so that's where, some sort of rationalization has to take place. They also talked about using Google TPUs as an alternative to more expensive NVIDIA chips. So they are rationalizing costs wherever they can for those offsets. But when it comes to the core technology, they'll keep investing, and 2026 will be a big investment year.
All right, very good. Stocks up, year to date up 11%, so lagging, the NASDAQ, so there's some concern there. So we'll see how that plays out. Mandeep Singh, Senior Tech Industry Analyst, Bloomberg Intelligence, joining us live here in our Bloomberg Interactive Brokers studio, talking all things tech. It's just, it's drinking from a fire hose for the tech space with all the news coming out about all the players and the money they're spending and the deals they're putting together. Some of those deals, circular type deals, which has some people concerned.
We don't worry about that right now.
I guess not. Yes, the NASDAQ is up, 21% year to date here, so we'll keep an eye on that. Again, Fed Day today, Bloomberg coverage, radio, television simulcast beginning at 1:30 p.m. Eastern Time. Tom Keenan and the surveillance team will bring you all through the Fed Speaks. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, Christina Kino sitting in for Scarlett Fu. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. It's cold out there, folks. I guess it should be. It's December in New York. We're also streaming on YouTube as well, so check us out there. Let's talk a little healthcare here like we like to do. Sam Fazeli, Director of Research for Global Industries and a Senior Pharma Analyst at Bloomberg Intelligence. He's based in London. Hey, Sam, I'm looking at the FDA. A lot of news coming out of the FDA here. They're examining possible adult deaths from COVID shots. What's going on there?
Yeah, well, so there is a database, and we don't know anything, right? In this full transparency FDA, we've got, I'm looking at share price to see what's moving. Sorry, my eyes are going the wrong way. It's full transparency FDA. Last week we heard that they've got data that shows that there were 10 children's deaths. Where's the data? Show us, right? They go and use this thing called VERS, the Vaccine Adverse Events Reporting System, which is totally voluntary. I can go on there and say, I had chicken nuggets just around the time as my COVID shot, and I had an allergic reaction. And they go, oh, okay, oh dear. So I can put that on there, right? In order to do an analysis of that database, which we as analysts try and do, which is very complicated because you need all the case background. Who was that patient? What happened to them? You need to do that work. Fine. I believe that they've done the work. Show us. Where's the transparency there? Here, I'm pretty sure I don't know for a fact that they're using the same system. Do you see people, I mean, of course, that's a ridiculous question to ask, falling over and dying in the streets after getting COVID shots all the time? There are issues that happen. A lot of people who take COVID shots these days are the elderly, which by definition have a higher probability of complications, etc. in general. So we need to keep an eye on this. I want to see the data, and I want it properly scrutinized. Let us do that.
Yes, Sam. Well, I mean, obviously, I guess this seems like it's in the early stages of investigation. But I mean, walk us through kind of the potential impact of this, right? Potentially, it could affect public health policy, and then potentially that will have some bearing on how companies move forward, especially the vaccine providers, presumably.
Yeah. I mean, so 2 or 3 things can happen. The FDA can say, well, actually, we didn't find the link, because this just says that they're looking at it. Number 2, they say, we found the link, we're going to put a black box warning into COVID vaccines. Fine. That increases people's hesitancy potentially. Or they can go and say, we want to take it off the market. I don't think they'll do that, but let's say, let's get there. There are 2 companies that are most exposed to this. Pfizer, of course, is one of the companies that sell the vaccine, but I mean, Pfizer has a lot more going on, right? The ones that are much more leveraged to the vaccines are Moderna and BioNTech. What I find interesting is that Moderna, who is much more leveraged to it because they're selling it themselves, they have a less of a cash cushion than BioNTech has. Let's say they end the year this year with $7 billion in the bank. BioNTech is at $18 billion in the bank. And yet it's the BioNTech share price that gets hit most, and I don't understand why. Moderna is more exposed because that cash cushion is lower. So if your revenue drops, then you're going to have an issue. Of course, they've been very good at cost management. So that's where I think this could end up if it goes really to the wire and they go, right, we're not going to suggest this anymore, which would be, I think, a tragedy for the U.S.
So, Sam, we've been 10 months into this administration. We've got a U.S. Health and Human Services Secretary, Robert F. Kennedy. We've been X number of months into his leadership. How are pharma companies and biotech companies trying to work with this new administration? Because there's a lot of, one could argue there's a lot of headbutting there potentially.
Yeah, there are. So I'm looking at the gauge of biotech sector performance, the S&P 500 XBI ETF, and it's up. We've almost doubled, not quite. I mean, we're meaningfully high, right? So it doesn't look like people are that worried about it. But I promise you, if I went on our anonymous drug chat with clients, about 2,000 people on it, and I asked, how worried are you? I tell you, no one's going to say 0. There's always this background of worry, right? Mm-hmm. The thing is, the sector's doing well. Only this week so far, we've had close to $2 billion of money raised from companies with good data that's driven the share prices up. This is between 5 and 6 companies. So the sector's thriving. We need to make sure the FDA is in a place that will have very clear guidelines so that people know what they're dealing with and not get advice today that in 6 months' time they go, well, whatever we said then, we have a different view now, right? So that is a problem, and there is something to worry about there. Let's hope that 2026 becomes a lot more stable for the FDA with logical, scientific-based decisions.
Yeah, well, Sam, speaking of the sector, it's doing well overall, but what do you think is going to be the key differentiator amongst the companies between the successes and, I guess, the less successful in 2026?
It's always been the same. Clinical data. Get me a drug that's showing me clean data. Don't give me press releases with some cut of the data, and the next press release is a different cut of the data. Publish the data. Take it to medical conferences. The reason these companies are up, most of them, and have been able to raise money is that they've been very transparent with their data. They present it, you can analyze it. Some more transparent than others. Some of them are presenting at medical conferences like the ones we just had, ASH, the American Society for Hematology. That is what drives this sector. Give me good clinical data. Of course, M&A is great because they come and you get a price and you decide the share price goes there. But it's clinical data that does it. It's that data that gets them to being taken out.
Very good. All right, Sam, as always, great to chat with you. Sam Fazeli does all the pharma and healthcare research for Bloomberg Intelligence, based over there in London. For our listeners in the U.S., a reminder, you can listen to us via satellite radio and Sirius XM Channel 121. Access the world's only global audio business network. Coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, YouTube, and Bloomberg Originals.
All right, coming up in this hour, we've got a lot happening here. Hannah Miller, Bloomberg media reporter on the Warner Brothers Discovery latest there on the M&A trade. Diana Rossetto Pena is going to join us here. Chewy reported some numbers, and we'll get to break those down. Diana's from Bloomberg Intelligence. Michael Halen, he's the restaurant analyst at Bloomberg Intelligence. Cracker Barrel reported some numbers. Stock not liking it right here. So this stock continues to struggle. We'll break that down. And then we're also going to check in with Danielle DiMartino Booth. She's the CEO, chief strategist at QI Research. She's based in Dallas. She used to be on the Dallas Fed. She's in New York today. She penned today an open letter to the Federal Open Market Committee, which is meeting today. We're going to break down what she wants the Fed to do. That's coming up. She's going to be in our studio right now. Let's go to John Tucker for a Bloomberg Business Flash.
All right, S&P 500, not much change there. Down, 9 points. Best performing stock in the index belongs to GE Vernova, hitting a record. The company doubling the dividend, increasing the scope for buybacks, raising the earnings projections. After the close, we're going to hear from Oracle. The focus there is going to be valuation as well as AI spending. And ahead of the Fed rate decision this afternoon, the betting a quarter-point cut. Francis Donald at RBC questions why the Fed would want to cut rates at today's policy meeting.
If I woke up this morning and I'd been in a coma and all I had was the data, I would think, well, this Federal Reserve must be neutral or hawkish heading into this period. They are in an environment where inflation has been above target for 55 months. The unemployment rate is extraordinarily tight.
S&P 500, 12 points lower right now, 68.28 on the index. The Dow up 103 points. NASDAQ Composite Index is 131 points lower. Two-year yield right now down almost 2 basis points, and that is at 359. The 10 down 2 basis points, and that is at 416. And SpaceX moving ahead with plans for an IPO. It would seek to raise significantly more than $30 billion, at least according to, that's yes with a B. That would make it the biggest listing of all time.
Yeah, Aramco was right around there.
Yeah.
The second was Aramco, Saudi Aramco?
Yep, that was the 30 billion.
Anyway, yeah, geek talk here. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Christine and Paul.
All right, thank you very much, John Tucker. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Let's see what's happening in the stock market here. Some stock movers. We do that with Isabel Lee. Isabel, what do you got for us?
Let's talk about Crackle Barrel. So ticker is CBRL, and the stock is fluctuating. It was down as much as 6%, then it was in the green, then now it's lower by nearly 2%. So the company expects sales to fall faster than forecast, now between $3.2 billion to $3.3 billion in the current fiscal year. So what does this mean? I mean, remember earlier this year when the restaurant chain unveiled their new logo, and really social media folks were unhappy with it. They were saying that they were erasing elements of traditional American culture, and it was all about Uncle Herschel, who I really didn't know who he was. I haven't eaten in a Cracker Barrel.
Paul Sweeney is a fan.
See, the thing about Isabel, she never gets off this rock of Manhattan. And when she does, it's to India or the Philippines. I mean, you got to get out there and see the country.
I will try. Maybe
and go to a Cracker Barrel.
We can have a field trip. So
yes, we can do that.
The company planned to update its dining rooms to give them a more modern feel, maybe just in time for my visit. The company posted a loss, including some items. But yes, it's Cracker Barrel's first loss since the pandemic. So that's probably why the stock is now down by 2%.
Okay. What else we got here?
GameStop, ticker is GME. So GameStop recorded lower revenue. That's as hardware, accessories, and software sales declined. And you know what surged? Collectibles. I didn't know that GameStop had collectibles, so I had to Google. And they look like action figures. So they actually increased by 50%, and they now make up, when I say they, it's collectibles, just a third of the overall revenue of GameStop. And that's up 20% from the year prior. And we know that GameStop is the original meme stock. And now, of course, they had to buy Bitcoin also. They bought 4,700 in May and June, and they were valued at $500 million. So there is that for GameStop. I feel like we've stopped talking about GameStop.
I wonder if they regret the Bitcoin purchase now, though, because if they bought that a few months ago.
Maybe, but it depends on your horizon. A lot of the people who buy Bitcoin are hodlers. Hold on to dear life. Hold on to dear life, Paul.
All right, one more. Pepsi?
PepsiCo. So ticker is PEP. The stock is higher by 2.5%, and this comes after JP Morgan upgraded the stock to overweight. So the bank credited the upgrade to an accelerated agenda of innovation and market spending. So earlier this week, Pepsi reached an agreement with Elliott Investment Management, that's an activist investor, to reduce their U.S. product lineup by 20%, and of course, the lower prices. And with that, you also pare down your workforce, but investors are liking that.
Pepsi owns Frito-Lay. Pound for pound, the best snack for me.
Really?
Frito-Lay? Fritos.
Fritos.
Yep.
Oh.
Yep.
We don't have that in the Bloomberg.
We don't have Fritos.
We don't.
Well, we have Ritz crackers, and we have...
And we have bananas and apples, and the goldfish, which you like.
Yes, the goldfish, which we're not there today.
Oh,
so
I'm
that's a
sorry,
big issue.
Paul.
I'm making some...
Paul Sweeney's going to be hangry
I'm
for the
making
next
some phone
hour.
calls. I'm making some phone calls. All right, Isabel Lee, thanks so much for joining us. Isabel Lee, cross-asset reporter for Bloomberg News. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports of the biggest winners and movers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere else you listen. All right, the M&A trade of the week, of the month, and maybe the year continues to be Warner Brothers Discovery. Got two active, credible suitors, Netflix and Paramount Skydance, P-Sky. Let's get the latest reporting there. Hannah Miller, she's a media reporter for Bloomberg News. Hannah, what's the latest here? I guess some of the reporting I saw today is, hey, get ready. This thing could take a while to get resolved.
Yeah, we are expecting this to drag out a bit and to maybe see an even bigger offer from Paramount. Things are definitely not over yet here.
Yeah, well, walk us through kind of like some of the debates around the competing offers, right? I know that Paramount, for instance, $30 per share, all cash bid, and at the heart of that is really kind of the valuation for the cable network. So they're valuing that at just $1 a share, but analysts saying it should be maybe closer to $4 a share. What's up with the debate there?
Yeah, so it's a little bit ironic here that these cable networks, which are not the most desirable assets in Warner Brothers' portfolio, that they may be the deciding factor here as the board weighs which offer is superior. Warner Brothers is home to networks like CNN, TNT, but as we know, cable audiences have severely declined. Paramount wants a lower value for those cable networks because that makes their deal seem better than Netflix's.
It's funny, we were talking to Rob Fishman, an analyst at MoffettNathanson. He was talking about valuing these cable networks at 4 to 5 times EBITDA. When I was doing this stuff as a banker and analyst, 10 times, 12 times EBITDA, 15 times if it was really growing. How times have changed here. Hannah, what's the kind of the time frame here? I guess we got a formal bid that's been accepted by the Warner Brothers board, but we've got this competing one from P-Sky. What's the timing?
Yeah, so Warner Brothers has 10 business days to respond. So, we'll see this ahead of the holidays. But, Paramount could adjust that offer. We could see even a lawsuit erupt over this. This could drag on for months. And we're not expecting a conclusion anytime soon.
Yeah, well, when we break down, for instance, the Netflix offer, right? So they, on the other hand, are excluding the cable networks entirely. What's the sense among kind of like the observers of this deal? Is that something that would put them on a road to success, especially because Paramount is going to be including the entirety of Warner Brothers?
Yeah, Netflix has zeroed in on the streaming and studios business for Warner Brothers. Whereas Paramount, they want the whole thing. They're building out their own streaming service that is a huge focus for them, but they're willing to take the cable networks. If the Netflix deal goes through, that means Warner Brothers Cable Networks will be spun off into a separate company called Discovery Global. So it'll be interesting to see what happens here. One thing that investors are looking at is Versant, which is a spinoff of some of Comcast cable networks. That starts trading soon in the coming weeks. And the price for that could actually be something that plays a factor into these negotiations.
Yeah, because they're very comparable companies, and presumably that would set a market value for what the networks, the cable networks from Warner Brothers would be valued at. Do we expect something from Paramount Skydance? Are they going to come in and do something here, or do they feel like we've got a good deal, we're ready to just go directly to shareholders? What do we expect to hear from them?
Well, we know David Ellison, the CEO of Paramount Skydance, really wants this, and he's raised a lot of money for it. I do think, when talking to people within the industry, that there is room to adjust here, and that we could see a bigger offer.
Yeah, very interesting dimension to this deal as well, of course, because you mentioned David Ellison, his family, of course, touting their very close ties to President Donald Trump. And then the president's own son-in-law, Jared Kushner, is also involved in this deal, though the president saying that he has not spoken to Jared Kushner about it. But there's also kind of a regulatory relationship to the administration sort of element to this deal, right? How's that all going to factor in?
Yeah, I think we have to remember here that, there are regulatory obstacles ahead. They're going to need, a blessing from the Trump administration for either deal to go through. David Ellison has talked about the good relationship he and his family have with Trump. Trump has also publicly expressed concerns over the Netflix deal, whether there could be an antitrust issue here. So, things change. We'll be closely watching what President Trump says.
Yeah, it's interesting. In reality, they don't need the support of the administration. They need the approval of the regulators, the Department of Justice and the Federal Trade Commission. But those days of being independent are a little bit gone by the wayside here. So it does, in fact, become very politicized, unlike it was in the past. Hannah Miller, thanks so much for joining us. Hannah Miller, media reporter for Bloomberg News. Let's switch gears. Going back to earnings here. Earnings continuing to kind of trickle out a little bit, particularly from the retail-oriented companies, the packaged foods companies. One of them is Chewy. So let's break that down with Diana Rosado Pena. She is an analyst covering the retail space, consumer product space for Bloomberg Intelligence. What are our good friends at Chewy.com doing?
They're doing fairly well. They actually reported sales and profitability that beat analysts' expectations. For their outlook, it seems that they're a little bit conservative, that actually, level up some of the gains earlier this morning for the stock. But again, it seems that there's a lot of tailwinds going forward.
Yeah, what's driving that more conservative outlook that you mentioned, Diana? Is it something related to concerns about consumer demand moving forward?
That is absolutely the case. They're seeing household formation, which is adoption versus surrendering, a little bit subdued compared to historical averages. And they think that that's going to overflow into 2026. We're not necessarily agreeing with that. We think we're a little bit more optimistic in terms of, the pace of adoptions going forward. So this is going to make the industry a little bit more interesting.
This is, if people recall, definitely one of the pandemic stocks. It just surged to a high of about $118, $119 a share back in early 2021, and then came down to a more normalized level here. So going forward, what's the growth drivers for Chewy? Is it taking share from the mom and pop pet stores? Is it, or just macro stuff, household formation, things like that?
Well, there's going to be a couple of things. They're focusing on verticals besides merchandise, which is, they're doing a lot of vet care. They're expanding into that. They currently have 14 buildings on that. They're expanding into 18 by the end of the year. So, you have healthcare, you have sponsored ads in the website, you have, the membership program, you have Chewy Plus. So all of those things were probably going to be tailwinds for the company going forward. They're focusing on gaining mid to high single-digit sales growth over the next few years, which is, I think it's a normal forecast. But right now they're growing 2 times the size of the industry. So, yeah. It's interesting.
Is this a trend that you're seeing moving forward for a lot of these kind of consumer-based companies, shifting back a little bit to that in-store sort of experience? Because that seems to be a strategy that's worked for other retailers outside of its space as well.
Yes. So, the pet industry, it's very sticky in terms of demand. So once these companies get the pet parent at the start of the, pet ownership, they are going to have them for the rest of the life of the pet. So, that is obviously a very interesting dynamic compared to other retailers. But in terms of, the in-store experience, this is something that Petco is also doing. They're leveraging their 1,400 stores to also increase that traffic and penetration. So definitely interesting times.
So Walmart, Amazon, how does Chewy compete against those players that have big e-commerce platforms?
So based off of them, they compete on price. A couple of years ago, we did a pricing study with Amazon, but Walmart and Chewy and other retailers, and Chewy and Amazon were pretty close in terms of pricing. Where Chewy beats Walmart and Amazon is that their customer service. They, if you call them and you have any questions about the food that you're going to feed your dog, they're very knowledgeable compared to, Amazon customer service. So that is like the edge that they have.
Oh, very interesting. Now, another bright spot, of course, is auto ship, right? Which is basically, if you're a pet owner, this is the thing that you sign up for, like my cat's food each month, and then it just keeps charging me every month. And then I get a surprise delivery of cat food that I was not maybe expecting. But so obviously that's a bright spot for Chewy. What's the outlook for that part of the business? Is that something that could be sustainable?
Yes, absolutely. So right now, 84% of their revenue comes from auto ship, which allows them to have a lot of scale and allows them to be very profitable. So that is obviously, they have been growing since I started covering this company. It was like in the 70s and now it's 84. So it's probably going to get to the 90s soon.
It's very convenient because you sign up for it and then you forget about it.
Yeah.
Right. And then
it just shows up.
And it's probably
like a Book of the Month club.
Yes, Book of the Month club. It's cat food in the mail. So there you go.
Cat food of the month.
Who doesn't need that? Diana Rossetto-Pena, thank you so much. We appreciate that. Diana covers the consumer staple stocks out there, including Chewy.com. She does that for Bloomberg Intelligence. She joins us live here in our Bloomberg Interactive Brokers studio. Again, just remember, this is Fed Day, and the way it works here at Bloomberg, Bloomberg TV and radio simulcast starting at 1:30 p.m. Eastern time. I just saw Tom Keene. He's still here because he's going to be anchoring that with some other members of the surveillance team. They're on at 1:30. Then the Fed statement is released at 2 p.m. Eastern time, and then there'll be a press conference with Fed Chairman Jay Powell and members of the media at 2:30 p.m. Wall Street time. And so Bloomberg Surveillance will be covering all of that for you through the afternoon to get a sense of kind of where this Fed is going now in terms of rates, and probably more importantly, where they're going in 2026. So there's a lot of discussion out there. I'd say there's probably some more dissonance than there was historically with this Fed. There's some folks that are on both sides of the camp in terms of cutting, not cutting. So we'll see how that plays out. The markets are pretty much indifferent right here. The S&P 500 is pretty much unchanged on the day. The Dow is up about 210 points. That's about 0.4%. The NASDAQ down 75 points. That's about 0.3%. 10-year Treasury yields 4.16. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. We're brought to you by Golden Crest Metals. Inflation, tariffs, and volatility. They have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Right now, the major average is, they're mixed, a little change. You have 8 of the 11 major industry groups in the S&P 500 higher right now. Industrials, they're near the lead. GE Vernova, best performing stock in the S&P 500. That is right now up close to 13%. The company doubling the dividend. They increased the scope for share buybacks and also raised the earnings projections. They're waiting for Oracle after their results come after the close of regular trading today. Ahead of that right now, they're down 0.3%. Warner Brothers among the most active, up close to 4%. Hostile bidding heats up. And Palantir right now up over 2%. They won a contract with the U.S. Navy to manage the supply chain of its nuclear submarine fleet. 2-year yield ahead of the Fed decision at 2 today, down close to 2 basis points, 3.59. The 10-year, 2 basis points lower. That is at 4.16. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Christine and Paul.
All right, very good. Christine Aquino, Paul Sweeney, Scarlet Fu out today. She'll be back on Monday. We're here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well here. Cracker Barrel reported some numbers today, some disappointing guidance. The stock's kind of flat on the day, but the stock has been down pretty significantly this year. They had that whole logo change. That was a real problem for them, and they're starting to see it in their traffic pretty big time. Stock's down about 50% year to date. Michael Halen joins us, senior restaurant and food service analyst for Bloomberg Intelligence. Michael, what did the company report today, and what's management saying about kind of the future plans here?
Yeah, so, guidance was cut, and this was their fiscal first quarter. So it's always tough to have a guidance revenue and EBITDA cut after your first report, but they hadn't seen a bounce yet in their traffic post-logo change, controversy, and everything that went along with it. On the positive side, they said, traffic has now steadied at this down 10 to 11% level, which is translating into a down a mid-single-digit same-store sales. So if you're a glass half full investor, you're saying that after the stabilization comes an improvement. Their new guidance has a pretty wide range. So the low end of the range is assuming no improvement through year end, which we think sounds pretty conservative to us, and then on the higher end, they would see a gradual slow improvement in traffic going forward. So what are they going to do? It's going to continue to be about improving the operations, right? That's been a key tenet under CEO Julie Masino. It's also going to be food innovation. It's going to be Southern favorites. It's going to be twists on old classics. It's going to be bringing back items that people loved and want to see return to the menu. But I think what really stood out is their willingness to listen more closely to their customers. I think that's a big key point of focus for them moving forward after all the controversy that they suffered.
Well, Michael, so in terms of what are they going to do, right? It seems that cutting CapEx is a part of the plan. Is that something that you think would signal discipline, or does it actually risk slowing the turnaround even more?
Well, they're going to still refresh the stores. What they're cutting back on is a more extensive remodel, which was in tandem with the logo change, which was something that was angering customers, right? So I think the CapEx change is probably, the lowered CapEx is probably smart. But they're going to continue to refresh their stores. They're going to continue to give them a fresh coat of paint, improve floors where they need to, clean up the bathrooms, things of that nature that nobody's going to get up in arms over.
I'm actually surprised in hindsight that maybe this management team kept their jobs there. I mean, this was a real self-inflicted wound there. What's the shareholders been saying? Has there been any pushback other than selling the shares?
Yeah, so listen, Julie Massino, you make a great point, Paul, and Julie Massino, the reason why I believe she's still there is that she was doing a great job until this controversy hit. You know, this is a chain that had been bleeding traffic for years, right? They've been really struggling for a long time to bring in younger consumers, right? And she had shown pretty good success over the 12 months leading into the logo change. Same-store sales at the restaurants were up 5% in the August quarter. So I think that's why, you know, the proxy fight kind of failed. The attempt to remove her from the board failed, and why she still has her job right now is that this chain was a mess prior to her arrival, and she was showing some pretty good progress up until August.
All right, very good. Well, I'm going to go this weekend, get my country boy breakfast with the country ham and the biscuits and gravy. That's going to be, I'm going to do my part.
Nobody talked to you, though.
No, nobody talked to me. I'll get my iced tea and I'll be good to go. Michael Halen, Senior Restaurant and Food Service Analyst for Bloomberg Intelligence. Thanks so much for joining us here. It is Fed Day, and what we really try to do every Fed Day is to talk to Danielle DiMartino Booth, because she's really got some really interesting thoughts about this Fed and fiscal policy and kind of where we might go here. She is the CEO and Chief Strategist at QI Research. Danielle, thanks so much for joining us here in studio. Danielle's based in Dallas, but she's here in our studio in New York today. Danielle, you wrote an open letter to the Federal Open Market Committee today. What did you say in that letter? Because I think that's getting some traction in the marketplace.
What I said in the letter is that the Federal Open Market Committee, the 19 of them, that they're actually in control of their destiny. It is not necessarily dictated by whoever is nominated to replace Chair Powell. Inside the Federal Reserve Act, it dictates that at the first FOMC meeting of every year, this coming year, January the 28th, all 19 members vote for the chair of the Federal Open Market Committee and the vice chair of the FOMC meeting. In other words, it does not necessarily have to be the chair of the Federal Reserve Board. And so you could have somebody at the podium for all 8 meetings of 2026 who is not nominated by President Trump. It's perfectly legal. It's never been done because of tradition, but it is perfectly legal.
So is the concern here that this Fed is either already become too politicized or is potentially going to become politicized? Is that the concern?
I believe that is the concern. I think that's even the concern among some of the main nominees potentially to replace Powell. Kevin Hassett earlier this week pushed back on the idea that monetary policy could be planned 6 months out. I mean, that was a vote for his own integrity, and that was the signal that he was sending to the market, and I think that's why the 10-year yield has been going up, is because maybe it's going to be harder to find a yes man or a yes woman than what President Trump thinks. Even so, even if he did get somebody who was to do his complete and total bidding, it's completely up to the Federal Open Market Committee and its 19 members to determine who is going to be the chair of the FOMC and the vice chair.
So, Danielle, you mentioned that this has never really been done before, even though technically the mechanism is there. What do you think will push the committee and the Fed to do this and break with tradition?
Well, you know, they broke, Waller and Bowman both broke with their own feelings about the U.S. economy and the employment mandate in order to stand in solidarity behind Jay Powell at the September FOMC and stand for Fed independence in the face of Stephen Myron being placed onto the Federal Open Market Committee as a plant. So if they truly want to indemnify their independence, they can take this step. It is perfectly legal. And by the way, it would require the Congress reopening the Federal Reserve Act in order to change this.
All right, closer to home today. We're going to hear from the Fed. We're going to hear from Fed Chairman Powell. He's like the rest of us, you know, lacking some data that we typically have. How do you think that's going to influence his comments today?
I mean, he can certainly, I was saying hi to Matt.
Oh, everybody says hi to Matt.
he can certainly lean hawkish by saying that he's still in the fog. But my goodness, ADP puts numbers out every Tuesday morning based on the private sector. You know, we hear from companies announcing layoffs all the time, PepsiCo yesterday. So he can either choose to listen to what the doves are watching on planet Earth in the real world and alternative data sets that we all relied on when the government was shut down, or he can wax hawkishly and say, until I see official data, I don't know squat. But we'll see a lot of dissents. So right now, between ChatGPT, I think, and Grok, I think it's between 2 and 4 dissents, according to AI, as to how many dissents we're going to see today.
Yeah, which is going to be historic, right? Well, yeah, so since you mentioned that, right, I think you're also thinking that maybe the focus is not going to be a presumptive rate cut today. It's going to be that distribution of the dot plot, right? So what is going to be the signal that you're looking for there?
So I actually think that we could see a barbell distribution in that dot plot. In other words, a lot of people who are saying, I'm super hawkish, I'm not advocating for rate cuts in 2026. I'm going to have to no longer feel like I'm going to see the whites of the eyes of inflation. And I think you're going to see the other end of the barbell, the super doves. I mean, I was at the Fed for nearly a decade. I follow the Fed. I'm the Fed whisperer. I've never seen this kind of dissent. I've never seen this level of dissent. And it's almost as if the dot plot is equivalent to what social media did for bank runs in Silicon Valley Bank. We see it live.
So, I mean, is it a problem that there's a lower level of consensus than we typically have? Why is that a problem?
And don't get me wrong, I wrote a whole book about dissenting, fed up. But it's important for financial stability. It's important for markets. It's important to have confidence in the world's largest central bank that dictates monetary policy effectively for the world. We want to have confidence in that institution, and we want to have confidence in the leader that they can lead.
Yeah, well, so increasing potentially dissent here moving forward for the Fed. How's that going to play out in markets, you think?
I think you're going to continue to see a lot of agitation in the bond markets, a lot of uncertainty. There's a huge tug of war going on right now between, kind of bond market hawks and bond market doves. You get a bad report out, like today you see the employment cost index, the Fed's favored gauge for wage inflation, falls to a 4-year low. And then you see bonds back up. The fundamental data is fighting with inflationistas who are bond market traders. And it's quite extraordinary to watch the constant volatility in this market.
All right, 30 seconds left. What's Fed Chair Powell going to do when he steps down from the chairmanship?
I hope to God, according to my open letter, that he stays on that committee and does not provide an open vacancy to fill. I hope he does the patriotic thing and stays on until January of 2028 and finishes out his 14-year term as a governor.
That's not the norm, is it?
Well, the gentleman whose name's on the building, Eccles, it wasn't the norm when Truman wanted him to leave either, but he stayed, and he stayed for the independence of the institution. Jerome Hayden Powell should do the same thing.
Very good. Leave it there. Danielle DiMartino Booth. She's the CEO, Chief Strategist, QI Research. Sometimes, folks, you just get lucky booking guests and timing. That's what's happened today. So check out that. Is that on your social media, that letter?
It is. The open letter is everywhere.
The open letter is everywhere out there. If you want to read Danielle DiMartino Booth and what she suggested to this Federal Reserve, you can check it out on her social media out there. S&P 500 up 7 points. The Dow up 239. And the NASDAQ's down 47 points. So not a lot of direction out there. 10-year Treasury, 4.16%.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We are brought to you by Harvard Business School, Executive Education, a world-class learning experience for aspiring and established change makers. Prepare for the next elevation of your organization and for yourself. Learn more at hbs.com/breakthrough. I just feel smarter reading that ad, actually. 2 o'clock on Wall Street, traders expect a 25 basis point cut. Real action, of course, is coming from the focus on the path ahead and Jerome Powell's newser. Ahead of the meeting decision, we had data. Danielle references the employment cost today, slowing in the third quarter, posting the weakest year-over-year pace since 2021. Again, risk assets kind of mixed right now. The S&P 500 up just 5 points, 68.45 of the index. The Dow up 233 points. The NASDAQ Composite Index is 56 points lower. Julian Emanuel at Evercore ISI says the job market, not inflation, is where the Federal Reserve is focused as they decide the path ahead for rates.
The labor market is about as clear as mud. I think whatever, it's not even mud. It's just, it's unknowable right now, and that's really the aspect of the flying blind that is probably going to weigh on markets.
And 2-year yield right now down 2 basis points, 359. The 10-year down close to 3 basis points, 416 right now. Best performing individual stock in the S&P 500. Again, it's GE Vernova after their results, up 13.5% right now. Worst performing stock in the S&P 500, and that belongs to Uber Technologies. This is from the nice to know file, I guess. Crypto traders are discovering that bragging online about some of their wins is giving criminals a handy roadmap for possibly kidnapping them. Right. Whoa. The threat's so severe, they're hiring private security and scrubbing their digital footprints. So there you go. Just keep it to yourself.
Exactly.
You know?
Well, I got to brag about it.
Exactly.
No,
You got to tell
don't
them.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash, Christina Paul.
All right, John Tucker, thank you so much. We appreciate that. Christina Aquino sitting in for Scarlett Fu. I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. Year-to-date, S&P 500 up 15%, the NASDAQ up 21%. Fixed income, high single-digit returns across the board. You got some good numbers out of the municipal bond market, too. So 2025, pretty solid across the board here. What do we do looking forward here with Shelby McFadden? She's going to help us out there. She's a senior analyst at Motley Fool Asset Management, based down there in Virginia, the land of the data centers, I guess is what people tell me. Shelby, what's happening here? We're going to hear the Fed today. Presumably, we'll get a rate cut. Is that all this market needs, or does it need a little bit more help? Because it's had a great 2025 so far.
You know, it's such an interesting question. What does the market need? There's so many different things. The first thing I'm thinking about is breadth. And I'm not quite sure that a rate cut is enough to return to breadth because we've had a few, right? And the question then is, what is the sort of floor? Where do we need to go for a return of breadth? I think the slight, maybe almost imperceptible difference we see between Dow and S&P shows us that, okay, we might get a little bit more interest in things like quality, industrials, value, things that are rate sensitive. But I'm not quite sure it's enough. I think we do still need to focus on things like the labor market, looking at things like mortgage rates, housing, all three of those major components that affect the consumer, and knowing that consumption drives the market. I think we have to look there as well.
All right, Shelby. Well, those are three, but which one of those three keeps you up at night, especially heading into 2026?
Probably the labor market, and mainly because there's been such a dramatic shift. A lot of times in the financial markets, or even just broader economics, we talk about lag, and what is the lag time between this decision and when it's, you know, the implementation lag, all of those different things. And right now, it seems really unclear. There have been certain sectors that are hit right away, but it's been a short period of time. We are just now starting to see a little bit of the implications of tariffs, and so we still have to see a lot of roll off for labor. So it could be at around the year mark from the start of drastic changes. It could be 18 months. So that's something that we continue to watch. That combined report from BLS next week for October and November, that's what keeps me up at night.
How about just sectors here, Shelby, because it's really over the last 3 years, if you didn't have exposure to big tech, particularly the AI-driven names, you kind of missed out there. You're struggling here. Is that, as we think about 2026, do you still expect the AI trade to be a leading trade for this market?
I would probably expect as much unless there is some sort of big structural change. Now, I will say that there are other ways to play AI sort of indirectly. So the first everyone's a bit more familiar with, which is sort of like enterprise software. But one of the sort of sleeper cells that you have is playing other larger blue chip companies that have had the time to invest in AI for the other products that they sell. So I'm thinking about companies like Walmart that have had their had all the capital and the ability and the scale to go ahead and continue to integrate this into their platform and to be able to maximize their traffic and their sales. That's why Walmart is in one of our new products. It's going to be our value factor ETF and MFVL because yes, it's not necessarily cheap, right? It's not the way that we would traditionally define factor or the value factor. But when we think about sort of the total shareholder yield, their ability to flex themselves into a growth market while still focusing on the value that they can provide to consumer and at a more affordable price than some of the leading AI players, that's what sort of makes it a bit more of a combination play, being able to provide you some growth, but also sort of stable shareholder return.
Yeah, very interesting kind of, I guess, traditionally not very AI-levered companies finding ways to work that into their workflow. Speaking of retailers, I know that Costco also remains one of your top picks. What's your kind of, what makes you like it at this point?
You know, the thing about Costco, and it's also something we're going to be watching out for because they'll report this week, is they're sort of a bellwether now. So it gives us an ability to see sort of how broader consumption is doing because they're typically getting the best prices and they have the biggest scale. So what we like about them is they still have expansion opportunity. When we look at the models and we see where they're going to be able to keep building warehouses, the United States is not down and out. There's still a lot of opportunity here. Plus, they're still actually doing pretty well in China. So knowing that they still have opportunity for growth and not just the replacement of warehouses is something that interests us. But also, they've been really successful with their labor model. They get a little bit of bolster from fuel from time to time. And again, with their ability to leverage that Kirkland signature, it's probably the best white label you've got out there. It's a very premium product. So that's something that we're excited to be able to hold on to as something that is sort of a core large cap play and sometimes flexes like a growth position if the market is in an upswing.
Shelby, earnings have been really, really solid coming out the last several quarters here. Are they good enough looking ahead for this market, do you think?
You know, I think so far the market has been pleased. The thing about the earnings line and why we in our analysis really separate it from things like cash flow is because there are things you can flex to bolster your earnings in the short term. So this is not me accusing anybody of cheating, but there are certain things like labor especially that you can flex that don't necessarily change how you're operating, how management's thinking, changing your strategy. And so earnings so far, if companies are coming out and reporting that, yeah, we've done some cost cutting, so on and so forth, I think just dropping right to that EPS line, it's a good short-term soother. But over the long period, investors are going to want to see that management teams are thinking strategically when it comes to M&A, when it comes to reinvestment in the business versus the choice to give capital back. So the short answer is, for now, I think seeing cruising altitude earnings is enough. But going into maybe Q2 of next year, I think they're going to want to see a little bit more when it comes to strategy.
All right, Shelby, thanks so much for joining us. We always appreciate spending a few minutes of time with you. Shelby McFadden, she's a senior analyst at Motley Fool Asset Management. They're based down there in Alexandria, Virginia. Again, the Fed reporting today. They'll have their announcement at 2 p.m., press conference at 2:30. Bloomberg will have full coverage. The Bloomberg surveillance team, Tom Keene leading the way. Starting at 1:30 p.m. That'll be simulcast on both Bloomberg Radio and television. So lots of good guests there talking about the Fed and kind of where interest rates are going and the impact on the markets as well. So they cover it all across the board there. Looking at the markets here, just a lot of indecision. Feels like the investors are kind of waiting here. The S&P's up 5 points. The Dow's up 230 points. That's about 0.5%. The NASDAQ down 58 points. That's about 0.25%. So not a lot of direction here. 10-year Treasury yield, 4.16%. That's down 3 basis points. We'll keep an eye on that. WTI crude oil, $58 a barrel. I know our friends in the oil patch would like it a little bit higher. This is Bloomberg. Good morning.
listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
All right, we have. So what do we got here? We're going to talk to Anurag Rana, right?
I'm sure he's busy.
Doing? I mean, what's he doing? All right, Anurag Rana, Senior Technology Analyst at Bloomberg Intelligence, joins us here. Anurag, we could talk to you. Well, we do talk to you almost every day. Either you or Mandeep here. There's so much stuff going on. I want to talk to you about this Meta news here. They're going to launch a new model into the marketplace, codenamed Avocado. Now, all I really know about this is a closed model versus what Meta's historically done, which is an open model. Why are they changing their strategy, and why is it important?
I think that's a very simple answer is you get paid more if it's a closed model because you control everything at that point, and you're not at the whims of other software developers improving the model. So when you have OpenAI charging a lot of money for people to use their models, there was no monetization model for Meta other than using that AI internally in their own operations. So if they launch a closed model, and if, let's say, it comes at par with something that Google has or OpenAI has, then people will use that model to infuse intelligence into their own operations. That could be banks, that could be telecom companies, it could be basically anybody. And whoever uses that model will pay a royalty for it. So it's a very simple business case, but you have to have that model to defend it, basically.
Right. So, Anurag, walk this further back for us non-experts here, right? So what was the rationale originally for Meta to even go with an open source model to begin with? And what does it say now that they're kind of shifting that strategy?
Now we're going the philosophies of software building, and a lot of companies go out and look at open source for two reasons. One, most of the innovation happens there, and two, that's not your core business. You're doing that as a way to improve your products, and you're letting crowdsourcing go out and improve that product. So whether it is an operating system or any other product, if you make it open source, then anybody can do it. Paul can go out and work on it, I can go out and work for it, and the product improves by itself. You don't need an army of engineers. But there's a problem with that concept, is you really don't have a business case for it because whoever uses it or improves it can use that model in whatever they do. So that is really the big difference between the closed-end system versus an open source. And that's, you can go back to the old days of Linux versus, Windows, for example. Oh, it can nowadays because all you're doing is prompting and understanding whether what it is writing is going to work or not. So it has become very easy for people like me to write something and get an answer. And the complexity is whether the code is efficient enough to run on a good infrastructure or not. I mean, that's a very different question then.
All right. Hey, I know you guys at Bloomberg Intelligence and technology folks came out with a survey where you surveyed a lot of companies and said, what are you guys doing with AI? Talk to us about that survey and what you found.
Yeah, this is probably, it took us over 6 months, 9 different industries, over 600 C-suite executives to go out and say, well, tell us a little bit about what's happening. Because, one thing I think everybody's clear on is what is the tech industry doing? But the question is what's happening on the implementation side, because at the end of the day, they are the ones who are going to foot the bill. The one thing that shocked me, at least when I first read the results, was everybody is worried about disruption. It's not just my software companies, it's the telecom companies, it's industrial companies. So everybody is nervous about it. It's the topmost agenda for the C-suites. The other thing they talked about was we are not going and adding AI functions into our products to cut costs. That's really not the reason. We are doing it because we are afraid of getting disrupted. So that was one big thing. Second one, which is I think it's more important for us, including Oracle reporting tonight, is what is the biggest bottleneck that they see right now? And for them, all of them said it was AI infrastructure. There were other factors such as clean data, cybersecurity, but AI infrastructure was the first one. Gives us little bit comfort of this entire talk about a bubble and not needing that infrastructure to build services.
Well, Anurag, you mentioned Oracle, so let's talk a little bit about that because they're going to be reporting later today. And yeah, you mentioned it has been at the epicenter of these concerns over an AI bubble, especially given that Oracle's credit rating is maybe not as good as some of its other peers in the space, right? So what are you going to be watching out for there?
I think they have to come out and give confidence to the street that they have the money to fund that big order that they have received from OpenAI. Now, it may not be their money. It may be a consortium that is going to go out and fund the data center as well as this particular backlog that they have, which means they will have to share a little bit of that with the street. But, it is very difficult for them to go out and raise, tens and hundreds of billions of dollars to do all of this internally. They would need some private credit help, some private equity help. So I think details around that would be most important for us.
All right, Anurag, thanks so much for joining us. Always appreciate getting some of your time. Anurag Rana, technology analyst for Bloomberg Intelligence. We appreciate getting some of his time. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only digital audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. We're coming up here. It is Fed Day. Let's review the coverage here. We're going to hear from the Fed, get their statement at 2 p.m. Wall Street time. They'll have a press conference at 2:30 with Fed Chairman Jay Powell. And it all starts with Bloomberg Radio TV simul coverage on radio and television, anchored by Tom Keene and their surveillance team. They always have a great group of informed guests to kind of help you understand what the Fed is thinking these days about its policy and its rates. So that starts at 1:30 Wall Street time. In the meantime, Christina Aquino, thank you for sitting in with Scarlett Fu. Scarlett, I understand, is going to be out tomorrow and try to be back on Monday, so no problem there. S&P 500 up 7, the Dow up 240, the NASDAQ is off 40 points, so not a lot of direction out there. Tom from the Upper East Side asked for a VIX reading 16.9, so comfortably below 17. We're going to have more coming up. This is Bloomberg. Good morning.
Thank you.
This is CBS News on the Hour, sponsored by Steel.
I'm Steve Kathan. We'll learn soon if the Federal Reserve will tack on another interest rate cut before the end of the year. CBS's Kelly O'Grady.
This would be the third interest rate move this year, third quarter point cut that we've gotten in a row. Now, the big question, though, is what comes next, because 2026, at the last time we got economic projections, that was 2 meetings ago, we were looking at likely 1 to 2 cuts for the year. So what we're really going to be looking for is, yes, do we get the cut today? But now where do we go from here?
A federal judge has ruled secret grand jury transcripts from Jeffrey Epstein's sex trafficking case can be made public. Legal analyst Lori Levinson.
Another federal judge has joined 2 others in deciding that, in fact, grand jury transcripts regarding the investigation of Jeffrey Epstein and his associate can be revealed to the public. And so the federal judge changed course. He had previously said that grand jury materials were secret.
And a federal judge ordered an end to the Trump deployment of the National Guard in Los Angeles, with troops to return to California state control. The government's just announced a $700 million investment in what's known as regenerative agriculture. Ag Secretary Brooke Rollins.
Regenerative agriculture is a conservation management approach that emphasizes natural resources through improved soil health, water management, and natural vitality for the productivity and prosperity of American agriculture and all of our communities.
A new travel forecast for the upcoming holiday push on highways and in the skies.
Better be prepared for a lot of company on the roads over Christmas. AAA is projecting that more than 122 million Americans will travel over the holidays, and nearly 110 million of those will be behind the wheel. Watch out for issues including dead batteries, flat tires, and empty fuel tanks. Millions are also flying and taking buses or trains. Allison Keyes, CBS News, Washington.
Well, travel could be tough in parts of the upper Midwest thanks to deep snow. CBS News meteorologist Rob Marciano.
We're looking at 5 to 10 inches, again, north of I-80 across Michigan, parts of Wisconsin, and north of Minneapolis, and lighter amounts as we head towards this. But the big story behind this is going to be the cold air. You think it's cold now. Wait till Thursday, Friday, and Saturday. Wind chills well below zero mini Chicago and getting that way towards the northeast as well.
CBS News has announced CBS Mornings co-host Tony DeCopel will be the new anchor of the CBS Evening News. Checking Wall Street. Right now, the Dow is up 218 points. The S&P is up 6 points. This is CBS News. There's an about face on typeface at the State Department.
Secretary of State Marco Rubio says the standard will return to Times New Roman for official correspondence 2 years after a Biden-era directive that switched it to the sans serif Calibri font to make it easier for readers with disabilities to see. The New York Times quotes a memo from Rubio explaining his decision will abolish yet another wasteful DEIA program. He says it's done nothing but degrade the department's official correspondence. He's also reverted to a smaller 14-point typeface after Blinken increased it to 15. Deborah Rodriguez, CBS News.
Venezuelan opposition leader Maria Corina Machado's daughter accepted the Nobel Peace Prize on her mother's behalf today. She said in a speech written by Machado that Venezuela shows the world that we must be willing to fight for freedom. Steve Kathan, CBS News.
A KFC tale.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Welcome to the Fed Day edition. With a rate cut expected just a day after President Trump launched his affordability tour in the great state of Pennsylvania, the stars are aligning on this inflation issue once again. We'll discuss President Trump's rollout, the way the White House is framing this when we talk with Bloomberg Washington correspondent Tyler Kendall, with insights from Stuart Paul at Bloomberg Economics. He's watching the data, and from Christopher Smart at our Growth Group. They're all up this hour on Bloomberg. We'll have analysis from our political panel, Bloomberg Politics contributors Rick Davis and Jeannie Shanzano, as we count down to the rate cuts. And we start, as always, by setting the baseline on Wall Street with Charlie Pellet. He's got the view from New York at World Headquarters. Charlie, what do you have?
Right now, we've got a market that is pushing higher, Joe Matthew. The Dow, the S&P, they are both gaining right now. 5-point advance, little change. The key takeaway ahead of the Fed decision, 2 o'clock Wall Street time when it all comes down. Of course, we'll have instant reaction right here on Bloomberg. 2:30, Jay Powell's news conference. All ears will be on that. We'll have that for you live, as we have over the years here on Bloomberg Radio. Right to the numbers here with the S&P, as I mentioned, a little changed, up under 0.1%. The Dow up 204 now, up by 0.4%. The NASDAQ Composite Index down now by 51. That is a drop of 0.2%. Your 10-year ahead of the Fed decision, 4.15%. Your 2-year, 3.59%. Gold, little changed, 42.01 the ounce, down $7, down 0.2%. West Texas Intermediate crude oil down 0.3%, 58.06 a barrel. And Bitcoin retreating now to 92,220 on Bitcoin. That is a drop of just about 0.5%. Chinese artificial intelligence startup DeepSeek has relied on NVIDIA chips banned in the country to develop an upcoming AI model. That's according to a report in The Information, citing sources. NVIDIA responded to the story, saying it is pursuing any tips it receives. It also says that, quote, smuggling seems far-fetched. NVIDIA shares down today by 1.2%. Again, recapping, S&P higher, as is the Dow. S&P right now up by 0.1%. Balance of Power continues now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Okay, Charlie, great to see you. Happy Fed Day. You know, Fed Day is like Christmas morning around here. And yeah, the building's going to shake right around 2 p.m. Eastern time. The one Charlie's in and the one I'm in here in Washington. Thanks for being with us on the Fed Day edition, indeed, of Balance of Power. It's Wednesday for the rest of you on Bloomberg Radio, on satellite radio, channel 121, and streaming live as ever on YouTube. Search Bloomberg Business News Live if you want to see the radio on TV. If you have YouTube TV, flip over to Bloomberg Originals. We're there both hours every day if you want to spend some time with us here in the studio. Next hour, of course, we're going to have our special Fed coverage. That starts at 1:30 p.m. Eastern time. But as I imagine here, as I mentioned, Christmas morning, it's Fed Day. For that, we have an early Christmas and Hanukkah gift for you. 1 hour from right now, the king of Detroit rock will be with us here in studio. No, not who you're thinking. Gene Simmons is in town this week in Washington. He was testifying on Capitol Hill yesterday about music royalties. He spent the better part of the week with President Trump. He was in the Oval a couple days, went to the Kennedy Center, got the Kennedy Center Awards. We're going to pick his brain a little bit. Dare we ask him for his interest rate forecast? So the affordability tour kicked off last night. We told you all about this, right? The president is hearing a lot about prices, and he doesn't like what he's hearing. So they decided to put the boss back out on the road, put him back in his element, the campaign-style rally, to deliver the message that prices are coming down. You've heard him call affordability a Democrat hoax and a con job, and we've talked about that every time he says it with members of both political parties here on Balance of Power. Look no further than the headline in the Washington Post. At the first stop on his affordability tour, Trump mocks affordability. He spoke for about 90 minutes, a room with 1,200 capacity, the ballroom at the Mount Airy Resort and Casino in the Pocono Mountains. Not unlike the Blues Brothers and their triumphant night at the Palace Hotel Ballroom. And we bring you back last evening to some of the highlights of that speech. Listen.
They gave you high prices. They gave you the highest inflation in history, and we're bringing those prices down rapidly. They say, oh, he doesn't realize prices are high. Prices are coming down very substantially. But they have a new word. You know, they always have a hoax. The new word is affordability. I have no higher priority than making America affordable again. You can give up certain products. You can give up pencils. You don't need $37 for your daughter. 2 or 3 is nice.
The stylings of C.C. Chernoff in New York, that was just a taste of it. That was 90 minutes. You don't need $37 for your daughter. 2 or 3 is nice. Who's got all these pencils, by the way? I mean, even the kids have laptops at school, right? We went way off topic on a number of times, heard a lot about Somalia last night. He had the crowd chanting, had the crowd laughing. It was definitely live at the Improv. And Tyler Kendall was, of course, watching, so you didn't have to. Bloomberg Washington correspondent is with us right now at the desk here in the D.C. Bureau. That was interesting. He even said that after mocking affordability, that Susie Wiles kind of forced him to come out there. He didn't really want to do the speech. Are we really going to get more of these?
Right. I mean, I think it's fair to say that what we heard last night was very similar to what we had been hearing from President Trump, right? Even though this was really being billed by the administration as being a reset when it comes to the president's messaging around the economy, because this really was his first domestic address around the issue of cost of living since Republicans suffered a slew of election losses last month. And we've seen in polling, in data, that consumer sentiment has been souring. I was pretty struck by this Fox News survey earlier this week. 76% of American voters feel negatively about the economy. And it's probably worth mentioning, too, last night, Democrats had some election wins. Republicans had suffered some election losses. I know you're going to talk about it later in the program, but the Miami mayoral race, this Georgia state House seat, comes to mind. But President Trump himself said last night that Susie Wiles wants him to go out there, be on the road. We can talk about some of the way that he framed this issue of affordability. He did try to tout some of his policies. Our headline here at Bloomberg on the terminal is that he spoke really about his tariffs, and he said that he thinks people are coming around on the idea that they're understanding how this policy works, and that he himself conceded that he's gotten some heat for it in his own words, because, of course, tariffs have been at the top of the economic agenda.
Right. Suggesting those who don't get it are stupid, I think, was what we also learned last night. You know, StartupPal is with us as well. We wanted to put Tyler and Stuart together and talk this out a little bit. Bloomberg Economics U.S. economist with us from New York City. Stuart, the president said last evening, quote, "We inherited the highest prices ever." I'm using you as a check here. We inherited the highest prices ever, and we're bringing them down. Is that on its face true?
No. Inflation has been coming down from a COVID peak of around 9%, but just because the inflation rate, the growth rate of prices, has come down.
Not hearing Stuart. Have you guys, anybody? All right, Stuart, I'm sorry. We might be having an issue here unless James tells me that something else is happening. So the idea here, Tyler, you are hearing him? All right, Stuart, I'm sorry. Let me know when we can talk to Stuart. The idea here is that he's arguing with the data.
Right.
But you also have Scott Besson and J.D. Vance asking people to have patience, because the programs, the initiatives he was talking about last night should lead to lower prices a year from now. We didn't hear him say that, did we?
No, not necessarily, but you're exactly right. The administration has been asking the public for patience. We hear them tout a lot what's in the tax bill, some tax cuts that are coming next year, but then also think about all the new proposals that have been floated in just the last week, but maybe haven't yet been implemented, with the goal of bringing down prices. President Trump urging his Department of Justice and FTC to investigate food supply chains, the administration issuing some exemptions for agriculture products that we can't grow as easily here in the U.S. and trying to bring tariffs down that way. So there was a lot here, but something that is going to add to this idea of affordability and patience and putting pressure on the White House. Of course, we'd be remiss if we didn't talk about healthcare and how that looming deadline and Capitol Hill trying to grapple with it right now is really going to end up putting the pressure on the president.
Yeah. Tyler, thank you so much. Bloomberg's Tyler Kendall with us in Washington. Let's bring back Stuart Paul from New York. I think we got that microphone figured out, Stuart. Let's get back to the facts here. We inherited the highest prices ever. That would be 10 months ago he's referring to, and we are bringing them down. What does the data show?
Well, the rate of inflation has come down from a COVID peak of around 9%, but the disinflation process has stalled with headline inflation running around 3%. The price level has certainly not come down, and even the inflation process has basically left us with price growth running at a pace of about 3%. While it is the case that the president is trying to make some headway to bring some consumer prices down, so for example, cutting trade deals with El Salvador, Ecuador, and so on, to try to bring some of those food prices down, as Tyler was just talking about, the overall price level certainly is not coming down.
What's up with the pencils? Are we going to lose pencils here? You can give up certain products, you can give up pencils, he said, but you always need steel. You don't need $37 for your daughter. We're doing things right. I guess the idea here is he's talking about the side effects of the tariffs, right? We've got steel protected, but I guess the pencils are not, Stuart.
I guess the pencils are not. It's just so ironic that he's talking about pencils, and I've heard him bring this up a few times. It's interesting that in Economics 101, we teach a paper called iPencil, because even something so simple as a pencil is made from hundreds, if not thousands, of different participants. People mining graphite and milling lumber and aggregating rubber and manufacturing something so simple as a pencil. It's intended to illustrate the benefits of trade. So when he says, maybe don't buy 37 pencils for your kid, it's just totally ironic that he must have skipped that day on Econ 101 talking about the benefits of trade.
Why? Maybe he's thinking back to the Wharton School of Business. Pencils are on his mind. As far as the dolls go, is this going to be a disappointing Christmas? I mean that in reality. When did the containers from China get on the boats and start coming over here from Christmas? And was it too late to avoid the tariffs?
Well, so what looked like was the case is that a lot of the containers were already shipped during the summer, and they already made landfall. They already stocked shelves. When we saw early signs of what holiday shopping looked like, it actually looked like nominal spending for the early part of the holiday season was up about 4% year on year, but again, with about 3% inflation, that leaves real holiday shopping growth just about 1 percentage point higher year on year. That's pretty dull, all things considered. That's not exactly a Christmas miracle for the kids. It's a little bit better than last year, but not much.
But the front running may have actually saved prices for this holiday season, it sounds like. Stuart, it's great to see you. Thanks for coming over, as always. Stuart Paul, Bloomberg Economics U.S. economist, and thanks to Tyler as well. We're going to continue this conversation coming up with Christopher Smart. I'm glad to say he's back in the nation's capital today, managing partner, our Growth Group, as we try to frame this Fed meeting against the backdrop of what the president does not like to call affordability. I guess Democrats do. Either way, it's the prices you're paying, and we're going to talk about the view the Fed has of all of this and exactly what it will mean for our economic policy going forward. Christopher Smart on the way. Our political panel is with us today as well. Rick Davis and G.D. Shanzano. And if you didn't hear me warn, Gene Simmons at the top of the hour on Bloomberg.
6:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We have got the Dow higher, the S&P higher, barely. NASDAQ in the red. All of this ahead of the 2 p.m. Fed decision, 2:30 J-Powell news conference. Yeah, we got it for you live. We got you covered here on Bloomberg. S&P up 1 point right now at 68.41. That is a gain of just under 0.1%. Stocks marking a second day of muted trading. The Dow up 207, now up 0.4%. While NASDAQ lower by 70. The NASDAQ Composite Index down 0.3%. The NASDAQ 100 Index also down 0.3%. While the Russell 2000 Index of small cap shares gaining now by 0.2%. 10-year at 4.15% with the 2-year, 3.58%. Gold is down $7 the ounce, 42.01, down 0.2%. West Texas Intermediate crude oil down 0.2%, 58.15 a barrel. And Bitcoin now lower, little change, down 0.2%, 92,463 on Bitcoin. Shares of Nextdoor Holdings are surging 18%, the most in over 4 years, as the man behind the retail-driven rally in names like Open Door and Better Home and Finance Holding took a bullish stance on the neighborhood social media app. Eric Jackson, founder of Toronto-based hedge fund EMG Capital, said the company was one of the most misunderstood platforms in the market, which has yet to recognize its potential in artificial intelligence. Again, Nextdoor now up by 17.4%. Recapping, stocks higher ahead of the Fed decision. S&P right now up 1 point, little change there. The 10-year 4.15%, and Bitcoin down 0.2%, 92,479. Balance of power continues right now. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, Charlie, we thank you. It's a busy day for Charlie Pellet. It's Fed Day. That's big stuff. And, of course, Charlie will have markets leading right up to and after the Fed decision with our special coverage starting a little more than an hour from now at 1:30 p.m. Eastern Time. We'll throw things back to New York. Glad to say Michael McKee, I just saw him in the pantry. He's down in town. He'll make his way over to the central bank for live reports shortly after. And, you know, he'll be in the room for the news conference. You'll see and hear that live on Bloomberg. It's quite a night for President Trump. He went all the way up to Pennsylvania to talk about affordability and mocked the word, calling it once again a Democrat hoax. But he was busy on Truth Social just about a couple hours before midnight. We saw the post. "There has never been a president that has worked as hard as me," he wrote, exclamation point. "My hours are the longest and my results are among the best." But interesting, and this was a long post. You get about halfway through it, and it was quite revealing. "I have done something no other president has done," he wrote, "on 3 separate occasions. The last one being recently, by taking what is known as a cognitive examination, something which few people would be able to do very well, including those working at the New York Times. And I aced," in all caps, "all 3 of them in front of large numbers," get this, "in front of large numbers of doctors and experts, most of whom I do not know." So the President of the United States is now taking on the regular. We've had 3 now in I don't know what period of time. Is that in the last 10 months? With a battery of doctors he doesn't know watching him? We'll just park that because I feel like we need to hear more about it. We heard a lot more about tariffs last night because you can't have one story without the other when it comes to affordability. And the president made it pretty clear to the people watching in Pennsylvania that if you're not on board with the tariffs, well, there's probably something wrong with you. Listen.
"I took a lot of heat. I got up early on. I said my favorite is turning out, you know, tariffs are bringing us hundreds of billions of dollars. I just helped our farmers out. It's amazing. It's the smart people understand it. Other people are starting to learn, but the smart people really understand it."
The smart people are starting to understand it. Let's see if Christopher Smart sees it that way. He's the founder, managing partner at Our Growth Group, former special assistant to the president, National Economic Council in the Obama administration. Great to have you back in the nation's capital, Mr. Smart.
Great to be here.
Is the president right about this? Because a lot of smart people have been questioning the impact of these tariffs and on prices specifically.
Well, we haven't taken our cognitive tests yet at the Our Growth Group, and I'm not sure whether you've done that yet at Bloomberg. But
do we have to do that, James? I didn't get one here.
Most economists, I think, will tell you that the tariffs that have been put in place have yet to really hit. And in terms of inflation numbers, a lot of the things that are showing up on store shelves today got on the boats before the tariffs.
Is that why it's front running? We were just talking about with Stuart Paul.
I think there's some of that going on, and then we'll see a little bit more of that coming in next year. I think those will be really reflected in the inflation numbers once we start getting inflation numbers again, because of course with the government shutdown we had that lag. But I think that's going to be a headwind for a lot of consumers next year, and that's going to make his case about affordability maybe a little harder to make. I mean, it doesn't really matter. You know, economists and investors look at the numbers and say, well, things are getting better. But if you don't feel like it's getting better for a politician, I'm not sure that translates into the votes you're hoping for.
That's the political side of things. But you're telling me that it's not about to get better. It's probably about to get worse. Combination of front running and companies. You tell me. We're hearing from the likes of Walmart and others to say that we can't absorb this forever, that at some point we will start passing this on in different ways. Is that what you're waiting for? And why did it take so long?
Well, I think that's right. I mean, on the other side of things, we don't expect tariffs to go much higher from here. It's really a question of the confusion of where things settle down. And so
hence the argument about the one-time price adjustment we hear from Scott Bessent.
Exactly. Exactly. And that's why I think people sort of expect there will be a one-time increase. The problem is when it starts feeding into inflation expectations, and when people aren't sure that these tariffs are here to stay or whether there might be some adjustments along the way, they have to start pricing in the potential for more coming along in their supply chains. At the same time, you've got the suppliers, the from abroad, looking for other markets to sell into where they may face fewer tariff barriers, and that's going to throw things off as well in terms of the price and the balance of supply and demand. And then on top of that, with the immigration crackdown, you've got a labor supply that may be more contracted, and that will probably feed through into wage increases next year. So I think there's a lot for the president to look at, and of course the Fed.
Spiral, if you consider the wage.
Well, it's certainly another wave of things. Whether it gets out of hand beyond that or not, it's certainly not. It's an inflation fuel rather than a.
Well, so if you're Jay Powell, you're still pulling your hair out. Maybe some folks thought around Liberation Day this would be settled. A lot of it is not, which you have already established. So I guess a quarter points in the books today. Tell me if you see it differently, but there's still great uncertainty about what happens after this last meeting of the year.
I think there's a lot of uncertainty. I think that is the problem for, Jay Powell is probably circling that date in May when he can go on to whatever he comes off next, and maybe he decides to stay or maybe he doesn't as a member of the committee. But I think these are the easy cuts, right? When we came from 9% down to 3% in terms of headline inflation, to keep Fed funds rates at 5 or 4 seems a little high. But I think now as you get closer with the cut today to 3% inflation, and we're sort of below 3% right now, but if these tariffs do come through next year, if we have a spike in oil prices or other commodity prices next year, and we have pretty resilient consumer demand, which I think most people are penciling in because of potential for tax cuts, because of other benefits in the One Big Beautiful Bill Act that takes effect at the beginning of the year. So I think it's going to be a much trickier path for the Fed to look at 3-ish inflation and say, gosh, the closer we get to that, we certainly don't want to go below 3% if inflation is persistent there.
Right. Jay Powell's pretty worried about the job market right now, and I know that's another big question mark going into next year. He's got to stand in front of a room with the likes of Michael McKee and everyone to answer questions about all this stuff today. With less data to work with than maybe he's ever had, at least recent data going into one of these meetings, could this be a short news conference? What could he possibly say?
Well, I think he's got a problem to fill time because, as you say, the data is not there. But there is a lot of non-governmental data that we've all been piecing together.
We can chew on the beige book and ADP all day long, but I also wonder about the political layers that are being added on top of the Fed here. The president's doing his final interviews apparently as we speak with this meeting taking place. It's been widely reported by Bloomberg that Kevin Hassett is at the top of the list here. Is there such a thing as a lame duck Fed chair?
Well, I think it's always difficult in the end of any Fed chair's
I'm just causing trouble now.
But I think it is, it's a difficult time for investors to look at. I think, most investors are still looking at those headline inflation numbers and those headline growth numbers. The Fed drama in the background is on their minds, but I don't think it's at the top of the list right now. And so, again, it's more a question of what happens when the next Fed chair takes charge. How much do they trust when they get close to that 3% number, how dovish is the new Fed going to be? How effective will the new Fed chair be in bringing the committee around? Because it's not just the one vote that matters, it's being able to steer the committee in the right direction.
Sure. What are you hearing about the culture inside the Fed? When they go behind closed doors for a 2-day meeting, is this the group of survivors? You know, we're all under fire here out there, we've got something in common, or are there factions like the cafeteria in grade school where Stephen Myron doesn't even have a table to sit at?
Well, I'm not sure it's quite like grade school cafeteria, but it is very new, I think, for a Fed to look so divided. And that's one of the things that we'll be looking at today is the dot plot to see how much dispersion there is among the forecasts of the new members. And the more there is a differentiated view of the way the economy works, Stephen Myron has a very different view of what R-star, what the natural inflation rate is, what the natural interest rate is, from a lot of the other mainstream economists. And I think that's going to be the beginning of a pretty fierce debate going forward.
What are people in the cocktail circuit, what are economists saying about Kevin Hassett? Because this is a man who had a lot of respect. He was an economic advisor on the McCain campaign. He's worked in multiple administrations. But he's taken on a slightly different role in the public sphere, essentially finding himself on cable news every day defending the president. And he's gone to great lengths to defend the president's economic policies. Will he be seen as a political animal if he gets the job?
Well, first of all, thank you for thinking that I spent a lot of time on the cocktail circuit.
I know better.
But I think he's in a box. I mean, he is a capable economist. He has done a lot of work over the years. But no matter what he does, it's going to be hard for him to differentiate himself from this role as being a partisan advocate for the president's policies to being a neutral judge of what the appropriate interest rates are going to be.
Is the market hoping for a surprise on this then?
Well, again, it sort of depends on what the numbers look like. You know, there's a viable case where inflation will drift lower from here, and so a few more rate cuts will make sense, and the market will accept that, and things will be fine. But I think again, when push comes to shove, and you've got the president making social media posts at night and the Fed meeting the next day, how that new Fed chair balances those is going to be very difficult.
Wouldn't want that job. The question is, because of course it's one voice in a room of many expert voices, the question that we keep hearing come up on this program, Christopher, is whether he can lead to consensus. Do you think he can?
Well, we'll see. I think he's got to be able to do that. And again, I think the problem is he comes from a few of his more recent roles as being, very partisan, supporting the president, supporting the Republican agenda as it is today, and stepping out of that to become more balanced in his judgment. I think time will tell. I think it'll take some work on his part to do that, both with his Fed colleagues, but also with the market audience.
It's amazing how much we still don't know about what form this Fed will take in the months ahead.
Absolutely.
Christopher Smart, our Growth Group, thank you so much. It's great to see you back in the nation's capital. I was up in your fair city last weekend, the great city of Boston. It's a special time of year up there, and I wish you happy holidays. I hope it's beautiful the next couple of weeks in Boston, Massachusetts. I'm Joe Matthew in Washington. We'll assemble our political panel next, only on Bloomberg.
6:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks are marking a second day of muted trading. The Dow, the S&P, they are both higher. NASDAQ, though, in the red. S&P, little changed ahead of the Fed decision coming up 1 hour, 20 minutes from now. S&P right now is advancing by 1 point. We've got the S&P at 68.42. That is a gain of under 0.1%. We'll call that flat on the day, with the Dow up 169 now, up by about 0.4%. NASDAQ, though, in the red. NASDAQ Composite Index down 66, drop there of just about 0.3%. Oracle among the names reporting after the close of trading today, along with Adobe, also Synopsys, and also Chewy. Right now, the 10-year, 4.16%, the 2-year, 3.59%. Gold down $7 the ounce, down 0.2%, 42.01. West Texas Intermediate crude oil down 0.3%, 58.05 a barrel. And Bitcoin down 0.3%, 92,420 on Bitcoin. Chevron is in discussions with the Trump administration about remaining in compliance with sanctions in Venezuela, emphasizing the benefits to the U.S. of the company's continued presence. That word from CEO and Chairman Mike Wirth, who was interviewed this morning on Bloomberg Surveillance.
I don't know what the president's intentions are. We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela. The Venezuelan oil is sought after by U.S. refiners, and we operate there in full compliance with all U.S. law and sanctions. We're in discussions with the administration to ensure that we stay in compliance, that they understand the value that our presence brings to America.
Chevron Chairman and CEO Mike Wirth, interviewed on Surveillance. By the way, you can watch the full conversation on YouTube on the Bloomberg podcast channel. Oil lower, Chevron shares higher now by 1.4%. Among other oil majors, ExxonMobil up 0.8%. ADRs of BP flat on the day, down less than 0.1%. Again, recapping here, Fed Wednesday. S&P up 2 points now. That's a gain of just under 0.1%. And for on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
As we count down to the Fed with Charlie Pellet, he'll have the latest on the markets coming up top of the hour, 1 p.m. Eastern time, as we welcome our global television audience to Balance of Power and start counting down to special coverage. That'll be at 1:30 p.m. Yeah, it's Fed Day. Big stuff. We'll have a decision at 2. And, of course, the news conference that follows with Michael McKee standing by, his questions for Chair Jay Powell. The Mount Airy Resort and Casino in the Pocono Mountains was the scene of the speech last evening, the first in what we're told will be a series of campaign-style rallies, addresses to voters by the President of the United States on the issue of affordability. 90 minutes, and it was the greatest hits. He did talk about affordability. He also mocked affordability and got through a range of different issues in this period of time, talking about everything from Somalia to what he said back in 2018 about certain African nations. We'll get to that in a minute. The point is, it was a noisy speech. The president was in full campaign rally mode, and there are questions as he reminded the crowd that he didn't even want to give that speech. He only did it because Susie Wiles forced him to. There are questions about whether this is going to be effective. We talked about it coming in. Let's do it now coming out with our political panel. Bloomberg Politics contributors Jeannie Sheehan Zaino and Rick Davis are with us. Rick is our Republican strategist, partner at Stone Court Capital. Jeannie Sheehan Zaino, remembering when Joe Biden tried some of this, as our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Hey, Jeannie, is this going better, based on what you saw last night at least, for Donald Trump than it was for Joe Biden?
It is not, Joe. And I think, did he call her Susie Trump last night a few times as well? So Susie Wiles, hey, listen, I flub words too, but it was good. You know, she said that he doesn't know it yet, but he's going to be out on the campaign trail for the midterm like it's 2024. And if yesterday or last night was any indication, that is not a good strategy. Not just what happened at this rally, but also what happened in Florida and in Georgia at these elections where Republicans are underperforming. So Donald Trump consistently telling people Everything's good. You only need to have, he brought up again, your favorite, Joe, the dolls. You only need a couple dolls.
Right.
This is not working. This is not working, and the polls show it.
He brought up the pencils as well, which we were exploring a little while ago with Stuart Paul. You don't need 37 dolls for your daughter, and you don't need all the pencils. He said only one should be enough. He twice called affordability a hoax, Rick, and then said that he's no longer allowed to use that phrase. What was the impact of this speech?
Well, it's got us talking about it. I think that was part of the strategy, was to try and change the narrative. He wasn't having a great narrative in the month of November and December, and they've been sort of off on various tangents for quite some time. And so this was at least the staff strategy of getting him out there talking about cost of living and affordability. Problem is, they didn't tell him what to say about it, obviously. I mean, like, yeah, I'm sure he got back to the White House and see, I said affordability 14 times. You can't call it a hoax 14 times and think you're going to get anywhere. Yeah, I mean, I think message discipline is going to be a really hot issue in this White House for the next year, because clearly they've made a decision based on what he said last night that he believes he's on the ballot in 26. And if I were running a campaign right now, I wish he were, because there's no proof that without him on the ballot, these sort of new Republican voters that came in through MAGA are going to show up to vote. They are 1 every 4 years voters, and they've always has been, and that's not new to Trump. So when they've signed on with MAGA, what MAGA signed on to was a very difficult off-year election strategy. And so I get it. It's the strategy saying, most presidents would run away from a midterm. He's going to lean in because, without him making this about him, he can't rely on these voters to show up. And then a lot of Democrats are going to get elected, and it's going to really derail his second 2 years in office.
Rick mentions message discipline. And yes, we are talking about the speech. The president certainly got a lot of eyeballs, but I guess one of the issues might be the parts that are going viral. They're not about affordability. They're not even about tariffs. In this case, a brutal attack on the Somalian community again. He had some very long passages about immigration and veered into a lot of topics like that really were not central to the affordability message. And even confirmed reports that he had denied about the comments he made about some African and Asian nations. Let's go back to the real here.
You say, why is it we only take people from countries, right? Why can't we have some people from Norway, Sweden, just a few? Let us have a few. From Denmark, do you mind sending us a few people? Send us some nice people, do you mind? But we always take people from Somalia, places that are a disaster, right? Filthy, dirty, disgusting, ridden with crime.
Filthy, dirty, disgusting. Jeannie, back in 2018, when it had been reported that he used that term to describe African and Asian nations, he denied it, called it fake news, and reported by the enemy of the American people. He was boasting about it last night. Should we take him at his word?
This has been Donald Trump since he came down the elevator in 2016. There is nothing new here. We have it on tape over and over again. He resorts to this kind of rhetoric when he's got nothing else to offer, because he thinks he is going to be able to rile up his base and get them out to vote. But the problem is the results, at least this year, are showing something completely different. You look down at that Miami mayor's race, where he endorsed the Republican candidate who lost by double digits to the first Democrat since 1998, the first female. And what did she run on, Joe? She ran, of course, on affordability, but in particular on these ICE raids, on the treatment of immigrants. This is something we are seeing writ large across the country, as we have an ICE that is out picking up young college-age freshmen in Logan Airport and transporting them against a judge's ruling back to a country they haven't been to since they were a child. We have a report out from Amnesty International yesterday describing the conditions at Alcatraz Alley as deplorable, violations of human rights. He's taken an issue that he was okay on and doing pretty well on, and he has turned it around. And why? Because of his treatment. And this rhetoric is another reminder of his treatment of immigrants and migrants to this country, which most people in the moderate and independents don't find particularly appealing, and which is costing Republicans elections like we saw in Miami yesterday.
How are you reading this Miami race, Rick? Eileen Higgins, the first Democratic mayor in nearly 30 years, is a heck of a headline. 59%, according to the unofficial results. Emilio Gonzalez had about 40%. He was supported by Trump and DeSantis. Is there a message here, or is this a one-off?
You know, it's a little bit of a canary in the coal mine. This should have been a no-brainer. Republican control of Florida has become a standard, right? Democrats barely even want to run there anymore. And to see something like this happen in the municipality, look, it's a ceremonial at best mayor's race. It's not Dade County, right? And so, but you know, the Republican was a Cuban. That should have ensured victory on its own just from the demographics. Cuban community tends to be monolithic in their voting patterns, and there are a lot of them in this jurisdiction. So, yeah, I think it's a wake-up call. I don't think it compares to what we saw last November, where, you know, Democrats swept state houses and, you know, in two important electoral states. I think that's the message, you know, Republicans need to be understanding, but this certainly is consistent with that. And that is, we're not getting our votes out. People aren't happy with what we're doing. I don't think this was an immigration vote. She ran on, the winner Democrat ran on corruption and cutting red tape so that we can have more real estate development in the city. I mean, like, I don't buy that that's the narrative, that this anti-immigration narrative is played out in this race. Maybe others for sure, but not this one.
Are we too quick to try to turn every race into a bellwether here, Jeannie? We've got some time before the midterms.
Some time to go. You know, yeah, you can't read too much into any single one, but if you look at the totality of the races we have seen, both the specials and the off-year elections this year, they have been all moving in the Democratic, into the Democratic side. Even those that Democrats have lost, they have been much too close for comfort. And, you know, I disagree with Rick. You look at her messaging. She was very, very much focused on the ICE raids. And you look at that, and that tells you something. He is not, and Republicans are not just vulnerable on the economy, where they are very vulnerable. They are also vulnerable on what has been his go-to issue, which is immigration. And people are seeing their neighbors treated in a deplorable way. It has been a consistent messaging on the Democratic side. You look at the New York City Democratic races coming up, that's what they're messaging on. It's across the country, and it is registering with moderates, and Democrats in a way that this was always a winning message for him, an issue for him. It is not anymore with the overreach of ICE.
I've got to ask you both, because we're walking up on a Fed decision here. We've been talking about affordability for the most part over the course of this hour. Rick, we get a quarter-point cut, it looks like, today. Do you expect anything that will follow, or are markets going to be disappointed?
You know, I can't tell what the market reaction to this will be. It's everything I've listened to on Bloomberg this morning indicates it's kind of baked into the equation. But what I would hope would happen is the president and his economic advisors go out and say, see, we told you so. We got it. We're cutting those rates, and this is a huge success for the Trump administration, and it's going to bring down cost of housing and other things that are credit sensitive. And I just wish they'd make it a positive instead of saying, oh, it should have been more, right? I mean, like, part of the imagery around people feeling comfortable about the economy is that some of what you're doing in the first year of office is actually having an impact. The White House should take a victory lap today if the rates get cut.
Interesting. Jeannie, we only have 30 seconds. Elizabeth Warren's going to say it's time to keep cutting after this, right? How about you?
Yeah, maybe. I am very excited to see what the Fed does today, Joe, but I'm most excited to hear you with Gene Simmons coming up. I have to say that Kiss has been running through my head. It's going to be great. That is a great song.
You and I both, since the Kennedy Center honors on Sunday night. Guys, he's in the building. Rick Davis and Jeannie Shanzano and Gene Simmons on the same show. This might be the pinnacle right here. I'm Joe Matthew in Washington. This better be Bloomberg.
From Washington, D.C., this is Balance of Power with Joe Matthew.
Fed Day edition, as President Trump kicks off his affordability roadshow in Pennsylvania. We're going to have a decision on interest rates just about 1 hour from right now as we talk economy and rates with Martha Gimbel from the Yale Budget Lab a bit later on this hour ahead of our special coverage that starts at 1:30. First, though, our conversation with an icon of rock in D.C. this week to testify on Capitol Hill for music royalties after receiving the Kennedy Center honors in our studio moments from now. Gene Simmons from the band Kiss. You don't want to go anywhere. Let's start, as always, by setting the baseline on Wall Street. Charlie Pellet has the markets for us an hour out from rates. Charlie, how we doing?
Right now we are looking at a mixed market, just about the best level of the day. Got to tell you, Joe Matthew, we cover it all, from Fed policy to rock and roll. That's what we do here at Bloomberg. S&P right now up by about 8 points. Gain there of just about 0.1%. Yes, music royalties as well. Dow up 211 now, up by about 0.4%. We've got the NASDAQ Composite Index lower now by 39 points, a drop there of just about 0.2%. Russell 2000 Index of small cap shares higher by 0.3%. Our Mag 7 Index down 0.2%. Dow Transports up 0.9%, all ahead of the Fed decision coming up 1 hour from now. Right here on Bloomberg, we get the decision. And of course, Jay Powell's news conference coming up 2:30 p.m. Wall Street time, right here on Bloomberg Radio. So we got you certainly covered on the Federal Reserve today. Again, S&P trading very close to session highs right now, up 9, a gain there of 0.1%. The 10-year 4.16%, with a 2-year ahead of the Fed decision, 3.58%. Gold right now down $8, little changed, right at 41, just below 4,200 now, 41.99, down 0.2%. West Texas Intermediate crude also in the red, right now down 0.3%, 58.08 a barrel on WTI, and Bitcoin down by 0.4%, 92,320 on a Bitcoin. Fed officials coming up. We'll have Jay Powell's news conference again, 2:30 Wall Street time. Chinese artificial intelligence startup DeepSeek is relying on NVIDIA chips banned in the country to develop an upcoming AI model. That according to a report and the information, which cites sources. It says NVIDIA's Blackwell chips are being smuggled into China through countries that do permit their sale. NVIDIA has responded to the story, saying it is pursuing any tips it receives, and also says smuggling, quote, seems far-fetched. NVIDIA shares right now, they are trading lower. NVIDIA down by 1%. Brian Kahn has pleaded guilty to defrauding hedge fund investors of about $300 million, a scandal that hastened the collapse of the retail company that he bought. Coming up after the close of trading, lots of earnings. Among some of the names reporting after the close of the bell, we will be hearing from both Oracle today, Chewy also checking in, Synopsys, and Adobe Systems. So again, recapping here, Dow, S&P, they are both advancing. Well, Fed officials, they're about to rock and roll all day and party every night. Let's head back to Washington now. Once again, here he is, your host of Balance of Power, Joe Matthew.
And that's something coming from the voice of the New York subway and the voice of Wall Street. Charlie Pellet, thank you and welcome to the Wednesday edition of Balance of Power. I had to think for a minute because time has become abstract. Just take a look around and see what's happening in Washington this week. Of course, we're always here for you in the nation's capital on Bloomberg TV and radio as we try to connect the dots between Washington and Wall Street. And today, ahead of our special Fed coverage, and before we start boring down into the Fed and interest rates later on in the program, we zero in specifically on the connection between Washington and the music industry, regulation, and I'll point you no further than an op-ed in the Washington Post. The headline, Congress, I have a plea for you. It was written by Gene Simmons. Yes, that Gene Simmons, who was on stage at the Kennedy Center last weekend, the Kennedy Center Awards. You saw him in the Oval Office with Donald Trump. And you also saw him testifying on Capitol Hill yesterday before the Judiciary Committee for something called the AMFA Act. This is about music fairness, royalties. Listen to what he said.
How do we dare come in second to Russia, an alleged country led by a despot, when they do a better job of paying our king of rock and roll, and we're going to stand by and not pay today's artists and future artists? Because let's face it, our children are tomorrow's stars. You got to change this now for our children and our children's children, and I know you will. The president will sign this once all you guys respectfully get your act together and put this across the board. Let's do the right thing. God bless America.
He's talking about the American Music Fairness Act, proposed legislation that may or may not get a floor vote. But of course, with the support of the president, that would go a long way. It's got the support of Gene Simmons, and he's with us right now in studio. You spent the week in Washington. Thanks for making us part of it.
Well, it's my pleasure, and people are shocked. I'll try to encapsulate
what all this is for. I know that's a big word like gymnasium. Look, I don't care what kind of music you listen to, but the American music, let's just stop at that point. American music means we created and invented the music of planet Earth. Rock and roll, blues, jazz, hip-hop, country, and Western, all invented and created here. Our stars are the stars of planet Earth. You can go to Africa and hear, you ain't nothing but a, no matter where you go. Yeah. Every Christmas, everywhere around the world, people listen to Bing Crosby, I'm Dreaming of a White Christmas, written by Irving Berlin. The astonishing, stunning, and shameful fact is that no matter who you hear on AM and FM radio, they're getting 0 pennies for the airplay. So let's play a game. Who's your favorite recording artist?
Kiss.
No, come on. Somebody from the past,
Why can't
present,
we go
or
with
future.
that? All right, Jimi Hendrix.
Jimi Hendrix. Jimi Hendrix has never in his entire career or now ever gotten paid a single penny when his music is played on AM and FM radio. The stunning fact is that the Russians and some other countries actually do pay performing artists on radio, land radio, AM, FM, and Americans do not. And this has got to change and should change. Now, look, I make a living, and people of my age and, who've climbed the mountain, clawed and scratched their way to the top, we're blessed by the American dream because it is alive and I'm living proof of it. So I make a living. But the new artists, every penny counts. And the fact that they can be played on radio and not even make 1 penny for their performance is criminal.
So this is surprising to a lot of people. We're on the radio right now. You see that big radio mic in front of you there? It's such a good radio show, Gene, they put it on TV. And I've been knocking around the radio business for a minute. We hear about BMI and ASCAP fees. Has this always been the case, or was it simply an exchange? You play my music for exposure, for publicity, and I sell tickets and I sell albums, and that's now out of balance. Is that what happened?
Artists are not interested in negotiating how their careers are built.
Understood.
Radio needs
where did the ASCAP BMI fees go?
ASCAP and BMI specifically relates to writers and publishers, which doesn't affect the masses whatsoever.
So is this radio's fault or your contract with the record company? How come the middleman isn't giving you money?
Nothing to do with the record company, because they make money when they sell records and writers and producers. This is the actual recording artist. You like Elvis? You like Sinatra? When you hear that song on the radio, the people we tune in for actually never get paid.
Amazing.
Everybody else gets paid, the writers and the publishers and the advertising dollars. Radio last year made $14 billion. You know how much of that went to the Sinatra estate or Tame Impala or all the new bands?
I think I'm getting
0.
Yeah. Okay, that's in contrast to satellite radio,
but
digital
we're
platforms.
Not talking about
no,
that.
I know, but I just want to square that you're suggesting the radio industry is behind the times because all of these other platforms
I'm not
are
suggesting
paying
anything. I'm stating fact that AM, FM radio is, well, I want to use language that doesn't get anybody legal involved.
Okay.
In the patois of the street, it's criminal.
Yeah.
You cannot, America is based on the premise that if you work hard, you should get paid. So everybody's getting paid. When a radio station, AM and FM broadcasts, the executives get paid, the advertisers pay money, the billboards on the street, which use our name and likeness for free. If you use my name and likeness, otherwise, I would take your firstborn and your house. But radio is allowed to do that. They keep $14 billion. And the new artist, by the way, who's trying hard to make it, is not going to make those precious pennies to help them survive. And that's, as far as I'm concerned, my opinion is, it's criminal.
Listeners, you write in the op-ed, are more likely today to discover new music on Spotify, Apple, YouTube, TikTok. At the same time, more and more local stations have been bought up by big corporations like iHeart and Odyssey. They still play the music without paying the artists, often hits that listeners already know, in order to generate ad revenue. I've, as I mentioned, worked in radio for a while, and I've seen rampant consolidation in this business. Has that made it worse?
Well, one way or the other, whether it's consolidated
fewer
or
potential
not,
payers
the
now.
result is the same. A truck runs you over, and the guy comes out and says, "I'm sorry I ran you over. I didn't mean to do it," or "I don't like you. I ran you over." What's the difference? You've been run over. So the question is an interesting dialectic, another big word like gymnasium. The result is nothing's changed. The artists are not getting paid. That, I mean, especially our children and our children's children are going to be the next generation superstars after they climb their way to the top and fight for it. What do they have forward to look? What do they have, looking forward? They're going to get 0 pennies when their songs are played on AM and FM radio, and that's insane.
Do you have the president's support on this? Did you talk to him about it?
I spent some time with the president alone in the Oval Office, and we talked about family. And I've known the president, proud to say, before he became a politician. But what else we talked about is a private issue.
Okay, so that wasn't about legislation, I guess.
I didn't say that, but you're leading the witness, Your Honor.
Oh, not to, but well, I wouldn't think that would be private.
Well, these are semantics, but I'm not anti-semantic.
I hope that you're not, because we wouldn't be able to do this.
It was a little clickbait there. What I talked, yes, I specifically said what I spoke with the president about is not for anybody else's consumption.
Okay.
Well, there is such a thing as privacy.
I completely understand. I only ask you because so many lawmakers come on the air and say, if we get a directive from the president, we can make this work. What did you hear in the committee from members? Did you get a sense that there are votes on this?
I've heard a lot of support. I met privately with Senator Marsha Blackman and Mr. Schiff. Both sides of the aisle seem, let's just say, as soon as Congress gets their act together, the president will sign this. I am convinced of it, my personal opinion.
Well, our audience should know, and you're talking to the business community right now, that you are no stranger to big business and some pretty shrewd moves. It was a Bloomberg report when you sold your publishing rights last year. Pop House Entertainment, $300 million.
That's not entirely accurate, so just here to correct it for the record.
Please.
An entity called Pop House, a futuristic company out of Sweden, came and bought KISS, the underlying rights, the makeup, logos, as well as the writing publishing, for a respectable sum, enough to buy Rhode Island. I give you a pregnant pause so that this sinks in. But the future looks even more gargantuan than the past. We are in the middle of the first motion picture to be directed by McGee. There's an awful lot of stuff that I can't talk about because nobody wants to find out where they're going to get for Christmas in July.
Fair enough.
There's an enormous commitment by Pop House in the future of KISS, and this is just the beginning. When you look at a caterpillar and you say, well, that's the end of its life, no. You're short-sighted. You don't understand that it's going into a cocoon, which is where we are now, and we're going to come out and defy gravity with beautiful wings and soar to the heavens.
Very poetic.
I am kind of a big deal.
I've heard that, and a poet.
I was a fan, actually, of Bloomberg when he was mayor. Met the gentleman, and he struck me as a powerful and attractive man.
Well, I can only agree with that.
And I loved his algorithm that made him rich and fit, but that's another story.
Well, I'll tell you what, we've got the terminal right here. I'm sure there's a disclaimer I'm supposed to read somewhere, but with everything you just described, you just outlined the future of the music business. Why are you chasing down the old format?
Well, look, the old formats, if they worked and they were justified, should and would continue. But tell me what your retort is, even though I know you're not retorted. How do you validate our stars, the people who fought their way to the top, never getting a cent for radio airplay? How do you validate that while radio is making $14 billion? Again, I'm not demonizing them. It bears noting we need each other, but somewhere between paying artists $0 and $14 billion, there should be remember the name of the act is Fairness, American Music Fairness Act. You should let me talk more. I can increase more people will watch this instead of SpongeBob SquarePants. Come on.
Believe that. That's why you're here. Nobody gets this much time, Gene Simmons. Okay, so you've said a lot. Well, we consider the future of the music business. Do you worry about AI regulation? Do you worry about these FACO bans coming up? Speaking of algorithms, and by the way, Mike Bloomberg is not only the boss here, but founder, chairman, Bloomberg LP.
That's right.
AI is a worry for you or not?
AI is a concern if left unregulated. Anything, beautiful horse that you just bring in, if it runs wild, you've got to have some parameters that we control instead of AI. Right now, there's a country in Western Star that's got a #1 record of sorts on some chart. Doesn't actually exist.
Yeah. What do you think of that?
Well, let me just go. The major problem here, potentially, hypothetically, and otherwise, is that if states have the right, and this has to be settled right away, the government must get a federal law that encompasses all of AI to get some sanity out of this, because if you can do AI legally in Delaware, where you have all your companies, so you don't pay, so you pay less taxes, because you're a very bright man besides being good looking. Why should they want to do real music and real art in New York when they can just go to Delaware and do AI? No, you need a federal law that encompasses the entire country, and I would highly recommend, and I would hope the entire planet really gets together. It's an issue for the UN to get a world body to accept it, because it's going to happen to the same thing that happened to the unions in America. You charge too much here, so we'll do business in China. No, you want to address the AI issue worldwide so we can control what the rules are, the comings and the going, and what's the income stream, who owns the IP, who's the owner of the trademark ad info. And I'd like to announce that I'm running for...
If you were a kid, you bought a guitar, you wanted to get in the music business, what would you tell them? Turn and run?
Well, I would tell anyone to do as I did, which is to say to have a fallback position, because anything that you pour your heart and soul into has a pretty good chance, and that means likely 95% or more, you will fail. And in my case, I became a 6th grade teacher and an assistant to the editor of Vogue magazine, Kate Lloyd, and the assistant to the Puerto Rican Interagency Council, Magdalena Miranda, for the Boricua community, where I did work for a government research and demonstration project, ad infinitum ad nauseum. In other words, if your thing doesn't work out, what's the backdrop? Like, I know you took ballet lessons. If this doesn't work out,
and I've
you
lost
can
my
get up
chops.
and, do your
I'm
thing.
not keeping up with it.
Yeah.
It's pretty cool for you to be here, and I appreciate it very much. It is the American Music Fairness Act. That's what he came here to talk about. You don't need me to tell you. Gene Simmons, only here on Balance of Power. I hope you enjoy the rest of the trip in Washington. Many thanks for being with us. I'm Joe Matthew in the nation's capital, a conversation you will only hear, especially on a Fed day, on Bloomberg TV and radio.
7:21 on Wall Street. We do check markets all day long here at Bloomberg. I'm Charlie Pellet. We are looking at an update for the S&P 500 index. The key takeaway, however, a little change ahead of the Fed decision. 2 o'clock Wall Street time, 38 minutes from now. Coming up at 2:30 Wall Street time, Jay Powell's news conference. Our Fed coverage will kick off momentarily right here on Bloomberg. S&P up 5 at 68.45. Gain there of just under 0.1%. The Dow up 211, up 0.4. NASDAQ, though, in the red. NASDAQ down 0.3%. 10-year at 4.15%. 2-year ahead of the Fed decision, 3.58%. Gold down $10 the ounce, 41.97. Look at that, trading below 4,200. Down today by 0.2%. West Texas Intermediate crude, 58.32 a barrel, up 0.1%. And Bitcoin down 0.7%. 92,040 on a Bitcoin. After earnings, Cracker Barrel shares are advancing by 0.9%. After earnings, GE Vernova surging now by 14.2%. Recapping, S&P higher by 5, up 0.1%. Balance of power continues now, and back we go to Washington. Once again, your host, here he is, Joe Matthew.
All right, we count down with Charlie Pellet. He's in New York. I'm in Washington, where the Fed, of course, will be announcing a decision on interest rates a little more than a half an hour from now, as Charlie just mentioned. Michael McKee has made his way over to the central bank, and he'll be in place to not only deliver that news as part of our special coverage, take a look at the dot plot, but he'll be in the room for the news conference with Jay Powell with always some compelling questions. 25 basis points is the idea here, the final meeting of the year. As I read in the Bloomberg Daily Brief, the surprise may come from how dovish or hawkish the guidance is. And this decision is coming against the backdrop of a big debate in Washington over affordability, the buzzword here, one that the president is not terribly fond of and even calls a Democratic hoax when we consider the issue of prices, inflation. The president beginning a road trip in Pennsylvania last evening in which he tried to get his arms around the issue. Listen.
They gave you high prices. They gave you the highest inflation in history, and we're bringing those prices down rapidly. They say, oh, he doesn't realize prices are high. Prices are coming down very substantially. But they have a new word. You know, they always have a hoax. The new word is affordability. I have no higher priority than making America affordable again. You can give up certain products. You can give up pencils. You don't need $37 for your daughter. 2 or 3 is nice.
2 or 3 is nice. Martha Gimbel joins us now as we walk up to our special coverage with her eyes on the Fed. Executive Director, co-founder of the Yale Budget Lab, former senior advisor, the White House Council of Economic Advisors. Martha, it's great to have you back on Bloomberg TV and radio. What does the Fed think of affordability?
I think the Fed is trying to really maintain its dual mandate here and not get sucked into the political conversations of the day. So they're not trying to get into conversations about $37 for your daughter or $3 for your daughter. They're trying to think about what's happening with labor markets and what's happening with inflation.
Well, which one are you more worried about today?
You know, I'm itchy about inflation. I do think the overall state of the economy is obviously confusing. You do have some weakness in labor markets, which obviously you've seen some people on the Federal Reserve responding to. At the same time, you know, inflation has been really sticky. We have not seen real progress on inflation since mid-2024. And so it's a little bit odd that the Federal Reserve is almost certainly about to cut interest rates by another 25 basis points when they really are not all the way there on their inflation goals.
So I'm glad you're with us because you were on the White House Council of Economic Advisors in the Biden administration when prices were peaking. Is this where we're at now? Is this a last mile story? Or did the president's tariff regime reignite the issue of inflation to make the issue worse?
Yeah, I mean, if you looked at where people thought we were going to be at the end of 2025, you know, sort of consensus was that inflation was going to be about 2.4%. So, you know, basically heading towards target. The last inflation reading we had on CPI was about 3.0. So obviously pretty substantially above where people thought we were headed. Now, you know, counterfactuals are hard, who knows? But we've certainly seen evidence that tariffs are starting to push prices up. I would also emphasize the immigration decisions, right? When you are pulling people out of the labor force, when you are making it harder for employers to hire, that is going to drive up prices, particularly in certain sectors like agriculture, construction, and that's not helpful either. So overall, I would certainly say that the administration's policy mix has been on the inflationary side. That's certainly what we've seen in our analysis here.
Well, I know we've been without a lot of data because of the government shutdown recently, so it's difficult to put numbers on every answer here. Martha, the president said simply last evening, quote, "We inherited the highest prices ever, and we're bringing them down," unquote. Are those two statements true?
I mean, inflation is not the highest that has ever been, certainly not when he inherited it. It was higher many times in history. Just after World War II, it hit 20%, which thank goodness we never hit in the aftermath of the pandemic. You know, inflation is hard enough. The cost of living issues that are facing families are hard enough. It does not help to not take them seriously and to not think carefully about what the data is showing us about where we are and where we could be headed.
Yeah. Kevin Hassett is speaking on another network right now, Martha, and I've just got my eyes on the headlines crossing the terminal. Of course, you know that he's been reported by Bloomberg to be at the top of a very short list here to replace Jay Powell next year. He just said that Donald Trump will make the final Fed chair choice in the next week or two. Is the market prepared for Kevin Hassett, if that's the name?
I mean, you've been seeing some reporting that people in markets have been going to Secretary Bessent and suggesting that the markets would not be happy about Kevin Hassett as Fed chair because, you know, there's some concern about Federal Reserve independence with him at the helm. We will have to see. I think markets have been, frankly, overly complacent about the issue of Federal Reserve independence. It is very clear that this administration would like interest rates to be lower, in my opinion, regardless of the overall economic situation. And frankly, you know, we've seen this before. We've seen this in the 70s. We've seen this in other countries. When you lose Federal Reserve independence, or even when it's simply threatened, that really hurts the quality of your economic governance, and it hurts economic growth, and it hurts residents of the country. And so
Understood.
I really do think that we need to be prioritizing that and that markets need to be responding to that.
Does it matter that he's on TV every day defending the president's economic policies and defending the president's approach to the Fed? Because he's become very good at that as a political animal inside this administration, but it's a very different job running the FOMC.
It's a very different job. I mean, you have had people who have been, you know, part of economic policy in the White House, then joined the Federal Reserve before, who have taken Federal Reserve independence very, very seriously. So it is not the case that simply because someone has worked in the White House that they cannot do a good job at the Federal Reserve. I want to emphasize that. But I do think that it is important that Kevin Hassett or anyone who is nominated makes it very, very clear that they are going to prioritize Federal Reserve independence in the face of a president who doesn't seem particularly interested in it.
Interesting. What's the question you would have for Jay Powell if you were in the news conference today?
I want to know if he's going to resign his seat. You know, I think if he stays on after he's chair, which he can do, which would be unusual, that may provide some reassurance to investors about, you know, the votes that there will be for steady macroeconomic management at the Fed.
Well, he's going to have a lot to talk about today, not only the decision, but also the dot plot that we'll be chewing on in our special coverage. And I'm really glad that you could join us, Martha, to spend some time here. Martha Gimbel, Yale Budget Lab, former senior advisor, the Council of Economic Advisors in the Biden White House. We thank you, as always, for the insights. Quite a half hour here on a Fed day. We started with Gene Simmons. We resolve with Lisa Abramowitz and Tom Keene. Yes, it's time for special coverage. Coming up straight ahead, a special edition of Bloomberg Surveillance. The Fed decides. Tom Keene and Lisa Abramowitz live from World Headquarters in New York straight ahead. I'll meet you back here on the late edition of Balance of Power. That starts at 5 p.m. Eastern Time as we try to keep the beat on politics here in Washington. with a big decision on rates straight ahead. Stay with us only on Bloomberg TV and radio.
Afternoon, live from New York City for our audience worldwide. Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Bloomberg Surveillance, The Fed Decides.
Live on Bloomberg TV and radio, counting down to another Fed rate decision and Chair Powell news conference. Tom Keene here, Lisa Abramowitz, as we count you down to, I think, one of the most exciting Fed meetings we have ever seen, given the fact this might be the last rate cut with a Fed led by Chair Powell.
I can state with great force, it will not be a snooze fest. I think we're there. Anna Wong within the last hour. My latest favorite forward-looking indicator showing renewed disinflation. That's behind the support of people looking for not only one rate cut, but many rate cuts to come.
So let's have a sound effect for every time someone says hawkish cut, because that's essentially what people are expecting, that yes, they will cut rates for a total of 175 basis points of decline since last September, but it will come with an indication there probably won't be that many more ahead.
It's wide open. I mean, we're going to have somebody said it's like a TV soap opera. That's what this is. You're tuning in here at 1:30 for the 2 p.m. Days of our lives, I guess, for the Fed. Within all that is we grab onto the latest statistics. The employment cost index, the ECI today, really did indicate a further disinflation, which gets you the confidence to get out to next year.
Well, the soap opera of markets is a real indirection right now, at least when it comes to equities, really fluctuating between gains and losses as people try to get a sense of exactly what's going forward. Looking at S&P 500, it's almost exactly where it was on October 29th during the Fed's last meeting. Euro dollar also pretty much almost exactly where it was at 116. Gold, however, is 7% higher, stronger than it was back on October 29th. The 2s, 10s, and 30 space is where the action's at. The 2s has been locked in at that 3.6% rate, just a little off that 3.59%. The 10-year, though, markedly higher. It is off today, yields lower, but watch that 10-year as globally you've got that bond sell-off.
You do, and the spread market is worth watching. The sophisticated pros like Bob Michael, they're not just looking at one statistic. They're looking at all sorts of fancy spreads, particularly out the curve to get indications.
Yeah, and how much the yield curve has steepened around the world. We're going to be speaking just shortly with JP Morgan's Bob Michael. We're so glad to have him, as well as Kathy Jones of Charles Schwab and SocGen's Subhaja Rajappa. They'll be taking us up to that Fed rate decision at 2 p.m. Eastern. Then immediate reaction from Jim Bianco of Bianco Research, Diane Swank of KPMG, and Deutsche Bank's Matthew Lazzetti. And finally, breaking down Chair Powell's news conference with Stephanie Roth of Wolfe Research, Bank of America's Aditya Bahave, and BlackRock's Jeff Rosenberg. So glad to say that joining us here in studio, as he does, is Bob Michael of JP Morgan, who helps us lead off our coverage of the Fed meetings. How important is this one in the pantheon of Fed meetings?
I'm with you on this. This is going to be an extraordinary meeting. There's so much that's going to go on. I think everyone is expecting the 25 basis point rate cut. It would be a stunner if it didn't happen. The Fed would have prepared us by now if it wasn't going to happen. But all the action is going to be with the dissents. How many is he going to have? Will it be limited to 2, or could there be as many as 5? I think that would be extraordinary. And then we have to watch the statement after the FOMC meeting to see how they tilt that. Will it be a little hawkish or not? And then the press conference. There's a lot going on.
I agree, and the specificity of the dissents will be fascinating to dissect. Michael Feroli at JP Morgan's way too young to remember Wayne Angel and some of the fractious moments in the 90s and even back to the 1980s. Bruce Kasman maybe can understand it because he's ancient like me. When the bottom line is this new territory, or is there an analog Bob Michael can work off of getting to this meeting and beyond?
First of all, Feroli does have some gray hair, so he's not as young as we all think. He's been around the block. I think we're entering new territory. I think most everyone has worked through the Greenspan era, where Alan Greenspan made sure to corral the Fed and come out with a unanimous decision. And the belief was, if you've got something to say it in the meeting. See if you can convince other people. If you can't, then get behind the decision that's been made and let's make it work. We can always come back and adjust. I think a lot of dissents is a seismic shift.
I had a luxury this week of a spectacular room at the Global Interdependence Center conference on stage with Shirakawa, Frenkel, and Portgay of Argentina as well. And one of the themes there is the risk, with all the politics behind this meeting, of being unanchored. Do you see any indications among your professionals that the markets are becoming unanchored?
I don't think we're there yet. I hope we don't get there. I do believe this is a Fed that goes in, it analyzes the data. Yes, there's been a shortage of data, so they've got to try and fill in where there are gaps. We'll get some of the employment data next week. It'll be a little bit later than when they normally make decisions. But I do feel they are trying to do the right thing.
Right.
And by the way, if they do cut rates 25 basis points, you're down to 3 5/8%. You're not at sub 3%.
Did you see what a money market fund is at?
Yeah.
I had no idea. I'm in the triple leveraged all cash. I was popping 8%. It's gone.
Which is the reason why some people think that you should get more of a bid into longer-term treasuries. And I know that Bob Michael is one of those who thinks that if the Fed does cut and indicates further cuts, you want to buy the sell-off in long-term yields. I guess to Tom's point, to build on that, do you see any indication that the sell-off globally in bonds is a result of unmoored inflation expectations, or is this something else that is more of an anomaly that gives you a buying opportunity?
So I'll tip my hand. We were in buying this morning when we walked in. So we liked yields at these levels. We thought that the market had backed up too far, and it made sense for us to stick our toe in. We do see a lot of moderation in the labor market. We do see inflation coming down a bit. That will probably be in the summary of economic projections. We should see them drop a tenth for each of the outgoing years. And it just feels to us that the market suddenly woke up to, oh my God, there could be dissents. They may not go every meeting. And there was selling, and the selling looked well overdone to us.
Last time you were here, you said that this is a Fed Chair, Jay Powell, who has lost control over the FOMC. And we seem to see that with the dissents that it came out during that meeting. If there are 4 or 5 dissents, can you say that this is a Fed Chair, Jay Powell, that is leaving a legacy of a Fed Chair that does not control the FOMC in the same kind of way, that you cannot give forward guidance with this type of fissure that we're likely to see persist?
So there's no wrong model, and the Bank of England operates with, if you disagree, vote that way, and we'll go with the majority. I happen to like everyone say what they have to say during the meeting. We've got to make a decision. Once the decision's been made, accept that you were unable to convince people, recognize that the majority wants to go in this direction, and get behind it. So I'm more in favor. But if this is a shift, I think that's going to be the future.
What does that say about Kevin Hassett Fed, or any kind of new leadership that comes in under President Trump? We know that Fed Chair Jay Powell will be replaced. Does that mean that that person is less important if the committee is already fractured and not willing to get behind that?
Oh, that's such a good question. I'm not a believer that this is a 100% deal with Hassett. He's interviewing with President Trump now, and I think President Trump is looking at Scott Bessent and saying, is this guy better than Bessent? And the one determining factor will be how convincing and persuasive will Hassett be relative to Bessent. Bessent has done an excellent job getting out there with the administration's message and calming the markets and explaining what's going on. I think that's something that we haven't seen from Hassett yet.
Who would replace Bessent then at Treasury? Would it be a building contractor in London looking for a new building out on the river? Mr. Diamond would be available?
Well, Bessent had, I hope not. I think Jamie's doing a fine job where he is. Let's not start that rumor. Let's keep Jamie where he is. I think that's the question. Why is Bessent not taking this role? President Trump has made it clear he wants him in this role. If I were Scott Bessent, I would say I would go to that role as Fed chair if I could name my successor as Treasury Secretary with you. We agree on somewhat.
This is like something out of the 19th century. I don't know which president was before Lincoln, but this meeting is nuts today.
We are in a new regime, and it does feel like we're seeing a sea change in terms of the Bretton Woods Accord, in terms of the financial markets, in terms of how the Fed operates going forward. This idea that everyone coalesces around one idea seems to be fading a bit as you see more dissents. Bob Michael is sticking with us to tell us his key question and so much more after being in markets to really talk about buying the dip, at least in bond prices, yields up. A real question of other people seeing the same thing because of what you said about the cash holdings and how little really gets yielding.
Biggest meeting since time began today, and again, the economic data here in 4, 5, 6 days. It's an eventful December, to say the least.
Yeah, biggest meeting since the beginning of time. You heard it here first. Coming up, Kathy Jones of Charles Schwab and Subhaja Rajappa of SocGen as we count you down to the Fed decision. This is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
In case you missed it, on Bloomberg Brief. This is a big difference from April. Remember when there was no poll, even though the 10-year is below 4%, if you start to see the labor market showing signs of firing, whether government or the private sector, I think then the 10-year has a lot of room to decline because then the Fed's cutting into accommodative territory, not just getting to neutral. Don't miss Bloomberg Brief, live every weekday.
We're coming to you live from Kuala Lumpur. The whole world is here.
The
APEC Leaders Summit bringing together heads of states of 21 APEC economies.
The White House is trying to use the stops to gain additional leverage.
This big deal with a number of the biggest companies in South Korea.
That's a big number.
Deals can't be done.
Trust Bloomberg for on-the-ground coverage.
Korea is not Japan.
Up-to-the-minute reporting.
In this latest salvo of this trade war.
What a visual.
And the analysis you need.
China's not going anywhere, nor are we.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Watch Horizon's Middle East and Africa every trading day at midnight Eastern Time. Only on Bloomberg.
The Fed needs to do more. The Fed needs to cut rates.
The rate cuts are baked in.
We think they will cut. They will cut.
We do expect the Fed to cut.
This cut is going to happen.
They're going to cut. They'll try to make it a hawkish cut.
I think they're going to leave it open-ended today.
This should be a mixed decision.
I think we'll also see quite a few dissents.
Historically, dissents are really the norm.
Things are confusing, and you can see that within the debate within the FOMC itself.
We just don't have a real clear picture of what's happening in the economy.
Inflation remains a very sizable problem.
The U.S. labor market is soft right now.
The labor market is about as clear as mud.
Driving through the fog is a good description.
It's a cyclical slowdown in the economy.
The underlying question is what the market expect the Fed to do versus what the Fed should do.
The market would be surprised by an overly dovish message.
There's so much at stake going forward with the Fed.
We're increasingly moving to an era where the Fed is more divided.
Clear as mud. This is Countdown to the Fed Decides on Bloomberg TV and radio. I'm Lisa Abramowitz with Tom Keene as we see in markets looking for direction ahead of a meeting that could potentially set a trajectory going forward. Clear as mud time. That's what we hear from so many people.
There's so many ways to go here. I would go with the latest economic data and what we're going to see after the meeting in the coming days. And as Anna Wong said, within the last hour, there's a new disinflationary perhaps that's out there. It's not assured, but some of the data indicates maybe a new bout to get to a better place, which means more rate cuts down the road.
Bob Michael of JP Morgan still with us. And Bob, how much are you seeing any clarity whatsoever in data that we are getting, given all the data that we are not receiving?
Not so much. And to admit, the labor market has been mixed. When you look at payroll data and weekly claims, it looks a little better than, say, the ADT data. We talk to a lot of companies that we invest in, and we hear the same message back. They're still trying to figure out what the impact of tariffs and AI will be on their labor force and their profit. So they're pausing on hiring right now.
What's notable is since the last Fed meeting, we haven't seen much change in the S&P 500, the euro-dollar cross. We have seen a 7% gain in the value of gold. We haven't seen much of a change in 10-year yields. We have seen, in 2-year yields. In 10-year yields, we have seen a market shift higher in 30-year yields as well. So it raises this question going forward. What does the market see with respect to the sell-off in bond markets that all other asset classes are not seeing? And is it a positive sign going forward? Joining us now is Kathy Jones of Charles Schwab. Kathy, from your perspective, are we looking at a new neutral rate that the Fed is coalescing around and that they can agree on?
Well, presumably they're looking at 3% as a neutral rate, if I can read the various indicators that they provided. And so, they could get down a couple more rate cuts and still be arguing that they were moving towards neutral. I think the problem is convincing the world that there is a neutral rate that can be determined and that they can base policy on. I think when we look at the steepening in the yield curve and what's happening with longer-term rates, it reflects uncertainty about whether the Fed's making the right move by cutting with inflation still elevated. It reflects the fact that bond yields in much of the rest of the world are starting to move higher, especially Japan, worries about fiscal deficits. So it all comes down to, is this the right move at the right time for the Fed? I think the market is not clear on that, and they're building in a risk premium as you go out the curve.
Okay, so I know you've published your outlook. It's 412 pages. Rip it up. It's going to be dead at 2:15 this afternoon. The new outlook off of this Fed meeting, Kathy, what does it mean for investors? Do you clip a coupon, or is there a total return opportunity into next year?
Right now, most of the return we're expecting will be from the coupon. There may be, if inflation does come down, if the labor market continues to slow from here, which not 100% sure that's going to happen, but if it does, then there might be some capital gains. But I think our expectation is returns will be positive, but not as robust as they have been in 2025.
Bob Michael with us, JP Morgan. Let me go Marty Fritzen on you here right now. Give us a review of how JP Morgan sees credit quality out there. It's a K-shaped economy. X amount of America's flat on their backs, but I don't see defaults, et cetera, within the credit market. It's pretty good out there, right?
Yeah, the public credit markets look pretty solid to us. Corporate profitability remains in a very good place. Businesses have been pretty good about how they've controlled costs. A lot of them are thinking about CapEx next year, doing a bit of hiring. So we're not hearing the things from corporate America that would particularly get us concerned as credit investors.
Well, let's go to Lisa Bramwitz. You're actually expert on this. Are we wicked tight right now? Where's the spread market?
Right now, it feels like that is the concern, that maybe we are too tight relative to even some of the idiosyncratic credit softening, but still, people want the income, and it raises the question, Subhadra, to the point, Kathy, to the point that you're making. We'll get to you in a second, Subhadra. Going forward, in terms of, is there a contradiction in the solid credit worthiness of so many companies and the idea that the Fed needs to cut so much more to really support the debt markets?
Yeah, I think that's the tension right now. And the reason we have a steeper yield curve is it's not clear to me with financial conditions as easy as they are, and inflation still elevated, and the economy looking fairly sturdy. It's not clear to me that this is a market that needs a lot more stimulus, or that we're that far from neutral that it's required at this stage of the game. But they are very focused on the labor market. There has been some slowing there. There's been a little bit of easing in wages. And it seems as if the big concern is the labor market that the Fed really wants to get ahead of. And it is in contradiction to a lot of the other signals that we're getting from the market.
Bob, do you agree with that? Do you think that there is a contradiction here?
I don't think so. I just look at what's happened in the last month as normal volatility. Some markets getting a little bit ahead of themselves. I'm expecting bull markets into year end. I don't care if you're looking at treasuries, you're looking at credit, or you're looking at the equity market. That's how much interest we're seeing from our client base.
Is this just a technical issue? And I guess, Kathy, that's sort of what is part of what's implicated here in Bob's statement, that there's so much cash. If people have $8 trillion of cash in money market funds, there's a lot of money looking for income. At what point does that overwhelm some of these other concerns and really wash out, a real sense of whether there are credit worries, et cetera? Right now, companies are doing okay, and there are enough people who want to buy.
Yeah, we're on board with the investment grade public market. We think it's pretty solid. We look at the corporate profits margins are okay. So we've been all year saying, stick with higher credit quality or solid credit quality and don't see a big blowout coming. I think the bigger concern for us, obviously, is the public sector debt accumulating and also the risk that the Fed is wrong about inflation coming down further and that it will not get to its target anytime soon.
Kathy Jones, thank you so much for being with us. We look forward to catching up with you after the Fed decision in just about 7.5 minutes' time. Joining us now is Subhadra Rajappa of SocGen. We will get to you. Subhadra, wonderful to have you in studio. Always great to see you. How important is this meeting going to be, not just with respect to whether they cut rates and the statement of economic projections, but setting a precedent for a Federal Reserve and how it operates in terms of the Fed chair and its role?
I think it's going to be very important. I mean, I think that in one way to look at it is that Chair Powell is really setting the stage for next year, and kind of setting the tone for what is going to happen as far as policy is concerned. I mean, for the most part, I think the expectation is that it's going to be a hawkish cut. I think if it turns out to be somewhat dovish, I think that that'll be, again, quite a surprise for the markets. But, to me, this meeting feels like a deja vu from last year where, coming into the end of the year, the Fed basically guided for, policy to be on hold for a good portion of 2025. That's what we saw, and that's exactly what we're going to hear from them for next year, because they have delivered a few preemptive rate cuts. Mm-hmm. So we'll have to kind of see how the data evolves from here on and what they have to do going forward.
Societe Generale owns a derivative market. You're always looking at the cross moments as well. What's the risk profile into this meeting?
I mean, clearly, to me, the risks in an environment where the Fed is biased to ease is towards easing and lower interest rates. In fact, in our year-end forecast for 2026, I think we might be a little bit out of consensus expecting 10-year Treasury yields to actually go lower from here. I think there's some of our counterparts who are expecting much higher interest rates.
What's your forecast to get to 3 o'clock this afternoon? I mean, is there a bet on the market being placed right now?
So if you look at the last few meetings, the price action has been to kind of rally softer into the market and then a little bit of a sell-off after the meeting. But for the most part, I think I'm aligned with Bob in expecting that the markets are going to be really cautious heading into year-end. So the bias ultimately towards the end of the year is going to be towards lower yields.
Bob, let's bring it back in. You're saying there's so much cash here, and that's part of the reason why you think that it's not inconsistent to see a rally, not only in rates, but also in the credit component. Is this liquidity going to get added to by the Fed's balance sheet, right? Are we sort of all careening toward a place where the Fed has to keep adding to its balance sheet in order for repo liquidity, for the functioning of markets, which only adds to the cash searching for income?
Well, let's remember, asset prices are denominated in money, and there's a lot of money sloshing around in the system, both from COVID-era policies and laws, as well as the QE that has now ended. Will the Fed keep growing its balance sheet? Absolutely. They've ended QT. They're starting to recognize that you talked about public sector debt. The size of the Treasury market is a big, unwieldy beast, and you need the Fed balance sheet in there to help stabilize it. So, yeah, I think we're just going to be more of the same. And let's not forget, the administration is pro-growth, pro-business, and that means stimulus and lower rates.
Subhadra, if you take that backdrop that Bob just laid out, and a lot of people are sympathetic with, why wouldn't you see higher inflation in consumer prices, not just assets?
You should, but I mean, the realized data has been somewhat on the softer side, right? I mean, we really didn't see the transmission of tariffs through to goods inflation. You're seeing broad-based services inflation. You're seeing a little bit of, cloudiness around the outlook for inflation. There's a good chance that inflation could be somewhat more hotter in the first half of next year. But, for the most part, I think that inflation expectations have remained relatively contained, and I think that leads me to believe that, there's not that much of a concern in the markets about inflation.
Very quickly here, as we get to the decision, I look at what both you are saying. I think of Frances Donald today with the Bank of Montreal, and she's like, okay, I parachute in, I'm Rip Van Winkle, and I come down on December 10, 2025. I got 3.5% Atlanta GDP now. Real GDP. I got nominal GDP, what, Bob, 5-ish plus?
Yeah.
5-ish plus. I got yields backing up a little bit. Everybody, including Lisa's, made a big deal about OMG rate cuts as we go, and yet yields are going up, price down. Jim Bianco's with us later. He'll talk about that. Tell me about the dissents. Both ways. Let me start with you, Bob. The people like Myron saying cut now, is it just a political mandate, or is there a case to let's go to cut interest rates?
Well, the case would be that the entire FOMC is still expecting rates, the neutral rate, to be lower, and the median dot is still down around 3% and will be there. So you're too far away from the median dot. And also, there are signs that there's some slack in the labor market. We'll see over the next couple months.
Just because of time, we got to get to the opening face-off. Just because of time here, Subhadra, tell me about the case to not cut rates today, or even, dare I say, go Kansas City and lift rates today.
Well, the economy's been extraordinarily strong. You've seen a significant amount of momentum going into the second half of the year. You're going to get a lot of fiscal stimulus next year from the big, beautiful bill. You're also going to be seeing a lot of AI spending coming into the corporate bond market. And you're going to see the reopening from the government shutdown and consumer spending start to pick up in the first quarter of next year.
Lisa, quickly here, then state the case for we delay the meeting, not have an announcement today, and wait for the economic data 4, 5, 6 days from now.
Yeah, December 17th, delay it a week. I think a lot of people would agree. MH in particular has been arguing for this. They're not going to do that, though. Subhadra Rajappa, thank you so much for being with us.
Thank you.
As we count down to this Fed decision, right now we've got about 90 seconds ahead of that decision, and right now markets churning a little bit of a negative tilt to the S&P, to the NASDAQ in particular. Yields lower on the front end. Watch this space as people expect that 25 basis point rate cut. On the long end, we've seen a little bit of a pulling back from an earlier sell-off with people buying the 10-year yields, including Bob Michael, who said that he was in just earlier, 4.16%. Let's just get your view, Bob. Do you think that you're going to get 4 dissents, 3 dissents, or 5 dissents? What's your view?
Well, exactly. Yes, that's my view. We're going to get some. I think the range is 2 to 5. For sure, you should get Myron on the 50 basis point rate cut. And for sure, I think you should get Schmid on no rate cuts whatsoever. Will we see Musselman, Collins, Goolsbee join Schmid? I don't know. We have to watch.
Right now, the market is watching, and what you are seeing is a 10-year yield that finished on October 29th at 4.07%. We're looking right now at 4.15%. It is somewhat higher, although pulling back from some of the earlier highs. And some could argue it hasn't risen as much as yields, say, in Germany and in France. Euro dollar has just been pegged because sort of pick your poison. Is it the European economy that's flagging, or the U.S. economy with rate cuts? We are just 2 seconds away. Let's get to Bloomberg's Michael McKee with that Fed rate decision.
The most divided Fed since before the pandemic voted to lower the benchmark rate by 25 basis points as investors expected. But there were 3 dissents for the first time since 2019. And on the dot plot, a total of 6 members of the committee suggested they were not in favor of lowering rates. There's also a hawkish line in the statement. In considering the extent and timing of additional adjustments to the target range, bringing back language from a year ago when they paused their first round of rate cuts. No surprise, Stephen Myron wanted a half-point reduction, but in something of a surprise, Austin Goolsbee joined Jeffrey Schmidt in dissenting for no cut at all. Next year's dot plot suggests just one cut coming. 7 members want no move, however, including 3 who think the rate might go up. The committee statement says economic activity has been expanding at a moderate pace, and the latest forecasts show a consensus GDP figure of 1.7% for this year. But in a big move up, they have revised growth forecast for 2026 to 2.3%. Unemployment forecast to finish this year at 4.5% will fall back to 4.4% next year. Using identical language from October, the statement says job gains have slowed this year and the unemployment rate has edged up through September. Nodding to the government shutdown caused absence of data, the statement repeats that more recent indicators are consistent with these developments. There's no change in the inflation assessment. It has moved up since earlier in the year and remains somewhat elevated. However, it is seen slowing markedly next year. PCE headline from 2.9% this year to 2.4% in 2026. And as always, they won't reach their 2% target for 2 more years in 2028. Core PCE will finish the year at 3%, falling to 2.5% next year. As for the balance sheet, the statement now says reserve balances have declined to ample levels. The Fed will buy shorter-term treasuries, mostly bills, but up to 3-year notes, as needed to maintain that ample supply. The first operation will be announced tomorrow, with the first purchases on Friday of approximately $40 billion in Treasury bills. Guys?
Michael McKee, stay close as we parse through this. Right now, what you see in markets is a collective cheer. Perhaps this was supposed to be a hawkish cut. The market is taking it slightly differently. S&P had been lower. Now it is positive by almost 0.2%. Euro climbing, dollar falling on the heels of what does seem to be like more Fed cuts. And across the board, 2s, 10s, and 30s, you are seeing a bid into bonds with this feeling that this is a Fed that not only is going to support rates with further rate cuts, but also with additional bond purchases, Tom.
To me, the most interesting nuance here is the dissent of the gentleman from Chicago. This is brilliant academics out of Milton, Yale, and the Massachusetts Institute of Technology. Austin Goolsbee is basically our technology president. He's wired into the internet, wired into the computers, and I'd love to know if his dissent has to do with the vibrancy of AI, which leads to a better productivity, a better GDP. Let's be careful what we do.
Yeah, right now we're looking at nine votes, 4 and 3 dissents. Bob Michael of JP Morgan with us here. What's your first reaction of this decision?
Not as bad as it could have been. There could have been a lot more dissents in favor of no rate cuts. When we look at things like PCE, we expected they would lower core PCE by 1/10. They did that. They left the unemployment rate for next year roughly where it was last year. They did raise their expectation of GDP a couple tenths from where it was. So to me, that seems to be, if you want to call it a hawkish tilt, the one hawkish tilt. And of course, adding the extent and timing of additional adjustments to rate policy going forward, that was pretty much in the market. So I think mostly as the market expected and nowhere near as bad as the market feared.
So not maybe as hawkish of a cut as people thought it might have been. Joining us now is Jim Bianco of Bianco Research. Jim, what's your first reaction to this decision, which, as Bob was saying, isn't as bad as it could have been? It could have been 4 dissents or 5 dissents, only 3 dissents. Is this a victory for Jerome Powell?
It's a victory for Jerome, but I'll take the other side, Bob. I'll say that it's not as good as it could have been. I was hoping for a 7-5 vote. I was hoping for a Fed that was more divided, that was more independent, that was going to send a message to the administration. You could put a guy in that wants to go to 1%, but he's not going to bully us to cut rates next year just because he's the Fed chairman. They kind of left the door open. I think that the Fed can be bullied by the next Fed chairman to do the bidding of President Trump.
Bob, you were saying that you wanted to respond?
Not as good as it could have been with more dissents. I think if you're the administration and you're invested in this market, this is pretty much as good as it could have been, other than no dissents. I'm not sure how additional dissents make this better.
Will McKee dissent at the press conference?
Well, let's find out. Mike, you were parsing through this. You've got something to add. What do you see?
Yeah, well, the point I'd like to make is that the SEP shows that growth is going to pick up significantly next year, unemployment is going to go down, and inflation is going to go down significantly next year. So what was the rush to cut rates today if they think that's the track that we're on? I think that's going to be a key question for Jay Powell in the news conference. Does this raise the possibility that they could be going the wrong direction with rates? There were some people who made that case before we went into today's meeting, and they're going to be still raising questions about it going forward.
Michael McKee, thank you so much. We will be catching up with you and, of course, listening to your questions. Jim, this is something that is near and dear to your heart as you call yourself a self-dubbed inflationista. Do you think that this really adds to that inflationary pressure if the Fed essentially is accepting that they're not going to get down to their inflation target for 6, 7, potentially even 8 years?
I agree. I think that the Fed has to be very worried about that. We're worried about affordability right now. This price CPI is up 27% since the end of COVID, and that's what people are upset about. How do we fix that? We need the inflation rate to run below 2% for a while so that wages can catch up. If the inflation rate is going to stay at 3 and moderate to 2.5, that is going to keep the affordability anger white hot over the next year to year and a half or so. And so I don't think that accommodating that by cutting interest rates is going to help. And that's the question I hope the chairman gets is, how are you helping affordability with 175 basis points of cuts in the last 14 months?
Jim, we got to review the past here. You were a leader on saying that inflation would be sticky. It was a lonely call years and years ago, and Bianco of Chicago said, you know what, folks, we're not falling down to 2%. So here we are, Jim Bianco. I just want to know the efficacy, Jim Bianco, where he says in the press conference, basically, one and done. We made a rate cut. Maybe we will have a sequence of future rate cuts, but we really, really now have to wait and see what the data says. Isn't that where we are, Jim Bianco?
Well, that's if that's what he says. And again, what I was trying to say before is if the chairman imitates that it's one and done, means the chairman's running the show. And in May, we're going to have a hand-picked successor from Donald Trump running the show. And we know what Trump thinks about interest rates, and that person's going to want to have lower rates. But if he does say that, then maybe the market will take it a little bit differently, and we'll see if he does. But most of the times he'll just say he's going to be data dependent, and it depends on what the data is.
This is an important vignette, folks, that I think just so valuable. I'm in a room with Axel Weber, Shirakawa of Japan, the wonderful John Lipsky with all of his work on New York Wall Street, many other worries. Tom Honig was there from Kansas City. And the room fell silent, Bob Michael, when they talked about the next regime of the Fed and the risk here that it would be cut, 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 cut. Is that a legitimate fear? That the next chairman and the apparatus will allow us to go towards some regime of new low rates?
Well, I think you have to look at which Fed presidents are coming onto the FOMC next year, and they're mostly in the hawkish camp. So whoever you put in as the Fed chair has to be very persuasive. And I guarantee you the president isn't looking to appoint the next Paul Volcker. They're looking to appoint someone who believes in supply-side economics.
And Lisa, this is critical. This is absolutely critical that we have an analog here with the Bank of England that over time has told the governor of the Bank of England and their chairman equivalent, no, we're not in agreement. We're not going to do it. Is that what our 2027 looks like?
Part of the problem is people get overwhelmed by the state of events, and this is something that you talk about a lot. And Jim, I'd love your thoughts on that. This idea that this is a Fed that is now buying bonds once more, buying notes once more, and they're doing so because of reserves issues and really technical considerations for the market. They don't want another repo freakout. At this point, though, it does indicate a structural issue with how much debt is out there, the government deficit that's not going down, and a question of the Fed's role. Are they being forced to monetize the debt in a way that will keep them artificially easy if you were just going off the economic outlook?
I think they are at least being forced to acknowledge fiscal dominance, that the fiscal situation is important. Basically, The funding market, the repo market, which funds the $38 trillion Treasury market, is too small. It's too small because the Fed has been doing QT and reducing reserves. Those interest rates, repo rates, have been going up. Now, one answer could be to tell Congress, you can't spend as much money. You can't run as big a deficit because the funding markets can't handle that size of a market. But if the Fed wants to elect to, let's expand the funding markets to meet the size of the bond market, you're telling Congress, go ahead, spend more money, run bigger deficits. We've got your back. We'll continue to expand that funding market to meet those goals. And the biggest driver of inflation over the last couple of years, other than the supply shock that we had in 21, has been government spending. And they seem to be encouraging more government spending.
Bob, do you agree with that?
Absolutely, 100%. But it doesn't change the fact that that's what's occurring and the market's responding to that. I look at everything that just happened in the last few minutes, and, you know, everyone got what they wanted. Those hawks on the Fed that didn't want to see a rate cut, they got that. When you look at the Fed futures market, we had 2 rate cuts priced for next year, mid-year and the end of the year. Now there's only 1 price for next year, and it's in the 4th quarter. So you got what you wanted. You got the market moving away from being in a rate-cutting regime going forward. But if you look at the doves on the Fed, if you think about the administration, they got what they wanted. They got another 25 basis points taken off of base rates, and the market's responding positively to that. It's rare that everyone gets what they wanted out of an FOMC meeting.
Jim, I'd love your comments on that, this idea that everyone wins. If you do have monetization of the debt, yes. You do have ongoing fiscal spending, yes. But that helps support the markets, and we're not seeing runaway inflation. So what's the problem?
We're going to get a new Fed chairman. That's the big issue. And the new Fed chairman is going to be perceived to be having a political agenda. And you were hoping that the current members of the FOMC were going to act as an independent brake on a political agenda that was coming in. And that's why I wanted to see more dissents to signal that they were ready, willing, and able to be that political brake. Now, maybe they will once we get that new Fed chairman, but then that looks political that they didn't take the chance to do it before the new guy came.
Jim Bianco, thank you so much, as always, for your insights. This really is going to be the debate. How does Fed Chair Jay Powell position himself and position the FOMC as being politically independent at a time that's highly politically charged? We hear every single day about the Fed Chair from this president.
The redo of independence is the core issue, particularly the heritage of the Fed back to 1951, and it's under threat, no question about that. It'll be interesting to see if the president gives way. As Bob Michael mentioned, the FT article today talking about, well, maybe it isn't 100% or 90% Dr. Hassett, and you get to a point where there's a renewed debate. We'll have to see on that. To me, it's a Chicago Fed meeting. We had Goolsbee dissenting, which is a shock in itself, and to have Jim Bianco with us is wonderful. Diane Swank owns the high ground of Middle America with KPMG. She's not out of 3 zip codes in Manhattan and joins us this afternoon. I look, Diane, at this moment, and when I see Goolsbee's dissent, and it's essentially a Chicago dissent. It's a dissent of productivity. Do we have any idea with this new AI that we have a new productivity that will allow for a better real GDP, a more effective and efficient America?
We don't know that yet. What we do know is that productivity growth has moved up, and that's because firms are doing more with less. We don't know that it's all from AI. We haven't seen enough adoption of AI yet to get there. And also what we don't know is how AI will be used, whether or not we'll see a lot of new jobs from this new innovation. That's usually what we see from innovation. Certainly that's not what Silicon Valley is telling us at this point in time. And also it matters who the gains of the AI actually accrue to. If those productivity gains continue to accrue to the owners of capital instead of workers, workers are going to feel left behind. And they're already feeling left behind because of the fact that the level of prices, as Jim pointed out, is just too high. Even if inflation were to cool from here, the level of prices are still too high.
Lisa, I set up that question because I knew what Dr. Swank would say. Who's going to be the winner of productivity? Who are going to be the winners out there? And that's the ultimate political tension.
Which is the reason why the Fed's role in this is getting increasingly politicized. Dan, I'd love your take on how this Fed is taking into account productivity gains of AI and talking about Goldilocks, because essentially that is the scenario that they laid out in their statement of economic projections.
Well, the Goldilocks scenario really requires, with productivity growth, it to be broad-based. And actually, people always forget this part of it. If productivity growth, they raise their growth rates for next year. If productivity growth is driving gains in overall economic growth, it means we can actually have higher break-evens on the Fed funds rate because the economy can grow more rapidly without having to lower rates. And I think that's important as well. And so we've really not seen all this yet. And I think it's still ahead of us. I am worried about the fact that we're getting fiscal stimulus in the form of the largest tax refund surge on record in the first and second quarter. Will hit between March and May. And we know that those tax refunds are treated like windfall gains due to the expansions of tax cuts passed in July of last year. They're retroactive to beginning of 2025. And that's going to be a big bump in fiscal stimulus at a time when we're still feeling the inflation from both tariffs and changes in immigration policy.
Yeah.
And I think that's really important. We're seeing service sector inflation pick up as well.
If that's the case, Diane, why are not forward break-even rates rising substantially? I was looking just now at the four-year forward break-even rates, and they actually went down after this Fed decision, not up, even though exactly what you're saying, if you do believe that there will be some additional fiscal stimulus that would be inflationary, you would think that this rate decision would only encourage those inflation fears.
I think we've seen some of it in financial markets already. The fact that it's not happening today doesn't mean it won't happen. And we've already seen some nervousness in the bond market, skittishness about the size of debt that they have to absorb, the mega merger deals that are coming out that are also financed by debt. All of that together, along with the fact that we're now going to see in 2026, the government debt is going to eclipse the size of the economy. It has not done that since World War II. And so we're moving into new territory. And I think a lot of things, people are sort of looking at the way the world was rather than what's changing. And things are changing very rapidly.
If you are just joining us, we did get that Fed rate decision. They did lower by 25 basis points as widely as expected. 9-3 vote, 3 dissents. The news really is that Austin Goolsbee joined the Fed's Schmidt in dissenting, saying that they should not lower rates. You, of course, had Stephen Myron, Fed governor, talking about a 50 basis point cut, dissenting on the other side. Not as many dissents as people had expected. The Fed did revert back to what we saw in the October statement, using language used just before pausing rate cuts. So potentially the last Fed rate cut for a long time by this chair, Jay Powell. I'm just wondering, Bob, if you think that right now this market is saying they are okay to do this, that the data that is available really doesn't signal that this cut and then maybe one more next year really is going to be inflationary.
Well, I think that's what the market's hoping for. I think there are a lot of businesses that we invest in where we do see the productivity gains from AI already. We also know within our own bank there are significant productivity gains. So some of that is already out there. The unfortunate price reset from pre-COVID levels to today is also a problem. I get that. But that's dampened aggregate final demand. What do we want going forward? Do we want the disinflation we seem to be in and what the Fed is projecting? Or do we want deflation where prices come down? I would argue we still want disinflation, and hopefully there will be a point in time in the not too distant future where wage growth and the trend in disinflation will normalize prices again. But all of that still is a headwind to consumption. So businesses are very careful how much cost increases they push through now.
Can I do a counterfactual?
Please.
Diane Swank, if we got a 50 beep Myron cut, what would happen to the American economy now? With the financialization of the American system, if you gave us a 50 beep cut now, it'd be a veritable banking explosion, wouldn't it?
It would certainly add a lot more stimulus to what we're already seeing, and stimulus is heat. Heat is inflation, unless you can really get all those offsets from AI in the right places. And I think that's the hard part, is the old economy is where the tariffs are hitting the hardest in manufacturing activity. And we are seeing it come through in prices. And we're also seeing labor shortages, even as the labor market weakens, in pockets where immigrants have dominated. That's showing up in prices as well, in-home elder care, child care costs, all soaring. That was just in September, and those shortages have only gotten worse since then.
Lisa, 2020, I looked at the clock right when Diane Swank said tariffs. First time we got to tariffs was 20 minutes into the show. For most of our audience, tariffs are a big deal. They're affecting their groceries, their health care, everything in the service sector as well.
Yeah, plastic Christmas trees, 15 to 20% higher because of tariffs. There you go. So this also is
a real Christmas tree or fake?
Fake Christmas tree, but it's also increasing the real ones because there are other people. Diane Swank, we'll let you stay out of this conversation. Thank you so much for being with us. Joining us now for this conversation, not this conversation, Matt Lazzetti of Deutsche Bank with us, as you typically do before the Fed press conference. Matt, just first, what's your impression? 9 to 3, was this what you thought would happen?
Yeah, to be honest, I think in terms of the statement, the SEP, the dissents, I think it was very much in line with expectations. You know, certainly there was scope to get greater dissents from a hawkish direction than what we got. I think 4 regional Fed presidents, potentially Governor Barr, was also leaning against this cut. But we always thought that it was the job of Chair Powell, through the statement, the language change that we got there, but then I think coming up through the press conference signals that he sends, to try to rein in some of those dissents, to have a hawkish message that allows, you know, those officials to speak through that. And so I think we probably got that as well. You know, you're seeing markets respond by taking rates down. I don't think that's really anything that we saw in the statement or the SEP or the dissents. I think it really was the Fed ramping up reserve management purchases, these T-bill purchases, a little bit earlier than was expected.
Matt Lazzetti, Binky Chadha is high on the street looking at the equity markets. He says the stock market's going to go up, up, up. How do you attach Lazzetti economics to Bikram Chadha's huge equity outlook?
Yeah, I think you know, the good thing about how we do it here, it's internally consistent. So I think Binky takes our economic growth forecasts, our global economic growth forecast, and builds that into his earning projections. We have 2.4% growth for the U.S. economy over the next year. That was sounding, I think, quite bullish relative to consensus expectations. But I would note the Fed median forecast came up to 2.3% today. I think was revised higher than what many anticipated, and is now much closer to our own expectations. So I think these two things are mutually reinforcing. We see a stronger growth backdrop. We see financial conditions easing through Binky's equity channel, and those two things reinforcing each other over the next year.
Matt, your other colleague, Jim Reed, put out a provocative question earlier this morning saying, what if the next Fed move was up? At what point do you think that the move that the Fed is laying out really sets up that counterfactual in a more real way?
Yeah, certainly a provocative question, and I think over the next year we are getting more questions about that, and I think it's more coming from the global sphere at this point. You're seeing, you know, places like the RBA turn a little bit more hawkish. There's questions about the ECB, Bank of Canada are seeing stronger economic data as of late. For the Fed specifically, though, I think you need 2 things to happen. One, you have to have a clear elimination of downside risks to the labor market. We are not there yet. There's still some fragility in this labor market over the next several months. You know, perhaps by the end of next year, we could get there. And 2, you need the labor market to return as a source of inflationary pressure. So you need the unemployment rate to decline, quits rate to move higher, and wage growth to accelerate. I think it's possible. I think you are seeing a substantial, reduction in labor supply in the U.S. economy. I think if you were to add on even more fiscal stimulus, so if we were to get these $2,000 stimulus checks from the Trump administration, I think that's the type of dynamic where that could really shift the debate. People would begin to think a little bit more actively about rate cuts in the U.S. But to be clear, I don't think we are there. Our baseline expectation is the next move is a cut.
Bob, what do you think? What do you think it would take for the Fed's next move or a move next year to be a rate hike and not a cut?
Well, I think you'd have to see the fiscal stimulus from the One Big Beautiful Bill Act hit and accelerate business investment and consumer spending. You'd have to see a labor shortage resulting from that, and you'd have to see a wage price spiral. maybe you'll see that in the second quarter. But right now, the Fed threaded the needle. Can't we just enjoy this into the holiday season?
Come on, you know us.
That's the smartest thing I've heard today. That's the smartest thing I've heard. And Powell's a piñata, I get that. But the bottom line is, we have a prosperous economy for the haves. Let's not upset that apple cart while everyone, well-meaning, tries to help people that are struggling so much. I mean, that's threading the needle right now is what we're doing.
Well, yes, but let's not forget that the One Big Beautiful Bill Act also has no taxes on tips, overtime, Social Security payments.
Right.
A lot of those are concentrated in the bottom couple quintiles of earners. So there should be some relief coming there.
Where's your lack of conviction? Matt Lazzetti on an outlook and off of this Fed meeting today, where's the question of your conviction into next year? What are you most worried about?
Yeah, I think in the very near term, it's that the labor market dynamic, which is this fragile equilibrium with low hiring and low firing, breaks to the downside. That you begin to see layoffs pick up. I really don't think we see that evidence as of yet, but it's a real risk over the next several months.
Do you agree?
I think over the course of 2026, I think there's some risks to the upside here. As Bob mentioned, on the fiscal side, the stimulus checks that have been floated, not part of our baseline, but would be a very real upside risk. And then I think we just can't put aside these risks around Fed independence. And, we heard Treasury Secretary Besson talking about regional Fed presidents, and we have to go through those votes. And you have a Supreme Court case for Lisa Cook coming up early next year. So I think that there are a lot of risks associated with it. From a Fed independence perspective, inflation risk potentially to come, long end of the bond market also at risk potentially from that.
Matt, we have about 3.5 minutes before the press conference begins. From your perspective, what's the one question you have for Fed Chair Jay Powell, potentially at the last Fed cut that he oversees?
Yeah, I think it's a little bit around the language that they introduced into the labor market and into the statement. How are we to think about that? Is that clearly sending a signal that there's a much higher bar in the near term? I also would ask him, are you internalizing what could be a very weak jobs report next week in today's decision? I think that's a really important thing for the market. I think the Fed would probably want to take out some of the sensitivity to next week's data. I think one of the reasons that Chair Powell wanted to push this rate cut through was an expectation you could see some weakness there. My expectation is, next week's data is going to be volatile. They are really putting more weight on the December jobs report in early January and the data we're going to get early next year in that assessment. But I'd like to get confirmation of that from the chair today.
Matt Lazzetti, thank you as always for your time, and I look forward to hearing what you think after the Fed conference. This is an important point. How much is this, in some ways, forecasting that December 16th jobs report that we should have already had? It should have been the sort of 1-2 punch where last Friday we got the November jobs report. They took that data into hand, and then this meeting, they responded to it. Bob?
Yeah, I think you can go back to September and say this is another risk management adjustment to policy, that there are some signs of a soft labor market. You're far away from what you're forecasting as your neutral rate. Why not take another 25 basis points off of that? It will help corporate America. I'll get a lot of questions in the next few days. Does 25 basis points actually do anything? Let's remember, most of corporate America are small and middle market businesses. Think of a $50 million EBITDA company. They generally have 7 times leverage. They've got $350 million worth of debt on top of $50 million in EBITDA. It helps them a lot. It helps stabilize middle market corporate America significantly.
If we say it's an original meeting, we've got to stagger to the next meeting, and we'll be wiser. We'll have data and all that. But as Lisa mentioned at the top of the show, the political overlay here is extraordinary. What did J.P. Morgan's Washington experts say about the politics of January?
Well, the question I would want to ask Powell is, were there only 3 dissents, or was there a considerable amount of bargaining to go from 5 dissents to 3 dissents? And was that in the statement, and then you ratcheted it up, GDP, 0.5% from where you were at the last summary of economic projections? His answers to questions like that will tell you how politically influenced the current Federal Reserve Board is.
That was a fantastic fantastic question, and I hope that he gets asked that as we really look to understand just what kind of clutch the Fed chair holds over this committee. Bob Michael, as always, thank you so much for being with us for all this time. Truly, always one of the absolute best. Right now in markets, a collective sigh of relief. It could have been a lot worse. That is sort of the message coming from it. The S&P up 0.1%. NASDAQ still suffering a little bit, down 0.2% suffering, I say. Still near all-time highs. And the Russell 2000 seeing that pop up 0.6%. What you are seeing in the bond space, 2s, 10s, and 30s, is this lift to bond price down in yield as people expect to see some sort of bond purchases as well as a rate cut coming in next year. It really seems to me that Jay Powell really has the chance to split the difference.
We'll have to see. I'm going to watch the bond vigilantes. I think they're in the press conference as well. Ed Yardeni's in there somewhere.
Well, let's take a listen to Fed Chair Jerome Powell at his last press conference of the year and potentially of a rate cut.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Howard.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
And if I could follow up on the outlook there, it seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving what's happening in the forecast. And I would say if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it's partly that consumer spending has held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment and the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down and the labor market began to show real signs of weakness. And so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well positioned to wait and see how the economy evolves from here.
If I could just follow up on the SEP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the two official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our two goals are a bit in tension, right? So, interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks? And what does your forecast look like? And where do you ultimately where do you think the bigger risk is? And you know, it's very unusual to have persistent tension between the two parts of the mandate. And when you do, this is what you see. And I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views. And you know, we come together and we reach you know, a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, you know, we all have an outlook in terms of what's going to come, but I think ultimately, having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple of times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
So I don't think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having